Yeah, guys, welcome to Direct Tax Marathon. So in this video, I would be covering the entire syllabus of direct tax along with the amendments as applicable for June and December 2024 exams. As you guys are aware, there are major amendments in direct tax for June exams. So I would be covering it in detail when I am doing the respective provisions. So whatever I would be using for my marathon or the revision classes would be this material. The hard copy, that is the printout, you can order it on ArivuPro website. So this is what it is, around 86 pages for direct tax. So actually direct tax regular study material is for more than 200 pages, but I have tried to condense it, simplify it as much as possible, and we have reduced it for 86 pages, guys. Now one major question is, sir, for whom it is? Is it only for new syllabus or is it only for old syllabus or for both? Guys, it is for both old as well as new syllabus. So the content, the syllabus is same, but the exam pattern is different between the new syllabus and old syllabus. So new syllabus has totally 15 chapters. This I have done as per the new syllabus, 15 chapters. Now, sir, if you ask me as per old syllabus, what is the changes? Same to same chapters are there, guys, but one additional chapter. One additional chapter for old syllabus. That is the last chapter in your syllabus as per my regular study material, if at all if you are following it. So that is the last chapter is the only addition for you, rest all remains same. You may find the difference in the chapter number. I have just altered it as per new syllabus, but please don't worry, because for the heads of income I have made it as a separate chapters now. Clear? So don't worry about the sequence of the chapter. Only thing which you have to study separately is the last chapter, guys. That is with respect to assessment, appeals and revision. Rest all remains same. So as you are aware of, so for old syllabus, tax is a part of module 1, that is paper 4, tax laws. It is completely MCQ type, multiple choice questions of 1 mark each. 100 questions would be there of 1 mark each. For direct tax, sir, how much it is? 50 marks. That means 50 questions you will have it. Then coming to the old new syllabus, sir, direct tax is a part of group 2. Direct tax is a part of group 2, which is for 60 marks, completely descriptive type, guys. So in my marathon video, I would be focusing more on the coverage of provisions, and wherever required, I will also be telling how to apply it in the problems. Fine. So this is all about the introduction part. Straight away we will get into, and the first page of my revision material, I have given the section numbers. It would be good for you guys to refer the section as and when you are covering a particular topic or provisions, guys. So even on the exam day, it is good if you guys are just going through it, and later chapters like heads of income and all, I have just given 15 to 17 salary, then 22 to 27 income from salary and all, sorry, income from house property. You guys can maintain a separate sheet where you would have written each and every section also. For example, in salary, 15 is what, 16 is what, 17 is what. While covering the provisions, I will cover each and every section in the order only. But you guys also, if you want on the exam day to cover it or to refer it, you can maintain a separate sheet, guys, by writing what section talks about what. In my regular class, actually I have made you guys to write, but still, if for your reference, you can still make a handwritten notes of the same. So this is what is a part of your syllabus. All the sections, whichever is applicable, we will be covering it, guys. So straight away, we will now get into chapter 1, which is very basic chapter, introduction chapter. Sir, what is tax? Tax is a compulsory payment which every person or every citizen has to make to the government. Sir, no sir, I am not getting any benefit from the government. I don't like this government, so I don't wish to pay tax. No. It is punishable under law. If you are supposed to pay tax, for example, if my income is more than basic essential limit, I am liable to pay tax. If I am eligible for rebate and all, fine, I will not be. But still, whenever I am liable to, I cannot take a protection telling I don't like this government, they are not using my money effectively or productively, so I don't like to give them, I don't like to pay taxes. No. The government collects tax in order to make public expenditure like health, education, infrastructure, public security, etc. There are two categories of taxes, guys. That is direct tax as well as indirect tax. Direct tax is the one where the impact and incidence is on the same person. Sir, what is impact? What is incidence? Incidence is the liability to pay tax. And liability means if I am the person who is earning the income, I am the one who is liable to pay tax. Yes. Then what is impact? Who is ultimately paying the tax? From whose pocket the money is going to the government's credit or government bank account? So that is called impact. Who is ultimately suffering the tax? Means from whose pocket it is going. Now, in case of income tax is one of the example for direct tax. Who is the one who is liable to pay tax? The person who has earned it. Who will ultimately pay tax? The same person who has earned it. Yes. Now coming to indirect tax. Indirect tax is the one where the impact and incidence is on two different persons. Now, for example, supplier means in GST. Supplier is the one who is liable to pay GST in majority of the cases. There are few cases which are taxable under RCM. I am talking about forward charge mechanism. Supplier is the one who is liable to pay tax under GST. Yes, sir. But can he collect it from the recipient? Yes. So incidence was on the supplier side, whereas he is trying to shift it to whom? To the recipient. So GST and customs duty is one which is the example for indirect tax. Then there are 4 canons of tax which are given by Adam Smith. What is it? Equity. That is, it should be based on the ability to pay. Sir, if I and you are having same income, then the amount of tax what we are paying should be same. See, definitely there might be a difference in the exemptions and deduction which we both claim. Because I assume I know tax provision, so I claim the maximum benefits, deductions, exemptions and all. I may end up paying less taxes. But whoever has the ability to pay more tax, for example, sir, the tax I pay and Ambani pay, is it same? No. Because the higher the income, higher will be the tax. Then certainty, there should be a clarity. If there is uncertain, how much tax should I pay? The government has not yet announced the rate. They have told, wait, we will announce at the end of the year. No. If you guys know, at the end, means Finance Act 2023 is applicable for your exams, right? Yes, sir. So, Finance Act is applicable from when? Previous year, 23-24. That is from 1st April 23. That means before the year start only, we know what is the rates applicable for the year. Clear? And for academic purpose, actually what we do is, whatever is outdated, we study. Okay, because now already we are in 24-25. Agree, but we are still studying for previous year 23-24 because, sir, what is applicable for that year will be seen from the beginning of the year. Clear? So by the time we write the exam, we would already be in the next financial year. But still okay, because all the rates or whatever we are supposed to follow during the previous year, we should know at the beginning of the previous year only. So the tax rates I should know at the beginning of the year. Sir, then when should I pay tax? What is the due date to file income tax returns? All this we should know well before. So that is called certainty. Then convenience. Sir, now everything is online. What if it was not online? Just imagine how people used to pay tax, how people used to file returns. Previously, there is a department in Electronic City, Income Tax Department. So people used to go there, stand, take the application, fill the form and then file the returns there manually. Now how many crores of people are filing the returns? If we are doing it manually like that, physically going and attending there and then filing the returns, it will take days together, months together. No one will be able to comply the provisions. If you want the people to comply the provisions, make it easy. Make it easy. If we are making it more complicated, then people will be like, no, I am not understanding, I am not able to do it. Yeah, this is what is happening in voting also. Clear? Means voting, the central elections are happening. Now why most of the people don't vote is because they will not be convenient in voting. Sir, it should be like more booths should be there. The queue, whatever we have now, because when it happens, even I went and stand in a queue for 2-3 hours, but I don't have any problems. But many people will have problems with it. Clear? I cannot go and stand like that for 2-3 hours. For me, time is very important. So people will be like that. So in that case, government has to see there are high risk of hacking and all, so they cannot bring it online. But at least offline, make more number of booths or more number of places where people can vote. And as soon as they enter, at least in 15-20 minutes, they should be able to come out. That is where we can push more people to vote. Clear? This is with respect to voting. Now let us come back to compliance. So when you are making compliance of any law more easier, that is online, you can sit and do it at any place, anytime, then it becomes easier for the people to follow it. That is how it is there in income tax now, guys. Even in GST also. Everything is made online. Next, economic. Cost of collecting the tax must be low. That is for the department or for the government. The cost of collecting the taxes should be low. If the cost of collecting itself is more than the tax what they are getting, then what are they doing? Clear? And especially in income tax it happens, because now you guys would be aware of there are a lot of raids which are happening. Income tax rates previously and all 10, 15, 20 years back and all, very rare we used to see in the news that raid has happened and that. Once in a while, like festivals it used to be. Now every day, okay, we will have our every week. So why is it happening? Because government want to collect tax literally. They don't want the people to keep their undisclosed money. So in that case, they are putting more efforts. Say they are hiring more and more people, because the raid cannot happen by 1 or 2%. They are hiring more and more people. So they are first they will do lot of deep research about that person. They will collect all the information, documentation. Only then they will go for a raid. It's not like they felt like, okay, let me go for a raid. Okay, today I am feeling bored. Let us choose any one person and go for a raid. No. They cannot do it. Okay, so you cannot disturb the people like that however you wish. So only when you have a proper evidence, conclusive evidence, you can go for a raid along with the team. So before that, they would have done in detail research about it, guys. So for all this, there is a cost involved, definitely. And in direct tax, why the cost of collecting direct tax is more is they have made it self-assessment. That is, the person himself has to calculate his total income, tax liability, and pay the tax and file the returns. And many people will be like, why should I? Why should I do it? So that is why the cost of collecting direct tax is bit high when compared to indirect tax. Why, sir? In indirect tax, they are told that supplier, if you fail to collect it from the recipient, you pay it. So what supplier will lose? Nothing. So better you collect it from the recipient and remit it to the government. And even recipient, whenever they are getting any goods or services on which GST is applicable, until they pay that amount to the person, they cannot enjoy that product or services. Yes, so cost of collecting tax must be low is as per this canon, but with respect to direct tax, it is bit high when compared to indirect tax, guys. So next, so the authority to collect tax is with the government, but who gave the authority to the government is the Constitution, the mother law for all other law in India. The authority to levy a tax is derived from the Constitution of India. Let us first understand what it talks about. So I have taken only not the entire Constitution, guys. Whatever is relevant, the relevant article for direct tax, I have taken it here. Or tax. Article 265 will tell no tax shall be levied or collected except by authority of law. Means they are telling government, you cannot all of a sudden bring one tax and start collecting it from tomorrow. First authority should be given in the Constitution. Sir, for income tax authority is given, yes, long back, 1961. Now what about GST, sir? They introduced in 2017. Before GST was implemented, they altered, they amended the Constitution, took the power. They have the power. Okay, they have the power to take power. Okay, so they amended the Constitution, took the power to implement GST, implemented GST, and they started collecting the GST. Article 246 distribute legislative powers including taxation between Parliament of India and state legislature. Means who should collect what taxes is given in Article 246, read with Schedule 7. Schedule 7 is a part of Article 246, guys, which enumerates 3 lists. What are those, sir? Union list, powers of central government. Means which taxes can be collected by the central government, and who has the power to make laws with respect to the tax? Central government. That is, income tax is a part of this, guys. Income tax is a part of union list. Then state legislative list, or we also call it as state list, powers of state government. Here, which all taxes can be collected by the state governments, the respective state governments, and with respect to those taxes, only state government has the power to make laws. Then concurrent list is where both central as well as state government has the power to levy and collect it, and also they have a power to make the laws with respect to the same taxes. Sir, what if there is a conflict? Both have the power now. Central also has made a law, state also has made a law. Now there is one particular point where there is a conflict between central law and state law. Who will prevail? Big boss. Who is big boss? Central government. Good. Next, so department wise administration. So Ministry of Finance is the topmost authority or department. Under that there is a Department of Revenue for all the revenue collections which belongs to the government. Guys, tax is one of the major revenue for the government, but tax is not the only source of revenue. Other than that, government has lot of investments on which they will be earning interest or dividends. So you would have seen in government companies and all. Okay, government would be the majority holders, or else even in other companies, so central government or state government would have invested. From that they earn the return in the form of dividends. If at all if they sell their shares, capital gains, or if they have invested in any bonds, debt and all, they earn interest. Then if they own any properties, buildings and all, they get rent. And also they collect fees, penalties, fines, all this are part of government revenues. But tax is the major source, guys. So under tax, there are direct tax as well as indirect tax. For direct tax purpose, they have set up a body or board called Central Board of Direct Taxes. Under that, for income tax purpose, there is the income tax department. They will be taking care of all the provisions with respect to income tax or administration. Then for indirect tax, we have a board called CBIC, that is Central Board of Indirect Taxes and Customs. Under that, for GST purpose, they have been set up GST Council. Any decisions with respect to GST will be taken by GST Council and they will recommend it to the central government and central government will notify it. Yes. So this is all about the first chapter, guys. We're done with first chapter. Now let us get into chapter 2.1, which talks about basic concepts of income tax. Again a basic chapter, but from here it is all about income tax. From here it is all about income tax, guys. Chalo. Income tax. Income tax is one of the major source of revenue of central government. So who will be living and collecting this income tax? Central government. So income tax is completely the revenue of central government, guys. So the responsibility for collection of income tax vests with the central government. This tax is levied and collected under the Income Tax Act 1961. So which act governs the income tax law is Income Tax Act 1961. So there are different components of income tax law. Sir, what is income tax law? What is Income Tax Act? Guys, you know, income tax law is like a team. Law is like a tree. Under that there are various branches. Clear? Under that various branches is like Act, Finance Act, Income Tax Rules, Circulars, Legal Decisions of the Court. Sir, which is the most important one here is this one. Clear? Or if I have to put it in different terms, income tax law is like an Indian team. Indian cricket team or whichever team you. I am a cricket fan, so I will take cricket. Okay. Income Tax Act is like a Rohit Sharma. Others are like other players. Clear? So, components of income tax law. Income Tax Act, Finance Act, which will be passed each and every year. Then income tax rules, circulars, notifications, legal decisions of the court. That is the judgments given by various courts, guys. So, Income Tax Act 1961, whatever we are covering in our entire syllabus is what is covered in Income Tax Act. So, you expect me to cover here only everything? No. Okay? Good. Income tax in India is governed by Income Tax Act 1961, which is amended from time to time through Annual Finance Act. So any changes for income tax law which will be brought through what? Annual Finance Act. This act came into force from 1st April 1961. Still now government has not found time to change this law. Clear? When they find time in the future, they may change. They may bring new income tax law. Like how they brought new Companies Act. Now 1956 Act was there. They brought 2013 Act. So the transition period will be very tough. Make sure that before there is a proposal to bring in new direct tax law or direct tax code they are talking about. So please make sure that before they bring, you pass out. Because what happens during the transition period, few sections of that act, few sections of this act, because all of the sudden the entire act they will not put it. They will make like few sections of old will continue, few sections of new will come into picture. Then again they will remove the old section, whatever was there, they will remove that and completely make the new act applicable. Yeah, fine. Means as a student it will be difficult for you to manage during the exams. So better before the new act comes, you pass out. Sir, what about professional? We will see. First, pass, execute. Chalo. Next, Annual Finance Act. Guys, every year, you know, the finance minister of the country, state, don't worry. Okay, we are talking about income tax. So, income tax means central government. So, every year, the finance minister of the country, that is as of now, Nirmala Sitharamanji. So, they will present a budget in February. And in the budget, one of the important component is finance bill. So in this finance bill, any proposal to make changes in any law, not only income tax law, any law will be proposed. Clear? Any changes, any alterations, any change, amendments to be brought in any law in India, it will be proposed through finance bill. Okay, sir. So for us, in income tax, if they are proposing to make any changes in tax rates or anything, they will propose it in finance bill. And the finance minister will read it in the parliament. Once it obtains the majority of the members' approval in Lok Sabha, it will go to Rajya Sabha, and once it obtains the majority of the members' approval in Rajya Sabha, it will go to president. Once president gives his or her assent, it will become an act. Finance bill will become an act, and it will be applicable from 1st April. 1st April. Sir, it will take a process. Presentation of budget will happen in February. So it has to be presented. There will be some discussion which will be happening, healthy discussion or whatever discussion. It will happen in the parliament. So once it obtains the majority approval, it will go to means from Lok Sabha, Rajya Sabha, from Rajya Sabha to president. In between, any changes can also be made, guys. Okay, means sir, the opposition party means criticized for few of the changes, so they may drop that changes, or they may make little bit more changes in that respect to that. Yeah. So by that time it is finalized, it will be up to like March end or somewhere, but it will be implemented from 1st April. Guys, every year normally there will be only one finance act. That is why we call it as annual finance act. But in the year of central elections, that is parliament, there will be two budget. One is before the election, one is after the election. Clear? But from academic point of view, you need not worry anything. Sir, will they ask any question? Definitely not. But only for your knowledge I am telling you, because here we have used the word annual finance act. So now especially in 2024, two budget would be there. One budget is already over in February. Now it will be after the new government comes, there will be one more budget. So in that case, you will be like confused, sir, what you taught, what is happening in our country is completely different. No, you should not feel it. Okay. Now, which is applicable for our exams, sir? For June as well as December 24 exams, Finance Act 2023 will be applicable. That is what we are covering in our classes, guys. But there are major changes which has been brought through Finance Act 2023, guys. Which are those? Everything as and when I am covering the respective provisions, I would be touching it. Okay, income tax rules. This will play like a supporting role. Sir, hero will be there, heroine will be there. Only two people will act and finish the films? No. There should be supporting characters, comedian, villain, everyone should be there. The same way income tax rules. Income tax rules came into force on first day of April 1962. So there is a saying also, only when villain is there, there is a value for hero. Clear? So now only income tax law? No. You have to study income tax law along with the rules. And in the income tax law, wherever required, they will refer to the rules, guys. For example, in income tax, there is a section called section 32, where they have told everyone are supposed to charge depreciation as per WDV method of depreciation as per electricity, except electricity company. Except electricity company. They have a choice. They can either follow WDV method or SLM method. Okay, sir. All others has to follow WDV method. So WDV method means you have to give the rates. Yes, they have given it. We cannot choose whatever rate we want. They have given the rate, but the rates are given in the rules. Clear? Same way, wherever in the act they would have referred to FMV, fair market value, or some other values. So that value calculations actually will be given in the rules, the format or the procedure. Next, coming to notifications. The CBDT issues notifications from time to time for proper administration of Income Tax Act. Any notification issued by CBDT and central government are binding on everyone. So any changes, even any in between the years, sir, can they bring any changes? Yes. So they will notify the people how. So every time Modi will come in the Mann Ki Baat and tell this is what the changes. So please follow it. No. They will notify it through notification. Clear? So any changes which the government want to bring, which they want to notify to the people, they will do it through notification. Sir, what about our institute ICSI? So everyone, they call all the students, this is what the timetable, please register and please write the exam, don't miss Santa. No, they will release the notification. And every student is bound to know that. You cannot tell, no sir, this time I was busy actually in preparation, I didn't notice your notification, please conduct the exam again in July or August for me alone or along with my friends. Okay, along with my friends, please conduct in July or August. No, any notification, everyone are bound to know it. Yes, sir, Vesho. So next, circulars. Circulars are issued by CBDT to clarify the doubt. See, that key terms are very important, guys. To clarify what? doubts. Sometimes the provisions will be brought, but the department itself will have a doubt. Sir, how to implement it? And here, so some changes they would have brought in the law, okay, but now the department people itself don't know how to follow it. So whom will they ask for? Government, and government will clarify it through circular. So circulars are issued by CBDT to clarify the doubts regarding the scope and meaning of the provisions of the law and provide guidance to the income tax officers and assessors. So wherever circulars are there, if you guys remember, even in GST we covered one circular telling, see, sir, if I have contributed anything philanthropic to any charitable institution or to any temples where they have displayed my name, is it a supply? No. If they just displayed my name, okay. If they have displayed my name along with my connection to profession or business, then it is a supply. They are advertising my business. They are advertising my profession. This clarification was given by whom? The respective board. Clear? So that was with respect to GST. So the clarification was given by CBIC, not CBDT. Same way, even in income tax law, wherever there is any confusion or clarification is required, CBDT will give it through circulars. And circular is binding on whom, sir? It is binding only on the officials, guys. That is the income tax officials or department, and not on the assessee. But assessee can take the benefit of these circulars. Okay, means he can tell, by mistake, income tax department came to my home in midnight telling we are conducting a raid. There is a circular telling, no, at night time you cannot conduct the raid. So can I make use of this circular and tell, no, sir, at this time you cannot come, please come back tomorrow. By that time I will make all the arrangements, so please make sure that you come tomorrow. Clear? So can I make use of it? Yes. Next, judicial decisions means court judgment, guys. Various court judgment. So this is when any question cannot be answered by the law. Sometimes there will be some loopholes in the law. So in that case, so the assessee or the department will take the case to the court, and now the court will give the judgment. So there are two main level of courts, guys, High Court and Supreme Court. Below High Court there is District Court also, but for income tax, High Court and Supreme Court are the major. Now if there is any decisions given by the respective High Court, it will be binding only to the assessee or the people of that state and the department of those states. Clear? For example, sir, Karnataka High Court has given a decision. It is binding only to the people of Karnataka and the department which is falling in the jurisdiction of Karnataka. Now, sir, what about same scenario, same conflict or same case is pending in Tamil Nadu also? So, can Tamil Nadu High Court copy paste what Karnataka High Court has done? Nothing. There is no obligation like that. But can they refer to? Yes, they can refer. But there is no obligation for the judge to copy paste the judgment given in Karnataka. Clear? They can refer to, but they can give their own judgment. Clear? Yes. Now, the apex court, Supreme Court, the topmost court in India. If any judgment is given by Supreme Court, it is binding on everyone within the country, guys, including the people as well as the department. Complete all the states and union territory, it would be applicable. Okay. Next, basis of charge. Guys, there are two set of charging sections in income tax. One is general charging section, which is section 4. And one is specific charging section, which is the first section under each head of income. First section under each head of income. Okay. So now what we are seeing is general charging section, that is section 4. As per section 4, the total income of a person earned during the previous year is charged to tax in the next following assessment year. Okay, so now we have to break this into different words and we have to learn the meaning of it. That is, what is total income is given in 245, what is person is given in 231, what is previous year is given in section 3, and what is assessment year is given in section 29. Each of this we have to understand, guys. Now first, income. Sir, what is income? Income is defined in section 224. We will call it as inclusive definition. Inclusive definition means whenever the definition start with the words income includes or something dash includes, we call it as inclusive definition. Oh, so income is defined in section 2 clause 24, which is an inclusive definition. It has a big list, guys. So whatever we will be covering in the respective heads now, that income is taxable under so and so head, all that will be a part of income definition. Then concept of income. Income may be In cash or in kind? Sir, cash here guys. See, in the law they are using the word cash. Cash means money. That is currency note or coins. Okay. So sir, whatever income I am earning, should it be always in the terms of money or cash? Need not be. Sometimes it is in kind also. So for example, I went for a barber shop, I took a haircut from him and I filed his income tax return. I took a barber haircut and I gave income tax filing services for him. So what is it? Did any money involved in this transaction? No. But consideration is there? Yes, but in kind. In that case, sir, if consideration is in kind, we have to consider the fair market value of it. Fair market value of it. Same way guys. Assume, sir, I gave professional services to my client. Instead of giving money, I asked, hey, buy me a car and give it. Okay, no one has given me, but I'm just giving an example. Then whatever I am driving, you people will think, someone has gifted. No. Now, sir, assume my client has gifted the car. In that case, gifted, not actually gift, we should not use the word gift. I have given the services. For that, instead of giving money, he has given the car. Because gift means nothing is flowing from my end. From my end, I have given services. For that, he is buying the car and giving it. So in that case, sir, is it a consideration? Is it an income for me? Yes. We have to value, that is, we call it as fair market value of the car. We have to take it, guys. But if it is a gift and all, what is it? We will cover it later. But here, it is not a gift actually. I have given the service, in return I am getting it. Sir, and where is it taxable, sir? Under the 8 PGBP. Because I gave professional services. So whatever I am getting in return is a professional income for me. It is taxable under the head PGBP, guys. Okay. Next, on receipt, if you guys are aware of, so many film actors also get this from the producers. Okay, actors, that is hero or heroine, whoever it is, they get paid in money also and they get in kind also. Okay, the producer will get them the car, building or land or whatever. In that case, is it considered as income for that prospective actor, sir? Yes. Next, on receipt basis or accrual basis. Some incomes are taxable on receipt basis, some incomes are taxable on accrual basis, some incomes are taxable on whichever is the clear basis. Okay, we will learn it on the respective head, guys. Clear? But either of the two, it will be taxable. But not on both the basis. For example, if an income is taxable on receipt basis, will it again be taxed on accrual basis? No. It will lead to double taxation. It will not happen. Same way. Sir, an income is taxed on accrual basis. Again, will it be taxed on receipt basis? No. Clear? Yes. Legal or illegal? Sir, even illegal money are taxable under income tax law? Yes. If you have earned income, we don't care about your source. Please pay tax. Okay, other things, illegality, everything will be taken care by Indian Penal Code. We are bothered about income is there. Yes, please pay tax on it. Please pay tax, that is income tax on the same. Legal or illegal, we don't care. Temporary or permanent? Temporary or permanent? See, some will be having permanent income. Permanent means not till I die and all. So, for example, salary and all, we consider it as permanent income or recurring income. That is every month we will be getting it till we retire. So, in that case, this will be considered as permanent income. So, is it an income, sir? Yes. Then temporary, sir, after the exam, we had a 2 months time. So, what I thought was, let me work as an intern somewhere and I earned around 10,000 rupees, sir. Is it an income for you? Yes. But is it taxable is the question mark. We will see it later. Shrutika, don't worry. You need not pay tax because, sir, your income would be less than basic essential limit. What we are seeing now is not about taxability. Is it an income? Yes. Even for a temporary period, you have done something. For example, sir, actors also. They will work, assume for 2-3 months. They will do acting for one movie and rest of the year they take rest. So in that case, they did temporary work and they earn the income. Sir, is it an income for them? Yes, definitely. Same way, freelancing and all is there. You guys would be aware of it. So in that case, sir, throughout the year I may not be working. In that case, whatever you have earned, even for 1 day, 2 day or 15 day, 30 day, how much ever you have worked for, if you have earned any income, it is income. Whether it is temporary or permanent, doesn't matter. Then lump sum or installments. Sir, now whatever income I am receiving, the pattern of receiving will not matter. Assume I made a sales of 10 lakh and I received it in one shot. 10 lakh. Is it my income? Yes. Now, sir, for my customer, he told, sir, 10 lakh in one shot I cannot pay, sir. Please give me a EMI option. So I asked him, okay, every year pay 1 lakh or every month you pay 1 lakh. I am receiving an installment. Is it still my income? Yes, it is still my income. Clear? If you want one more example, I will give. Assume guys, I am publishing my books. So I have given the copyright to a particular publisher. So for each and every copy he sells, he will pay me a royalty. He will pay a royalty. Now we have two options. Now I will tell, hey, every time you print and sell a book, you pay me so much royalty. I have put a condition. Every book you sell, pay me a royalty. Amount should be credited to my bank account. Okay. Second one is, sir, every time it will be more work for you also. Even I cannot keep the accounts of it. What I tell is, sir, throughout 6 months you sell. At the end of 6 months, you settle the amount. Okay, how much ever books you have sold into royalty per book, you credit it to me. Credit it to me. Depends on our agreement. Clear? In both the cases, is it my income? Yes. How I receive is left to us in our understanding. But income is income. The nature will not change. Next, gifts. Sir, even gift is taxable? Yes. So there is a dedicated section for it, 56 to 10 under income from other sources. Gifts would be taxable under the head other sources, guys. But there are certain exceptions for it where gifts are not taxable. We will learn it under the head other sources. But if the gift is given by employer to employee, then it is taxable under salary. By others means income from other sources. Okay. Then revenue or capital receipt. Sir, whether what I have earned, is it a revenue or capital? The revenue receipts are normally taxable until and unless exemption is given. Whereas capital receipt normally not taxable. But if it is specifically given in the law, telling, hey, this capital receipt is taxable, then it is taxable. Then it is taxable. Now, sir, what is revenue? What is capital? Guys, it is actually accounting concept. In income tax law, they are not told what is revenue, what is capital, how do we differentiate it. But, sir, is it important for tax? Yes. So, this is actually whatever we are seeing now, till here, guys. This is what is given in the income tax law. This is a part of accounts. But still, sir, is it a part of our syllabus? Definitely. Okay. Capital versus revenue. How do we differentiate whether a transaction is capital or revenue? An amount referable to fixed capital is a capital receipt. Whereas a receipt referable to circulating capital is referred as what? Revenue receipt. Sir, what is fixed capital? What is circulating capital now? Fixed capital is not involved directly in the process of business but remains unaffected. Means it will not change for a long period by the process. Example, sale proceeds of building, machinery or plant will be a capital receipt. In simple, if I have to tell, balance sheet items. Okay, then circulating capital. Circulating capital is turned over in the business and which is ultimately results in profit or loss. Example, sale proceeds of stock in trade is a revenue receipt. So sale of stock. Sir, stock, we will disclose it as a current asset in the balance sheet. But when I sell it, where do I record it? In trading or P&L account. Clear up? Yes, sir. Next, revenue receipts. Profits and gains arising from various transactions which are entered into in the ordinary course of business or those which are incidental to or closely associated with this business would be revenue receipt, chargeable to tax. Revenue receipts are normally taxable, guys. But if there is any specific exemption given in the law, then that exemption would be applicable. Sir, I have earned some income for which exemption is not given in the law, sir. In that case, it is taxable. It is understood that it is taxable. Okay. Next. Sir, how do we identify? Oh, first, let me finish capital receipt also. Capital receipts normally not taxable unless specifically included in the act. But sir, what is capital receipt? What is not revenue? What is not revenue is a capital. And capital receipt normally not taxable. But in the act, if they have clearly told, hey, this is taxable, then it is taxable. They have given it. For example, sir, compensation received on the termination of agency contract. Capital, because every time the contract will not be terminated and I will not be receiving. Actually, for agent, what is the regular income? Revenue receipt means commission. Here, sir, contract was entered for 5 years, but the principal was not happy with the agent services, so he cancelled the contract at the end of first year only, and he paid a compensation of 5 lakh. In that case, will he be receiving recurringly? No. In that case, even though it's a capital receipt, but in income tax law, they have clearly told it's taxable. Same way, compensation received on the premature termination of employment contract is also taxable, even though it is capital in nature. Same way, capital gains on the transfer of capital asset. Capital gains on the transfer of capital asset is capital receipt, but still taxable. Why, sir? because section 45 talks about that. Capital gains on the transfer of capital asset is taxable in the previous year in which transfer took place. Okay. Now, sir, what is the main point to distinguish between the revenue receipt and capital receipt? Guys, whenever there is any sale especially or purchase, check for that particular business or person. Is it a stock or fixed asset? Is it a stock or inventory or goods, whatever we call, everything is one and the same, or fixed asset? For example, I am a share trader. For me, stock is what? Inventory. If I sell it, what is it? Revenue. Same way, sir, assume I am not a stock trader now. I am just a normal person. I have purchased the shares as an investment. So in that case, what is it for me? Fixed asset. Investment will fall under fixed asset. So in that case, if I buy and sell, what transaction it is for me? Capital. Same way. Now ArivuPro Academy is for purchasing some bench, desk, furniture and all. So for them, what is furniture? Fixed asset. So purchase, revenue purchase. Okay, revenue transaction. Sir, sale, sorry, not revenue, capital. So when they purchase, what is it? Capital purchase. When they sell it, sir, capital. Now, sir, assuming ArivuPro also start a business of furniture trading. So they buy and sell the furniture. So in that case, what is furniture for them? Inventory, stock. When they purchase, revenue. When they sell, again revenue. Revenue receipt. Is that clear? So always, whenever there is especially purchase and sale, first identify. Is it a stock for them or fixed asset for them? If it is a stock, then revenue. If it is a fixed asset, capital, guys. Then person is defined in section 2 clause 31. Person includes everyone. An individual, that is natural human beings like you and me, who you are HUF, Hindu undivided family, a company, every type of company, guys. That is private, public, foreign, Indian, government, everything. One person company, small company, big company, every kind of company is covered here. Okay, there is nothing called big company, I guess. No, correct na? In company law, small company is there. A firm, that is nothing but partnership firm. A firm includes LLP also here. For income tax purpose, a firm also includes LLP, that is limited liability partnership. An AOP, that is association of person or body of individual. That is a group of people when they come together to achieve a common goal, guys. We call it as association of person or body of individual. Association of person can be formed by anyone, including company. Anyone can be a member of association of person. Whereas body of individual can be formed only by individuals. Local authority, that is the Gram Panchayat, Taluk Panchayat and all, or local government we call it as. And every artificial juridical person not falling within any of the preceding subclasses like colleges, universities, hospitals, all charitable institution, everything will come in the last category. Then assessee, important definition. Assessee is defined in section 2 clause 7. Sir, what is assessee? Assessee means a person by whom any tax means income tax here. Okay, not GST, customs and all. Okay, any tax, they have used the word any tax, but here any tax means income tax, guys. Or any other sum of money. Any other sum of money means what, sir? Interest, late fee or penalty. Guys, in the definition, they have not used the word interest, late fee, penalty. I have given here for your more clarification. Clarity. Okay. So any other sum of money means interest, fee or penalty. Guys, now listen, interesting. Sir, my income is 4 lakh. I am a resident individual. I am eligible for rebate. Hope you guys know at least what is rebate when they are eligible and all. We will cover it. Okay. But still, I am a resident individual. My total income is 4 lakh. Am I eligible for rebate? Yes. So what is the tax I have to pay? 0. But should I file the returns? Yes, I should file the returns. I should file the income tax returns. Now, I thought, no, anyway I need not pay tax. So I will not file returns. Why should I file? Anyway, I need not pay tax. Now, why? Many people are doing like this. Clear? Who are eligible for rebate, they think that, they believe that, they assume that we need not file the returns. Thank you, government, for giving rebate and that. But actually, they are supposed to, because in section 139 subsection 1, we have seen if your income is more than basic essential limit, you have to file your returns. Now, I was supposed to file my returns, but no tax. I failed to file my returns. In that case, anything for me? Yes, late fee. Late fee would be there. Clear? Yes, sir. Now, I am not paying any tax. I was supposed to file returns, I am not filed. For that, they are charging me some late fee. I filed it later, so they are charging me. Late fee under section 234. 234 F. F late fee. Already forgot. 234 F. Clear. So in that case, am I called an associate? Hey Bala, am I called an associate? Your attention should be on me only. Chala. Next. Is payable under this act. See, that is why I told you any tax, na? Any tax means, sir, any tax, no, payable under this act. Which act? Income Tax Act. Under Income Tax Act, you will pay GST, No. And it includes means, if I pay income tax, I am an assessee. If I pay anything other than income tax, but under Income Tax Act, that is interest, late fee, penalty, still I am an assessee. Sir, I am not paying any of this. Still, if you are covered under any of this, you are still an assessee. What is it? Every person in respect of whom any proceedings has been initiated, any proceedings means they have taken any steps. Who? They means department. Has been initiated under this act for the assessment of means computation of. Sir, I didn't file my returns, I didn't pay tax, I didn't pay anything, but income tax department, they pitch in and they are computing my income on which I should pay tax, not they. I cannot tell, you are computing, you pay, why should I pay? No, I cannot do that. So, if at all, see, first of all, it is self-assessment. If I don't do it, they will pitch in, and definitely when they pitch in, they will ask for more. Not bribe, legally only. Interest, penalty, late fee and all. Okay. So, when they have taken the steps for computation of my income, his income means mine, I am in my example, the income of any other person in respect of which he is assessable, like clubbing and all, or the loss sustained by him or by such other person. Now I have filed my loss returns. If I want to carry forward my loss, I have to file my loss returns. Yes, except house property and connections I am giving. Sir, why are you doing it here only? Because you would have at least done one study. So, you would have filed your loss returns to carry forward your losses. Yes, except house property loss and unabsorbed depreciation. Very good. Now, you have filed your loss returns and you have claimed 10 lakh loss. But income tax department is telling, no, I will recompute. You don't know how to compute the loss also. That is why you are suffering loss. Okay. So, I will compute your loss. So, they recomputed the loss and they told 6 lakh. In that case, are you an assessee? Yes, you are an assessee. Sir, no income, sir, no tax, sir. No problem. The amount of refund due to him or to such other person. This will not make much sense, but still. Sir, when will I claim refund? When I have paid tax. Correct, now I have paid, but I have paid more. When I have paid, I have already covered here. Correct, I am already assessee, but still later they are telling, if you have claimed any refund, you are an assessee as per this point. Clear? Sir, I have already paid, or I have paid advance tax, or on my income TDS has been deducted. It has been deducted more. Now I want to claim refund. To claim refund, I have filed my returns. I have claimed a refund of 2 lakh, but they are telling, no, because it is only 1,50,000. In that case, I am an assessee? Yes. But as I told you, it will not make much sense. Why? Because I have already paid tax. Now I am telling that I have paid excess, so I am claiming a refund. When I have already paid, where I would be covered? Here. In the first stage only I would have been covered. Okay. Every person who is deemed to be an associate, like representative associate, or for example, sir, I have a minor child who is earning income from his own efforts, sir. So who has to pay tax? Minor child. Who has to file the returns? Minor child. But I will act as a guardian. So I will act as a representative assessee for my minor child. In that case, I am the assessee. I am deemed to be an assessee for my child. Definitely my child is an assessee. He is the one who is liable to pay tax. But he or she will not have signing authority and all. So I will act on their behalf. Same way. Sir, a non-resident is having some business activity in India. He is earning good amount of income. I am acting as an agent for him in India. So I will be representing him in India. Yes. So will I be also considered as representative? Yes. Assessee in India as I am acting as a representative assessee? Yes. I will be considered as an assessee. So, any law which that person is supposed to follow here, I should make sure that he is following it. Okay. So, under income tax law, whatever that non-resident is supposed to do, I should make sure that he is doing it. Next, Every person who is deemed to be an assessee in default, that is, sir, I have violated some provision. Because of that, they are considering me as an assessee. For example, sir, who should deduct TDS under income tax law? Payer. If he fails to do, then he is considered as assessee in default. He is considered as assessee in default. Sir, I was supposed to follow your provisions, but I have violated it or I have not followed it. In that case, I would be considered as assessee in default. And any loss of revenue due to the violation what I have made, if government has suffered any loss of revenue, I have to make it good. I have to make it good means, sir, if I have failed to deduct TDS from the amount which I am paying to the payee, then I have to pay that amount out of my own pocket along with interest. Along with interest. And also that failure to deduct TDS will also attract disallowance for my expenses under the head PGBP. Every assessee is a person, but every person need not be an assessee. Understood, na? Every assessee, obviously when he is a person only, he can become assessee. But sir, every person is an assessee? No. This girl is not an assessee. It's good. Okay. So she is not covered in assessee definition. Why? She doesn't have any income. She is not paying any tax. No proceedings has been undertaken by income tax department. So in that case, don't worry. When she only is telling why you guys are worried about. Okay. So in that case, she is not covered here. But is she covered? Where is person definition? Here. So is she covered in person? Yes. Almost everyone are covered. Okay. And here, to be covered here, we are just individual enough. Clear income or tax doesn't matter. Okay. Assessment year. Section 2 clause 9. Assessment year means a period of 12 months. Definition itself is telling it is a period of 12 months. Commencing on 1st April every year and ending on 31st March. Sir, is there any change? Is there any exceptions? No. It is always a period of 12 months starting from 1st April to 31st March. But it will always be a succeeding year. Previous year 23-24 means assessment year would be 24-25. But it will always be a period of 12 months, guys. Then previous year section 3. Previous year means financial year. Immediately preceding the assessment year. Means before the assessment year. Income tax is payable on the income which is earned during the previous year. Previous year is nothing but financial year, guys. Clear? But in income tax, we use the word previous year. Previous year is the one in which we have earned the income, but assessment year is the one where we have to pay taxes. And it is assessed in the immediately succeeding financial year, which is called as assessment year. See, assessed is nothing but we will compute our income and pay tax and file returns in which year? Assessment year, which is nothing but next year. All assessees are required to follow uniform previous year. Sir, previous year means what? Financial year. When will it start, sir? April. When will it end? 31st March. No, sir. April 1st full day. I don't want to start. I want to start on January 1st. Okay. We always follow the new year on 1st January. So we will start on that. Why 1st April is called full stay, you know? Sir, till 31st March, whatever we earn, we have to pay tax. We will pay tax and again we start working more with an intention that next year we should earn more so that we pay more taxes. Clear? Chalo. So, uniform financial year means it starts from 1st April and ends on 31st March. Right? Generally, the previous year also, in the definition they are not used. But generally, previous year will be a period of 12 months. Majority of the cases. But in a rare cases, exceptions, previous year can be less than 12 months. Sir, which are those cases? This kind of questions can be asked, guys. Because normally, general rule, everyone will know. Exceptions is what they target in the exams. Okay, when is it that previous year can be less than 12 months? Sir, once you guys qualify, okay, immediately you celebrated for 1 month, full 1 month gungo, okay, success gung, nothing else, okay, celebrated and later joined the work and started earning for the first time in between the year. Assume you started from what date? Assume you got 25th August result, September end, October 1st you started. October 1st you started working and you are getting good pay. Now your previous year, first previous year will start from when? 1st October. First October, not August. First October. First October. Better? You need to focus. First in between something I will use, which is out of syllabus. Don't worry about that. Within the syllabus, what I am using, you will be worried about that. So from 1st October to 31st March is your first previous year. In the next year also same, sir? No. Next year will start from 1st April only. Is that clear? Means for the first time if you start earning anything in between the year, it will be first previous year will be less than 12 months. Sir, next year I am continuing my employment. Along with that, I am doing some small profession also, freelancing work also, sir. But in between I started, sir. From 1st August I started. What is your previous year? Still 1st April only. It will start from 1st April. Clear? Because for each source of income, different financial year will not be there. Okay, for one assessment, one previous year. Sir, okay, I already had salary income, sir. Another income I started earning from 1st August. So which is my previous year, sir? When will it start, sir? 1st April. Clear? Yes. Okay. So which are those two cases? In case of newly set up a business or profession, so I assume you guys, after qualifying, you started your practice from 1st January. 1st January. So in the year in which you set up the practice, in the first year, which is your previous year, when will it start? 1st January. When will it end? 31st March. But from next year and all, it is always 1st April to 31st March. Or a new source of income coming into existence in the middle of the previous year, and that is for the first time. Please be careful. Okay. Then in case of discontinued business, that is in case of discontinued business means, sir, I am shutting down my operation, I am liquidating, putting the shutter, okay, in between the year for my business. Fed up of this business, or I don't like to do it, I want to have relaxed life, retired life, so I am shutting down my operation on 31st July. So in that case, what is my last previous year? 1st April to 31st July. Clear? Yes. However, assessment year can never be less than 12 months. Sir, even in this case, sir, assessment year cannot be less than 12 months? No. Assessment year will always be a period of 12 months. Guys. Then, so in general charging section itself, we saw what is general charging section 4 is telling. General charging section is given where? In section 4 of Income Tax Act. What is it telling? Total income of a person for the previous year is charged to tax in the next following assessment year. Correct? Means income earned in previous year is chargeable to tax in the assessment year. Yes, sir. That is again a general rule. That is again a general rule. Sir, in all the cases, same thing will be applicable? No. General rule is that income earned in the previous year is taxable in the assessment year. Exceptions to the general rule: in the following cases, income of the assessee is taxable in the previous year itself. In the previous year itself means you have earned the income in that year, pay tax also in that year. So again an exception for general rule. What is the general rule, guys? Come on. Income earned in the previous year is taxable in the assessment year. Good. So what are the exceptions? Again important always, because majority of the time, guys, what to ask in general? Nothing is there to ask in general rule. Okay, they target what? Exception. They may ask, which explain the cases where the income is taxable in the previous year itself. So first one, shipping business of a non-resident. So if non-resident is carrying on any shipping business in India, in that case, 7.5% of whatever freight he has collected to carry the goods and passengers from Indian port to foreign port will be considered as income, not tax rate. 7.5% is a income. For example, sir, a non-resident shipping company is carrying the goods and passenger from Indian port to foreign port. Okay, so from Indian passengers, they are collecting a freight of totally 10 lakh. Freight means the charges what they are charging. Okay, transportation charges or freight. 10 lakh they are collecting for the people to carry the goods or passengers, sir. So on that, 7.5% is considered as deemed income. Remaining 92.5% is deemed expenses. They need not even prove how much profit they have made, how much loss they have made. 7.5% is considered as income. On that, whatever is the tax rate, they will pay. Whatever is the tax rate applicable for that respective assessee, they will pay. If it is a foreign company and all, the tax rate is in India is 40%. They will pay at that much. Only then they will be allowed to leave Indian port. Or else we will not leave you, catch you here. Clear? Yes. So only when the taxes are paid before the ship leave the Indian port, you pay your taxes on the revenue which you are earning to carry the passengers and goods from Indian port to foreign port, pay tax on that. Only then you will be allowed to leave Indian port. Then person leaving India permanently, section 174. Sir, now see guys, whenever a person is leaving India, we believe as a common citizen, we believe that government will get to know. Okay, but here there are some cases which are happening. People are leaving where government may not be able to notice. I also don't know how the government is not able to trace them. But if common people are leaving India permanently, definitely government will get to know. That is because the passport and visa is under the control of central government. So in that case, if department get to know, that is income tax department get to know that if any person is leaving India permanently, then immediately they will send a notice telling him, sir, please before leaving India, up to the date you leave India, means till the airport, whatever income you earn in India, please pay tax and leave. Clear? We will give a good send off for you. If not, your journey will be bad. Okay, we will not allow you to continue with your journey only. Chalo, association of persons or body of individuals or artificial juridical person formed for a particular event or purpose. Sir, association of person or body of individual. Assume we all formed a body of individual to construct an apartment. We completed the construction of an apartment on 15th September. So we served our purpose. We completed our purpose. For what purpose body of individuals was formed? It is done on 15th September. So in that case, we will liquidate on 15th September. Yes. So now assume in the assessment year, if the department come and ask, Vikas and co, you guys had formed body of individuals. In the last year, you have earned so much of income. Please pay tax. I will tell. Go and ask others. Go and ask others. We are not body of individuals now. I am a separate individual. Clear? So in that case, one will start blaming the others because there is no body of individuals in the assessment year. So that is why they are telling, if at all, if any body of individuals or association of person is coming to an end in between the previous year only, for whatever income you have earned till that date, pay tax in the previous year itself. Next, transfer of property to avoid a tax. Means if department, not in every case guys, because whenever you transfer a property that is a capital gains, you are supposed to pay tax, but they will wait till assessment year. But if department get a smell, what they will get? Smell that a person may evade a tax. May evade a tax. He doesn't have any intention to pay tax. For example, he had only land 10 acres, everything he has sold, and income tax department got to know that this person, if we wait till assessment year, he will not have any money to pay tax. So better we collect the taxes in the previous year only. Clear? So in that case, transfer of property to avoid a tax or to evade a tax, only in that case, the person whoever has transferred it or sold it can be taxed in the year in which the property is sold. Then discontinued business, section 176, optional. That is, discontinued means complete shutdown guys. Liquidation we call it as. Now, we were carrying on the business from last 25 years. So in the current year, we are shutting down our operation. We are liquidating it. In that case, till the date of liquidation, any income earned by our business, we are supposed to pay tax in the previous year only. But especially in case of companies and all, there is a procedure to be followed. Liquidation means, sir, I was running a company, so I don't want, from tomorrow I want to live peacefully, so I shut down my operation and from tomorrow full relief. No, there is a procedure how you have to liquidate your company. So you have to appoint a liquidator. So liquidator will supersede the management of the business or the company. He will take care, means management in the sense he will not continue the business. He will make sure that all the assets are sold, all the liabilities are paid in the order, in the sequence. There is a sequence of repayment, only in that order it has to be made. So as the power is with the liquidator and not with the board of directors, assessing officer can wait till assessment year. Clear? Only in this last scenario, the assessing officer has a discretion either to collect tax in the previous year only or he can wait till assessment year. Choice is the assessing officers. Okay. Next, agriculture income, again one of the important definition. Agriculture income is defined in section 2 clause 1a, guys. What is it? We will see. Agriculture income means any rent or revenue derived from a land which is situated in India and used for agriculture purpose. Any rent or revenue derived from a land which is situated in India. So preconditions are what? Land should be in India, used for agriculture purpose. Land should be in India, used for agriculture purpose. Sir, who should use it, sir? Anyone. I am the owner of the land, agriculture land, using for agriculture purpose. I am growing the crop, cutting it, severing it, and I am selling it. Whatever I am getting from the sale of crops, is it an agriculture income? Yes. Agriculture income. Next, sir, I am a lazy person. I have agriculture land. I don't want to grow anything there. Okay. So in that case, I let out my agriculture land for a hard-working farmer. He will cultivate the crops there and sell it. In that case, for him, is it an agriculture income? Yes, sir. Now, he is paying rent for me. Rent for me. Who? The tenant, who is actually cultivating the crops. He is paying a rent for me. In that case, is that rent also considered as agriculture income? Yes. Now, rent can be in two forms. Either in money or in kind. Money means, assume every month he is paying me 10,000. Is it an agriculture income? Yes. Next, in kind. Assume whatever the tenant is growing, I told 50% belongs to me. As a rent, you give it in kind. 50% of whatever you grow is for me. In that case, sir, is it an agriculture income again in my hands? Yes. Clear? So, if an agriculture land is let out, for the owner, whatever rent is earning, either in money or in kind, is an agriculture income. For the tenant, whatever is growing, cultivating, and then harvesting and selling it, sale of crops, whatever he get is also an agriculture income, guys. Next, any and agricultural land should be used for agricultural purpose. Clear? Sir, agriculture land is let out for shooting, not shooting, film shooting. Clear? In that case, whatever the farmer is earning from the film production house, what is it? Agriculture income? No, it is not an agriculture income. Why, sir? Land was not used for agriculture purpose. Land is agriculture land, but not used for agriculture purpose. So during election canvas and all, some people will do the, okay, so this politicians, they will go and put nati. Okay, so in that case, don't know what is nati? EPS or OPS or you do whatever, whoever it is. Shrutika. So in that case, sir, assuming the politician paid some amount to the farmer because he is using his space for canvassing and all, or to do whatever he is doing there. So in that case, sir, again, is it considered as agriculture income? No, guys. Next, any income derived from such land by agriculture or by the process employed to render the produce fit for market or by sale of such agriculture produce by the cultivator or receiver of rent in kind. See, guys, from land, whatever I am growing and getting the income is a agriculture income. Plus, next, sir, some activities. Now, sir, I have grown the crops. As it is, I cannot sever and go and give it to the customer. Clear? I have to clean it, dry it, tending, pruning, all this I have to do it. Only then I can make it available in the primary market. So, this activities, whatever I am doing, is it considered as agricultural activities? Yes. Now, sir, I am growing potato. From potato, I am making lace, chips. In that case, is it considered as agriculture activity? No. Sir, I am growing sugarcane. Agriculture? Sugarcane. Agriculture, na? Yes. From sugarcane, I am manufacturing sugar. Is it an agriculture? No. You are changing the nature. You are changing the nature. Clear? Yes. So, in that case, you should not change the nature of the crop. For that, if you are doing any activities, yes, it is considered as an agriculture activities. Clear? Now, whatever example I told you, sir, potato into chips, sugarcane into sugar, is it an agriculture? No, it is considered as manufacturing. Next, any income derived from a farm building. Land is always. Land always is an agriculture income. Sir, what about building? Subject to conditions. Sir, there is a building along with land. So, in that building, whatever income you are getting from that building, is it an agriculture income? Yes, but subject to conditions. Yes, subject to condition means it has to be in so and so area and the building should be in the agriculture land or next to agriculture land. All those conditions are there. If it is satisfied, income from building will also be considered as agriculture income. Next, see guys, if I am doing only agriculture, 100% income is agriculture income, which is exempt under section 10(1). What is 10(1) is telling? Any agriculture income from a land situated in India and used for agriculture purpose is exempt from income tax. Yes. Sir, what if I am doing only manufacturing? I am purchasing sugar cane from the farmers and I am converting it to sugar or jaggery. In that case, I am doing only manufacturing. 100% income is taxable. Next, same way, sir, PepsiCo is manufacturing Lays. They are not growing any potato and all. In that case, what are they doing? Manufacturing. So in that case, 100% income is taxable. But there are some scenarios where same person might be growing and manufacturing. Let us take an example of ITC, Indian Tobacco Company. They are growing as well as manufacturing. In that case, sir, how will we consider or how will we split? How much is agriculture, how much is business? Because agriculture income is 100% exempt. Business income is taxable. But they are doing both. How will we differentiate it? For example, sir, they are growing and whatever they are growing, they are not selling it. They are using it as a raw material in their manufacturing process. They will manufacture the product and then they sell it. So from the sale of that ultimate output, whatever they get, it is not completely agriculture also. It is not completely business also. So for splitting that, how much is agriculture, how much is business, they have given the ratios in the rule. In the rule. What is it? We will see. So specific rules are there. 7A, 7B1, 7B1A and 8 is the specific rules, which is talking about the respective products, guys. Whereas any other product is covered in general rule. That is rule 7. Rule 7. Okay, let us see it. First, rule 7A. Growing and manufacturing of rubber. So in that case, 65% will be your agriculture income and 35% would be your business income. Percentage is important, guys. You have to remember it. You can get a question. Then 7B1. Coffee grown and manufactured in India. 75% is agriculture income and 25% is business income. Guys, manufactured, if they just use the word manufactured or cured, apply this 75-25. If they use extra, that is coffee grown, cured, roasted, and grounded. Okay, roasted and grounded is there means more of business. More of business. So 40 is business, 60 is agriculture. Clear? If they have simply used the word only grown and manufactured, please apply 75-25. If they have used the word roasted and grounded, then 60-40, guys. Okay. Then tea grown and manufactured in India, 60-40. Yes. So these are specific rules which are talking about rubber, coffee and tea. Sir, what about any other product? Then rule 7, guys. Rule 7. And before I go to rule 7, sir, this percentages has to be applied on what? Guys, now please listen here. Sir, I grown coffee plants. Coffee plants. Then I am converting this into coffee beans. Coffee beans. Now whatever coffee plant I am growing, I am not selling as it is. I am using it as a raw material and I am converting it into beans or powder and then I am selling it. Okay, sir. Coffee beans or coffee powder. Okay, this plants. Now, sir, in that case, whatever I get from the sale of this, assume guys the beans or powder, whatever I have manufactured, I have sold it for 10 lakh. Sale value. I have sold it for 10 lakh. From this two cost I have to reduce. Two cost I have to reduce. What is it? Cost of cultivation of what? Coffee plant. Cost of cultivation of coffee plant. Assume 2 lakh. Next, manufacturing cost. Manufacturing cost. Assume 4 lakh. Reduce it. You will get profit or income. How much is that? 4 lakh. On this you have to apply the percentage. On this you have to apply the percentage. So in simple, percentage has to be applied on the profit or income element, not straight away on sale value. Clear? See, if they are given like this breakup, you calculate. Sir, no sir, they have given from the sale of coffee, we have got 10 lakh income. They have straight away given. Please apply the percentage directly on this because we cannot imagine any figures, cost figures. Clear? If they are given separately like this, sale value is so and so, cost is so and so, please reduce the cost and take the income, on that apply the percentage. Sir, no sir, in the exam they are not given any details about the cost. In that case, whatever figure they have given, you will believe that, you will assume that it is an income and apply the percentage straight away. Next, rule 7, general rule. Where in any other case, the income is partially agriculture income and partially business income, the market value of any agricultural produce so raised by the assessee, which has been further utilized, processed in such business, will be considered as agriculture income, and the same shall be allowed as deduction or cost while calculating the business income. This is general rule, and it is not talking about any product. Anything other than rubber, coffee or tea will be covered in rule 7. So let me just take an example. Sir, I am growing potato, and from potato I am doing potato chips. I am growing potato and I am not selling potato as it is. I am using it as a raw material in my manufacturing process, and I am converting that into potato chips. In Kerala they do a lot of this, banana chips. No? So in that case, sir, assume for growing potato, cost of cultivation what I have incurred is 5 lakh. Cost of cultivation. Okay. And for manufacturing process, I have incurred manufacturing cost of 15 lakh. 15 lakh. So potato has been sold, guys. Potato has been sold. Sale value, not potato chips. Sale value of potato chips is 30 lakh. Is 30 lakh. Sir, here how do we calculate business income? How do we calculate agriculture income? You have to do it. Segregation. Now, on what date did you put potato into the manufacturing process? You have to identify that date. On what date did you put the potato into the manufacturing process? Clear? On that day, what was the fair market value of the potato? Means, if you are sold in the open market, how much you would have got? Or if you are purchased from open market, because it is a raw material, if you are purchased it from the open market, how much you would have paid? Clear? Means open market value you find out. Okay. So, assume on this date, guys. Assume on this date, the fair market value of potato was 8 lakh. 8 lakh means the same quantity which I am using in my production process or manufacturing process, same quantity we have to take. Not per kg, take only per kg and put it. No. Per kg into number of kgs which I have put in my manufacturing process. Okay. So now I have to calculate separately. Agriculture income is how much, sir? So what is the fair market value of my potato on the date on which I put potato into manufacturing process? 8 lakh. Minus cost of cultivation. Cost of cultivation or growing 5 lakh. So what is my agriculture income, guys? 3 lakh. Next, coming to business income. What is my business income? Sale value of potato chips 30 lakh. From this, guys, for manufacturing there are 2 costs involved. What is it, sir? Manufacturing cost plus cost of raw material. Cost of raw material. What is raw material for manufacturing process? Potato. Did I purchase it? No. But if I had purchased, I would have incurred a cost. Yes. How much? Fair market value. Fair market value. So I will name it as cost of raw material. Cost of raw material, which is nothing but FMV, guys. So whatever we have taken here, same amount we have to take. FMV. Clear? Which is allowed as cost now. How much is that? 8 lakh. 8 lakh. Then, sir, manufacturing process will not happen like that. We have to incur cost for it. Yes. Whatever manufacturing cost include everything, guys. Labor cost or any other manufacturing process cost, overheads, each and everything will be taken care. Yes. So manufacturing cost is 15 lakh. So 7 lakh. 7 lakh is my business income. Is that clear? Yes. Now, sir, agriculture income, should he pay tax? No, completely exempt under section 10(1). Sir, business income, see guys, there is different names for it. Business income, non-agriculture income, taxable income, everything is one and the same. Clear? Because sometimes in the question they will use different names. Business income, taxable income, non-agriculture income, everything is one and the same. That is 7 lakh here. Okay. Sir, is it taxable, sir? Yes. And guys, when question is silent about any other things, assume this is the total income of the assessee. He doesn't have any other, he might have, but we cannot imagine all that. Clear? When question is only about this, please assume that this is the business income and this is the total income. Clear? So this is taxable? Yes. As per the rates applicable to the assessee. But When the same assessee has both agriculture income as well as non-agriculture income, the computation of tax differs. There is a separate way of calculating the tax cuts. How is it? We will learn it in tax rates chapter. There I will explain it, but you should know that. Clear? Because all this sometimes would be hidden information. So they will ask you, same question, they will merge. Okay, also calculate tax liability of the respective person. So what you will do, on 7 lakh you will apply the tax rates and calculate it, but not straight up. When the same assessee has both agriculture income as well as non-agriculture income, the tax computation format, rates and all will remain same, there is no change in rates, but the format will change. They will just try to push you to the higher slab. How is it? What is the format? We will learn it in the next chapter. Okay. So some important definitions we have covered in this chapter, very important from exam point of view guys. Agriculture income 218, assessee 27, then assessment year 29, then income 224, total income I will cover it later. Okay, because total income I will cover when I start with heads of income. Then person 231, total income as I told I will cover later. Previous year section 3. Section 3. So as of now we have covered what all sections? First section is very easy. For any act, first and second section will be same guys. Sir, what is the short title? Income Tax Act 1961 is the full name. IT Act is the short form. Short title is what? IT Act. IT Act means not Information Technology Act, Income Tax Act. Then extend, sir, where and all it is applicable, sir? Entire India, including Jammu Kashmir. As on today, Jammu Kashmir doesn't have special status, but still, in 1961 they add. Clear? But still, it is applicable to entire India, including all the states and union territory. Next, sir, commencement from 1st April 1962. 1st April 1962, guys. Next, definitions. Guys, in any act, definitions will be given in section 2 of various words, whatever they would have used in the law. Now, the common people may not be able to understand it. What is it? They have to define it. That is the safer place for the lawmaker. So, they will always tell what is this word stand for. So, definition will always be given in section 2 and that too in alphabetical order. Alphabetical order. Have always that in your mind, because sometimes in the exam hall especially you will get confused. Assessee 2, 7 not 231. So A will come first or P will come first? A. So at least in that cases this shortcuts will help you. Then section 3 talks about previous year. Section 4 talks about general charging section. Till year we have covered this. Till year we have covered. Yes, fine guys. So now we will revise chapter 2.2, which talks about the scope of total income and residential status. Two topics are covered in this chapter, that is residential status and scope of total income. First we will do residential status because the scope of total income depends on the residential status of a person. So residential status of a person will decide the incidence of a tax, that is whether he is liable to pay tax on his income in India or not, depends on a person's residential status, guys. Residential status of a person is given in section 6 of Income Tax Act. So what are those? One by one we will see. Section 6 subsection 1 talks about the residential status of individual. Basic conditions are given here. Two basic conditions are given. If you satisfy, that is if an individual satisfy any one condition given here, he or she will become resident in India. Once he or she become resident in India, we have to go to section 6.6 and we have to check whether they are ordinary resident or not ordinary resident. So additional conditions for individual and for HUF. On top of HUF, Karta has to satisfy. Okay. So additional conditions means again here also two conditions are given. If both the conditions are satisfied, they are ordinary resident. If none of them are satisfied or any one is satisfied but not the other, then they are what? Not ordinary resident, guys. Then section 618 talks about deemed resident, that is irrespective of how many days you are in India, you will be considered as resident in India if you satisfy the condition given under section 618. What are those? We will see later. Then section 6.2 talks about the residential status of HUF, AOP and partnership firm, and this has to be read along with section 6.4, guys, because under both the section criteria is same. 6.4 also talks about residential status of body of individual, artificial juridical person, AJP, not KJP or not BJP, it is AJP, and local authorities. So in that case, in both these cases, If control and management is in India, partly or only, it is considered to be resident in India, guys. And residential status of companies is given in section 6(3), 6 subsection 3. Okay. Then 6 subsection 5 is telling one residential status for all sources of income. Now there are 5 heads of income under the income tax law. Yes. Sir, will there be different residential status for each head of income? No. So in a year, sir, will it keep on changing? No. So for 1 year, one residential status for all the sources of income. Sir, once I become resident, will I be a resident forever? No. We have to check the residential status for each and every year separately. Clear? So this is what the gist of section 6, guys. So I have made one simple chart which covers the entire residential status. We will now see one by one. So please be very attentive. Especially the residential status of individual is very, very important, guys. Questions would be mainly targeted on this, guys, because others and all is easy. What is complicated, they want to test whether students know that complicated provision or not. Okay, not complicated, simple only. Okay, because if you have that complicated in your mind, then it will not go to your head. So, section 6 subsection 1, which is applicable for individual. We call it as basic conditions applicable for individual, both male, female, no distinction here. Okay, so in that case, 2 conditions are given, which depends on number of days of stay in India. That is in previous year. So for us, what is the previous year? It is previous year 23-24. We should always check how many days an individual was in India in the previous year 23-24. Clear? Yes, sir. So during the previous year 23-24, if he or she is in India for 182 days or more, fine, first condition is satisfied. Then no need to check second, because if you satisfy anyone, you are resident. Okay. No, sir, I am not satisfied first, then check second. 60 days or more during the previous year, 23-24, and 365 days or more during 4 years preceding the previous year. So while counting that 4 years, don't consider again 23-24. 60 days is for 23-24, whereas 365 days is during 4 years preceding the previous year. For example, so now assume previous year it is 23-24. First check always, is it for more than 182 days? If yes, first condition satisfied, no need to check second one. No sir, first is not satisfied, then we have to check second. Yes sir. So assume 60 or more. Yes. Check last 4 years. In the last 4 years, they should be in India for 365 days or more. And please be careful while checking that 4 years. 23-24 will not be considered. It is the history, past. Clear? Yes. And both has to be satisfied here. Sir, in the previous year, more than 60, sir. But in the last 4 years, 350 days, sir. You are not satisfied the second condition. So in the second condition, there are 2 cumulative, guys. Both has to be taken care of. Okay. Yes, we'll go back. So if any one of this condition is satisfied, an individual is resident. Okay. Once he or she is resident, we will check whether they are ordinary or not ordinary or extraordinary. Okay. There is no extraordinary. And now we will come to section 6.6. Additional conditions are given in section 6.6. Guys, only when you are satisfied any one condition given here, we will check whether you are ordinary or not ordinary. Sir, I am not satisfied both, sir. Thank you. You are a non-resident. 6.6. An individual is said to be ordinary resident if he or she satisfied both the conditions given under section 6.6. Both, and is there in between. Hope you guys can identify the difference between or and and. And means both has to be taken care. Okay, what is it? Resident in India for at least 2 out of last 10 years preceding the previous year. Means leave 23-24. And guys, one thing you always have it in your mind, while checking additional condition, we will leave previous year 23-24. Because we have already taken care here. Na? Again, why to consider the same year again and again. Okay, so don't be in the same place again and again. Go back to the past, history. So in the last 10 years, check how many years he or she was a resident in India. Obviously, in the last 10 years, when he or she will become resident, only when they are satisfied condition given under section 6.1. Clear? And they are telling only resident, they are not using the word ordinary resident, not ordinary resident and all. So that means in the last 10 years, at least in 2 years, if you have taken care of this condition, anyone, you would have become resident in that year, in that respective year. That means, yes, in the current year, you have satisfied this condition. this condition. Hope you guys are able to understand. Clear? So they are telling at least in last 10 years, at least for 2 years, you should be resident. More than 2 means always good. Clear? Yes. Next, second condition. During the last 7 years, leave previous year 23-24, last 7 years, at least 730 days or more, you have to be in India. You have to be in India. So if I have to simply explain in time chart, so 23-24 is our current previous year. Now we are checking the residential status for which year? Previous year 23-24. Our assessment year 24-25. Okay, sir. But while checking additional condition, we should completely forget this. We should completely forget it. First condition is telling what? Go back to last 10 years and check in that last 10 years how many years you were resident. So in the exam we have to do so much calculation. No, sometimes you have to apply common sense. What is it? If you have, I will tell. Okay. Now, sir, in the question somewhere they would have given a clue telling he left India during so and so time. Before that, it is understood always that he was in India. Clear? So assume last 2 years back he left or she left. Last 3 years back they left India. So before that they will be completely in India. So it is understood that they were resident. When they were in India, they are considered to be resident in India, guys. Sometimes we have to work on that basis. Okay. And last 7 years. Means leave 23-24, go back to last 7 years and check how many years they were in India. Sometimes this number they will give directly in the question, or else sometimes you have to use common sense, or sometimes they would have given last 7 years, each year how many days and all, you have to just add it up. You have to add it up, guys. Is that clear? Yes. So please be careful. One thing, because students will tend to get confused in individual residential status, guys. So the 7 years and 10 years is preceding the previous year 23-24. Okay. Fine. Next. So 6.1 is telling basic conditions. If you satisfy any one, you will become resident. If you become resident, you will go and check ordinary or not ordinary. Sir, if both the conditions are satisfied, ordinary resident. If any one is violated or not satisfied, then they are not ordinary resident. We call it as resident, but not ordinary. If they satisfy both, resident and ordinary resident. Okay. Now, but there are certain exceptions. What did we learn in section 6.1? If you satisfy anyone, you become resident. But there are 2 exception cases where second condition is not applicable. Second condition is not applicable. That means if you are covered in this exception, only if you satisfy the first condition of 182 days or more, you will become resident in India. Sir, which are those 2 exceptions? Indian citizen who leaves India as a member of Indian ship or for the purpose of employment outside India, means during the previous year. You are in India, you are an Indian citizen. During the previous year, which is our previous year, 23-24, you are leaving India. You are leaving India as a member of Indian ship or for the purpose of employment outside India. You got a job, foreign job. Okay, sir, in foreign country I got a job opportunity, so I am telling tata bye bye to India. So in that case, second condition is not applicable. Here we will not check, we will not even check income. Please be very careful. Irrespective of their income, for them, second condition is not applicable. Second, they are leaving India. Please be careful. Now coming to India. Sir, few people, they are settled abroad. Now they want to serve the nation. They are coming back. They have made the good money there and they want to do some startup here and they are coming back to India. Always welcome. Indian citizen or a person of Indian origin engaged in business, employment or profession. BP means business, employment or profession outside India. They were outside India, engaged in any business, employment or profession. Comes on a visit to India. Okay, I told business and all because if they are coming back to do business and all, they have to permanently set up here. But here, what they are telling is visit, not for any other purpose. Okay, to India during the previous year, and his total income other than the income from foreign sources is up to 15 lakh. In simple, Indian income is up to 15 lakh. Okay, or income from Indian sources is up to 15 lakh. Come on, guys. What is the second case? See, please be careful. First case, no connection to any income. Don't check the income at all. Second point, Indian citizen or person of Indian origin, they were settled abroad for business, employment or profession. Now they are coming to India when? During the previous year. Clear? During the previous year, sir. They came back last year, sir. Will this exception be applicable? No. Only during the previous year. Okay. And They are coming here for what purpose? Visit. Sir, you gave an example of starting startup in India or coming and settling back in India. Assume they were working outside India, but now they came back to India during previous year to permanently settle here. Are they covered here? No, they are not covered. Please be careful. They are coming only for a visit. Visit whom, sir? Maybe for tourism purpose or to visit their family or their parents to stay with their parents for whatever reason or whomever they want to visit in India. To India during privacy. We cannot ask that. During the previous year and his total income other than the income from foreign sources. In simple, income from Indian sources is up to 15 lakh. In this case, again, second condition is not applicable. So if they want to be resident in India, they have to satisfy only the first condition, guys. Because when these two cases, now normally in the previous year they might be more than 60 days, and in the past also they would have satisfied 365 days. They're telling no. Only for that purpose we are not considering you as a resident. That is why they're telling second condition is not applicable. Only if you are in India for more than 6 months, approximately 6 months, 182 days they are told. Clear? So you know 365 divided by 2 means, so exactly 182 will not come. Okay, it's okay. Consider 180 to 6 months. Clear? Average. So if you are more than 6 months in India, we are considering as resident. If not, okay, you can come and go. No problem. Next, sir, in this case, they told up to 15 lakh. What if it is more than 15 lakh? Same second case. But what if it is more than 15 lakh? Then here, same scenario, guys, but income, Indian income is more than 15 lakh. In that case, it will come here. In the previous year, that is the Indian income is more than 15 lakh in the previous year, second condition under section 6(1) is applicable, but instead of 60 days, it would be 120 days. Instead of 60 days, it would be 120 days. Okay, means, sir, second condition is alive here, not dead, it is alive, but instead of 60, it is 120. Instead of 60, it is 120. Okay. Next, there is a and person of Indian origin means whom, sir? If your parents or grandparents are born in undivided India, that is before 1947, India, Bangladesh, Pakistan are everything one and the same. Undivided India we call it as. If your parents or grandparents, both father side, mother side, if they are born in undivided India, then you are called as person of Indian origin. Okay. Next, deemed resident provision also is there, 6(1)(a). Deemed resident provision we will check only if you are not covered above. If you are already covered above, again don't check 6(1)(a). Okay, 6(1)(a) is like adopting. Okay, you are left over by all other countries and you have some good amount of income. Come, we will adopt. We will adopt you. Chalo. So please be careful. If you are already covered in 6(1), please don't check 6(1)(a). 6(1)(a) is like a last checkpoint. Indian citizen having total income other than income from foreign sources more than 50 lakh. Again, other than foreign sources means Indian income, guys, or income from Indian sources more than 15 lakh. What is it? See, what if it is less than 15 lakh? Not covered here. In the previous year, shall be deemed resident in India. Deemed resident. We don't even care where you are, how many days you are in India. We don't even check that. If he is not liable to tax in any other country. So you have income from Indian sources more than 15 lakh. Yes, sir. And you are Indian citizen? Yes, sir. Then you didn't pay tax in any other foreign country? Yes, sir. Come, sir. We will adopt as deemed resident. Clear? So he is a deemed resident, and here number of days of stay is irrelevant, guys. Because sometimes they may confuse you by giving in the question, he was there in India for 50 days, 40 days, 30 days and all. Don't care about it. Don't care about it. Yes. And sir, is there any possibility that same person may be covered here? Yes, definitely yes. Here, for example, I am an Indian citizen, having Indian income more than 15 lakh, and I am in India for more than 182 days. Where am I covered? Deemed resident here. First point, 6(1). Please be careful. I told you that is why 6(1) is last checkpoint. Clear? Yes. And whenever a person become resident as per 6(1)(a), or this point, guys, this one part. That is, second condition is applicable, but instead of 60 days, it is 120 days. They are always not ordinary resident. Means we need not check the additional condition under section 6(6). Even if they are satisfied additional condition given under section 6(6), still they will be not ordinary resident. We need not check. We need not check means why will you check? Clear? So sometimes in the question they would have given the information in such a way that they would have satisfied 6 but still they will be not ordinary resident. You don't even check, don't even care. Stop it at that point only. They are straight away always not ordinary resident. Now please listen here. Please listen here. Guys, sir, I am an Indian citizen or a person of Indian origin, having Indian income more than 15 lakh, so I am covered here. For me, second condition is applicable. Yes. So second condition is 120 days. But I was in India, I am covered here, sir. I am covered in this point. But I was in India for 190 days during previous year. So I am satisfying first condition or second condition? First condition. I was in India for 190 days. So should I check additional condition? Yes, you have to check. Clear? So when you should not check additional condition is, sir, I am covered in this provision. I am covered in this provision and I have satisfied the second condition, that is 120 days or more and 365 days, and I have become a resident. In that case, don't check additional condition. Don't check additional conditions. Yes. So this is all about individual, guys, and please be careful. Some differences are there, guys. See, first point, only Indian citizen are covered. Second exception, Indian citizen as well as person of Indian origin. Same thing will carry here also, for this point also. Whereas for deemed resident, only Indian citizen again. Please be careful. Sometimes they will ask questions straight away on that. For example, for 6.1a, they may ask question, same thing, every condition is satisfied, but he is a person of Indian origin. But he might be a person of Indian origin. Please take care of small things like that. Next. So here, first point, who is having the remote? Switch on. Yeah. First point, guys, please pay attention. Indian citizen who leaves India as a member of Indianship is there, na? First exception, yes. So that means for them second condition is not applicable. Yes, sir. There is a separate rule also for them, guys. There is a separate rule for them. What is it, sir? According to rule 126, an individual being a citizen of India and a member of crew of a ship, the period of stay in India in respect of a eligible voyage means simple. Their starting point is in India or destination point is in India, whereas the other is outside India. For example, if starting point is in India, destination is outside India. If starting point is outside India, destination point would be in India. Oh, they are engaged in international traffic. Clear? Yes. Shall not include the period beginning from the date of joining till the date of signing off, as mentioned in continuous discharge certificate. And if at all if the question is asked, they will mention those dates. And those days are considered to be outside India, not in India, outside India. So if at all if the question is on this, first you have to check how many days. So guys, please, in our previous year, how many days? How many days? 366. 24 is a leap year. One day also will make difference. Please be careful. Yes, sir. Next. In this, as per continuous discharge certificate, you will calculate how many days. So you will remove it from this. Assume you got 120 days. You will remove it. So how many days he was in India means 366 minus 120. And how to calculate this 120 is, guys, assume they are giving the date of joining the ship as per continuous discharge certificate is 1st July 23. And date of signing off is 30th September 23. Including both the days you have to calculate. Including both the days you have to calculate. To be what? To be outside India. Clear? So how do we calculate now? 31 days in July, August, September. August, September. 92 days. Is that, sir, you wrote 120 randomly I wrote, okay? So here 92. I am trying to show that you have to include both the days. Please be careful. Clear? Yes, sir. And sir, here, hope this thing is clear for you. Next, sir, while counting the number of days of stay in India, date of arrival as well as date of departure, how should we consider it? Is considered to be in India. Date of arrival as well as date of departure is always considered to be in India, irrespective of the time. He came in the noon, morning, night, doesn't matter. The date of arrival as well as the date of departure is always considered to be in India, guys. Okay, please take care of those things, especially when he's coming to India. when a person is coming to India, when an individual is coming to India, from the date of arrival, including that day, till the end of the year you calculate. In between the year, if he is departing again, only till that date. Clear? Next, sir, in between the year is going out, sir. Tata bye bye. In that case, from the beginning of the year till that date, including that date. Including that date. So those days calculation, please be careful because sometimes vice versa students might do. Yeah. Next, the residential status, some important points to be kept in mind. The residential status has got nothing to do with citizenship, nationality and place of birth or domicile. Domicile means the place where you have permanent home. Hence, a person can be a resident in more than one country. Just because I am an Indian national or citizen, will I be always permanently resident in India? No. Clear? Guys, exceptions sometimes give connection to Indian citizen, person of Indian origin and all. But they are not telling Indian citizen always resident in India. Indian nationals always resident in India. No, no, no. Clear? Yes. Next, for all practical purposes, that is for calculating the number of days, the date of departure and date of arrival is taken to be in India. Now, sir, we saw here 182 days, 60 days, 365 days, 730 days and all. Should it be continuous? No. Even if you are coming, going and all, how many days totally you were in India, we will count it. Clear? So, totally in India, how many days? 182 days means continuous you need not be. 3 months you were, went out. Again you came, 1 month you were, yes, we will count it. Again you went back. Then again you came, 15 days you were. So we'll keep on counting how many days you were in India during the previous year. So the stay need not be continuous, guys. Stay in India need not be continuous or active, nor it is essential that their stay should be at the usual place of residence, that where they stay, for what purpose they stay, with whom they stay, doesn't matter. Business or employment of the individual. Next, 6.1 and 6.6 is done. 6.2, guys. 6.2 and 6.4 we will do it together because both has same criteria, but sections are different. 6.2 talks about the residential status of HUF, AOP and partnership firms including LLP. Then 6.4 talks about the residential status of body of individual, artificial juridical person and local authorities. So when they are said to be resident in India means when the control and management of the affairs, business affairs, is wholly or partly in India during the previous year. Means where the policy decisions are made. Where decisions are made is important, not where it is implemented. Where the decisions are made is important. Okay. Now, for HUF alone here, once the control and management is in India, wholly or partly, even if one decision is taken in India, they are resident. Okay. Once HUF become resident as per section 6.2, we have to check additional conditions for HUF under section 6.6. But on behalf of HUF, Karta has to satisfy it. Karta, the head of the HUF has to satisfy it. That is, if Karta of the HUF satisfy both the condition given under section 6.6, then HUF will become ordinary resident. If Karta fails to satisfy, then HUF would become not ordinary resident. Then HUF would become not ordinary resident, guys. Is that clear? So please be careful. We are not checking the residential status of Karta. For Karta as an individual, we will check section 6.1 along with 6.6 for Karta. Residential status of Karta. Who is Karta? Individual. Correct. For him, we will check the residential status separately. Now, whose residential status we are checking? HUFs. So for HUF, we have to apply 6.2. Once they have crossed 6.2, we have to apply 6.6. But for 6.6, on behalf of HUF, who has to satisfy? Karta. Karta has to satisfy. So please be careful. Karta may be non-resident, ordinary resident, not ordinary resident, doesn't matter. We are straight away checking, did he satisfy both? Sir, is there any possibility that Karta is non-resident, but HUF, Karta is non-resident, but HUF is ordinary resident? Can it happen? Yes. For example, in the previous year, Karta was in India only for 50 days. In the previous year, the Karta was in India only for 50 days. Straight away, both the condition ruled off as an individual. As an individual, for him, both the condition ruled off, so he is a non-resident. Clear? But in the past, he was completely in India, sir. In the past, he was completely in India. So if I check additional condition, will he satisfy both? Yes, he will satisfy. But for Karta as an individual, we will not check it because he is straight away not non-resident. But for HUF, when we are checking whether Karta has satisfied both the condition, did he satisfy? Yes. So in that case, what will be the residential status of HUF? Ordinary resident. Whereas Karta is non-resident. Clear? Next, sir, Karta is ordinary resident, sir. In that case, if HUF's control and management is in India, they will always be ordinary resident. Clear? Next, sir, Karta is not ordinary resident, sir. In that case, if HUF control and management is in India, at least partly, they will also be not ordinary resident. Hope you guys are getting it. Next, 6.3. 6.3 talks about residential status of companies. 6.3, company, third alphabet, C. So 6.3, subsection 3. Indian company will always be resident in India. Will always be resident in India. We don't check any other condition. No if, no but. Always resident. Yes. Foreign company only if their poem is in India. Only if their poem is in India. What is poem? Place of effective management. Place of effective management. Now, how do we decide place of effective management, sir? Where the key management and commercial decisions are made. If it is made in India, poem is said to be in India. If it is made outside India, poem is said to be outside India. Clear? So in that case, sir, there are some different stages to check whether the poem is in India or not. I just mentioned it. Pay attention. Poem is presumed to be outside India. Poem is presumed to be outside India if these two conditions are satisfied. What are those two conditions, sir? Active business outside India and majority of the board of directors meeting is held outside India. For a company, who will take the decisions? Board of directors. If they are conducting the majority board meeting outside India, they are going for Maldives, they are enjoying, and one meeting they are conducting there. Every time they are doing like that only, sir. They go for a trip. Many companies do like that. Okay, they go for a trip and there only they will conduct. They will have some conference hall or something in the evening. They will have half an hour, 1 hour meeting and they will conduct the meeting. So if majority of the board of directors meeting is held outside India plus active business is outside India, then poem is presumed to be outside India. If poem is outside India, foreign company is a non-resident. Now majority of the board of directors meeting, okay sir, what is this active business outside India? Active business is said to be outside India if all the 4 conditions are satisfied. If all the 4 conditions are satisfied. What are those 4 conditions, sir? First one, your passive income is less than or equal to 50% of your total income. Passive income means which is indirectly which you are earning. Clear? Means your active participation is not there. Active participation is not there. Okay. Second condition, assets in India. Assets in India is less than 50% of total assets of the company. Means how many assets are in India? Less than 50% of that is in, out of the total assets, less than 50% of the assets are in India. Okay. Third one, Indian employees is less than 50% of total employees. Means number of employees in India is less than 50% of the total employees of the company. Same way, salary expenses of Indian employees is less than 50% of total salary expenses of the company. Total salary expenses of the company. If all these 4 are satisfied, yes, their active business is outside India. Clear? Yes, please be careful. We are not straight here. What are we deciding? Active business outside India. I will just give an example, guys, for this. Sir, assume the company's total income is 100 crore. In this, passive income is 30 crore and active income, other than passive income, is called active income, 70 crores. First condition satisfied, huh? Yes, less than 50. Less than or equal to also fine. Only here less than or equal to both are there. So it is less than 50% of the total income. Fine, sir. First condition satisfied. Next, company has a total assets of 500 crore, guys. 500 crore. In that, in India, outside India. In India, 200 crore. Outside India includes any country other than India, 300 crore. Again, less than 50%. Less than 50%. So in that case, sir, is second condition satisfied? Yes. Second condition is also satisfied. Yeah. Next, total income. Number of employees will take. Employee strength. Employee strength, we will take 1000 employees. So company totally has 1000 employees. In that, in India how much? Outside India how much? $300, $700. Again less than 50, huh? Yes. So in India, the number of employees are less than 50%. So in that case, again, this is satisfied. Next, the salary paid to these people. So total salary we will take. Total salary. How much will take? 50 crore. Okay. 50 crore. For the employees in India, the company has paid 20 crore and outside India 30 crore. 30 crore. So in that case, again less than 50%? Yes, sir. So all the conditions are taken care. All the conditions are taken care. Total salary is 50 crore. In that, how much is paid for the employees in India? 20 crore. Less than 50%. Less than 50%, guys. So that means they are satisfied all the condition now. Yes. Even if one condition is satisfied, then active business is not outside India. Clear? Yes. So active business outside India and majority board meeting held outside India means poem is outside India and foreign company is non-resident. Clear? So what if active business is not outside India? In that case, check who is making decision. Where are they making? Who? Where? Who? Where? If for the where answer is in India, then poem is in India. Who is making the decision and where are they making? If where they are making is in India, then their poem is said to be in India, and when poem is in India, residential status is resident. And only for individuals and HUF, we check additional conditions, guys. For any others, they are straight away resident or not ordinary. Sorry, they are resident or non-resident. There is no question of not ordinary at all. Clear? When they are resident, straight away we consider them as ordinary. If they are non-resident, straight away non-resident. No in-between category for them. That is only for individuals and HUF. 3 possibilities are there. Whereas for others, only 2 possibilities. Okay, we are done with residential status. 6.5, as we already saw it when I was explaining the sections here, we covered it. 6.5 is talking about what, guys? One residential status for all the sources of income. And, sir, residential status has to be checked for each and every year separately. That means once I become resident, assume in previous year 23-24, I become resident. That doesn't mean that I am resident forever. That doesn't mean that I am resident forever, guys. Okay. So, done with 6, we will move towards 5 now. Here I am covering vice versa, guys, because 5 depends on 6. 5 depends on 6. That is why I did 6 first and then we are going to 5. Okay. Scope of total income. Scope of total income. This section talks about what income is taxable in India, which depends on the residential status of a person. So there are 3 possibilities, guys. One is what? Resident and ordinary resident. Then resident, not ordinary resident. Last one is non-resident. But the middle one is only for individuals and HUFs. Okay. Income which is received in India, deemed to be received in India, is always taxable, irrespective of what is your residential status. Always taxable in India, guys. Deemed received means as if it is received in India. Income which accrues or arises in India, in simple, earned in India, or deemed to be accrue or arise in India, is always taxable, irrespective of who you are. So always keep it simple. If income is earned in India or received in India, it's always taxable. Source is in India, so it's always taxable. Next, sir, income is earned outside India, received outside India. We call it as foreign income, but the hold is in India. The control is in India. That means earned outside India, received outside India. Last case, guys. Last case. Okay. Yes. So in that case, business, it is from a business controlled from India. Means decisions are taken in India. Business is carried on outside India, earned there, received there. But control is in India, means decisions are taken here. Mukesh Ambani is taking the decisions in India, sitting here of his subsidiary company in foreign. In that case, is it considered as controlled from India? Yes. Or profession set up in India. I went to US, UK, gave some services there for client. Profession set up in India. I was practicing a child accountant in India. I went there and I gave some services there. Earned there, received there. But profession was set up where? In India. So it will fall in this category. So it would be taxable only in case of ordinary resident or not ordinary resident. Whereas if it is non-resident, not taxable. Any other case means, sir, earned outside India, received outside India, no connection to India, no control in India, nothing, sir. In that case, it is taxable only if you are a ordinary resident. It is taxable only if you are a ordinary resident. So, if you are ordinary resident, simple thing is global income is taxable. Earned anywhere, received anywhere in the world is taxable. Sir, I went for a Mars and there I earned something, sir. Non-resident means only Indian income is taxable. Only Indian income in the sense, only earned in India or received in India. No control, nothing. Only earned in India, received in India. That's all is taxable. Clear up. Guys, one important thing connected to section 6. See, in two places here, is total income other than income from foreign sources. Here also, is total income other than income from foreign sources. And here also it will have an impact. That is more than 15 lakh. So for this three, what and all we should consider, sir? I repeat, too much mess up here. For this one, and for this one. Total income other than from foreign sources. Means what all we have to take care, sir? This three, guys. 1, 2 and 3. We have to take. Clear up? We have to take Indian income plus the control or profession is set up in India. That also we have to take to calculate that 15 lakh limit. Clear up? Yes, only this one will not come in that 15 lakh calculation. Fine, sir. Next, points to remember here again. When once the amount is received, sir, I have earned and received it. Later, I transferred it to my wife's account. I transferred it to my parents for their own expenses. Will it be considered as income for them also? No. Subsequent transfer or remittance will not amount to receipt for them. If the person was earned it, received it, yes, it is taxable for him. But again, if he is subsequently remitting it or transferring it to someone else, that will not be considered as income. Then, any past untaxed foreign income, if brought into India, is not taxable in the hands of any assessee. Sir, I had earned income in 2015-16 in US. I was supposed to pay tax there, but I have not paid. Now, in the current previous year, I want to bring that money into India. Come, bring it. Money is anyway flowing into our economy. Bring it. We will not tax it because we are not losing anything. Where you are supposed to pay tax there, you are not paid. Whose loss it is that? US government's. So in that case, we are not losing anything. Bring it here. We are more happy because money will flow into our economy. Next, any exempt income will be excluded from the total income of every assessee. Means if at all, here we discussed which income is taxable. Sir, in India, I have earned an agriculture income from a land situated in India used for agriculture purpose. So definitely earned and received in India. Is it taxable? No. So even though it is earned in India, even though it is received in India, if exemption is given for any particular income, don't include it in your total income calculation. So you will enjoy the exemption there only. For some exemptions, they are given list of the following and all. So in that case, for example, I assume I have earned 10 lakh, but I am eligible to claim an exemption of 8 lakh. So in that case, how much should be included in my total income calculation? 2 lakh. 2 lakh has to be included. So here, they have given the connection to income deemed to be received, deemed to be earned or arise. Actually, arise is nothing but earned, guys. So what is that? Section 7 and 9 also we have to understand. 7 is small, 9 is bit lengthy. Let us see both. Income deemed to be received in India. Deemed to be received in India means, guys, as if you have received it. Maybe in this year you have not received it, but who is the ultimate beneficiary? You only. Might be you are not getting the money today only. Sir, where is money, sir? To pay tax, you would have not received it. But you are the beneficiary. You are the ultimate beneficiary. So they are considering it is deemed to be received in India. So which are those also we will see. In addition to the income actually received by the assessee or on his behalf, certain other incomes not actually received by the assessee and are not received during the relevant previous year are also included in his total income for the income tax purposes. Some of the examples of such income are annual accretion. Annual accretion means contribution. Okay. To recognized provident fund to the extent taxable, that is contribution in excess of 12% of salary to recognized provident fund or interest credited in excess of 9.5% per annum. Right. This is a part of salary hit. Employer contribution to recognized provident fund in excess of 12%. Up to 12% it is exempt. If it is more than 12%, the difference is taxable. Sir, employer has contributed 15%. That means 3% is taxable. As what? Salary income for employee. Now, sir, employee is not getting any money today, sir, because it is contributed to the PF account of the employee. So, when the employee actually withdraw the amount, he will get the money. But it is contributed during the previous year. Yes. So, who is the beneficiary of that PF account? Employee, because it is in whose name? Employee. So, even though literally he has not received the money during the previous year, still it is deemed to be received by him. If at all, if it is taxable. If it is exactly 12% or less than 12%, nothing is taxable. So, no income is deemed to be received. Same way, interest up to 9.5%. Actually, it is less than 9.5 only now. Okay, but still for academic purpose, any rate they may give. Okay, so assume rate of interest they have given 10%. So, in that case, up to 9.5% it is exempt. In excess of that will be taxable. For whom? Employee. To transfer balance from unrecognized provident fund to recognized provident fund to the extent taxable. Guys, you know, for unrecognized provident fund, there is no tax benefit. Employee contribution, he cannot claim ETC deduction. Employer contribution, taxable, but when it is withdrawn. Interest, taxable, but when it is withdrawn. Clear? Now, when it is withdrawn from unrecognized provident fund, now unrecognized provident fund account is opened in the name of employee. Now, if amount is withdrawn from unrecognized provident fund, they got to know it is taxable. So, what they planned is, sir, I have a balance of 10 lakh in unrecognized provident fund account. So, what we thought was, we are converting that into recognized provident fund now. We are converting that into recognized provident fund account. And we are transferring this balance, 10 lakh. So, in future, when I withdraw the amount from recognized provident fund, I enjoy the exemption. One condition is minimum 5 years of service you should have given. Yes, sir. So, when you withdraw the amount from recognized provident fund, you enjoy the exemption. So, your employee is trying to manipulate. So, what they have done is, when you try to transfer the fund balance from unrecognized provident fund to recognized provident fund, you are not withdrawing the money. You are just transferring the balance from unrecognized to recognized. This is considered as income. In which year, sir? In which year you are transferring it? Clear? Yes, sir. But entire 10 lakh may not be taxable because employee contribution will not be taxable. Because his contribution will not be taxable. Employer contribution plus interest will be taxable. Employer plus interest. Hope you guys remember. In salary we have covered now. So, for example, in 10 lakh, I am just randomly mentioning the amounts. Employee contribution, employer contribution, interest. Interest, this is interest part on employee contribution, interest on employer contribution. So, let us take this as 4 lakh each. This is 1 lakh each, totally 10 lakh. Correct. Now, sir, employee contribution, will it be taxable? No. Why? Because what money he has put, he is getting back. So, this will not be taxable. Whereas employer contribution, will it be taxable? Yes, under salary head. Interest on employee contribution, will it be taxable? Yes, under the head income from other sources. Interest on employer contribution, will it be taxable? Yes, under the head income from salary. Clear? So, in the year in which I am transferring the fund balance from unrecognized to recognized, entire 10 lakh will be taxable? No, sir. It is only 4 plus 1 plus. But I didn't receive the money, no, sir. I just transferred it from one fund to another fund. It is deemed to be received. It is deemed to be received. And in the future, when you withdraw the amount from recognized, it will not again be taxable. You enjoy the exemption. Last one. Contribution by central government or any other employer in the previous year under the pension scheme referred to under section ACCA. Guys, if you remember, so employer contribution to NPS first should be added to the salary and claim deduction under section ACCA for both the contribution, employee as well as employer contribution. Clear? So now, sir, actually employee didn't receive the amount, sir. Amount has gone to NPS account, sir. NPS account is in whose name? Employee name. So you are the ultimate beneficiary. Clear? First it has to be included in the salary. Which contribution? Employer contribution. Include it in the salary. Then claim deduction under section 80CCD for both employer as well as employee contribution. Clear? Same thing is now applicable also for Agnipath scheme. Agnipath scheme, guys. Okay, deemed to be received and done. The secret of going ahead is getting started, which is very important. Now you guys have already started. No, you have to carry on, continue. Make sure that, guys, you are very near verge, last moment. You have to improve your strike rate. You would have started well, you would have continued well, but the improvement now, you have to do it. You cannot continue in the same way how you were doing last 2 months back, 3 months back. Now you have to push yourself to contribute more and more hours. So please make sure that now I don't think you guys will have any other things except studies. Okay, few students might be doing degree and all. Try to take off for how many days hour is possible for you. Clear? If possible, entire month you take. If not, how much ever maximum is possible, try to take off and contribute towards your CS, guys. Very, very important now, because now each and every day will contribute at least 4 to 5 marks for you. I'm telling you. And this last day's preparation will give you a cushion. That is, even if you are able to get now, at least till now, you will be in some comfortable position. After this, if you are assume you are able to score plus 40-50 marks, definitely that is where you are carrying from that 180-190 to the next level, guys. Clear? So please make sure that this last few days will make a count for you. And that is very, very important, because in the last moment, if you give up thinking I have studied or I cannot do it this attempt, guys, miracles can happen anytime. So don't think that, sir, I cannot pass, I have not studied well and all. So even if by chance, if you are watching this marathon, definitely you will have a confidence of getting good marks, guys. So please make sure that each and every subject you prioritize and divide that time. Don't overstudy one subject and understudy the other subject. You have to prioritize each and every paper and try to score above 60 in each and every paper. And try to score. If by chance worst case, worst paper, sir, highly challenging paper, tough paper, whatever, still if you are not able to score 60, at least you will be in a comfortable position. More than 50 is also fine, guys. Clear? Your target is not 40. Your target is 60. Clear? Sir, passing is 40, I know that. But you have to aim for 60. Clear? If you target 40, you will not end up getting 40, guys. Okay, so we'll proceed for next section. Income deemed to accrue or arise in India, section 9. The following income shall be deemed to accrue or arise in India. Any income accruing or arising to an assessee in any place outside India, whether directly or indirectly, through or from a business connection in India. If you are earning anything through business connection in India, sir, what is business connection? If any business activity is carried on by a non-resident in India through an agent, for that non-resident, whatever income is earning through business activity in India is considered as income deemed to accrue or arise in India. Then through or from any property in India or any asset in India. Now, guys, I have a property or asset in India. If I am earning any income from it, source is in India, it will be taxable in India. Sir, I sold that property, then capital gains also is deemed to accrue or arise in India. Next, second clause. Income which falls under the head salaries, if it is earned in India, salary payable for the service rendered in India would be treated as earned in India. Now, if services is rendered in India, it is always taxable in India. Sir, salary I received outside India, it doesn't matter. If you are in employment in India, it is always tax. Okay. Next, sir, I have rendered my employment service in India. I have rendered my employment service in India. I retired. Now went and settled somewhere in foreign country. I am getting pension from my former employer. What is it? Indian income. You are getting pension which is taxable under the head salary for the services rendered in India. So source is in India. Oh, next, income from salaries which is payable by the government to a citizen of India for services rendered outside India. Sir, Indian government has appointed some employees outside India who is rendering services from outside India but for Indian government. Who is paying salary for them? Indian government. In that case, even though they might be providing services outside India, they might be receiving salary outside India, still it is considered to be income deemed to accrue or arise in India. Then, dividends paid by Indian company outside India would be taxed in the hands of the shareholder at the normal rates in India. So, dividend paid by Indian company is always income deemed to accrue or arise in India. Where it is paid doesn't matter, guys. And dividend income is always taxable at normal rate. Please be careful, you may get confused because capital gains is taxable at special rate. But dividend income is a normal income which is taxable under the head other sources at normal rates. Then interest, royalty and fee for technical services. Interest, royalty and fee for technical services is deemed to accrue or arise in India for a recipient who is a non-resident. For a recipient who is a non-resident, if it is payable by. So who is the person who has earned any of these three? Guys, I have covered all these three together because the provisions is same. Clear? Same person may not earn all three. If he has earned any of this is how the treatment is. Okay. The person who has earned it is a non-resident, and who is paying it? Government. If government is paying it for the recipient, it is always deemed to accrue or arise in India. Next, sir, the payer, the person who has paid the interest or the fees or royalty is a person who is resident in India. These people are the payers, guys. Okay. Then, generally taxable in the hands of receiver. So, normally it is taxable in the hands of receiver, that is the non-resident. But in the following two cases, it is not taxable. If the money borrowed and used on technical services or royalty services, whatever is utilized for the purpose of business or profession carried on outside India. If the services obtained or the money borrowed is used for any business or profession outside India, then it is not an income deemed to accrue or arise in India. When it is not an income deemed to accrue or arise in India, it is not taxable for a non-resident. Correct? Na? Because for a non-resident, only what is earned or received in India is taxable. Next, if the money borrowed and used for or technical services or royalty services are utilized for making income from any source outside India, means you are investing the money to earn income. If it is outside India, then again it is not income deemed to accrue or arise in India, hence not taxed. Okay. Reverse scenario is here. Sir, what if the payer is a non-resident? Payer also non-resident, recipient is also non-resident. So in that case, it would be taxable in the hands of recipient. Recipient is who, guys? Non-resident. Please be careful. That is this person. Why are we checking the payer is just to see whether for the recipient is it an income deemed to accrue or arise in India. We are not telling, hey payer, you pay tax and no. Because it is not his income. For him, it is actually expenses. So, whether the income is taxable for the recipient depends on who has paid it and for what purpose it is utilized or used. Taxable in the hands of recipient only if money is borrowed and used for the purpose of business or profession carried on in India. So now business or profession is carried on in India, you are used for that purpose. Or else, if technical services or royalty services are utilized for the purpose of business or profession carried on in India or making any income from any source in India. So only if money borrowed is used for any business or profession in India, or sir, the services whatever I have taken, technical services or royalty services is used for any business or profession in India or for making any money in India, only then it is taxable. What if it is used outside India? Not taxable, because it is not income deemed to accrue or arise in India, guys. Then last one, any sum of money paid by a resident Indian to a non-corporate non-resident or a foreign company. Section 918. Income arising outside India being any sum of money paid without consideration by a Indian resident. So who is the person who is paying it? Indian resident. To a non-corporate non-resident, means other than company. Other than company, non-resident or foreign company, would be deemed to accrue or arise in India if the same is chargeable under section 56(2)(10), which talks about gift taxation. That is, if the aggregate of such sums received exceeds 50,000. Simple, guys. Sir, outside India, Indian resident has given to a non-resident a gift worth more than 50,000. Means he is not receiving anything in return. He is not receiving anything in return. So in that case, non-resident or foreign company, 56(2)(10) get attracted. 56(2)(10) get attracted, and it is taxable for them under the head income from other sources. Under the head income from other sources, guys. That's it. Yes, so we are done with chapter 2.2. Now we will get into chapter 2.3. Tax rates for different types of assessee for assessment year 24-25 or previous year 23-24. Very important chapter, guys, because the major changes are there in this chapter. The major changes are there in this chapter. So, rates of tax. Income tax is to be charged at the rates fixed for the year by the Annual Finance Act. Tax rates depends upon the category of a person, amount of income, residential status of a person, age of the individual. Age of the individual only if he is resident and if he is following the optional scheme and all. Then type of income. What income he is having. So the total income can be subdivided into two types, special income and normal income. Special incomes, they are given in the law. So and so incomes are specials, which are taxable at special rates. No matter who is having that income, it is always taxable at a special rates, guys. And irrespective of the scheme chosen by them, whether they are following default scheme, whether they are following optional scheme, doesn't matter. For them, if at all, any person who is having special income is always taxable at special rates, irrespective of who has earned it and which scheme they are following. And special rates are given in the respective section of the income tax law only. Then normal income, any income other than special is always normal income, which is taxable at normal rate. Normal rate can be either flat rate or slab rate, depending upon the category of the person. And this will also vary depending upon the scheme opted by him, whether he is following default scheme or optional scheme. Clear? So especially this one, yes, we have to be careful. Because here the category of person will matter and the scheme they are opting also will matter. Okay. Special incomes which are taxable at special rates I have given here. Well, just list of it. We will cover it later, guys. Okay. Guys, before I want to start with the rates, I just want to give one disclosure, especially for those who would have already attempted their exams. Something has gradually changed, guys. What is it? I will just tell you. Previously, there was something called as old regime and new regime. Old regime or new regime. Clear? Old regime is what the people used to follow. If they don't want, they can follow new regime. And this new regime was given under section 150 BAC. Clear? It was called old and new. Old and new. But now the name has been changed. Whatever was old now has become optional scheme. Optional scheme, and whatever new was there has become default scheme. So default scheme is under same section 150 BAC one. Section, conditions and all almost same. Rates also they have changed little bit, but the schemes, names and all has been changed, guys. So now default scheme means everyone is understood that you are following default scheme under section 150 BAC. Here the rates are kept lower, but you have to forego certain exemptions and deductions. So automatically your total income will get pushed up to a higher level, but tax rates are kept lower. If you don't want to follow this, then you can opt out of default regime and follow optional regime. Optional regime is as per regular provisions. Optional scheme we will also call it as regular provisions. Okay. So in that case, you can opt out of default scheme and follow optional scheme, where the rates are kept little higher, but you can follow, you can claim all the exemptions and deductions. You are free to claim all the exemptions and deductions. This is one of the change, guys. Please make a note of it. So before I start with rates also, we'll just discuss the format once. Yeah. Format for computing the tax liability. First we will check. Tax is always calculated on which figure? Tax is always calculated on total income. Tax is always calculated on total income. So from total income, first we should check whether there is any special income. And if there is special income, they will definitely highlight that in the question. If nothing is given, we will assume the entire total income is a normal income. So total income, if at all, if there is any special income element in that, we will segregate it, and normal income separate. Okay, sir. Special income is taxable at special rate. First calculate tax on it, and normal income is taxable at normal rates. Okay. So tax on special incomes at specified rates, that is as per section 111A or 12 or 112A or 115BB respectively. and tax on balance income or normal income at either slab rate or flat rate depending upon the category of the person plus scheme opted by them. Okay. Once we calculate both, we get something called as gross tax liability. Gross tax liability. Then from that we will reduce the rebate. If at all, this is available only for resident individuals whose total income is within certain limit. If at all, if a person is eligible for it, we will reduce it. How much ever is eligible to claim. Then we will get tax liability after rebate. Then if at all, if surcharge is applicable. Surcharge is applicable only if the total income is crossing certain limit. Like 50 lakh, 1 crore, 2 crore, 5 crore, 10 crore and all. Yes. So, but please be careful. In the format, I have given both rebate and surcharge, but both will simultaneously not work. Either of the two will be there because rebate is available only if your total income is within 5 lakh or 7 lakh. Whereas surcharge is applicable only if your total income is more than 50 lakh, 1 crore, 2 crore, 5 crore, 10 crore like that. Clear? Both for the same person simultaneously cannot be there, guys. As the format I have given it here, that's all. Okay. So surcharge, if at all if it is applicable, it will always be calculated on gross tax liability at whatever rate. Gross tax, not on total income. Please be careful. Then you will get tax liability after surcharge. On that always 4% cess would be there. 4% health and education cess would be there. If at all if surcharge is there, 4% will be applied on this figure. No sir, surcharge is not there. Then 4% will be applied on this figure. Clear? Sir, I am eligible for rebate. I am eligible for rebate, and after rebate, still some positive figure is there, sir. Still some positive figure is there. In that case, 4% cess has to be applied on this figure. 4% cess has to be applied on that figure. Clear? But please remember, as a format, don't get confused. Rebate and surcharge cannot be applicable simultaneously to the same person in the same year. Okay, so final tax liability, and this final tax liability should always be rounded off to the nearest 10 rupees, guys. Nearest 10 rupees as per section 288B. Okay, now let us go back to the rates. Very important, so please be attentive, and I am very sure that the questions would be asked on this in the exams, guys, because this is very, very important for this attempt. On any of this tax calculations, whatever we will discuss now. Income taxable at normal rates or gross rate or base rate, we will call it as. Individuals HUF, AOP, BOI and artificial juridical person. Guys, previously 115 BAC was eligible only for individual HUF, but now they have made it open for all the slab rate associate. That is, who and all can follow 115 BAC? Individual, HUF, AOP, BOI and artificial juridical person. In simple, I call them as slab rate associate. Can pay tax at concessional rates under the default tax regime under section 150 BAC. Please try to remember the section also. Because in the question, sometimes they will mention the section. When they mention the section, you should understand whether it is default or optional. And for optional, there is no specific section, guys. We call it as the regular provisions. However, they have to forego certain exemptions and deductions under this regime. Okay, which we will cover head-wise. Okay, under each and every head, we will see if the person is following the default regime, what he has to forego. Oh, so if you are following a default regime under section 115 BAC, yes, tax rates are kept lower, but you have to forego certain exemptions and deductions. The list of that exemptions and deductions, we will be covering it head-wise, guys, the particular head. Alternatively, sir, this is the ultimate option? No. Alternatively, they can exercise the option to shift out of default tax regime and pay the tax under the optional tax regime as per the regular provisions of the Act, which we call it as optional tax regime or regular provisions, one and the same. So what are the tax rates? Default tax regime under section 115 BAC of the Income Tax Act 1961. Any individual, whether they are resident or non-resident, residential status doesn't matter here, age doesn't matter here. Every HUF, AOP, BOI, artificial juridical person, if their normal income means special income taxable at special rate, so total income, in total income we will take only normal income element up to 3 lakh. Up to 3 lakh, basic exemption limit, nil. 3 lakh to 6 lakh, 5%. 6 to 9 lakh, 10%. 9 to 12 lakh, 15%. 12 to 15 lakh, 20%. More than 15 lakh, 30%. Easy to remember, guys. For every 3 lakh increase in the income, tax rate will increase by 5%. But there is no 25% slab here. There is no 25% slab here. Straight away above 15 lakh, 30%. Clear? Yes. And its slab rates, please be careful. Assume my income is 20 lakh. How do we calculate the tax? Up to 3 lakh, nil. 3 lakh to 6 lakh, 5%. So 3 lakh into 5%, 15,000. Let me just quickly show that roughly. I hope you guys would be already aware of all this. Nil. Then 3 lakh to 6 lakh. The difference between the upper limit and lower limit is 3 lakh into 5%, 15,000. 5%. Then 6 lakh to 9 lakh. Again, the difference between the upper limit and lower limit is 3 lakh. Taxable at 10%, 30,000. Then 9 lakh. All these are more than 9 lakh to 12 lakh. 15%. Again, 45,000. 3 lakh into 15%, guys. 12 lakh to 15 lakh. 20%. 60,000. Then more than 15 lakh. 30%. How much I told? 20 lakh. Huh? Total income 20 lakh. Whenever they cast the tax calculation, if the question is not mentioning anything about special income, consider the entire total income as normal income. Okay, 20 lakh. Entire 20 lakh we are assuming as normal income, guys. So 20 minus 15 lakh into 30%. So 5 lakh into 30%. 1 lakh 50,000. 1 lakh 50, 1 lakh 50. 3 lakh. Clear? Sir, is surcharge applicable? No. Okay, as of now we are not covered, but still when it is 20 lakh, surcharge is not applicable. So on this we have to add 4% cess and pay it to the government, guys. That's all. This is how we apply slab rates. So this is for which scheme? Default scheme. Please remember the rates under both the schemes, guys. And always know the difference between both also, so that it would be easy for you to recall quickly. Yeah. Tax rate prescribed by Annual Finance Act under optional tax regime. Optional tax regime, regular provisions of the act, everything remain one and the same. So please don't get confused. Any individual, whether resident or non-resident, every HUF, EOP, BOI, artificial juridical person, if their total income, in which normal income is up to 2,50,000, nil, 2,50,000 to 5 lakh, 5%, 5 lakh to 10 lakh, 20%, more than 10 lakh, 30%. But here, these two are additional under optional scheme. This is not there under default regime. Please be careful. If an individual is a resident who is aged 60 or more, whom we call senior citizen, okay, he has reached 60, great, senior. So in that case, instead of 2,50,000, what is the basic essential limit? 3 lakh. All other things remain same. Sir, what if the person at any time during the previous year, he has reached 80? He cannot be both, guys, either 60 or more, less than 80, or 80 or more. Okay, so 80 or more, sir, at any time during the previous year. In that case, the basic essential limit is 5 lakh. No first slab. No first slab. Here 5% slab is not at all there. So that means, sir, what if their income is 4 lakh 80, 4 lakh 50 and all, they need not pay tax, they need not even file the returns. Okay. Now, sir, reaching 60 or 80 when, sir? Anytime during the previous year. Anytime during the previous year, if you are celebrating your 60th or 80th birthday, you are eligible for higher basic essential limit under optional regime. But, sir, what if I am celebrating my 60th or 80th birthday on 1st April of assessment year? 1st April of assessment year. Still you are eligible. Still you are eligible because you would have completed 60 or 80 on 31st March. This is the clarification given by CBDT. Clear? Yes. Sir, now I have celebrated my birthday, 60th birthday, assuming. Okay, not now, somewhere in future. 1st April of the assessment year, you celebrated your 60th birthday. 60th birthday. Now income tax department told, no, you are following optional scheme means you have to pay tax over and about 2,50,000 and that. Now circular is there. Can you make use of it and tell the department? Can you take the advantage? Yes. Is it binding on you? No. On whom? Department. But if they are not following it, can you make an advantage of it? Yes. Sure. Next. So this is for slab rate assessee, guys. Whatever we saw till now was for slab rate assessee. Now, sir, please be careful. One major difference is this thing is there only under optional regime. Under default regime, irrespective of your residential status, irrespective of your age, rates remain same. Basic essential limit is 333. That's all. The tax rates applicable for other categories of assessee are as follows. Firms, LLP or local authority, flat rate of 30% on the total income except special income, guys, means normal income. Okay, all this, whatever rates we are discussing is normal rate, which is always applicable on what? Normal income. Then companies, different categories are there. Two categories of company for income tax purpose, domestic and foreign. Sir, we are aware about other companies and all in company laws, sir, public company, private company, one person company, small company. for income tax, domestic, foreign. Clear? For rate purpose. Foreign company means 40% straight away. 40%. Whereas Indian company or domestic company, they have an option. They again have an optional scheme. No default and all for them. Please be careful. Optional. So they have two optional schemes. BA also is there, which is not so relevant. So I am covering only BAA and BAB. If they have opted for BAA, then tax rate is 22%. If they have opted for BAB, which is available only for domestic manufacturing company, which has registered on or after 1st of October 2019, but before 31st March 2024, which is already closed now, end of our previous year. Okay, then the rate is 15%. But if they are following any of this optional scheme, they have to forego certain exemptions and deductions, guys. They have to make some sacrifices. Okay, no sir, we are not ready to make any sacrifices. Then you can follow regular scheme, not optional scheme, regular scheme. Clear? So in that case, what is the tax rate, sir? Check whether you are a small company or big company. That depends on your turnover in the year 21-22. We are checking what? Tax rate applicable for domestic company in the previous year 23-24, which depends on your turnover in 21-22. If it is more than 400 crore, you are considered as big company, pay tax at 30%. No sir, it is less than or equal to 400 crore, then it is 25%. Then it is 25%. So for domestic company, it is always like this. First check whether they are following optional scheme or regular scheme. Clear? So for optional scheme, they have two choices. Actually three. BA, but BA is not so relevant, so I am just ignoring it. 115 BAA or 115 BAB. So here the tax rates are kept lower, but they have to make certain sacrifices. Sir, no sir, they don't want to follow this regular scheme. In that case, check their turnover. Turnover of financial year 21-22. More than 400 crore or less than or equal to 400 crore. So less than or equal to 400 crore means what is the tax rates, guys? Come on, 25%. Here it is 30%. Here it is 30%. Is that clear? Yes, that's all. So please be careful. Only when they are not opting for optional scheme, we will check this. If not, whatever is the rates under the respective optional schemes, which is BAA 22, here it is 50. BA means 25%. 115 BA means 25%. Next, cooperative society. Cooperative society up to 10,000, 10%. Income. Okay, up to 10,000, 10%. 10,000 to 20,000, 20%. Above 20,000, 30%. Even for cooperative society, they have some optional scheme. What are those, sir? Tax rate in case of manufacturing cooperative society. Manufacturing cooperative society. Resident in India means they should be resident as well as engaged in manufacturing. Set up and registered on or after 1st April to 2023 and commences manufacture of an article or thing before 31st March 2024. Opting for concessional tax regime means optional regime under section 115 BAE. BAE. Then what is the tax rate? 15% of the income derived from or incidental to manufacturing or production of an article or thing, means whatever income they have earned from their manufacturing activities, 15% is the tax rate on it. 15% is the tax rate, guys. Okay. Sir, what? They are resident cooperative society but not engaged in manufacturing. Then they have one more optional scheme under section BAD. BAD. 115 BAD. What is the tax rate? 22%. 22%, guys. Now, cooperative society resident in India can opt for concessional rate of tax under section BAD or BAE. What do we call it as? Optional scheme. But subject to certain conditions. Means they also have to forego certain exemptions and deductions, guys. So please be careful. Only for slab rate assessee we call it as default and optional. Default and optional. Whereas for domestic company and cooperative society, that is resident cooperative society to be very precise, we call it as optional and regular scheme. Optional and regular scheme or regular provisions. Next, we are done with normal income, the tax on the same. Guys, the tax on normal income always depends on the which scheme you are following. Whereas the special income, whoever is having it, and whichever scheme they are following, the rate will always remain same. The rate will always remain same. Guys, whenever question is specifically mentioning about it, consider it. If not, consider the entire income as the normal income. So, capital gains, special incomes. What are those, sir? Long-term capital gains. Pay attention, again important. Long-term capital gain on the transfer of equity shares, unit of equity oriented fund or unit of business trust. In short, I call them as EFT. E stands for equity shares, F stands for equity oriented fund, F, and T for trust, that is units of business trust. So if you have any long-term capital gain on the transfer of any of this EFT, then it is covered under section 112A. The tax rate is 10% in excess of 1 lakh. In excess of 1 lakh means up to 1 lakh it is not taxable. In excess of 1 lakh, 10%. But guys, please be careful. Sir, I have long-term capital gain on the transfer of equity share 1,50,000. Entire 1,50,000 has to be included under the head capital gains to compute total income. But while calculating tax, we will reduce 1 lakh. So please be careful. 1 lakh, don't reduce it while computing the income. You have to reduce it while calculating the tax. Clear? Sir, what if my long-term capital gain on the sale of equity share is only 80,000, 70,000, 50,000? Include it in your income. But while calculating tax, 0. On that particular, I'm not telling your entire tax is 0. On that long-term capital gain, it is 0. Next, sir, what if it is on any other asset? I have long-term capital gain on the transfer of any other assets, or land, building, gold, anything. In that case, it is covered under section 112. The tax rate is 20% on the entire amount. Observe the word entire amount. No 1 lakh deduction and all here. Clear? And under section 112, there is something without indexation, with indexation and all. Those things are not so important. Whenever there is any long-term capital gain on the transfer of any other asset, if question is silent, always apply 20% guys. Sir, what if the question they have given only long-term capital gain? They have not mentioned the asset. Please consider under section 112. Consider it under section 112 guys. Next, short-term capital gains. Again, on the transfer of EFT. Long we saw, now short. Short-term capital gain on the transfer of EFT. Again, special income covered under section 112A, taxable at 15% on the entire amount. On the entire amount. Here also don't reduce 1 lakh and it is special income. And for both of these guys, 112A as well as 111A, condition is securities transaction tax has to be paid. This three, this and this is always special. Sir, what if there is any other short-term capital gain on the transfer of any other asset other than EFT, like land, building, gold? Is this special? No, it is normal. Taxable at normal rates. Taxable at normal rates, guys. So please be careful. This is not special. This is not special income. Clear? Yes. So there is no special rate applicable on it. Next, section 115BB, we call it as casual income. Winnings from lottery, crossword puzzle, race, including horse race, card games and other games of any sort. Gambling or betting of any form or nature. What is the tax rate? 30%. We call it as casual income. Then 115BBJ, winnings from online games. A new section added, new section. BBJ, winnings from online games. It is also casual. Tax rate is same, but now they have made it as a separate section, guys. So what is the tax rate, sir? 30%. Same. So please be careful against this special incomes. Which are those special income? Please be careful. This is not special. Okay. Capital gains 3 are there plus 2 casual incomes are there. You cannot claim any chapter 6A deductions. You cannot claim any chapter 6A deductions. Please pay attention. All these are some key important points. You cannot claim chapter 6A deductions against special income. Any special income. Yes, sir. Listen. Sir, can I adjust my loss? Can I adjust my loss? Yes. Against capital gains, you can adjust. Long-term loss can be adjusted against long-term gain. Short-term loss can be adjusted against short-term gain or short-term loss can be adjusted against short-term gain or long-term gain. Clear? Yes. Now, sir, against casual income, can I adjust any loss? No, you cannot adjust any loss. Sir, can I claim any expenditure? No, you cannot claim. Against casual income, there is a stringent rule. You cannot claim any expenditure. You cannot adjust any loss. You cannot claim any chapter 6A deductions. You cannot claim any chapter 6A deductions. One more important thing. So you can see some examples also I have given, Dream 11 and all. You guys, some of you will be knowing it. Now, important guys, again important. Now listen. Sir, I am a resident individual. I am a resident individual. My normal income is less than basic exemption limit. There is a shortfall or unexhausted basic exemption limit. Can I adjust it against special income? Yes, only against capital gains special income. Only against capital gains special income. This is available only for resident individual and HUF. For example, listen here. So assume I am following optional scheme. What is the basic exemption limit applicable for me? 2,50,000. Less than 60 guys. I am less than 60 for your information. Okay. So 2,50,000 is the basic exemption limit. Assume my total income is 10 lakh. In that 112 is 8 lakh. Normal income is 2 lakh. So 112 means tax rate is 20% up. Yes sir. Now normal income is 2 lakh. Taxable at normal rate. But what is my basic exemption limit? 250. So my normal income is less than basic exemption limit. So there is a shortfall of how much? 50,000. Sir, can I adjust it against my special income? Yes, you can adjust only if you are resident individual and HUF. So here I am a resident individual. So can I adjust it? Yes. So 7.5 lakh is taxable at 20%. Is taxable at 20%. Sir, what if I have 2-3 capital gain special income? You can adjust. You can decide the order. So obviously whichever is higher rate, you try to adjust for it. For example, assume my total income is 10 lakh. I have long-term capital gain under section 112 5 lakh. Short-term capital gain under section 111A 3 lakh. And normal income 2 lakh. Normal income 2 lakh. So what is my basic exemption limit? Again optional scheme only, age less than 60. So 50,000 is my shortfall. Now you tell me, against what should I adjust? 5 lakh or 3 lakh? Should I adjust it against 5 lakh or 3 lakh? Which is taxable at higher? Both are capital gains income. I am a resident individual. Am I eligible to set off? Yes. So against what will I set off? 5 lakh or 3 lakh? 5 lakh would be better option. Beneficial. Why? This is taxable at 20%. So try to take maximum benefit. In the act, there is no strict order here. So we have to choose it. So we have to choose in such a way that it will maximum my benefit. So try to adjust here as it is taxable at 20%. Remaining 4.5 lakh taxable at 20% and 3 lakh 15%. And 3 lakh at 15%. Sir, what if I had along with this 112 also? There in excess of 1 lakh is taxable at 10%. So try to keep it at last. Try to keep it at last guys. If at all, if you still have shortfall after adjusting against 112 and against 111A, only then you go and adjust it against 112A. This is all about the special incomes. Now coming to rebate. Again, rebate is very important for this time. Rebate from income tax to a resident individual. It is available only to a resident individual. Resident individual. Please be careful with it. Okay. Sir, I am an individual but non-resident. Not eligible. Then, sir, I am a resident but HUF or AOP, BOI. Am I eligible? No. Rebate under section 87A is available only to a resident individual whose total income is below certain limit. Rebate to a resident individual paying a tax under default tax regime under section 115 BAC. If total income of such individual does not exceed 7 lakh. Optional regime. Very important change. Previously it was different. Now they have made change. Rebate to a resident individual under default regime. If the total income of such individual does not exceed 7 lakh, means up to 7 lakh, the rebate shall be equal to 100% of his tax liability or 25,000, whichever is less. Maximum 25,000. Sir, what if my total income is more than 7 lakhs? Still eligible. Means marginally more than 7 lakh. Marginally more than 7 lakh. If total income of such individual exceeds 7 lakh, the rebate would be still available as follows. We have to check the steps. Step 1, total income minus 7 lakh. We will give a notation here. Then compute total income on, tax liability on total income. Whatever is your tax liability on the entire total income. Okay, give a notation B. If B is more than A, that is B minus A is a positive figure, means yes, to that extent of difference, you will be eligible for a rebate. So simple guys. Under default regime, if the total income is up to 7 lakh, always eligible for rebate. If it is more than 7 lakh, if it is marginally more than 7 lakh, you are eligible. So how to check it? You have to apply the steps. But I have a shortcut for you. You check only if the income is within 7,28,000. If the total income is more than 7,28,000, even if you apply the steps, you will get rebate 0. You will get the rebate 0. This is a shortcut. It is not mentioned in the law. You don't explain this in your answer and all. Okay, just keep it in your mind to check the rebate availability. Clear? Yes. I will just show you the calculation, guys, because some of you might get confused with it. Yeah, quickly. Guys, see, Raghav is an individual, aged 26 years, resident in India. Total income 6,50,000 is following default regime. So is he eligible for a rebate? Yes, sir. So let us see how to calculate rebate. Don't simply write tax liability is nil. Thank you. They will also tell thank you. Up to 3 lakh, nil. Basic exemption limit. Then 3 lakh to 6 lakh, 5%. So the difference is 6 lakh minus 3 lakh, 3 lakh into 5%, 15,000. Then 6 lakh to 9 lakh, 6 lakh to 9 lakh, 10%. But here, total income of the individual is only 650. So we will stop it there only. 10%. So 50,000 into 10%, 5,000. What is this gross tax liability? 20,000. Then rebate, is he eligible? Yes. How much, sir? Actual tax liability or 25,000, whichever is lower. Actual tax liability is 20 or 25, whichever is lower. 20. 20,000. So you will pay nil. When is tax after rebate is nil, don't add 4% cess and all. 4% of 0 is 0. Clear? And sir, shall I show, sir? Add health and education cess 4%, nil. Final tax liability, nil. If you have time, you do whatever you want. But definitely you will not have so much time in the exam hall. Don't waste your time. Hope you guys got it. Next, that 7 lakh thing we will check. Sir, Pawan, age 35, resident, catch the points whenever they have given some clue. And total income is 7,50,000. Marginally more than 7. Okay, is following which scheme? Default. Okay. Total income is in excess of 7 lakh. How much? 15,000. That is total income minus 7 lakh. Total income minus 7 lakh. Then tax on total income. What is total income? 7,15,000. So do it as a working note. Up to 3 lakh. Then 3 to 6. Then 6 to 9. Good. Already you are done. You are so telling it. So 6 lakh to 9 lakh 10%. But here total income is only 7,15,000. So we'll stop it there. So 1,15,000 into 10%. So gross tax liability is 26,500. Clear? Now rebate we will not reduce it here only. So 26,500. 26,500. Tax on total income. So give a notation A and B. So B minus A. Sir, B is more than A na? Yes. If B is more than A only, they will be eligible. Sir, if by chance A is more, sir, that means you are not eligible. That means your total income would have been more than 728. If you can take any random number, 7,50,000 you take and try it out. You will get A more than B. Clear? Yes. Okay. So now 26,500 I will take. From that, am I eligible for rebate? Yes, sir. How much, sir? Difference. Calculate. 26,500 minus 15,000. 11,500. Good, sir. So the difference is again 15,000. On that 4% cess. And when this figure is positive, calculate the cess. Don't stop it there only. 600. So final tax liability is 15,600, guys. 15,600. Please be careful. I feel somewhere this is very important because this is one of the major change under the Finance Act 2023, guys. This was not there before. This marginal thing. Marginal relief is different. This is different. Next, sir. No, sir. I don't want this 7 lakh and all. I am following optional scheme. So in that case, am I eligible for rebate? Yes. If total income of such individual does not exceed 5 lakh, up to 5 lakh. the rebate shall be 100% of the tax liability or 12,500, whichever is lower, half of it. 25, here 12,500. Clear? Yes. Whichever is less. Sir, here marginal thing and all is applicable? No. If your total income is only up to 5 lakh, you are eligible for rebate. Sir, my total income is 5 lakh 1,000, sir. You should start paying tax from 2 lakh 50. You should start paying tax from 2 lakh 50. If by chance you are a resident, senior citizen and all, then up from 3 lakh. Then, some important notes. Notes common for both. The amount of rebate under section 87A shall not exceed the amount of income tax, gross tax liability on the total income of the assessee. So the amount of rebate under section 87A shall not exceed the amount of income tax, that is actual tax liability or limit, guys, either 25,000 or 12,500, whichever is lower. Rebate shall be computed before health and education cess. Always please be careful with it. Then rebate under section 87A is not available in respect of tax payable at 10% on long-term capital gains taxable under section 112A. Only against this tax. Only against this tax, rebate is not available. Even though your total income is less than the limit, still you are not eligible for a rebate. Only against this tax. For example, listen, I am following default scheme, guys. My age and all doesn't matter. I am a resident individual. Okay. My total income is 6,80,000. Am I eligible for rebate? Resident individual whose total income is 6,80,000. Am I eligible? Yes. Let me give a breakup now. Long-term capital gain under section 112A. How much you want? Okay. Your request 4 lakh. Then normal income 2,80,000. 2.8 lakh. Now interesting calculations are there. Take care. Listen. First, what is the basic exemption limit? Hey, we are under which scheme? 2.5 and 3 lakh. So what is the shortfall? 0.2 lakh. Hey, under default regime, what is the basic exemption limit? What you want to confirm with that? I am there, my here. Listen. Shortfall 0.2 lakh or 20,000. Now, sir, can I adjust this against long-term capital gain? Yes. So, I will minus 0.2 lakh. So, how much is left? 3.8 lakh. 3.8 lakh. So, on this, I am supposed to pay tax? Yes. How much? Minus 1 lakh. Minus 1 lakh. 112A? Yes. So, remaining is how much? 2.8 lakh. 10%, 28,000. My gross tax liability is how much? 28,000. Can I claim any rebate? No. Why? It is 112A tax. Complete tax is 112A. Clear? Can I claim? No, sir. So in that case, I have to add 4% and pay to the government. Interesting, huh? Yes. Next, we'll change the scenario. Total income. I am following default scheme. I am a resident individual. Who am I, Sarvesh? Resident individual. What is my total income? 6,50,000. Long-term capital gain under section 112A is 3 lakh will take. Thank you for suggestion. Normal income 3.5. Here I will take 3.5 lakh. Okay, sir. So here basic exemption limit I am reducing, remaining 50,000, 0.5 lakh into 5%. 50,000 is taxable at 5%. So 2,500. Okay, normal tax. Coming to special. So 3 lakh minus 1 lakh, which is 2 lakh on that 10%, guys, which comes to 20,000. So, sir, what is my gross tax liability? 22,500. Sir, am I eligible for rebate? Yes, I am eligible. My total income is less than 7 lakh. How much rebate I can claim? How much rebate I can claim? 25,000 or actual tax liability, whichever is lower. But here, restricted to 2,500. 2,500. Sir, 25 no, sir. Against this, you cannot claim rebate. Against this tax, you cannot claim rebate. Even though your total income is less than 7 lakh, you are eligible. But against this, you cannot claim. Clear? So that means you can claim only maximum 2,500. So remaining is 20,000 plus 4% cess we have to pay to the government. Clear? Sir, what if the person's total income is 6 lakhs, sir? He is following default scheme, sir. He is a resident individual, sir. He has only entire income is long-term capital gain under section 112A, sir. Entire income is 112A. You guys quickly tell me how much tax he has to pay. Quickly, tuck. 112A. Huh? 50,000. Any other answer? Simple maths, guys. How much tax should he pay to the government? How much tax should he pay? Okay, I will only tell. Now, entire total income is in special income. Long-term capital gain under section 112A, 6 lakh. So, normal income is 0 na. So, shortfall is how much? 3 lakh. Shortfall is 3 lakh. So, can I adjust shortfall here? Yes. So, remaining is how much? 3 lakh. In 3 lakh, 112A, 1 lakh we have to reduce. 1 lakh. So, how much is left? 2 lakh. On that, what is the tax? 10%. How much it comes to? 20,000. So, rebate he can claim? No. 4% cess. How that is to us. Clear? So, after seeing this, no one will imagine so many things will be there. I will explain. So, I will repeat once again. Default scheme, I am following, plus I am a resident individual, total income is 6 lakh, entire 6 lakh is a long-term capital gain under section 112A. Yes, sir. And normal income is 0. What is the basic essential limit for me? 3 lakh. Entire basic essential limit is a shortfall? Yes. I am a resident individual. Sure. Can I adjust my shortfall against capital gain special income? Yes, I can adjust. I am eligible for it. So, shortfall, first I will adjust against capital gain special income, 3 lakh. So, how much is taxable now? 3 lakh. But as per 112A, up to 1 lakh it is not taxable? Yes. We will reduce that 1 lakh also? Yes. So, how much is left? 2 lakh. 2 lakh is taxable at what rate? 10%. What is the amount? 20,000. Can I claim rebate against it? No. Plus 4% we have to pay to the government. Plus 4% we have to pay to the government, guys.
So, if the long-term gain is from other sources, other tax, like 112, then we can claim rebate.
Yes. So, if the tax is on any other capital gains like this or this one, can we claim rebate, sir? Yes. So, against casual income tax also can we claim rebate? Yes. Rebate is available, but you cannot adjust any loss, you cannot claim chapter 6A deduction, you cannot claim any expenditure. Clear? But on the tax which you are paying on casual income, you can claim rebate. You can claim rebate. Guys, one more thing, one more important thing. Against casual income, you cannot even adjust basic essential limit. You cannot even adjust basic essential limit. So, for example, sir, I am a resident individual following default scheme. I have casual income straight away 4 lakhs, sir. What is the tax I have to pay? 4 lakh into 30% straight away. 4 lakh into 30%, 1.2 lakh. Clear? Sir, basic essential limit, I can adjust shortfall? No, that is only against capital gain special income. Casual income will always be taxed at a flat rate of 30%. But sir, can I claim the rebate here? Yes, you can claim the rebate under section 87A. As I am following default scheme, what is the maximum rebate? 25,000. Remaining 95,000 plus cess I have to pay. So please be careful. Even though casual income as well as long-term capital gain special incomes, both are special, but there is some differences between both. I will quickly repeat this, guys. Listen. All these are special. What is the tax rates we know? What is the section is covered we know. Sir, if there is any unexhausted basic essential limit or if there is any shortfall for resident individual and HUF, can they adjust it against any special income? No. They can adjust it only against capital gain special income. Only against capital gains income, special income. That too only available for resident individual and HUF. Sir, I am a non-resident. Am I eligible for it? No. I am a company, partnership firm, and for you guys flat rate. Why are you worried about basic essential limited? Clear? Yes. Next, sir. Against this special incomes, can I claim any Chapter 6A deductions? No. Against any special income, you cannot claim Chapter 6A deductions. Okay. Then, against casual income alone, you cannot claim any expenditure, you cannot adjust any loss, you cannot even adjust your basic essential limit. Straight away, entire gross income is taxable at 30%. Is taxable at 30%. Okay. Next. Against long-term capital gains or short-term capital gains, sir, can I adjust any loss? Yes, you can adjust each other. Short-term loss can be adjusted against short-term gain or long-term gain. Long-term loss can be adjusted only against long-term gain. But assets can be different. But gain has to be in the same nature. Yes, guys. And please be careful, rebate is not available only against 112A tax. Against any other tax, rebate is available. Yeah, surcharge. Again, one more important thing, surcharge not applicable always. Only if your total income is crossing certain limits, it would be applicable, guys. It would be applicable. So when is it? Surcharge is an additional tax payable over and above income tax. It is a part of income tax only, but it is calculated on gross tax calculation. Surcharge is levied as a percentage of income tax. So please be careful, guys. Surcharge, whenever it is applicable, it is always calculated on what figure? Gross tax. Clear? Not on income. Gross tax, yes, we will calculate on income, but surcharge is always on gross tax. Okay. Category of person. Individual HUF, AOP, BOI and artificial juridical person pays tax under default tax regime. If their total income is up to 50 lakhs, no surcharge. More up to includes in exactly equal to 50 also, no surcharge. More than 50 lakh but up to 1 crore, 10%. More than 1 crore but up to 2 crore, 15%. More than 2 crore, 25%. Please be careful, here 37% is not there under default regime. It is only under optional. Okay, sir. And please be careful, this is flat rates. Sir, my total income is 2.2 crore, sir. In that case, straight away it is 25%. It is not like up to 50 nil, 50 to 1 crore, 10%. No. Here, yes, it is given like slab, but when it is applicable, flat we have to apply. Clear? Yes. Next, same category of assessee, that is slab rate assessee, if they are following optional regime. In that case, up to 50 lakh, nil. More than 50 lakh, up to 1 crore, 10%. More than 1 crore, up to 2 crore, 15%. And more than 2 crore, but up to 5 crore, 25%. And more than 5 crore, 37% extra here, which is not there under default. Please be careful. One of the highlight point between optional and default. Guys, when we are checking here, we have to take total income, entire total income. Whether it includes special income or normal income, we don't care. We have to take total income. If total income is more than the certain limit, then surcharge would be applicable at the respective rate. Then, other assessee. For the partnership firm, LLP, local authority, if the total income is more than 1 crore, always 12%. More than 1 crore, any amount, 12%. Then for foreign company, if total income is more than 1 crore or up to more than 1 crore up to 10 crore, 2%. More than 10 crore, 5%. Sir, total income of the foreign company is 15 crore, straight away 5%. No slab rate and all, straight away 5%. Okay. Domestic company or a cooperative society, total income is more than 1 crore and up to 10 crore, 7%. More than 10 crore, 12%. Sir, what if the total income of a foreign company or domestic company less than 1 crore? No surcharge. No surcharge. But in case of a domestic company who is following optional scheme under section 115 BAA or BAB or cooperative resident cooperative society following the optional scheme under section 115 BAD or BAE, always for them surcharge would be applicable at the rate of 10%. Always surcharge would be applicable at the rate of 10%, guys, irrespective of their income. Sir, they have only 1 lakh income, sir, 2 lakh income, sir, 10% is the surcharge. Clear? Here 1 crore, 10 crore limit and all is not applicable. Then, for AOP consisting only companies as a members, AOP which is having only company as a member, no other person. Sir, what if they are having any other person as a member? Then they will fall here. They will fall here. So AOP having only members as a company. Whoever is the members of AOP, they are only companies. Whichever company, domestic, foreign, doesn't matter. In that case, whether they are following default or optional, doesn't matter. If their total income is up to 50 lakh, no surcharge. More than 50 lakh up to 1 crore, 10%. More than 1 crore, it is 15%. Any amount, more than 1 crore, any amount, 15%. So please be careful. This is one of the difference between optional scheme and default scheme is there, guys. Up to 25% actually same only. But here there is no higher limit. Up more than 2 crore always 25%. But here more than 2 crore up to 5 crore 25. More than 5 crore 37. That is one of the major difference. Then health and education says whenever your tax liability is there, health and education says will always be applicable at 4%. No if or but. If or but is there only for surcharge and rebate. Clear? So it is not conditional always. The amount of income tax as computed including surcharge thereon shall be increased by health and education says at 4%. And total income should always be rounded up to nearest to 10 rupees as per 288A. And as per 288B, final tax liability has to be rounded up to nearest 10 rupees. Please be careful here. Total income, not sir. We will calculate income under each head now. We will round up. No, total income. That is, after aggregating the income under each head, we get gross total income. From that, we will claim chapter 6A deduction. After that, we get total income. That figure has to be rounded off. Clear? And if you have confusion between 288A or 288B, which will come first, income or tax? Income. Only when you have income, you can calculate tax. So 288A, rounding off of total income. 288B, rounding off tax liability and final tax liability. That means this figure. This figure, guys. So we have discussed tax calculation format already. So please be careful with the same. Next, partial integration of agriculture income with non-agriculture income. That is, when the same assessee has both agriculture income as well as non-agriculture income, there is no change in the rates and all. Only the format they are changing it. Clear? Means they are just trying to push you to a higher slab. And is it applicable always, sir? No. It is applicable only to individual HE of AOP, BOI or artificial juridical person who simultaneously have both net agriculture income more than 5,000, agriculture income more than 5,000. Net means what, sir? Sales minus expenses. Okay, means your income. And non-agriculture income means normal income or taxable income, what we call, is more than basic essential limit. Whatever is the basic essential limit applicable for you. If you are following optional scheme, 2 lakh 50, 3 lakh or 5 lakh. If you are following default regime, 3 lakh. If your non-agriculture income is more than basic essential limit, only then this aggregation is applicable. When aggregation is applicable, what should we do, sir? First, add up both. Agriculture income plus non-agriculture income. Non-agriculture income is nothing but total income, guys, which is taxable. Clear? Agriculture income plus non-agriculture income, total of both. Please don't call this as total income. C is not total income because total income will not include the exempt income. Agriculture income is an exempt income. Okay. So total of A plus B. So tax on that at applicable rates. At applicable rates. Whatever is the rate applicable to the assessee, slab rate assessee, either optional scheme or default rate, apply that and calculate. Okay. We are done till here. First step. Next, second step. A, that is agriculture income plus basic essential limit as applicable for the assessee. Either 2 lakh 50 or 3 lakh or 5 lakh, whichever. Okay. So agriculture income plus basic essential limit. Calculate tax on that at whatever rate applicable to the assessee. Okay, sir. Second step done. So now what we have to do? Net tax payable. That is whatever tax we have got here and whatever tax we have got here. So we are doing what? T minus F. That is tax on the total figure minus tax on agriculture income plus basic essential limit. Clear? We are reducing it. Means ultimately they are not telling you are literally not paying tax on agriculture income. Clear? But somewhere they tried to push you for a higher slab here because they added both na, and here the tax amount will go up. Clear? Yes. So net tax payable is D minus F. So that is nothing but this minus this. Okay. So next, the calculation continues, which is same. Third step is almost same, guys, whatever we have discussed. Rebate only if non-agriculture income is within the limit. What is non-agriculture income? Total income. If it is within 5 lakh or 7 lakh, you are eligible for rebate. Okay. Then surcharge only if non-agriculture income is more than specified limit, like 50 lakh, 1 crore, 2 crore, 5 crore and all. Okay. Then health and education cess will always be there for, and this two will not simultaneously come. Please be careful. As a format I have given everywhere. Clear? Okay. Health and education cess 4%. Then final tax payable would be whatever figure we get. That is what they have to do. Means ultimately we will not pay tax, but on agriculture income. We will not pay tax on agriculture income, but we may end up paying little more tax. Yeah, yes. Then marginal relief, the last point in this chapter, guys. Marginal relief. It is applicable in case of all the assessee where surcharge is applicable. But is it applicable always? No. Only if your total income is marginally more than the specified limits which are applicable for surcharge. Only then check relief, guys. Even, sir, I have a doubt whether relief is applicable or not. Apply it. If relief is available, you will get it. If not, you will get it as 0. That's all. Okay, you will spend little more time. Clear? And you keep some percentage gap, guys, like 8 to 10%. Clear? So if your total income is crossing the limits by within 8% or 10%, apply relief and check it. Sir, no sir, it is much more. For example, my total income is 70 lakh or 1 crore 50 lakh or 2 crore 80 lakh and all. In that case, the difference is huge. Don't check the relief. Even if you check, you will get it as 0. Okay. Marginal relief has to be checked only when total income is marginally more than 50 lakh or 1 crore or 2 crore or 5 crore or 10 crore. That is the limits what we call, guys. So here again important. So there are 3 steps to be followed here. Total income we will take, on that calculate tax. So tax means again same format. Special income if at all if it is there, and on normal income at whatever rate it is applicable. Then surcharge as applicable at whatever rate because we have crossed the limits. So it is applicable. The first step is same like our regular calculations, guys. Okay. Here please don't take the cess. Just stop it at surcharge point. Okay, sir. We got EA. Next, second step. Tax on which limit you have crossed. Whichever limits you have crossed. 50 lakh or 1 crore or 2 crore or 5 crore or 10 crore. Whichever limit you have crossed, take it. And for that we have to add surcharge. Only if you have crossed second or higher limit. In the second step, we will take surcharge only if you have crossed second or higher limit. For example, sir, my total income is 2 crore 5 lakhs. Sir. In that case, I have crossed 2 crore. So that means, sir, exactly if my total income is 2 crore also, surcharge is applicable? Yes. So that is how. So assume your income is the limit what you have crossed. Calculate tax on it at whatever rate is applicable for you. Okay, sir. Then add surcharge. If your total income is exactly that amount what you have crossed, surcharge is applicable, or if yes, add it. If not, don't add it. Sir, I have crossed first limit, sir. 52 lakh is my total income. I have crossed first limit. So here will surcharge come? No. Because you will calculate tax on what? 50 lakh. So if your total income is exactly 50 lakh, will surcharge be there? No. Only if it is more than 50 lakh. Clear? So please be careful. In the second step, only if you are crossed second or higher limit, only then surcharge will be applicable in second step. Then add up one more item, that is total income minus the limit what you have crossed. That is the figure what you have taken here. Na? Total income minus that figure. You will add up that also. You will get B now. You will get B. Compare these two, guys. Compare these two. Whichever is lower, we have to pay. That is the third step. Whichever is lower, we have to pay to the government. Health and education cess is on 4% on the same, on this figure. Clear? So normally what we are supposed to pay is this. Clear? If by chance if B is lower, that means we are eligible for relief. If B is lower, that means we are eligible for relief, guys. So means this is what something special na, for checking the relief. If B is lower, that means we are eligible for relief. So how do we calculate the relief? A minus B. Sir, if A minus B is negative, that means we are not eligible for relief. We are not eligible for relief. Clear? Yes. Final tax liability. So your questions can be to calculate final tax liability or to calculate relief, guys. And in the question, they may not even give int check marginal relief also. From the figure given, you have to understand, should I check relief or not? Please be careful. Whether it is rebate, surcharge or relief, they may not give int in the question. You have to apply there. By seeing the figures, residential status, amount and all, you have to check whether it is applicable or not, guys. Clear? Yes. Next, assumptions. If nothing is specifically mentioned in the questions, you have to make certain assumptions, guys. Especially for new syllabus under descriptive type, please give a note of whatever you assume. So if assess's residential status is not given, assume is a resident. Then age is not given, means assume less than 60. Then If they have not given the breakup of special income and normal income and all, assume the entire total income includes normal income. Then assessee is following, means if they are not given, they have to give it in the question. If by chance, if they are not given, whether the assessee, that is individual HU of AOP, BOI, artificial juridical person and all, whether they are following default or optional, if they are not given, assume they are following default. Assume they are following default, guys. Yes. Now, and one more thing, guys. So as I already told you, the soft copy of the material will be shared in my Telegram channel. Plus, from April 1st to April 30th, I have updated some MCQ question on both direct tax as well as indirect tax. If at all, if you have not seen it, try to make use of it. If you have not yet attended, try to attend it as and when you cover the respective topics, because topic wise from the starting till the end I have posted the questions, so it would be benefit for you as and when you prepare the particular topic if you are just trying to answer them. So around 190 to 200 questions have been posted, so it will be helpful for to cross check yourself about your preparation. One more important topic in this chapter is, sir, now this slab rate assessee have options. They can follow either default regime or optional regime. Now, when they should inform the department, or should they inform the department which scheme they are following? Yes. It is divided into two categories. Do I have income under the head PGBP or not? If I don't have the income under the head PGBP, then I can choose whether I am following default or optional. I can choose at the time of filing the returns. At the time of filing the returns, I can choose default or optional. Sir, what if I have income under the head? And one more thing. Sir, I don't have income under the head PGBP. Every year, can I switch between default and optional? Yes. Every year you calculate where your tax is lower and you can choose that if you don't have PGBP income. Next alternate. Sir, I have PGBP income. I have any income under the business or profession. Then in that case, when should I inform the department that I am following default or optional? Before the due date of filing the income tax returns. Before the due date of filing the income tax return, I am obliged to inform the department which scheme I am following. If I am not informed, it is understood I am following default regime. And sir, when I have PGBP income, every year can I keep on switching between default and optional? No, you cannot. Once, see, every year you are understood you are following default. Once you can opt out of default and go to optional. And from optional you can again come back to default once. And you have to continue with default in the future. Sir, in the future, if I close down my business, will I have a freedom? Yes. You will have a freedom to choose between default and optional. Hope you guys got it. I repeat once again. For the assessee who has PGBP income, they will normally be following default. That is, they have to start with default. No, sir, I don't like default. Then you can opt out and follow optional scheme. In all the future year, you are understood that you are following optional scheme. No, sir, now I am not liking optional scheme, sir. I want change. So again, you can come to default. But once you come to default, you can never go out. Okay, but if you are ceasing to have the income under the head PGBP, then you will have an option to switch between optional scheme and defaults. Clear, guys? Yes. So this is all about the tax rates chapter. Yeah, now we will revise chapter 3, which talks about the heads of income, guys. From here on, it is heads of income. But chapter 3 is all about salary. But before we start salary, we'll just talk few things about the computation of total income. So as per section 14, there are 5 heads of income. Means section 14 classifies the income into 5 heads of income, which are income from salary. Section 15 to 17 talks about income from salary, 15 being the charging section. So income from house property is covered in section 22 to 27, 22 being the charging section. Sir, what about section 18 to 21? It has been omitted from the income tax law, guys. Then profits and gains of business or profession is covered in section 28 to 44, D, 28 being the charging section. Then capital gains is covered in section 45 to 55A, 45 being the charging section. Then income from other sources, section 56 to 59, 56 being the charging section. The first section under each head of income is a charging section, which will tell what income is taxable under the respective head. Okay. And if at all, if there is any income which is exempt under the income tax law, we will see which all incomes are exempt. As of now, we have covered agriculture income. If at all, if there is any income for which the assessee enjoys the exemption, he will claim the exemption under the respective head only, guys. Under the respective head only. So next, there are 2 adjustments to be done. That is clubbing of income and set off and carry forward of losses. Clubbing of income means when for someone else's income, I am liable to pay tax. but not always, only in few cases like spouse income, minor children's income and all. Then clubbing will always get attracted under the head income from other sources. Then set off and carry forward of losses. There are two types of adjustments, that is intra-head adjustment as well as inter-head adjustment, along with exceptions. Few exceptions means few losses cannot be adjusted against the others. What are those and all we will be learning in a separate chapter. So next, once we do all this, we get a figure called gross total income. And from gross total income, the assessee is eligible to claim chapter 68 deductions from section 80C to 80U, if at all if he is eligible for. So once he claims the deductions, the figure what we derive is called total income or taxable income, on which we are liable to pay tax. So how to calculate tax we already seen in the last chapter. Clear? Now we are learning how to derive that total income. Tax is always on total income. Correct now? So what is general charging section 4 is telling? Tax is on total income. Correct now? So total income, how to compute? We will start from here. So if at all if there is any tax calculation, there are two possibilities, guys. They may ask you to compute income and then tax, or else they may give the income, total income figure and all they may give and ask you to calculate tax. So accordingly the marks weightage would be there. Okay. So here the first line item here is salary, guys. So is it a ready figure? No, we have to compute it. So how to compute the income from salary, or we also call it as taxable salary, is our chapter 3. So income from salary is covered in only section 15 to 17, only 3 sections, 15, 16, 17. Okay. Computation of taxable salary or income from salary we call it as. So salary will have various components, guys. Salary, wages, everything is one and the same for income tax purpose. Clear? So anything which employee gets from his employer under the employer-employee relationship is taxable under this head. So what all can be there? For income tax purpose, there are different components and all. Normally they will not straight away give salary. They will give different elements which are part of salary. What are those, sir? Basic pay, dearness allowance. Dearness allowance is given by the employer to meet the increased cost of inflation. So you know the inflation effect. Okay. So how the things are, the whatever daily products we use and all, the costs are going up. So that is why to meet it, in addition to basic pay, the employer may also give dearness allowance or dearness pay. Everything is one and the same. Then bonus based on the performance or the performance of the employer or performance of the company, they give the bonus normally once in a year, not every month. But however it is given, please take it. Whether it is monthly, quarterly, yearly, however it is given, you take it. But guys, if they are simply given bonus 1 lakh, assume it is per annum. Then commission. So commission will always be taken year. In salary calculation, we will always take commission, guys. Important thing is, see, dearness allowance and commission is always fully taxable. But while calculating few exemptions under salary head only, we will take dearness allowance and commission subject to condition. Means if condition is satisfied, we will take it. If condition is not satisfied, we will not take it. Sir, what is that condition? For dearness allowance, they are telling if it forms part of retirement benefit. Only then we will take it. While calculating exemption, here we always take it. While calculating salary, only while calculating exemption, if condition is met, we will take it. If condition is not met, no, we don't consider it. Commission also. The condition to calculate exemption is if expressed as a fixed percentage of turnover. Means if normally given to salesmen and all. So salesman, if whatever turnover you achieve, whatever sales you make, 5% we will give it as commission for you. Company has told. So in that case, commission is expressed as a fixed percentage of turnover. So while calculating exemption, should we consider commission? Yes. Sir, commission is paid, but every month 5,000, sir. Fixed amount. Is it based on the percentage of the turnover or sales? No. In that case, while calculating exemption, should we consider commission? No. But while calculating salary year, taxable salary, should we take it? Yes, you have to take it. Clear? So I repeat, dearness allowance and commission is always fully taxable. Irrespective of the condition, you have to consider it in salary calculation. But while claiming few exemptions, for DA and commission, they have told we have to consider subject to condition. Only if that condition is satisfied, consider it there. If not, don't take it. Okay. Next, city compensatory allowance, that is when you are appointed, assume you were working in tier 2 city, now you have been transferred to tier 1 city. So again, your cost of living there will increase. So for that, again, the company or employer may give city compensatory allowance. For example, assume sir, I was appointed in tier 2 city. Now I have been transferred to Bangalore, where cost of living, rent, everything is more. So obviously, in addition to salary, you have to give something which is city compensatory allowance. Then medical allowance, which is going to meet medical expenditure of the employee and his family. These things are always fully taxable, guys. Still here, everything fully taxable. Always. Whatever employee is getting from employer, fully taxable. Then there might be many other allowances for which exemptions might be there. If it is exempt, then we have to calculate how much is exempt separately by way of working note or note. So calculate it. Received minus exemption. Remaining, if still some figure is there, positive figure, we call it as taxable allowance. Bring that figure here. Bring that figure here. Sir, there is some other allowance for which exemption is not available, sir. Straight away, full received amount, you bring it here. Clear, entire received amount. Sir, there is an allowance which is fully exempt, sir. Then you can simply give a note telling the following allowance is exempt. Clear? Or else here also you can write, and in the amount column you can mention nil, or else just give a note. Okay, sir. Then perquisite. What is perquisite? We will discuss later. That is benefit in kind given by employer to employee. Now, even in case of perquisite, where the benefit is given in kind, in income tax law only they have given how to value it. How to value it. So when they have given how to value it, you will value as per the provision given there. The value of perquisite, you will take it here. Taxable value of perquisite, you will take it here. So you will show the calculation in the working note or note and bring the main answer here. Okay. Then you get something called as gross salary, guys. Sir, here it is very simple. Very easy, sir. Simple, sir. We will see how to calculate perquisite and allowance. Perquisite especially is a bit challenging. We will see it. Because here only one line item. Yes, sir. Easy, sir. Good, sir. Gross salary we get. Then from this, there are 3 deductions which are available under section 16, guys. That is 16(1)(a), standard deduction available for all the employees. 50,000. All the employees, whoever is having salary income. Then entertainment allowance under section 16(2) and profession tax under section 16(3). Okay, all this in detail we will cover, guys. This is just a format. That's all, not the entire head. This is just a format. Clear? So before I proceed further, I will just go back to the sections till now. What all we have covered. So 4 is done. Then 5 and 6 we have covered. Scope of total income and residential status. So along with scope of total income, we have covered 7 and 9. Along with scope of total income, we have covered 7 and 9. Sir, what about dividend income? Guys, this I will be covering along with income from other sources. Okay, because dividend income is always taxable under the head other sources. Next, general exemption, we will be covering it under the respective head, guys. Then special exemption and all, we will again see as a later chapter. See, as per ICSA study material and all, exemptions will normally come before the heads of income. Before the heads of income. But I would be doing it after the heads of income, because most of the exemptions I would be covering it along with the heads. For example, under salary head only we will cover few exemptions. Likewise, same way under each head, whichever exemption is connected to that head, I will cover it there only. Then later, whatever exemption is left out, we will cover it later as a separate chapter. Clear? Yes. So 10, 11, 12, 13, 13A, 13B, we'll talk about exemptions, which we will do later. 10, whatever general exemptions are there, I would be covering few of them under the respective head only. Okay. Then section 14, classify 5 heads of income, which we just now covered. Now we are doing 15 to 17. 15 to 17. Each of this section is a part of your syllabus. We will be seeing it, guys. Yeah. Salary income. Section 15, 16, 17. I have just given a chart here. 15. All income received as a salary under employer-employee relationship, that is the criteria here, is taxable on due or receipt basis, whichever is earlier. 16 gives 3 deductions and 17 defines 3 terms. 17.1 defines salary, 17.2 defines perquisite, 17.3 defines profit in lieu of salary, guys. Yes. So the basic criteria for a salary income is employer-employee relationship. So section 15 is a charging section which tells all income received by an employee as a salary under employer-employee relationship is taxed under this head. This head means salary head on due or receipt basis, whichever is earlier. That is when you have earned or when you have received. Shweta, when you have earned or when you have received it, whichever is earlier. Sir, if salary is taxed when I have earned it, will it be again taxed when I have received it? No. Same way, sir, I had received some advance salary from my employer for next 3 months. Again, he will not pay you, but you will be earning it in next 3 months. So if something is taxed on receipt basis, will it be again taxed on accrual basis? No, guys, it will not be. Whichever is earlier, that's all. Then foregoing of salary versus surrender of salary. Sir, what is foregoing of salary? What is surrender of salary? So will it be taxable or is it exempt? We will see. Foregoing of salary doesn't protect a person from his liability to pay tax. It is only application of income. Sir, I am working for TCS Limited. I got a monthly salary. I told, no, you only use it. So for some charitable purpose, or else give it to some charitable institution, I told. I have earned, but I have not received it. Can I escape from tax liability? No. I am liable to pay tax on it. Clear? So foregoing doesn't mean that I need not pay tax on it. Next, surrender of salary. If there is a surrender of salary in the public interest to the central government voluntarily, it is exempt. Means on that we need not pay tax. Okay. Now coming to allowances. First of all, sir, what is allowance? Allowance means, guys, when employer is giving an amount to the employee to use it for a particular purpose, we call it as allowance. Means it is given in money. It is given once in a year, once in a month, or once in a quarter, however it is given by employer to employee in the money terms to use it for a particular purpose. Fully taxable allowances means the following allowances are fully taxable. If employer is giving so and so allowances to employee, it is fully taxable in the hands of employee under the head salary, guys. What are those? Dearness allowance, additional dearness allowance, or dearness pay. Everything is one and the same. Fixed medical allowance, tiffin or meal allowance, servant allowance, non-practicing allowance, warden allowance or proctor allowance, deputation allowance, overtime allowance, or other allowances like family allowance, project allowance, marriage allowance, city compensatory allowance, dinner allowance, telephone allowance. All these are money is given by employer to employee to meet for a particular purpose. Fully exempt allowances. Allowances provided to High Court or Supreme Court judges. Any allowances. Then allowance paid to UNO, that is paid by UNO to its employees. UNO stands for United Nations of Organization. If they are paying any allowances to their employees working in India, it is exempt, guys. Then allowances provided to government employees by the central government. That is a citizen who is working outside India but servicing to whom? Central government. Clear? Any allowances are exempt, guys. Even perquisites are exempt, but as of now we are covering allowances, so we are only touching allowances. Is that clear? Any allowances. I am not named anything here. Dash is there. Means any allowances. Any allowances, guys. Next, partly taxable allowances. Partly taxable allowances. HRA, house rent allowance, means these allowances are not fully taxable also, fully exempt also. Exemption is available, but subject to conditions, like least of the following or lower of the following. What is it? We will see. First of all, what is HRA, sir? House rent allowance. Employer is giving allowances to the employee to meet rental expenditure of the employee or his family members whenever they are staying in rented house. Here, employee can enjoy the exemption only if he is staying in rented house and paying rent. Sir, he is staying in his own house, sir. Can he claim exemption? No. Paying rent is a criteria here. Only if you are paying rent, you can claim exemption. If you are not paying rent, then full HRA will be taxable for you. Okay. So 1013A talks about that. HRA is exempt to the extent least of the following, lower of the following. What are those, sir? Actual HRA received, whatever is the actual HRA employee is receiving it. Next, B, rent paid minus 10% of salary. Rent paid minus 10% of salary. And what is salary and all we will see at the end, guys, because I have given just as a summary at the end. Or amount equal to 50% of the salary where such accommodation is situated at Chennai, Delhi, Mumbai or Kolkata. CDMK, we have found a party during our regular class. Not CDMK. CDMK. Chennai, Delhi, Mumbai, Kolkata. Chinnamma's DMK. Next, in any other district or in any other city, it is 40% of the salary, guys. Clear? 40% of the salary where accommodation is provided. Now, sir, guys, if nothing is mentioned in the question, we assume that HRA is given throughout the year. Throughout the year. Sir, assume HRA is given only for 6 months or only for 3 months. Then you take only for actual HRA received only for 3 months. Then rent paid also we have to take only for 3 months. Sir, I stayed in rented house for full 12 months. Sir, no, rent paid should be only for 3 months. Relevant paid they call it as. Relevant paid means the paid for which you have received the HRA and staying in rented house. Okay, so only 3 months rent you have to take and 10% of salary. Salary you received for full 12 months, but you are enjoying exemption only for 3 months. So you take salary only for 3 months, 10% of it. Same way, 40% or 50% whatever we apply is for 3 months. Clear? Another scenario. Sir, I am receiving HRA for full 12 months, but I am staying in rented house only for 8 months. Remaining 4 months I stayed with my parents in their house. Later we had a fight, we went out. Okay, I am just giving an example. Now, sir, 8 months rented house, 4 months own house. So I have paid rent only for 8 months. So in that case, exemption can be availed only for 8 months. Remaining 4 months, whatever HRA is received, fully taxable. For another 8 months, claim the exemption. So here, actual HRA received should be how much? For 8 months. And rent paid obviously is only for 8 months, you will take it. Then 10% of salary. So salary I should take for 8 months. 50% or 40% of salary. Salary I would have received for full 12 months, but take it only for relevant paid. What is relevant paid? The paid for which I have paid the rent. Clear? So only 8 months. Clear? Because in the question it is very clear that, sir, I am working as an employee throughout the year. So I am getting basic pay, DA, commission throughout the year. So should I straight away take it? No. Clear? This is only when some masala is given. No sir, no masala, only salt and pepper. So in that case, they are simply given, this is what HRA is received, this is what rent is paid, that's all, and city name and all. In that case, assume that HRA is received for full 12 months and rent is paid for full 12 months. Clear? Means they are staying in a rented house for 12 months. Plain question. Next, special allowances for performance of official duty. That is, employer is giving allowances to the employee to meet official duty expenses or office related expenses. Here how much is exempt, sir? Actual expenses incurred or the amount received, whichever is lower. Actually how much you have received or the amount you have spent, whichever is lower. Whichever is lower. Sir, received 10,000 but spent 12,000. How much exemption I can claim? 10,000. Always have one thing in your mind. You cannot claim exemption more than what you have received. Clear? Maximum is what you have received. Clear? Sir, I received 10,000 allowance but I have spent only 7,000. How much exemption I can claim? 7,000. Remaining 3,000 is tax. Yeah. So what are the allowances which are covered here? These allowances are traveling, conveyance allowance, daily allowance, helper allowance, research allowance, uniform allowance, etc. Taxable allowance, actual amount received minus actual amount utilized, guys. Next, allowance to meet personal expenses. Section 1014(2). Personal expenses 1014(2). 14 personal to meet personal expenditure. At least 2 people should be there. So 1042. Allowances which are granted to meet personal expenditure are exempt to extent of the amount received or the limit specified, whichever is less. So how much exemption you can claim here? The amount you have received or the amount which is specified here, not spent. We don't care about how much you have spent here. So how much you have received or what is given here, whichever is lower. Clear? Yes. Now, and please be careful, guys. The heading is actually to meet personal expenditure, but all the expenditure covered here is not personal. Clear? The heading is personal. But everything what is covered here, especially this transport allowance and all, sir, these are not personal, sir. Still, it is covered under 1014(2) only. Okay. Tribal area allowance. So, if employee is appointed in a specified areas of Madhya Pradesh, not entire state, only the specified areas of Madhya Pradesh, Tamil Nadu, Uttar Pradesh, Karnataka, Tripura, Assam, West Bengal, Bihar, Orissa, means some notified tribal areas in that state, then you will get 200 rupees exemption for going and staying there. Next, children education allowance. So employer has given allowance to the employees' children to meet the cost of education. Exemption is huge. 100 rupees per month per child, up to a maximum of 2 children. Yeah, shh, silence. So for children education allowance, exemption is 100 rupees per month per child, maximum 2 children, and hostel 300 rupees per month per child, maximum 2 children. Sir, here what if the employee has more than 2 children? He can have no limit. Okay, but the thing is, exemption is available only for 2 children. Clear? There is a concept, government concept called P2 hours to earn. So that is what they are trying to push to the people. What is your doubt now? Huh? No.
What do you mean?
Transport allowance. Transport allowance, expenditure to meet commuting between the place of work to residence. Exemption here is available only to physically challenged person or who is deaf, dumb, blind employee, guys. Exemption is how much, sir? 3,200 per month. Now, sir, allowance for transport of employees who is actually engaged in transportation. That is the employer who is engaged in transportation business, guys. Clear? Whether goods or passenger. So for those employees who are working under that employer, they will enjoy how much exemption, especially the drivers, conductor and all, they will be on road, especially lorry, truck drivers and all. So for them, allowance would be given by employer to employees, that is the driver or conductor. How much exemption they can enjoy, sir? 70% of such allowance or 10,000 per month, whichever is less. Whichever is less. Sir, I have written a letter for PM. Okay, please take back this exemption and we don't want, or anyone don't want, any parent will not require this, take back or else increase the amount. Chala, listen. Now, sir, allowance is very easy, guys. You remember only two lists. What is fully exempt? What is partly exempt? You remember. Partly exempt or partly taxable? You remember this too. All other things are fully taxable. All other things are fully taxable. So there are three which is fully exempt. There are three, that is HRA plus 1014(1), 1014(2), which are partly taxable. Partly taxable or partly exempt, one and the same. Clear? And all other allowances are fully taxable. Clear? So easy to remember what is fully exempt, what is partly taxable. Remaining all is fully taxable. Now comes our boss. Perquisites. Perquisites covered in section 72. Sir, what is perquisite? How is it different from allowance? Guys, perquisite is something which is given as benefit in kind by the employer to employee. Like car is given to for employee to use it, or house is given for employee to use it, or any other asset. Clear? Or company's asset has been sold to employee for a lower price, or company shares has been allotted to employee for a lower price or at a discount. So this is a benefit which employer is giving to employee. Agree? Why? Because of employer-employee relationship. Employer will not call any person, hey, who is going in the road, hey, come here, I will give this, take it, and he is giving to his employee. Why is he giving? Because of employer-employee relationship. So in that case, any benefit which employee enjoys is taxable under the head salary, guys. Now in case of perquisite, it is very important for us to see what is the benefit received, how much is taxable. And how much is taxable is told here, not how much is exempt. Clear? Depending upon what benefit the employee has received, how much is taxable is given here. Guys, one thing is always common. If employer has recovered anything from employee, while valuing any perquisite, we have to reduce it. We have to reduce it. Means simple. We are telling what is perquisite? Benefit given in kind. So first we will calculate value of benefit. Value of benefit. So if anything is recovered from employee, obviously he is not enjoying free of cost. Agree? So he is paying something for it. So reduce it. And after that, if still something is there, that is the value of taxable perquisite. That is the value of taxable perquisite. No sir, this figure is negative sir. In that case, nothing is taxable. Nothing is taxable, guys. Clear? Sir, nothing is recovered. See, I am telling you, if at all, if something is recovered, we have to reduce. Sir, nothing is recovered, sir. Straight away, value of benefit will become value of taxable perquisite. Clear? So, in simple, at free of cost, what is the benefit which employee is enjoying? Or net benefit what the employee or his family members are enjoying? We have to check it. Only that component would be taxable in the hands of employee under the head salary, guys. Clear? So, what all perquisites will cover is the benefit given by employer to employee in kind or reimbursement also. Like employee has incurred some expenditure and that is reimbursed by the employer. That is reimbursed by the employer. Or else, sir, employee's expenses, his personal expenses is paid by employer. Will that also be covered under perquisite? Yes, it will also be covered under perquisite. Yeah. Any facility, benefit that is granted by the employer, the use of which is enjoyed by the employee or any member of the employee's household is considered as perquisite and hence attracts tax. So how to value it is the biggest challenging thing. We will see it. Valuation of taxable perquisite, one by one we will start with. The first item is rent-free accommodation. Rent-free accommodation. Here, rent-free accommodation means, not HRA, rent-free accommodation. Employer has given the house for the employee to stay. Either alone or along with his family, however you want. You will choose that. Employer will not decide. Okay, whom to get married, with whom we have to stay, and all. Employer, why is he bothered about it? Clear? So, employer has given a house for an employee to stay. In that case, we have to check whether it is only the house which is given or along with the furniture. Furnished accommodation or unfurnished accommodation, we will check. Whether it is furnished or unfurnished, first step remains same. If it is furnished, for whatever value we have got in the first step, we have to add furniture component for it. Clear? Yes. So now, whether the accommodation furnished or unfurnished, we will assume that it is unfurnished and calculate first what is the value for the building. Then for the value of building what we have got, if it is furnished, we will also add the value of furniture component. No sir, it is completely unfurnished. Then only value of building is the taxable perquisite. Okay. First, value of taxable perquisite in respect of unfurnished accommodation for non-government employee. We are in the first step now. We are in the first step. Okay. Non-government employees, guys. Means the employer is not a government. Fine. In that case, we have to check whether the accommodation is owned or hired. Means employer has given the house for employee to stay. Na? Is it owned by employer or is he taken as a rent and then given to the employee? Assuming it is hired or leased, means employer has taken the building on rent and then he has given it to the employee to stay. In that case, what is the value of perquisite? Amount of lease rent paid or payable by the employer or 10% of salary. Whose salary? Employee salary, whichever is less. Clear? This is when the property is hired. Sir, what if it is owned? What if it is owned? Important, because there is a change in this. Very important, there is an amendment in this. Please pay attention. As per 2011 census, which has been updated. As per 2011 census, check the population of the city in which accommodation is provided. If the population is up to 15 lakh in that city, then take 5% of salary. Population more than 15 lakh but up to 40 lakh, then take 7.5% of salary. Sir, population more than 40 lakh, 10% of salary. Sir, population more than 40 lakh means we have to consider all three. Nah? No, straight away 10%. Any of this will come, not all. Any of this. Clear? Even this, either this or this. Not both. Either it can be owned or it can be hired, guys. Clear? Hired means very easy. Actual hire charges, that is nothing but rent or 10% of salary, whichever is lower. If it is owned, depending upon the city's population. Clear? See, city's name if it is given, especially if it is an important cities or metro cities and all, guys, population will definitely be more than 40 lakh. Straight away take 10%. Straight away take 10%. Okay. Next. So please be careful with this. This is change amended part. Where the accommodation is provided by the central government or state government to an employee who is serving as on deputation with any body. Sir, what body, sir? Central government's body or state government's body, or undertaking, that is PSU, public sector undertaking, under the control of such government, which is controlled and managed by government, is to be calculated in accordance of the above table, as if the accommodation is owned by the employer. Again, important change. Sir, what are they trying to tell? Now, I am an employee of PSU, public sector undertaking, as you mean Indian Railways. Clear? For me, the accommodation is provided by central government. Accommodation is provided by central government. In that case, you know Indian Railways is controlled and managed by central government. Accommodation is provided by central government, sir. In that case, what they are trying to tell is compute the value as if they are covered here. Non-government employees. As if they are a non-government employees. Means, if you are an employee of any body or undertaking, which is under the control of the government, and accommodation is provided for you by not that body or undertaking. Accommodation is provided by central government or state government. In that case, guys, I will repeat once again. Sir, a person is working as an employee of a body or undertaking which is controlled by government. And for him, the accommodation is provided by central government or state government. In that case, sir, will we follow the B point or A point? A point. It is A point as if it is owned by any other employer. Clear? Means they would be covered in point A and not point B, guys. Clear? Means in simple we have to apply this provision. That is 5%, 7.5% or 10%. So please be careful, this is an amendment. Then if they are straight away central or state government employees, then what is taxable as perquisite is license fee. What is taxable as perquisite is license fee. If rent or part of the rent is paid by the employee, then it has to be reduced from the above value. This is step 1. So this value, whatever we have calculated, is for building. So if only building is provided, there is only house, no more calculation. We will stop it here. But here whatever value we have got perquisite for building, if it is provided along with furniture, we call it as furnished house. In that case, furnished accommodation not being in hotel, whatever value we have got here, we have to add furniture component. So not being in hotel, sir, in that case, find out the value of perquisite on an assumption that accommodation is unfurnished as stated above. Okay, first we will calculate that. This value we will take it. Fine. For that we have to add 10% of the cost of the furniture per annum if furniture is owned by the employer. Sir, furniture are purchased by the employer and he has given to the employee. Clear? That is like bed, refrigerator, washing machine, AC, fan, whatever it is, television. Next, sir, what if it is hired? Actual hire charges paid or payable if furniture is hired by the employer. Sir, what if it is partly owned, partly hired? Possibility is there. So in that case, for example, assume as per first step, that is for the building, we already got 2 lakh, guys. 2 lakh. Sir, furniture is provided by employer to employee. 5 lakh worth of furniture he has only purchased. Who? Employer. The employer owns it and he has given to employee. And remaining he has hired it. So hire charges is 5,000 per month. 5,000 per month. In that case, for this furniture component, what is the taxable perquisite? 5 lakh is the worth of furniture which is owned by the employer. Take 10% of it, 50,000. 50,000. Then for hired one, 5,000 into 12, 60,000. So how much you get? 1,10,000. So for this 2 lakh, we have to add 1,10,000. So what is the value of furnished accommodation? 3,10,000. This is unfurnished, this is furnished. So totally you will get value of furnished accommodation, 3,10,000. That's all. Sir, what if furnished accommodation is in a hotel? Straight away you will apply this. No step 1, no step 2. Straight away this one. Clear? Sir, we will not take this and then add this whatever we are discussing now. No. Straight away this calculation. Clear? So accommodation is in the hotel, sir. 24% of salary, 24, or actual hire charges paid or payable, whichever is lower, is the value of taxable perquisite, guys. Is that clear? Straight away. No step 1, no step 2 here. Straight away. This is when the employee has been transferred from one place to another place and there he has been given the accommodation in a hotel. In that case, this is what we will calculate. Actual hire charges is nothing but room rent or whatever the room charges you are paying. Employer would be paying it. Perquisites which are not taxable. Even though accommodation is provided, in the following cases it is not taxable. Accommodation provided in the remote area is 100% exempt. Not the remote which you will find at home with your siblings. Remote area where the population is very less. What is remote area? Remote area means area located 40 kilometers away from the town and having population less than 20,000. Then hotel accommodation up to 15 days on account of transfer of employees exempt. Sir, I have been transferred from Karnataka to assume Kolkata. My employer immediately I cannot go and I don't have any branch there. Agree na? So obviously I have to go find my place. So it will take time. So assume for 15 days whatever accommodation is provided. Sir, is it taxable? No, it is exempt. Sir, what if hotel accommodation was provided for 30 days? Up to 15 days it is exempt. Remaining 15 days it is taxable. Clear? Sir, how to take for 24% of salary? Obviously, you will receive salary per month only. Take 15 days. Clear? So, assume monthly salary is 50,000. Monthly salary 50,000. Take 15 by 30. That's in that 24%. Clear? And please be careful. Here also 24% is for which period? For the period which accommodation is provided. Clear? Here also, sir, what about this 5% of salary, 7.5% of salary or 10% of salary is for the period for which accommodation is provided. If nothing is given, we believe that accommodation is provided for full entire year. If the clearly given accommodation is provided only for 4 months, 6 months, 8 months, 9 months, then even though you might be receiving salary for full year, for this perquisite valuation, please take only the rent for that relevant, salary for that relevant period, guys. Okay, last one. If the employee is provided with accommodation on account of his transfer, sir, assume, now same case we will take. I was working in Bangalore, I have been transferred to Kolkata. So in Bangalore, accommodation was provided by my employer. Okay, it was taxable, sir. Yes. Now I have been transferred to Kolkata. There also accommodation is provided. In Bangalore house, we have retained, my family members are staying. My employer has given new accommodation in Kolkata also where I am staying alone. In that case, as I am getting two accommodation, up to 90 days from the date of transfer, only one house would be taxable. Up to 90 days, only one house would be taxable. Even after 90 days, if I am having both the house, if I am enjoying both the house, in that case, both the house would be taxable. So for the first 90 days, only one house. For which house, sir, I can decide. So as an employee, what I will do is, I will value the perquisite of both the houses. Wherever it is lower, I will consider that. Clear? I will consider that as taxable. Whichever is higher, I will consider that as exempt. Clear? To try to take maximum benefit. Clear? I repeat once again. I will calculate the perquisite for Bangalore house, Kolkata house, both. Whichever is higher, I will try to exempt that. And whichever is lower, I will try to offer that for tax. Even after, this is only for 90 days, choice. After 90 days also, I am enjoying both the houses, means both is tax. No choice. Okay, next. Valuation of perquisite in respect of interest-free or concessional loan. Interest-free means, sir, employer has given a loan to the employee, is not charging any interest, sir. Dharmaraya, you know, no? Like that, sir. So in that case, whatever interest which SBI would be charging, if they are given the loan, that would be taxed. Sir, employer has given the loan, sir, but is charging lower interest, 4%, sir. Market assume 10%, but we are charging only 4%. Concessional loan we call. Loan is given at a concessional rate. Okay. Where the employer grants a loan to an employee or any member of his household more than 20,000. Sir, what if loan amount is less than 20,000? Oh, enjoy. No problem. Nothing is taxable. Only if the loan amount is more, not salary amount, loan amount more than 20,000. Taxable perquisite would be loan amount into SBI interest rate minus actual interest rate charged by the employer. If at all, if he is charging. If he is not charging anything, straight away SBI rate. Sir, SBI rate assume. It will be given in the question. You need not, sir. We have to search our exam day before. Full searching SBI interest rate and sitting and wasting the time. Please don't do that. If at all, if the question is there, they will mention it in the question. So assume 10%. Sometimes students spend time on unnecessary things. Okay. Our Sarvesh was talking in the break. He told, sir, I am watching full motivation video with 1.5 speed. Okay. I am watching full motivation video. I should get energy, sir, with 1.5 speed. And I told, what are you doing with by saving that time? He told, sir, I am watching other shorts and reels.
That's why he's afraid to show you.
What is he showing for you? Huh?
He's afraid to show you this.
Okay. Chala. SBI interest rate 10%. Actual interest rate, assume guys, the employer is charging 4%. So in that case, 6% is taxable. Because the discount given by him is 6%. Clear? Sir, no sir, he is not charging anything. Straight away 10%. Loan amount into 10%. But if loan is taken for the purpose of medical treatment of prescribed diseases and all, nothing is taxable. Even though the amount is more than 20,000, nothing is taxable, guys. But if until and unless given the question, you don't assume this prescribed disease and all. If nothing is given, if loan amount is more than 20,000, then tax as perquisite. Value of perquisite in respect of use of any movable asset by an employee or any member of his household other than motor car, means employer has given an asset to employee to use it or his family members to use it other than motor car. Sir, what about motor car? We will see that later. There is a separate provision for it. So there are three categories of assets here: laptop or computer, other assets owned by the employer, or other assets hired by the employer. Other assets means other than laptop, computer and motor car. Clear? Yes. Now, sir, for laptop and computer, nothing is taxable. because it is very much necessary now. Okay, it is very much necessary. Sir, in laptop, whether employee is doing only office related work or is doing Google, YouTube or anything personal also, fine. We don't even bother about it. So other assets owned by the employer, 10% of the cost you take. If anything is recovered, reduce it, balance is taxable. Sir, other asset hired means the employer has taken his own rent and he is giving it. In that case, whatever rent is paid or higher charges is paid minus amount recovered, the balance is taxable. Amount recovered, if at all if it is there, we have to reduce it. I have told at the beginning only. It is a common dialogue for all the perquisite guys. Okay. Because it may not be there always. If nothing is given in the question, assume that nothing is recovered. Next. Sir, what about motor car? Few pages after, it is there. Motor car. Interesting and important also. And you know, even the paper setter was once a student. As a student, what students may skip, you already know. Who? Paper setter. And definitely we'll try to add at least 1 or 2 points on that. Clear? Because yes, some points, some provisions which are challenging, students will think, just leave it. Okay. We'll study all other things and that. But in the exam, question will be on that. Oh, you will be like, how much unlucky I am. I covered the entire salary but left this point, but question is on this only. How unlucky I am. Why did I born? Okay, what am I doing in my life? All these questions will start eating to you. Correct, this will happen. This you would have asked before you skip. Okay, control. Enjoy your birth. Your birth should be celebrated by others. You should live like that. Okay. Where guys, here few important things are. Let me tell you. Who owns the car? Who is the owner is important. And car is used for what purpose? Usage of car is important. Then the last one, who incur the expenses is important. These three are important to decide what is the taxable perquisite. Who is the owner? Who is using the car or for what purpose it is used? Obviously here who is using the car means employee. If employer is using, then there is no question of perquisite here. Clear? Employee is using it, but for what? Purpose of usage. Clear? Sir, three purpose might be there. Completely personal, completely official or party. What is more important is party. Okay. And expenses is borne by whom? Employer or employee. So here two possibilities guys, employer, employee. Who owns the car? Either employer or employee. Or employer has taken in the rent and he has given to the employee. Like that. Next usage, I told you, personal, official, party. Then expenses again, two possibilities. Employer or employee. Okay. First, where car is owned by the employee. So, is the employee getting any car benefit? No. Because car is owned by him. He is the one who has paid and got it. Yes, sir. So, first category there. Under that. Where car expenses are met by the employee. Owned by employee. Expenses met by employee. What did employer give? Nothing. So, nothing is taxable. Nothing is taxable. Next, B. Sir, car expenses, maintenance expenses are owned by employee, but expenses maintained by employer, like repairs and maintenance or car, petrol, diesel or electricity. By chance, if it is electric car, electricity. It is taken care by employer in that case. If it is only used for official purpose, only officer, I am taking every day morning from home, I am going directly to office, coming back to home. Nowhere else stoppage. Clear? So in that case, assuming it will happen. So in that case, nothing is taxable. Nothing is taxable. Sir, what if it is for completely personal? You are enjoying car. Correct. Actually, car is owned by employee only. What you are enjoying is expenses. So in that case, value of perquisite would be actual expenditure incurred by the employer minus amount recovered if any. Clear? What is the benefit you are enjoying? That is taxable. Next, partly. Partly. Car is used partly for official and partly for personal. What we have to take? Value of perquisite is equal to actual expenditure incurred by whom? Employer. Minus 1800 or 2400 depending upon the CC of the car. If the CC of the car is up to 1.6 liter, 1800. If it is more than 1.6 liter, then 2400. Any one, not both. Per month, please be careful. Per month it is. Actual expenditure also most of the time will be given per month only. Even if it is given per annum, take it. but while minusing 1800 or 2400 is per month. And even if driver is also provided by whom? Employer. Employer is paying salary for employee's driver. In that case, 900 rupees has to be added. Sir, 900 rupees, who will come for driving, sir? You don't care about actual salary. Add 900 rupees. Clear. Employer might be paying 20,000, 15,000, 30,000, whatever is the salary paid. What we have to add is 900 rupees. This only if driver is provided by employer to employee. For whom salary is paid by whom? Employer. Sir, employee himself is driving, sir, or employee has appointed the driver, sir, then he is not getting that benefit. We need not add it. Minus amount recovered, if any. Then when car is owned or hired by the employer, owned or hired, one and the same. Okay, means for calculation of perquisite I am telling you. Okay, owned means the employer has purchased it and given to the employee to use, or else hired means, sir, he has taken on rent and he has given the car to employee to use it. So for valuation of perquisite, both is one and the same. Okay, so let us see who is incurring the expenditure. Who is incurring the expenditure? First category, employer. Employer is incurring. In that case, double benefit employee might be getting. What is? Car plus expenses. But let us see for what purpose it is used. If it is used only for official purpose, nothing is taxable. Because ultimately, whether whoever is giving it, ultimately I am using it for your own business, sir. For your own office purpose, sir. So nothing is taxable. Then only for personal purpose, value of perquisite is equal to actual expenditure incurred by the employer plus this is for expenditure plus for car is also owned by employer, so we have to add something for that also. What is it? 10% of the actual cost of the car or higher charges if car is taken on higher. This is for car element. So double benefit is enjoying. One is car, one is expenditure. For expenditure, whatever is the actual expenditure, take it. And for car, 10% of the cost of the car. If it is per annum, please be careful, 10% is per annum. Sir, what if it's hired? Means employer has taken on hire and he has given to the employee. Then actual hire charges paid by the employer has to be added. Then if any amount is recovered, we will reduce it. Then, sir, what if it is partly for office and partly for personal purpose? Then value of perquisite would be 1800 per month. No, sir, will we take actual expenditure and then reduce? No, straight away 1800 or 2400. Straight away. That is the value of perquisite. 1800 or 2400 depending upon the CC of the car. Even if driver is provided plus 900. Minus if anything is recovered. Okay. So please be careful. There is a difference between this and this, guys. Here in the previous case, what we discussed already, we have to take actual expenditure incurred and deduct 1800 or 2400 per month. Whereas here straight away 1800 or 2400 is taxable depending upon the CC of the car. Next, car is owned by whom? Employer or hired by employer. Now expenses met by whom? Employee. In that case, see the purpose. Only for official purpose, nothing is taxable. So whenever, guys, car is used for officially purpose, nothing is taxable. Who owns the car, who meets the expenditure, doesn't matter. Only for personal purposes. Value of perquisite is equal to 10% of the actual cost of the car or higher charges if car is taken on hire plus salary of the driver if any paid. Actual salary, not 900, actual salary here. Because it is for completely personal. Clear? Yes. So here only one benefit employee is enjoying. What is it? Car is used by whom? Employee. Owned by whom? Employer. So what is the expenses met by whom? Employee. So what is the only benefit which the employee is getting? Car. So only 10% of the cost. 10% of the cost of the car or actual hire charges. If driver is also provided by employer and expenses met by him, then add the salary, actual salary, not 900. Then, sir, what if it is partly? 600 or 900 per month, depending upon the CC of the car. 600 or 900 per month. Sir, what if driver is provided? Add 900. If something is recovered, minus it. That is common for everything, guys. Clear? I would have not mentioned it here, but it is common for everything. Okay. This is when the assets are given by employer to employee for use. Sir, what if it is sold? There is a difference. Ownership is transferred now. Value of perquisite in respect of movable asset sold by an employer to his employee. Find out the actual cost to the employer. Find out the actual cost of what? Asset to the employer. Okay, very simple. Let me first explain like this. Any asset given by the employer to employee to use, we have already seen. Now it is sold by employer to employee. Obviously, when it is sold, first employer should own it. Can employer sell what is hired by him? No, he cannot. Now, sir, employer had purchased the asset. The cost of it is 10 lakh. And he has used it for, assume, 3 years. He has used it for 3 years. And for that we have to reduce depreciation. Yes, how much depreciation as per which method? Everything they have given. I am just randomly taking 3 lakh. After using it for 3 lakh, 3 years, the asset was sold by employer to employee. So what is the value of the asset on the date of sale? 7 lakh. We call it as WDV, or the value of the asset on the date of sale. Now compare this with sale value. Assume sale value is 5 lakh. What is the benefit which employee is enjoying? 2 lakh. 7 lakh worth of asset was sold by employer to employee for only 5 lakh. What is the benefit he is enjoying? 2 lakh. That is a taxable perquisite. That is the taxable perquisite. Yeah. Find out the actual cost to the employer. So for whichever asset, actual cost you take. But depreciation depends on the nature of the asset. Depreciation for each completed year. Completed year of what? Usage by employer. From the date of purchase till the date of sale, how many years did he use it? If there is any months, ignore it completely. Even if it is more than 6 months, ignore it. For example, the employer used it for 3 years, 9 months and sold it to the employee. We have to take only 3 years. Sir, 3 years, 11 months, 3 years. Sir, 3 years, 2 months, 3 years. Okay. So if it is electronic equipments, the life is less, guys. That is why the depreciation is 50% per annum as per WDV method. If it is motor car, 20% per annum as per WDV method. If it is any other asset like cycle or two-wheeler, any other asset other than electronic equipment and motor car, then 10% as per SLM method. Sir, why this difference? Nonsense. Okay, but still we have to learn. This is how the law is. Clear? Because one rate, one method, they should have kept it. Clear? Here for each category, different rate, different method. Percentage is okay because electronic equipment 50% because it has limited life and all. But last, why did they change for SLM method? Great. Okay. So once you reduce this, guys, you will get WDV of the asset as on the date of sale. Okay. From that, what should you reduce? Amount recovered. Amount recovered is nothing but sale value. Amount recovered is nothing but sale value. Yes, sir. Then you will get what? Taxable perquisite. You will get taxable perquisite. Okay. Notes. Electronic equipments refer to the computer chips, not the one which you will have. Okay. This is what will be a part of the computer or laptop and all. Hard disk, printer, etc. If asset is used for more than 10 years old, then instead of putting for scrap, he told one scrap is working in my company, let me give it for that scrap only. Clear? So after using it for more than 10 years, the employee didn't even give it freely, he sold it for some price to employee. In that case, nothing is taxable. Nothing is taxable. If the asset is more than 10 years old, nothing is taxable. Next, sir, this depreciation percentage method and all is given now. Is it anywhere connected to section 32? No. Nowhere connected. Please don't get confused. Don't connect also. Clear? Because here also depreciation, there also depreciation. That is for the employer when he is using it for his own business. Section 32. Clear? That there the rates are different. Here the rates are different. This is to value perquisite in the hands of employee. Please be careful. No connection for this and section 32 of PGBP, guys. Next. Perquisite value in respect of sweeper, gardener, watchman or PA means, sir, a person who is working for employee or his family members or in his house is appointed and salary is paid by employer. Employer is paying the salary for domestic servant or PA of whom? Employee. Who is getting the benefit? Employee. But cost is incurred by whom? Employer. In that case, whatever salary the employer is paying is a perquisite in the hands of employee, guys. Now, employed by employer means that servants or gardener, sweeper and all is employed by whom? Employer. And salary is paid by whom? Employer. In that case, actual cost to the employer, that is the total amount of salary paid or payable by the employer, it is taxable as perquisite in the hands of only specified employee. Only specified employee. Who is specified? We will see. Employed by the employee. Sir, servants are appointed by employee for whom salary is paid by employer. In that case, perquisite value would be actual cost of to the employer, whatever salary is paying, it is taxable for all the employees, irrespective of whether they are specified or not. Sir, who is specified employee, who is not specified employee? I have given up a few pages here. Let me just do it. Specified employees. Specified employees includes an employee of a company who is also a director. So the director who is an employee of a company will always be a specified employee. Then an employee who is having substantial interest in the company, that is 20% or more of the voting power, that is equity shares. Employee whose income from salary exceeds 50,000 per annum, not per month, per annum. Majority of the people would be covered here. Clear? In is a specified employee. So if question is silent and all, we always assume the employees are specified employees. Guys. 50,000 per annum, any employee will have now. Okay, let us move forward. Perquisite value in respect of gas, electric energy or electricity in simple, or water supply for household consumption. Sir, employee's electricity bill or water bill or gas bill is paid by employer. Employee's electricity bill or gas bill or water bill is paid by whom? Employer. So in that case, whatever is the cost to the employer, that will become perquisite to the employee, guys. So there are two possibilities. Amenities purchased by the employer, means in simple, he is taking from someone and giving it, or he is paying the bill. In that case, whatever amount paid or payable to the outside agency minus amount recovered would be taxable perquisite. Sir, what if amenities are provided from own source? Means, sir, I am working as an employee in a company who is engaged in electricity supply. They told Vikas, anyway we are engaged in electricity supply. We will supply it free of cost to you. Enjoy it. Clear? So in that case, assume in a year I have totally consumed 1500 units. In a year, I have totally consumed 1500 units. So to generate that 1500 units, what is the cost to them? We have to calculate. Means they would have given it in the question, if at all if it is there. Assume 10 rupees. This is the value of perquisite for me. Minus if anything is recovered. Clear? Means if employer is engaged in the supply of water, gas or electricity, if he has given free connection to you, in that case, whatever is the cost of generating that to the employer will be perquisite in the hands of employee. If anything is recovered, we will reduce it. Next, value of perquisite in respect of free education or concessional education. Guys, education allowance is different, free education is different. This is perquisite. The possibility is what is covered here is, sir, employee's children's school fees paid by employee, later reimbursed by employer. Or employer straight away paying it, sir. Or employee's children are studying in a school which is owned by employer free of cost. Those things are covered. Allowance is different. Employer is giving money and asking to meet the cost of education. That is allowance. Perquisite is different. Okay, there is a difference between both. Okay. Training expenses of employee is not a perquisite. Fixed education allowance is a taxable under section 1014(2). Actual amount of school fee paid or reimbursed by the employer for the children of the employee is chargeable to tax as a perquisite in the hands of employee. Sir, employee paid 1 lakh fees which is reimbursed by employer. What is the taxable perquisite in the hands of employee? 1 lakh. Sir, employee school children's studying in a school where the fees is paid by employer. Whatever employer is paying is a taxable perquisite in the hands of employee. Okay. However, reimbursement of tuition fee can be claimed as deduction under section ATC. ATC, one of the element is tuition fee. Sir, employer has paid or employee has paid. Can we claim deduction? Yes. See, if I myself has paid tuition fee, straight away I will go and claim deduction under ATC. If employer has paid tuition fee for my children, first include it in salary head, then claim deduction. Ultimate effect is nil. Next, sir, employees' children are studying in a school or college which is owned or managed by the employer. Which is owned or managed by the employer, free of cost. In that case, leave that school. Check the competitor. In the similar locality, similar institution, what is the cost of education? In the similar locality, similar institution, what is the cost of education? If it is up to 1000 rupees per month per child, no limit for number of child. 1000 rupees per month per child, no limit for number of children. So in that case, if it is up to 1000, no school is having this 1000 rupees concept. Clear? Where is government? See, They are still in 1,000 rupees generation. Okay, so in that case, if at all, if the cost of education in that respective school or college is 1,000 rupees up to 1,000, less than or equal to, then nothing is taxable, nil. Sir, what if it is above 1,000 rupees? Entire amount is taxable. Sir, should we reduce 1,000? No, entire amount. For example, the cost of education in the similar institution is 10,000 per month. Entire 10,000 per month into 12 will be taxable. Will be taxable. Clear? So please be careful. If education is given free of cost to the employee's children in a school owned or managed by the employee, owned or managed by employer, then we will leave that school or college. We will check which is the similar institution in the same locality. Competitor, in simple. What is the cost of education in that school or college? If it is up to 1,000 rupees per month per child, nothing is taxable. More than 1,000, entire amount is taxable. So if anything is recovered, we will reduce it. Then scholarship received by the employee's children from the employer is a perquisite in the hands of employee, but it is fully exempt. It is perquisite, but fully exempt perquisite. Okay. Next, value of perquisite in respect of free meal or concessional meals provided by employer to employee. The value of free food and non-alcoholic beverages provided by the employer to employee shall be the amount of expenditure incurred by such employer. Whatever is the cost the employer has incurred, that will be the perquisite. However, the following shall not be taxable as perquisite. Free meals and non-alcoholic beverages provided by the employer during the office hours at an office or business premises is not taxable. Through paid voucher which are not transferable and usable at eating joints, we call it as Zodaxo, food coupon, whatever we call it as, those things they are talking about. To the extent the value thereof either case does not exceed 50 rupees per meal. Up to 50 it is exempt. For what if it is above 50, up to 50 it is exempt. Means assume the cost of the meal is 80 rupees minus 50, 30 is only taxable, not entire 80. Only 30 is taxable. Only 30. Okay. Sir, what if the cost of meal is only 40? Nothing is taxable. Next, tea snacks provided by the employer during office hours. Free meals provided during the working hours in remote area. Yes, exempt guys. Nothing is taxable. Next, free or concessional tickets. The value of any benefit or amenity provided by the employer who is engaged in the carriage of passenger or goods. Means employer is engaged in transportation business. Employer is engaged in transportation business. He is telling his employee, anyway, my bus or my vehicle, you go travel freely. You travel freely, and in that case, to any employee or to any member of his household of a private journey free of cost or at concessional fare. In any conveyance owned, leased or made available by any other arrangement by such employer for the purpose of transport of passenger or goods. What is the taxable value of perquisite? Value at which such benefit or amenity is offered by such employer to the public. Means, now sir, we are traveling in a bus owned by my employer. He told free of cost, travel Vikas along with your family. How much he is charging for others? Assume 5,000 rupees. So in that case, what is the taxable value of perquisite? 5,000 rupees. Whatever is charging for others. So if anything is recovered, we will reduce it. Next, however, there would be no such perquisite to the employees of airline and railways. Sir, Indigo has given a free air ticket to one of his employee, best performing employee, to travel all over India for 6 months or 1 year. In that case, will anything be taxable for them? No. Same way Indian Railways. So if any of your family members are working in Indian Railways, you know that they have a benefit. Their family members can travel free of cost. The family members of the person who is employed in Indian Railways, they can travel free of cost in railway, not in whichever mode you want. In that case, sir, will anything be taxable as perquisite in the hands of that employee? No, nothing is taxable. Value of perquisite in respect of gift. Gift, there are two categories. Gift by employer is covered here. Others I have just mentioned it here so that you will have an idea. If gift is given by employer, check what is that gift. Is it in kind or is it in cash? That is in money. If it is in money, always fully taxable. Whatever money is given. Clear? Best employee of the month, 2,000 cash, take it. Next month, 5,000 cash, take it. So in that case, it is fully taxable. A part of that you have to give it to government as gift. Next, in kind. Sir, what if it is gift is given in kind, like watch or any vouchers or anything like that? If the FMV of that gift is less than 5,000, nothing is taxable. If it is more than or equal to 5,000, entire amount is taxable. Entire amount is taxable. Sir, employer gifted the watch to the employee. whose cost is 4,000 or fair market value is 4,000, nothing is taxable. Sir, cost or fair market value of the watch is 8,000. Entire 8,000 is taxable. Entire 8,000 is taxable. If it is less than 5,000, whatever is the amount, nothing is taxable. Yeah. Then, sir, what if it is given by others, not employer? Then we have to check the applicability of section 56 to 10 under the head other sources. Given by others, guys. Next, sweat equity shares. Value of perquisite in respect of specified security or sweat equity shares. Now, see, as per Companies Act 113, no company can issue shares at discount. But sweat equity shares are allowed. Legally valid. Value of perquisite would be what? Fair market value of the shares issued on the date of exercising the option minus amount paid by the employee to acquire the shares, guys. Clear? Means here the shares would be offered to the employee at a discounted price because of his contribution to the entity or to the company. So assume the fair market value of the shares is 500 rupees. Shares has been offered to the employee at 300 rupees. So what is the discount he is enjoying? 200. So if you had purchased the shares of the company, you should have paid 500 in the open market. So he has to pay tax on 200 rupees. Clear? Into number of shares. Into number of shares. Later, in the future, if your employee sell these shares, what is the cost of acquisition for him? 500. What will be the cost of acquisition for him? 500. So fair market value. If shares are listed on a recognized stock exchange, average of opening price and closing price of the shares we have to take. If it is listed on a recognized stock exchange. Sir, what if it is listed on more than one recognized stock exchange? NSE also, BSE also. In that case, average of opening price and closing price of the share on the recognized stock exchange which records the highest volume, that is the quantity, buy and sale quantity. Check on the date of exercising the option, whether the shares are highly traded in NSE na BSE. So assume it is NSE, take the average of opening and closing price. Sir, what if the shares are not at all listed? Private company shares, sir. In that case, value as determined by merchant banker. He is the one who will decide the value of the shares, guys. Then use of motor car we already seen. Next, value of perquisite in respect of credit card expenses. Taxable value of perquisite is equal to membership fees or annual fee incurred by the employer on a card provided to the employee. Means card is enjoyed by employee, expenses made by employer. So whatever cost the employer is meeting, that will be the perquisite in the hands of employee minus amount recovered. However, such expenses incurred only and exclusively for official purposes, means office, would not be treated as perquisite subject to certain condition. Means employer has to maintain the data, okay, that it is incurred for official purposes and all. Then value of perquisite in respect of club expenditure. Taxable value of perquisite is equal to cost incurred by employer minus amount recovered from employee. However, in case of employee enjoys corporate membership in a club, the value of benefit wouldn't include the initial membership paid by the employer to acquire the corporate membership. However, again same story, same like before. Such expenses incurred only and exclusively for official purposes would not be treated as perquisite, guys. Then value of perquisite in respect of health club, that is gym and all. Sports similar facilities, no perquisite if provided uniformly by the employer to all the employees. Sir, if it is given to only selected employees, then for that employee it will be taxable. The cost of employer will be the perquisite to the employee. Next, employer contribution. Employer contribution, guys, please be careful because for PF and all, both employer as well as employee will be contributing, but what is considered here is only employer contribution. As per section 17 to 7, total of the following in excess of 7,50,000 during the previous year will also be taxable under the head salary as perquisite. What are those? Employer contribution to recognized provident fund, employer contribution to approved superannuation fund, employer contribution to national pension scheme. Okay. Now assume all these three put together during the previous year. Employer has contributed 10 lakh. 10 lakh. In that case, how much is in excess of 7.5 lakh? 2.5 lakh. So this is taxable as perquisite in the hands of employee. Also, on this 2.5 lakh, whatever interest or income is earned, that is also taxable in the hands of employee as perquisite, guys. Clear? So amount in excess of 7.5 lakh, that is taxable plus interest on that or income earned on it, both. Sir, what if all these three is not there? Assume only recognized provident fund is there. Check how much is the employer contribution. Assume 5 lakhs, sir. Nothing is taxable. Sir, 8 lakhs, sir. Only 50,000 is taxable. Only 50,000 is taxable. If all three is there, assume employer contribution to recognized provident fund 8 lakh. Superannuation fund 5 lakh. Then national pension scheme 2 lakh. So totally 15 lakh. Agree na? So in excess of 7.5 lakh, how much is there? 7.5 lakh. So how much is taxable perquisite in the hands of employee? 7.5 lakh plus income earned on this. Okay, income will be earned on the entire 15 lakh. But what would be taxable is only income earned on 7.5 lakh. That is the taxable component. Next, tax-free perquisites. In all the cases, means the following perquisites are always tax-free, guys. Nothing is taxable in the hands of employee. The value of the following perquisite is not to be included in the salary income of the employee. What are those? Refreshment. The value of refreshment provided by the employer during the office hours and in office premises is fully exempt. Then, subsidized lunch or dinner. Subsidized lunch provided to an employee during the working hours at office or business premises, provided the value of such meal is up to 50 rupees. If it is above 50, up to 50 exempt, remaining would be taxable. Recreational facilities. The value of recreational facilities provided is exempt. That is like in-house indoor games and all. However, the facility should not be restricted to selected few employees. It should be open to all the employees. Telephone facility. Telephone facility provided, not telephone allowance. Telephone facility means connection is given in the employee's house for which bill is paid by employer. Telephone facility provided at the residence of the employee is exempt to the extent of amount of telephone bills paid by the employer when it is used for official and personal purposes of the employee. Transport. Transport provided by the employer to an employee as a group and not to any individual or a few employees alone from their place of residence to the place of work. We call it as cab facility, which is exempt, guys. Then, perquisite allowed outside India by the government. For this person, even allowance is fully exempt. Any perquisite provided by central government to a citizen who is working outside India but for the government is completely exempt. Then, employer's contribution to staff group health insurance scheme is exempt in the hands of employee. However, if it is a life insurance premium paid by the employer for the policy taken in the name of employee, it will be taxable. It would be taxable, guys. Personal accident insurance, again exempt. Payment of annual premium by employer on personal accident policy affected by him to his employee is exempt in the hands of employee. Next, amount spent on training of employees. Amount spent by the employer on training of employees or amount paid for refreshment management course, including expenses on boarding and lodging, is exempt. So for improvement of any skill or any training is given for the employees. Assume, sir, employees has been sent to different place along with accommodation, food, everything is taken care. Full amount is exempt. Free rations. The value of free rations given to the armed force, that is army, guys. Personal is exempt. Okay. Computer or laptops is again exempt, which is given for usage. Then rent-free houses or conveyance. Rent-free houses or conveyance to High Court. Conveyance in the sense any vehicle. To High Court and Supreme Court judges, officer of Parliament, Union Minister and leader of opposition in Parliament are exempt. Tax paid by employer on a non-monetary perquisite of employee is exempt in the hands of employee under section 1010 CC. See, on the income earned by employee, he has to pay tax. Sir, what if employer has paid? If employer has paid tax on the employee's income, then it is again a perquisite in the hands of employee. But tax paid by employer on non-monetary perquisite of employee is exempt in the hands of employee. Non-monetary perquisite means which is not in the form of money. Like car is given, house is given to stay, that we call it as non-monetary perquisite. Next, medical facilities, which is given here. Fixed medical allowance is always fully taxable. Medical allowance, which is fully taxable. Sir, what about medical facility? The following medical facilities provided by the employer are not chargeable to tax. The value of any medical facility provided to an employee or his family member in any hospital, clinic, or etc. maintained by the employer. Guys, in two hospital, if the treatment is given, it is fully exempt. That is, the hospital which is owned and managed by employer or the hospital which is owned and managed by government or local authority. If the treatment is given in these hospitals, Assume the employer has paid it, or in his own hospital he has given free treatment for employee or his family members. Nothing is taxable. Nothing is taxable. Sir, what in any other private hospital? Whatever is the cost to the employer would be taxable. Whatever would be the cost to the employer, that would be taxable. Sir, what if medical facility is outside India where the cost is incurred completely by employer? In that case, cost of medical treatment and cost of stay, that is the accommodation there, is exempt only up to the limit permitted by RBI. Whereas the cost of travel is exempt only if gross total income of the employee, gross total income, not gross salary, gross total income of the employee before including such expenditure doesn't exceed 2 lakh. If it is more than 2 lakh, whatever travel expenditure is incurred by employer is taxable. If it is within 2 lakh, nothing is taxable. Whereas medical treatment cost and cost of stay will be exempt only up to the limit permitted by RBI. Next, leave travel concession. Leave travel concession 10(5). Any employee can claim exemption under section 10(5) in respect of leave travel concession. Exemption under section 10(5) is available to all the employees, Indian as well as foreign citizen. Exemption is available in respect of value of any travel concession or assistance received or due to the employee from his employer, including former employer, for himself and his family members. Who is traveling means assessee along with his family members, in connection with his proceedings to any place in India. Means travel is to any place in India. Sir, what if I am going foreign? Nothing is exempt. Either on leave or after retirement from service or after termination of his service, guys. So either on leave, that is you are doing employment, or after you are retired you are going, or after termination of the service you are going, for which the entire sponsorship is taken care by whom? Employer. Entire expenditure is taken care by employer. Exemption is amount of exemption, actual amount spent by the employer or the amount specified as per the class, whichever is lower. Means class of travel, depending upon the mode of transport. Exemption can be available only for 2 journeys in a block of 4 years. The block applicable for current period is calendar year 22-25. 22 to 25, guys. Sir, maximum exemption which you can claim in a block is 2. But if you have not utilized one or both, you can carry forward 1. Maximum you can carry forward 1, and in the next block you can claim maximum 3, guys. Then salary paid tax free, guys. On the salary income of on the salary income of employee is the one who is liable to pay income tax. But employer came forward and told, I will only pay that also. In that case, whatever income tax which employer is paying for employee, that is also perquisite in the hands of employee. But tax paid by employer on the non-monetary perquisite of employee is exempt in the hands of employee. Clear? Sir, what about any other benefit or amenity? We saw some list. Is that the end list? No, may not be. The employer might be giving some other fancy benefit to the employees. In that case, what is the value of perquisite? The value of any other benefit or amenity, service, right or privilege provided by the employer shall be determined on the basis of cost to the employer under an arm's length transaction as reduced by employer's contribution, if any. Arm's length transaction means the transaction between 2 unrelated parties, guys. 2 unrelated parties at a fair price without one being controlling the other. Okay. Now coming to retirement benefits. Gratuity. Exemption is given under section 10(10). The gratuity received at the time of retirement or termination of employment or death of the employee is exempt as under. If it is received by government employee, 100% exempt. Then non-government employee, check whether they are covered under POGA Act. POGA means Payment of Gratuity Act. If yes, least of the following is exempt. Actual gratuity received or statutory limit of 20 lakh, or the last one. Last one is very important. 15/26 into last drawn salary per month, that is before you retire, into number of years of service completed. Round off if months is more than 6 months. So 20 years, 9 months. 20 years, 9 months means you have to take 21 months. 21 years. Same way. Sir, what if it is 20 years, 3 months? You have to take 20 years. Clear? More than 6 months, you have to round it off. Okay. Next. Sir, what if is a non-government employee not covered under the POGA Act? Means not covered under the Gratuity Act. In that case, least of the following is exempt. First 2 points are same. Actual gratuity received or statutory limit of 20 lakh. Last one is different. Please be careful with the last point. First 2 is common for both guys. Last one. Half into average salary of last 10 months per month into number of years of service completed. No round off is required. No round off. Clear? No round off means only years you will take. 30 years, 9 months, 30 years. 30 years, 4 months, 30 years. 30 years, 11 months, 30 years. You have to take only years. Ignore completely the months. Okay. So what if gratuity is received during the service? It is fully taxable. If gratuity is received during the service, it is fully taxable, guys. Now, commuted pension. The exemption is given under section 1010A only for commuted pension and not for monthly pension. First of all, sir, what is commuted pension? Guys, assume I retired from my employment. I am receiving a monthly pension of 20,000 rupees per month. Sir, is it taxable? Yes. Whatever monthly pension I receive, irrespective of whether I am a government employee or a non-government employee, always taxable under the head salary. Sir, after you retire, how come under the head salary? Because that is again connected to my employment. Why am I receiving pension is because I have given employment service to my employer. So again connected to that employer-employee relationship. Clear? So even after retirement, if I am receiving any monthly pension, it will be taxable under the head salary. But sir, what if employee has died and his family members are receiving family pension? Then in the hands of the family member who is receiving the family pension, it will be taxable under the head other sources. It will be taxable under the other sources. Now, what is this commuted pension? Commuted pension, as I told you, assume I am receiving a monthly pension of 20,000 per month. Now, there is some emergency. I want some lump sum amount. So, what I requested my employer is, sir, please give me some lump sum instead of giving me monthly pension. So, assume my employer gave me 60% of whatever I am supposed to receive monthly pension in the future. He commuted it, means calculated it, and he gave me 6 lakh rupees lump sum amount. He gave me 6 lakh rupees lump sum amount. This we call it as commuted pension. Okay, now monthly pension. First we will talk about monthly pension. Sir, assume this we did it on 1st September, guys. 1st September of our previous year. Okay, so that means from 1st April to 1st September means 30th August. 1st April to 30th August, I am receiving how much monthly pension? 20,000. Yes, sir. Then on 1st September, I did commutation. Yes. So, will I continue to receive same 20,000? No, 60% is commuted. That means remaining 40% I will continue to receive. Yes. So, till 31st March. Till 31st March, how much I will continue to receive? 20,000 into 40%. Into 40% per month. Okay, sir. So in that case, sir, what we have to do? Monthly pension, whatever is received from April to August, fully taxable. Fully taxable. For how many months, sir? April, May, June, July, August, 5 months. So into 5 months. Then monthly pension, whatever we receive for the remaining 7 months, not entire 20,000, only 40% of it, will also be taxable. Will also be taxable, irrespective of who I am. Now, during the year, that is on 1st September only, I commuted and received 6 lakh. Sir, is that also taxable? Yes, but exemption is available. If I am a government employee, entire 6 lakh is exempt. Entire 6 lakh is exempt if I am a government employee. Sir, what if I am a non-government employee? Then, it depends on whether I have received gratuity also or not. Guys, if I have received gratuity, double benefit I am getting, that is when I retired, I got a lump sum amount in the name of gratuity also. Now I am also getting monthly pension, but I commuted that and received lump sum. So double benefit I am getting not from the government, from my employer only. Still, in that case, they are telling the amount of exemption what they will give is less. So what is the amount of exemption? For the employee, non-government employee who is receiving gratuity, 1/3 into commuted pension received divided by commutation percentage means, same example, let us take my example, 6 lakh we have received. By commuting how much, sir? 60%. 60% means if you had received the entire commission, how much you would have got? That is what the calculation we are doing. Okay, into 1/3 of it. Into 1/3 of it. Sir, what if I had not received gratuity? Then instead of 1/3, it is 1/2. The amount of exemption would be more. Sir, 3 more than 2, no, so don't go by that. Okay, 1/3 means the amount of exemption is less. 1/2 means the amount of exemption is more. Okay. Please be careful with this. By chance, students may go mistake with this. That is 60% is commuted percentage. Remaining, you will continue to receive monthly pensions. So, what I applied here was remaining percentage. What I am applying here is commuted percentage. Clear? So, please be careful with those percentages. Sir, what about government employee? Received gratuity, not received gratuity? It doesn't matter. It is always exempt. Okay. Monthly pension, as I told you, is always fully taxable. Now coming to leave salary or leave encashment, we call it as. Exemption is given under section 1010AA. So first of all, what is leave encashment? Guys, every year employer will be allowing the employee to take a number of leaves, paid leaves. Okay, like 30 days, 40 days, 45 days. It depends on employer. Okay, how much ever days he want, he can give it to the employee. So some employers will give 15 days, 30 days, 45 days, 60 days, how much ever it is. So assume my employer has given me a paid leave of 50 days per year. Every year I can take 50 days leave with pay. Means for whatever leave I take also they pay me. Okay, they will not deduct it from my salary. Over and above 50 if I take, yes, they will deduct from my salary. Now assume, sir, every year I was very well, so no health issues and all. So I have not taken very, much leaves. So too much of credit I had. Means every year I used to take only 5 to 10 leaves. So whatever remaining is there, na, that will be eligible for me as leave credit. Leave credit. Now during my employment or at the time of retirement, I can encash this leave credit. Means I can submit this leave credit to my employer and get the money for it. Assume guys, at the time of my retirement, I had 8 months of leave credit. Means which I was eligible to take but didn't take during my employment. So if I submit this 8 months credit, I will be getting the salary equivalent to 8 months. Over and above, for whatever I have worked, they would have paid salary. Over and above that, they will give me 8 months salary for leave credit. This can be encashed during the employment also or at the time of retirement. But if I have encashed during the employment, it is fully taxable. It is fully taxable. If I have encashed it at the time of retirement or termination, then exemption is available under section 1010AA. What is it? We will see. If the employee is a government employee, 100% exempt. If an employee is a non-government employee, means other than government. In that case, least of the following is exempt. 4 conditions are there. Please be careful. Actual leave salary received. Okay. Statutory limit of 25 lakh. Yes. Last 10 months average salary. That is before you retire or terminate. What is the salary you have got in the last 10 months? Before the date of retirement. Okay. Into 10 months. Sir, what is this? Last average salary of last 10 months into 10 months? Yes, that is how it is there. What you have to do is last 10 months, we have to take your basic pay plus DA plus commission for DA and commission condition attached. So last 10 months before you retire or terminate, how much basic pay plus DA plus commission you got, you take it. If it is same, there is no increment hike and all, monthly salary straight away you can take. No sir, in between in the last 10 months there was an hike or increment. Then in that case, take last 10 months salary, only basic pay plus DA plus commission for DA and commission condition is there. Add up everything, divide it by 10 months. So you will get average salary per month for the last 10 months. Multiply it with 10 months. Multiply it with 10 months. Okay. Then leave credit into 10 months average salary. Whatever we have got here now. So same thing, 10 months average salary per month it would be into leave credit. Sir, what is this leave credit? Leave credit has to be calculated as per Income Tax Act, guys. Very important. Sir, how to calculate it? Leave eligible as per IT Act is 30 days for each completed year of service. For each completed year of service by the employee, he is eligible to take only 30 days leave. That means 1 month. Okay. Now assume I have completed 30 years, 9 months of service. How much leave I can take? 30 months. Sir, 9 months? No proportionate at all. For each completed year of employment service, I can take 30 days leave. Sir, can we calculate proportionately 33 days, 34 days, 35 days and all? No. It should always be 30 days for each completed year. Sir, I have completed 31 years, 2 months. Take 31 months. 31 months, guys. Okay. Now, sir, employer might be giving 45 days, 60 days. They will confuse you in the question sometimes like that. Employer might be giving it. But as per IT Act, while calculating this leave credit, you should always take 30 days. Okay. So leave eligible as per IT Act, that is 30 days minus leave taken. Leave taken will never change. Whether it is as per employer or as per IT Act, it will remain the same. Actual can never be changed, guys. Clear? So please be careful with it. This is what the leave which the employee has taken during his service. Okay, this is all about the leave encashment. Then provident fund. There are different types of provident fund. Statutory provident fund available only for government employee or of any university or college. For employee contribution, guys, first of all, sir, what is PF? PF is for the benefit of employee after he retire, so that he should be independent. So that he should be independent even after he retire. He need not depend on his children's or anyone else for his financial needs. So what government has done is, employer, you open the PF account in the name of employee. Whenever employee join for your employment in your company, open the PF account in the name of employee, and every month you also contribute, employee also will contribute. Minimum 12%. Minimum they are told 12%. Sir, can employer contribute more than that? Yes, your wish. But minimum 12%. Okay, both has to contribute. So for every PF account, employer contribution would be there, employee contribution would be there, plus PF will give interest for it because we have contributed. So are we withdrawing every month? No, no. Whatever we are contributing, we will be withdrawing normally at the time of retirement or whenever there is any need. Till then they will give me interest. Yes. So interest will be both on employer contribution as well as employee contribution. Clear? So there are totally 4 components. What are those guys? Employer contribution, employee contribution. We call it as principal contribution. Whatever money we are contributing. In the name of whom? PF account of employee. Account is in the name of employee. Sir, can now employer withdraw this money and go for a tour? No, no, no. Okay, it is in only for the benefit of employee. Next, on both the contribution, that is employer contribution as well as employee contribution, interest would be credited. Credited to PF account, not to your bank account. Here it is called, we call it as compounding. The interest would be compounding monthly or yearly. Okay, sir. So for all this contribution, is it taxable or is there any tax benefit? We will see, guys. Guys, employee contribution, is employee getting any benefit? No. Sir, for my own account, PF account is in whose name? My name. For my own account, I am contributing. So it is not my income. Okay. Employer contribution, is it an income? Yes. Sir, interest, is it an income? Yes. But is it taxable is a question mark. We will see. Okay. Employee contribution as an investment, they are telling we will promote it. So we are giving deduction for employee contribution under section ETC. Then employer contribution fully exempt. Fully, how much ever employer is contributing, 12% or 15% or 100% or how much ever is contributing, exempt. Interest is also fully exempt, irrespective of the actual interest rate. Okay. Then recognized provident fund. Recognized provident fund means which is recognized by the income tax department or the commissioner. For employee contribution. So recognized, unrecognized is available for other than government employees, guys. Okay. For employee contribution, deduction is available under section ATC, and for employer contribution, it is exempt only up to 12% of the salary. Sir, what if employer is Dana Pura Sharana? He has contributed more than 12% for the benefit of the employee. In that case, in the hands of employee, in excess of 12%, whatever is there is taxable under the head salary. For example, employer has contributed 14% to recognized provident fund of the employee. 2% would be taxable, guys. 2% would be taxable. Sir, here salary means what? Same story, basic pay plus DA plus commission. For DA and commission, condition attached. Then interest. Interest is exempt up to 9.5% per annum. Sir, what if it is in excess of 9.5%? Assume it is 10%. In that case, 0.5% would be taxable. Actual interest rate now in the market on PF is less than 9.5, but for academic purpose, they may give any percentage. So please be ready with it. So please here remember the percentages, guys. And 9.5% of salary, sir. No, interest rate. 9.5% is not of salary, interest rate. If interest rate is less than 9.5, nothing is taxable. If it is more than 9.5, only excess is taxable. Unrecognized provident fund. So again, if by chance any provident fund which is opened by non-government employer, if it is not recognized by the department, we call it as unrecognized provident fund. Department is not promoting it. It is unsafe. It is not safe to invest there. And that is what they are highlighting. So they are not giving any tax benefit. For employer contribution, there is no deduction under section ATC. Okay. For employer contribution and interest, it is taxable, but not yearly or monthly. It will be taxable only when you are withdrawing it. Fine, sir. Now, when you are withdrawing it, I already told you how it is taxable. When you are withdrawing employee contribution, sir, I gave, I am getting it back. Nothing is income. Employer contribution, whatever is there, is taxable under the head salary fully when I am withdrawing. Then interest on employer contribution, again taxable under the head salary. Interest on employee contribution is taxable under the head other sources. Irrespective of the interest rate, it is fully taxable. Okay. Next, public provident fund, open to public. Anyone can open it. Guys, For the first three to be opened, there should be employer-employee relationship. Employer will be opening it in the name of employee. Whereas public provident fund, anyone can open. Sir, I am a self-employed, I am an entrepreneur. Can I go and open it? Yes. Sir, can I open it in my minor child name also? Yes. Can I open it in my wife's name who is a housewife? Yes, I can open it. So public provident fund, only employee contribution will be there, no employer contribution here. So deduction under section 80C for assessee's contribution. Let us not call it employee's contribution, assessee's contribution. So for my contribution, I can claim it under section 80C. Then interest is fully exempt. Interest is fully exempt, guys. Yes. So in the previous class, in the previous section, we have seen that, sir, if employer contribution to recognized provident fund, approved superannuation fund and national pension scheme NPS is in excess of 7,50,000, the excess part is taxable in the hands of employee. Agree? Yes, sir. Now, sir, for recognized provident fund and all, if it is in excess of 12% also taxable. If it is in amount term, if it is in excess of 7,50,000 also taxable. That means it may lead to double taxation. Yes, it may lead to double taxation. But that is how they have framed it, guys. Okay, when the contribution is huge, that means you are wealthy enough to pay more tax. That is what they are trying to do. But somewhere that 7,50,000 thing, whatever we saw under perquisite, that is a recent provision which they have made. But somewhere that is missing the actual principle of the income tax law, because the actual principle of income tax law is they have clearly told we will not tax the same income twice. But somewhere that is missing there. Maybe in the future they may come out with the amendment. We don't know. Let us see. Okay, that is how it is there in the provision, guys. So you need not get confused. Now coming to notes. Withdrawal of an amount from recognized provident fund before the continuous service of 5 years is taxable. Sir, normally when you withdraw the amount from recognized provident fund, it is not taxable. Completely tax-free. But if you are withdrawing it within 5 years, the purpose of RPF itself or PF itself is to benefit you after you retire. Sir, I started my employment 2 years back. My PF contribution was there around 40-50,000. I withdrawn and purchased iPhone, sir. Or I went for a Goa trip, sir. People will literally do this. I have seen. So in that case, what happens? Sir, will they enjoy the exemption? No. At least 5 years of service you should have completed. But it is not taxable in case of disablement, ill health, contraction or discontinuance of employer's business. Means if you are withdrawn within 5 years due to any of this reason, it is exempt. It is exempt. Now, exemption under section 1011, 1012 would not be available in respect of interest accrued. Interest they are talking about, only interest. During the previous year, to the extent it relates to the amount or aggregate of amounts of contribution made by that person or employee exceeding 2,50,000 or 5 lakh when there is no employer contribution. If there is employer contribution, limit is 2,50,000. If there is no employer contribution, then 5 lakh. In any previous year, in that fund, on or after 1st April 2021. This provision was brought from 1st April 2021. Sir, what are they talking about? Guys, employee contribution, not employer contribution. Employee contribution, if it is in excess of 2,50,000 per annum. Per annum. Assume, guys, employee in the previous year 23-24, employee contribution is 3 lakh. How much is in excess of 2.5 lakh? 50,000. On this, whatever interest is earned is taxable. Not 50,000. Interest is taxable. Not 50,000. Please be careful. And whose contribution we are talking about? Employee contribution. Please be careful. Yes, sir. Next, sir, only employee is contributing, sir. Employer is not contributing. It cannot happen like that. But if at all, if it is like that, sir, only employee is contributing. In that case, instead of 2,50,000, they are told it is double of that. 2x, 5 lakh. Clear? Means employee contribution up to 5 lakh will not be taxable. If it is in excess of 5 lakh, for example, let me take. Assume only employee is contributing. Only employee is contributing 7 lakh. Only employee. Okay. Now, in that case, how much is in excess of 5 lakh? 2 lakh. On 2 lakh, whatever interest is earned, assume 8%, that is taxable. That is taxable. 16,000. 16,000 is taxable, not 2 lakh. Is that clear? And please be careful. This is different from what we have covered. 7,50,000 thing. That is for employer contribution. Employer contribution to 3 funds in excess of 7,50,000. Assume the employer has contributed 8 lakh. In excess of 7.5 lakh, how much is there? 50,000 is there. This is also taxable as perquisite. Plus, on this, whatever interest is earned also is taxable as perquisite. This is for employer contribution. Okay. Next, coming to deductions, important deductions, especially 16(1)(a), very important. Standard deduction under section 16(1)(a) available for all the employees. Whoever is having salary income, they can claim a standard deduction of 50,000, guys. 50,000 means, sir, what if my gross salary itself is less than 50,000? You can claim only that much. You can claim only that much. But if my gross salary is more than 50,000, then straight away a flat deduction of 50,000 you can claim. Guys, many a times question will not mention about this, but still you have to consider it. Clear? And many a times the question may not be completely on salary. A part of the question is salary. They would have given Vikas received a salary of 10,000 per month or 20,000 per month, or Vikas received a pension of 20,000 per month. In that case, you have to take care of standard deduction. Clear? Sir, in the question they have clearly given income from salary in bracket computed. Then no, it is already computed figure. Standard deduction is already taken care. Please be careful with it. Next, entertainment allowance deduction, not exemption, deduction. It is available only for government employees, guys. First, you include it in the salary, whatever entertainment allowance, actual entertainment allowance received is included in salary. Then, deduction is least of the following. Actual entertainment allowance received 20% of basic pay or 5,000. 5,000. Sir, 5,000 per month? No, 5,000 per annum. Okay, whichever is lower. The entire amount of entertainment allowance will be first included in gross salary, and deduction is allowed only for government employees. Then profession tax. This is the tax paid by the to be paid by the employee to the state government for providing the employment in that state. Sir, state government didn't give me the job, sir, my employer gave. Yes, but employer has been given the opportunity to run the business in the state, na? Yes, so he is enjoying the resources of the state. Yes, so employee is liable to pay profession tax to the state government. So it is obligation of employee, guys. If employee has paid it, straight away claim deduction of whatever you have paid. Sir, employer has paid on behalf of employee. In that case, first include it in the gross salary as perquisite. Because what employee was liable to pay was paid by employer. So first include it in the gross salary as perquisite and then claim the deduction. Ultimate effect would be nil. Clear? And it is always allowed on payment basis. Sir, for current year I didn't have money, sir. So I asked Karnataka state government, wait, next year I will earn well and I will give both the years. So can I claim the deduction in the current year? No, you cannot. Okay, it is allowed only on payment basis. Okay. Important note with respect to salary, that is whenever we are calculating the exemption or the perquisite value and all, sir, what value should we take? They would have mentioned 10% of salary, 15% of salary, 7.5% of salary. So what is salary, sir? I have given it as a summary here, guys. For the purpose of this chapter means salary. Salary is equal to basic pay plus DA if provided in terms of employment or forming part of retirement benefit, one and the same, plus commission if it is expressed as a fixed percentage of turnover. So wherever we are considering certain percentage of salary, we have to take this. But it will change in 3 scenarios, guys. It will change in 3 scenarios. Sir, when is it? Gratuity covered under the Gratuity Act for non-government employee, where salary is only basic pay plus DA. Basic pay plus DA. That is non-government employee who is not covered under the non-government employee who is covered under the Gratuity Act. Please be careful. Sir, what about the non-government employee who is not covered under the Gratuity Act? For them, basic pay plus DA plus commission. Okay. Next, entertainment allowance, it is only basic pay. Just now we saw it is 20% of basic pay. Okay. Sir, what about perquisite? Especially that is for rent-free accommodation. Nowhere else in perquisite they will refer to salary and all. In perquisite, rent-free accommodation, salary is equal to basic pay plus DA if provided in terms of employment plus bonus plus commission, no condition, please be careful, plus any fees and all taxable allowances. Sir, what about perquisites? We should not take it. Sir, what about any retirement benefit which I am receiving? We should not take it. Clear? This is what salary we have to take care, guys. So at the end, we have the impact of default scheme on salary head. And before this, guys, sir, can we have any loss under the head salary? No, there is no chance of having loss under the head salary. If employer is appointing you, because of you, he may suffer loss. Clear? But you will never suffer loss. Okay. Now, impact of, that is the default scheme under section 115 BAC on salary head. That is, if the individual HUF, AOP, BOI or artificial juridical person, if they are following default scheme, they have to forego certain exemptions and deductions. So under salary head, what they have to forego, we are seeing it in this single table, guys. Okay, first, so wherever I have given in red color, danger anta, not allowed for them. Okay, green means allowed. So remember either of the two, guys. If you try to remember both, it might be confusing. Either of the two you remember. What is allowed or what is not allowed. So which is easy? You decide. HRA not allowed. HRA exemption 1013A. Sir, I am paying rent, sir. Doesn't matter. Okay, even you would have satisfied all the condition given under 1013A. But still, if you are following default scheme, no exemption. Then any allowance paid to High Court or Supreme Court judges and paid by UNO to its employees, not allowed. Any allowance payable outside India, any allowance and perquisite, that is allowed. Okay. By central government to citizen of India rendering service, yes, sir. Next, I have given it in the order so that it becomes easy for you. Exemption under section 1014(1), that is for employment related expenses, guys. Traveling allowance allowed, conveyance allowance allowed, daily allowance allowed. Then helper allowance, any allowance granted for encouraging the academic or research and training pursuits in educational and research institution, uniform allowance, not allowed. Okay, this three not allowed. Then exemption under section 1014(2), that is personal. Children education allowance, hostel expenditure allowance, other allowances, any special compensatory allowance, not allowed. Only one thing is allowed is transport allowance to handicapped, deaf, dumb, blind employee, that is 3,200 per month. Only that is allowed. Okay, sir. Next, coming to perquisite, allowance is done. Perquisites. Perquisite only these three are not allowed. All others are allowed, guys. Okay. Free food and beverages through vouchers provided to employee up to 50 rupees per meal or per snacks or tea and snacks is completely exempt. Meals means up to 50. Tea, snacks and all fully exempt. Milk and all. Sir, 50 rupees they were giving. That is also they are telling now we will not give if you are keep it. Enjoy. Even this children education allowance 100 rupees. What is that? Hostel 300 rupees and all. Now, sometimes we should have very good opinion on our government. But by doing all this, I don't know what opinion they are creating to the people. Leave travel concession under section 10(5), that is in a block of 4 years you can claim twice and all. No? So that is also not allowed. Then leave rent-free official residence and leave travel concession provided to an High Court or Supreme Court judge, not allowed. Any other perquisite exemption if it is there. I am not telling any other perquisite fully exempt. No. We saw the list of tax-free perquisites. Na? So those things are exempt. Clear? So please be careful. Whatever we have learned, if you have learned that that is exempt, they will enjoy the exemption. If you have learned that it is taxable for them also. Clear? Whereas this three, even though for others it is exempt, for the assessor who is following default scheme, it is not exempt. It is like that. Then coming to retirement benefits, everything is allowed. Thank you. Everything is allowed. When they are retiring. Na? So deductions under section 16, very important change. Standard deduction which was not allowed before, now is allowed. Previously this was blocked. Please take care of it. Standard deduction is allowed, remaining two is not allowed. Remaining two is not allowed. So please take care of this, guys, because this would be the twist in most of the questions. Because they will not mention about standard deduction, but still whenever you are calculating salary income, you have to provide for it. It is your duty. Okay, done with salary rate. Next, chapter 4, income from house property. Section 22 to 27 talks about income from house property. Sir, what about section 18 to 21? As I have already told, it has been omitted from Income Tax Act, guys. Sure. Next, chargeability. Section 22 is the charging section for income from house property, which talks about the annual value of the property. The annual value, not rent. They are not straight away using the word rent. Annual value of the property comprising of building or land appurtenant thereto, means attached to the land. Okay, sorry, means land attached to the building. Sir, building along with parking is there. Building along with garden is there. Or below the building also land is there. Agree na? So both are considered as house property only. Clear? So here, sir, should we differentiate how much is charged for land, how much is charged for building? No. If land is attached to the building, means even parking, gardening, or the land which is underneath the building is considered as house property for this data purpose. Of which the assessee is the owner. So assessee should be the owner of the property. Is chargeable to tax under the head income from house property. Sir, now I took the property on rent and I sublet it. For my owner, it is whatever rent I am paying is taxable under house property. But whatever rent I am earning from subletting will be taxable under the head other sources. Other sources means what rent I am charging for my tenant minus what I am paying. The net figure would be taxable for me under the head other sources. Yes. Exceptions means in the following two cases, income is not taxable under the head house property. Sir, then where is it taxable? PGBP. Huh?
PGBP.
Not PUBG. PGBP. Property occupied by the assessee for the purpose of his own business or profession. Sir, I am using my own building for my business or profession. So PGBP. Then, sir, I am engaged in the business of letting out. I am engaged in the business of letting out the property. In that case, whatever rental income I get is taxable under the head PGBP. Notes, this head deals with self-occupied property, let out property for both residential and commercial purpose. Sir, I have let out my property for residential purpose. Whatever I am earning is taxable here. Sir, I have let out my property for commercial purpose. It is taxable here. But if you are engaged, normally commercial letting out might be their business. Okay, may not be always, but I am telling you. Sir, if letting out the property for commercial purpose is my business, then it will be taxable under the head PGBP. No, sir. Sir, I have an house. Below that one shop is there. I have let out that for commercial purpose. Where is it taxable? House property. House property. You would have observed many people will be like that. Okay, means in the first floor, ground floor. In the ground floor, normally they would have made space for a shop, and in the first floor, second floor, and all people would be staying. So in that case, sir, first and second floor we have let out for residential purpose. Ground floor, shop, whatever is there, we have let out for commercial purpose. Where is it taxable? All three under the head house properties, guys. Okay, so for income tax purpose, there are three types of house properties, guys. One is let out property covered under section 24(3) subsection 1. You can have any amount of income or loss for let out property. Second one is self-occupied property or unoccupied property. Section 23 subsection 2 talks about it. Maximum, any assessee can have maximum 2 properties as self-occupied. 2 or less, not more than that. Sir, I am having 5 houses. All 5 I am using for my use or for my family purpose. In that case, only 2 will be considered as self-occupied. Remaining 3 will be treated as deemed to be let out property. Now, for self-occupied property, we will either have nil income or maximum loss of either 30,000 or 2 lakh. Either of the two, not both. Okay. In case of deemed to be let out property, one of the special nature of the income from house property, guys, even notional income can be taxable under the head house property. Why, sir? Sir, I am using my own property for my own use, sir. Still maximum you can use 2. If you are using more than 2, remaining is considered as deemed to be let out property. That means as if it is let out, and it will be taxable under the head house property. That means even though I don't have any income, still they are taxing it. That is what is called notional income provisions. Yeah. So deemed to be let out property, any amount of income or loss. Sir, how to compute the income? So under the head house property, there is a fixed format. Guys, wherever I have highlighted the format like this in the green color, please stick to the format. It is a standard format in my revision material. Wherever I have given anything in this green color highlighted, please stick to the format. Stick to the format. Please don't interchange any position as per your wish. Then the evaluator will go as per his wish. The property which is let out for rent is known as let out property. That is, sir, I have given my property for a tenant on rent. In that case, we call it as let out property. So if the property is let out or deemed to be let out, how do we compute the income from it? First, gross annual value of the house property we have to take. Sir, how to calculate it? I have given it later. We will see that. Gross annual value of the property is the base to start with. Okay. From that, we have to reduce local taxes paid by the owner during the previous year. Local tax, property tax, municipal tax, everything is one and the same. Paid by whom? Owner. During when? Previous year. Allowed on payment basis. Okay. We will reduce it. We get net annual value. Sir, what if it is paid by tenant and all? No deduction. Then deduction under section 24. 2 deductions are there. 24A, 24B. 24A standard deduction, always very important, available for everyone. 24A, 30% of net annual value. Okay. Then interest on housing loan. If at all, if it is there. If you have taken any loan for your house, then whatever interest you are paying, not principal. Principal repayment is allowed as deduction under section 80C, whereas interest is allowed here as deduction under section 24B. Yes, sir. So once you claim that, whatever you get is called taxable income from house property, which we have to include in our total income calculation. Okay. Now, sir, gross annual value, some fancy name which you have not heard. Normally, rental income is what I am earning as an owner. But what is this gross annual value? Because there is high chances of manipulations by the owners. They are made to compare actual rent with some figures, so that even if you are charging less, still you will be liable to pay tax on higher amount. Your property is worth getting 1 lakh rent rupees per month, but you are charging 20,000. You might be full, but not the department. Clear? So that is what they are telling. Even you might be charging less, but we are considering some municipal value, fair rent, standard rent and all. As per that, we will calculate the gross annual value. Now, what is municipal value? Municipal value is a value which is fixed by a municipal authority for payment of municipal tax. Municipal tax. Okay. Then fair rent means, sir, what is a reasonable rent similar property is fetching in the same locality? Means your neighbor's house. Clear? So competition will be there sometimes. Okay. They have constructed 2-floor house. We will construct 3 or 4 house. 3-floor house. Okay. Some people will be having only ground floor. Now just because they have constructed 2-floor, now they have affected my ventilation. Let me affect their ventilation. Let me construct 3 floors now. Clear? So in that case, fair rent means the rent of a similar property in the same locality. Clear? Whatever story I told, don't take that for the exam. Only follow the provisions. Chalo. And what is standard rent, sir? Standard rent is the maximum rent that can be charged. There is some control, Rent Control Act. Okay, it's now owners cannot charge how much ever they want. So there is some restriction based on the cities, tier 1, tier 2, tier 3 and all. Based on that means how much square feet is there, all those things. And in the exam, you need not worry. If at all if standard rent is there, they will give it in the question, accordingly follow it. So standard rent is like a maximum rent which the owner can charge to a tenant, guys. Okay. Where the property is let out throughout the previous year, means for full 12 months the property is let out, sir. In that case, municipal value, fair rent you compare, whichever is higher you take. Whichever is higher you will compare with rent, standard rent you will take whichever is lower. I told standard rent is maximum. So that is why we are taking whichever is lower here. Clear? And we call that as expected rent, whatever we derive. And we will compare that with actual rent. Whichever is higher is my gross annual value. Now, sir, what is actual rent? Annual rent. That is, we have let out the property for entire year. Yes. Monthly rent into 12 months. That is called annual rent. Minus unrealized rent. Minus unrealized rent. Unrealized rent means tenant is staying in my property but not paying rent. Tenant is staying in my property but not paying the rent. Sir, why? Reason we don't. Maybe he suffered loss or whatever reason. Or he is like Gunda. He is telling whenever I go, hey, you want rent or life anta. He is scaring me. In that case, I told okay, fine anta. So in that case, unrealized rent, please be careful. There is something called as loss due to vacancy also, which is different. Unrealized rent is tenant is staying in the property but not paying the rent. Okay. Now, when there is vacancy means even part of the year, need not be entire year. Sir, property was vacant for 15 days, 1 month, 2 months, 3 months. Then this is how you have to calculate gross annual value. So first we will see annual rent means the rent receivable for the year. Means simply guys, monthly rent into 12 months. Okay. Actual rent means annual rent minus loss due to vacancy minus unrealized rent. Unrealized rent I have already explained you. Unrealized rent you can reduce both the cases, year also as well as year. You can reduce only if rule 4 conditions are satisfied. That is, the tenancy has to be bona fide and I should have taken the legal actions against the tenant to recover the amount. If not, at least I have to prove that even if I take legal action, I should only spend my money and energy and it is waste of cost. It is waste. And if I can prove, then fine. And I should have taken steps to vacate the property from a tenant and I should make sure that I am not giving some other property in some other area for the same tenant. Clear? Yes. Only then I can reduce the unrealized rent. Then what is loss due to vacancy? That is due to vacancy, how many months rent I lost. How many months rent I lost. Okay. That is how we calculate actual rent. So here, while calculating actual rent, we have to reduce one extra thing called loss due to vacancy. Okay. When there is vacancy, even for a part of the year, guys, how do we calculate? Expected rent, till year everything remains same. Till year everything remains same. Calculate expected rent, only last step will change. Okay. So, expected rent we will calculate till there. Okay. That we will compare with what? Actual rent plus loss due to vacancy. We will compare with actual rent plus loss due to vacancy. See, while calculating actual rent, you have reduced already loss due to vacancy. But again add back and compare these two figures. If expected rent is less than or equal to actual rent plus loss due to vacancy, then actual rent is the gross annual value. Oh. Only for comparison, we are taking loss due to vacancy. Okay, but it is not taxable because obviously I am not earned. Why should I pay tax on it? Next, expected rent is more than actual rent plus loss due to vacancy. Then expected rent is the gross annual value. Please be careful. Comparison is different. Deciding factor is different. Okay. Next, sir, this municipal tax paid we saw. So municipal tax or property tax or local tax paid by the owner during the previous year is allowed. Sir, it is accrued but not paid, sir, not allowed. Sir, paid by tenant, not allowed. Sir, for last 3 years, in 1 year it is paid. In whichever year it is paid, it is allowed fully. It is allowed fully. Sir, for the current year, it is still accrued. Owner told I will pay next year for both the years. For both the years, next year it is allowed, not in the current year. Okay. Municipal tax. Then deduction under section 24. Standard deduction 24A. Guys, see, there are 2 specific deductions under income from house property. What are those? Municipal tax paid and interest on housing loan. All other things are covered under 24A. There is no separate deduction for painting, repairs, or any depreciation on building and all. There is no separate deduction. Everything is covered under 24A standard deduction. So 24A is a standard deduction allowed for lettered property or deemed to be lettered property, which is 30% of gross annual value. Sir, whatever for self-occupied property, it is not allowed. It is not allowed. Interest on borrowed capital means if I have taken the loan for the purpose of PCRR, purchase, construction, repairs, renovation, reconstruction. Clear? So if I have taken any loan for any of this purpose, whatever interest I am paying on it is allowed as deduction under section 24B. If I am paying interest for lettered property or deemed to be lettered property, whatever interest I is getting accrued, fully allowed. No limit, nothing. Accrual basis. Not payment, accrual basis. Next. Sir, what if it is a self-occupied property? Then there is a maximum limit. Actual interest or maximum 30,000. Or actual interest maximum 2 lakh subject to conditions for self-occupied property. Sir, what is maximum 2 lakh? When is it? You have to satisfy these conditions. What are those conditions? Property is acquired or constructed from a loan borrowed on or after 1st April 1999 and such acquisition or construction is completed within 5 years from the end of the financial year in which loan was borrowed. Means check first what is the date of loan. Come to the end of that financial year. From there plus 5 years. Okay, for example, sir, date of loan is 1st August 2020. Clear? So end of the financial year. So which financial year is, guys? 2021. Correct. Huh? So end of the financial year 31st March 21 plus 5 years. Construction will take so much time, whereas purchase and all obviously they would have completed. Clear? So if it is constructed within this time, then they are telling you can claim maximum 2 lakh. Maximum 2 lakh. If not, 30,000. If not, 30,000. And please be careful, this 2 lakh is allowed only for purchase and construction. Sir, what if it is repairs, renovation, reconstruction? Maximum 30,000. Maximum 30,000. Next, sir, I had taken a loan for construction. So property is getting ready. Till the property get ready, that is before the construction is completed, how can I claim the interest? There is no property. If there is no property, there is no income from house property. When there is no income from house property, there cannot be a loss. Agree na? So when there is no property, can I claim interest, sir? No, you cannot. So hold on. Till you complete the construction, you hold on. Once you complete the construction, in the year in which you complete the construction, you can start claiming the interest from that year only. Sir, what about the interest which I have paid in the past? You can claim it in 5 equal installments from the year in which construction is completed. Clear? Listen this. Sir, I have taken the loan, date of loan on 1st April 2018. Date of completion of construction is 1st July 21. Date of completion of construction. So, which year did I complete the construction? 21-22. So can I start? Property is already ready in that year. Irrespective of the date, whatever interest is there for the entire year 21-22, you can claim in 21-22 and onwards. Whatever interest is there, you can claim it in respective year. Now, check which is the preceding 31st March for this. That is 31st March 21. Correct now? Before the date of completion of construction, which is the preceding March, you have to check. So whatever interest is, we call this as pre-construction period, guys. Pre-construction period. Whatever interest is there for this period will be allowed from 21-22 in 5 equal installments. In 5 equal installments. Is that clear? So please make it very clear. In the year in which construction is completed, irrespective of the date, you can start claiming the interest for the entire year from April to March. You can claim everything in that year only. Sir, I completed construction on 30th March, sir. Doesn't matter. From April to 31st March, you can claim full interest. Sir, what about before 31st March? From the date of loan till 31st March, preceding the date of completion of construction is called pre-construction period interest. It will be allowed in 5 equal installments from the year in which construction is completed. Clear? So for the first 5 years, you will have pre-construction period interest plus that year interest. We call it as current year interest. Whereas from 6th year, if still loan is outstanding, only current year interest would be there. Clear? Yes. Now coming to different types of property, self-occupied let-out property we already seen, subsection 1, how to calculate gross annual value and all. Self-occupied property, section 23, subsection 2. Maximum how many properties we can have as self-occupied property? 2, subsection 2. Yes, sir. So calculation format I have given here. Straight away for self-occupied property, go only for interest. Target only interest. Nothing else will come, guys. Nothing else will come. Don't worry, sometimes they will give all the masalas and all. Please don't give any importance to any other items except interest. Okay. So that is why I just mentioned the format also so that you will be very clear. Interest on housing loan, that too if it is there. Sir, I have constructed my own house with my own hard-earned money. No loan, nothing. In that case, no interest also. So in that case, income from house property would be nil. Okay. Interest on housing loan, maximum 30,000 or 2 lakh. Clear? Not both. Either 30 or 2 lakh. For 2 lakh conditions are there. If you satisfy 2 lakh. If not, 30,000. If you are claiming interest, then there will be a loss from self-occupied property, guys. And if you are following default scheme, then this is also not allowed. Income from self-occupied property will always be nil. Will always be nil. And 2 lakh or 30,000, whatever interest is there, is per person or per assessee. Sir, I have 2 self-occupied properties, sir. What is the maximum interest I can claim? 30 or 2 lakh only. It is not 30 plus 30 or it is not 2 plus 2. It is only maximum 2 lakh or maximum 30,000. Clear? Per person, not per property. Important. And please be careful, sir. I am paying only interest 20,000, sir. Claim only 20,000. Or else, sir, I have satisfied both the condition. Maximum interest is how much? 2 lakh. But I am paying only interest 1 lakh, sir. 1 lakh only. Maximum is 230. That doesn't mean that you will straight away claim that much. If interest is more than that, it is restricted to maximum 30,000 or 2 lakh. Next, property partly let out and partly self-occupied. Partly let out, partly self-occupied. How is it, sir? For few months it is let out and for few months it is self-occupied. Assume, guys, during the previous year I self-occupied my property for 4 months. Remaining 8 months I let out. It will be treated as let out property for the entire year, guys. For the entire year. So, actual rent for the let out period will be compared with expected rent for the entire year. Whichever is higher is the gross annual value. But all the deductions I can claim. Municipal tax paid I can claim for full year. And 30% of gross annual value standard deduction I can claim. And even interest for the entire year without any limit I can claim. Clear? Means as if it is a let out property for the entire year. We have to treat it. Okay. Next. Deemed to be let out property. Section 23, subsection 4. Deemed. 4th alphabet. Subsection 4. Now, in case of individual and HUF, only for individual and HUF, maximum they can have 2 self-occupied property. If it is more than 2 properties, if they are occupying for self-occupation, then the remaining properties will be deemed to be let out property. Means as if it is let out. Sir, as if it is let out means how to compute the income from house property? Expected rent will be straight away the gross annual value. Expected rent, whatever year is there now, will be straight away gross annual value. Sir, what about actual rent? We know that actual rent is 0. So, okay, now, so assume expected rent is 5 lakh. Actual rent is 0. Whichever is higher, 5 lakh. Correct, na? So, we have to straight away take expected rent as gross annual value. Fine, na? Sir, what about the deductions? Will you give at least that everything? Yes. For deemed to be let out property, it is as if it is a let out property. You can claim municipal tax paid, 30% of any gross annual value, and also for interest there is no limit. You can claim full. It is as if it is a let out property, guys. Clear? But please be careful. This maximum 2 of properties as self-occupied is given only for individual and HUF. Sir, what if it is a company or partnership firm? They have properties which they have purchased for occupation of their employees. Occupation only, self-occupation. So can they claim the benefit of self-occupation? No. Even if they are using it for their own employees to stay, still it will be considered as deemed to be let out property. Deemed to be let out property. So please be careful. This is available only for individuals and HF guys. Now, so if a person, tax planning we call it as, if a person is having more than one houses and all, or more than two houses, better to split it. Split with their family members, not outsiders. This is what many people will try to do also. Okay, means they will try to transfer it to their wife or other children and all, but for that also twist is there. Okay, where deemed ownership will pitch in. But you should make sure that when you transfer to a person, that will not come back to you or it back to you. So can I transfer it to my like brother, sister, father, mother and all? Yes, you can do it. Because here deemed ownership, which we will cover later, is applicable only if you transfer the property to spouse or minor children. Clear? Because what even income tax believe is, property will always go from year to year and it will not go from year to year. Didn't understand. From parents to children it will come, but from children to parents it will not go on. This is what they believe. And in income tax they are allowing it. Clear? Means if the child is inheriting the property from their parents, it is tax free. It is tax free. That is what one politician has told and made a ruckus. Okay, that we will bring inheritance tax in India. And that is whenever the future generation is inheriting the property from their parents, we will tax them. But somewhere I also believe it is actually to be brought. Why? See, instead of taxing me, when I earn, you are taxing me at 30%. 30% maximum. When I am giving it to my children, where they are getting it freely. Okay, definitely I have worked hard for it. And when we are passing it to the next generation, they are taking it freely without any efforts. So at least what they have to do is reduce my tax burden. Bring it to 15% or 20%. And when I pass on, maybe tax at 5% or 8% or 10%. Something like that. But still, this is my personal opinion. Property let out partially. That is, sir, guys, each house has to be treated separately. Now, sir, I have ground floor and first floor. Ground floor I am letting out. First floor I am staying self-occupied. In that case, self-occupied property is different. Then the ground floor let out property is different. Sometimes in one floor only we have two houses. One is self-occupied, one is let out. In that case, normally the municipal value, fair rent, standard rent and all will be given for the property. We have to divide it between self-occupied portion and let out portion. For self-occupied portion, we don't want anything because GAV will always be nil. Whereas for let out portion, we have to take the proportionate part. Clear? Because normally the standard rent, municipal value and all will be given for the entire property. Accordingly, apply the percentage or ratio, calculate only for let out portion. And deductions are allowed only for let out portion. Even if municipal tax paid or interest and all is given for the entire property, take it only for let out portion. Whereas interest for self-occupied is allowed. Next, inadmissible deduction. Sir, I have taken a loan outside India. I am paying interest. Can I claim the deduction under income tax law in India for while calculating the income from house property? Yes, I can claim it. But if you are not deducted TDS, you cannot claim the interest. Because you are causing loss of revenue to the government, we will also not allow the deduction for it. So for the interest what is paid outside India, only if TDS is deducted and remitted to the government, you can claim the interest. If not, no interest. Then arrears of rent and unrealized rent received subsequently. Arrears of rent means, sir, my owner has increased the rent retrospectively. My owner has increased the rent retrospectively. That is from last 2 years. He told, from COVID time I have not increased the rent. So I am increasing the rent from 15,000 to 20,000. Not from today, from last 1 year. Last 1 year. So for last 1 year, the difference I have to pay? Yes. So did he receive it in the past? No. For my owner, when is it taxable? Now he has increased it now, but retrospectively. So when I give, it is taxable for him. Okay, now? Yes, same way. Unrealized rent. So we saw unrealized rent we can reduce while calculating gross annual value only if rule 4 conditions are satisfied. All 4 conditions? Yes, sir. So while calculating GAV in that respective year, we have reduced unrealized rent. But in the future, my tenant, old tenant, realized his mistake. He came back to me and told, sir, I was your tenant. I couldn't pay the rent in that year. Please take it now. he gave back to me. So I realized it. What I recognized as a loss while calculating GAV in that year, now I am recovering it. Will it be taxable for me? Yes. Now assume by this year I have already sold the property. This person was staying in my house in 2018-19, where I was the owner of the property. After this incidents, I was fed up with this house. I thought, let me sell this property and settle somewhere. I have sold the property. Now in 23-24, the tenant came in search of me and gave the rent, whatever he was supposed to pay me in 18-19. And in 23-24, I am no more a owner. Still, is it taxable? Yes, it is taxable. Yes, it is taxable. As per section 25A subsection 1, arrears of rent and unrealized rent received subsequently, that is in the future, from a tenant shall be deemed to be the income from house property in the financial year in which such rent is received or realized. Means in whichever year it is received, it is taxable on receipt basis, irrespective of whether he is the owner of the property in that year. Further, section 25A2 provides a deduction of 30% of arrears of rent or unrealized rent subsequently by the ACCA, because standard deduction is there when we are calculating rent. Same way here also they are giving standard deduction. So that means in case of arrears of rent and unrealized rent, only 70% would be taxable. Remaining 30% is flat deduction. Flat deduction. Sir, now I recovered 1 lakh. You are telling 70% is taxable. Okay, good. So that means 70,000. From this, can I claim any expenditure? No. 70,000 straight away taxable. Now assume, sir, in this year I also have income from house property. I have not sold it. I am renting it out to some other tenant. In that case, for that you would have followed the format and calculated the income from house property. Yes. Assume you have got 5 lakh for that. You have followed the format and you have calculated 5 lakh you have got. Yes, sir. For that, we have to add 70,000. So what is your total income from house property for this year? 570. For the same year, if you have both. Clear? No, sir, I have already sold the property, means you will have only 70. You will have only 70. Okay. Then coming to section 26, co-ownership. Sir, I own the property along with my wife or brother or sister. So in that case, first check whether the property is self-occupied or let out property. If it is self-occupied, very simple. Straight away go and eat interest. And interest is 30,000 or 2 lakh per person. That means each co-owner can claim 2 lakh 30,000. Yes, many of the people do this. If you guys are aware, any of your family members cross-check. If they purchased flat, apartment and house and all, they would have obtained joint loan in the name of husband and wife both. Why? The benefit is both can claim maximum 2 lakh 2 lakh. Both can claim maximum 2 lakh deduction. Clear? Or if condition is not satisfied, 30,000 rupees. Okay, majority of the cases condition will be satisfied. And if in the exam, if question is silent, assume that conditions are satisfied and give maximum 2 lakh. Okay. Now each co-owner 2 lakh. Assume I co-own a property along with my wife. How much interest both of us can claim? 2. And sir, along with this property, I have one more house, self-occupied. How much I can claim? 2 plus 2, No, maximum 2 per person. For both the houses put together, maximum I can claim is 2 lakh. Hope it is clear. Yes. Next, let out property. If it is let out property, compute the income, guys. As if it is owned by one person, compute it. Final figure, you just divide it. Assume, guys, I and my brother own the property. Just a second. Okay. I and my brother own the property. We have calculated the income. Income from house property is 10 lakh. Income from house property is 10 lakh. Okay, sir. First check. What is the ratio of ownership? 50-50, sir. In that case, my income from house property is 5 lakh. My brother's income from house property is 5 lakh. Sir, what if it is 60-40? Then 6 lakh, 4 lakh. Calculate the income from house property as if it is owned by one person. The final figure, you divide it in the ratio of ownership between the two persons. So, assume it is 60-40. So, 6 lakh would be taxable in the hands of me and 4 lakh will be taxable in the hands of my brother. So, what is my income from house property? 6 lakh. What is my brother's income from house property? 4 lakh. Next, deemed ownership. Deemed ownership means, guys, section 22 clearly told assessee should be the owner of the property. But here there are some exceptions. Legally, someone else might be the owner, but we are treating you as the deemed owner. If you are treated as the deemed owner, then who is liable to pay tax on the income from house property? You. So, which are those cases? As per section 27, the following persons, though not the legal owners of a property, are deemed to be the owners for the purposes of section 22 to 26. transferred to a spouse. Spouse means who? For husband, wife, for wife, husband. Or minor child, other than minor married daughter. Minor married daughter, you cannot marry a minor. First of all, you should know it. Abolished. Okay. For you, marriage itself is abolished. Why will you spoil the other's life? Better you enjoy alone. Hey, you only man, why are you seeing back? See the strategy. I was just kidding. Fine. Transferred to spouse or minor child. Guys, we know that minor child cannot be married. But if at all it is there, what is given here? Okay. Minor child here will not include minor married daughter. Clubbing will not be attracted. Sorry, clubbing will be attracted, but not deemed ownership. Okay. I will try to connect to clubbing also, hoping you guys have some knowledge about clubbing also. Okay. Now, if I have transferred my house property for inadequate consideration, or I have given it free of cost for my spouse, I am the deemed owner. Legal owner might be my spouse, but still I am the deemed owner. Same way. Sir, I have transferred the property to my minor child. Here I am trying to shift the income. So what they told is, I am considered as deemed owner. Even though the legal owner is the recipient, still income from house property will be computed in my hands and it will be taxable in my hands. Clear? Now sir, what if I have transferred it to minor married daughter? Then clubbing will be attracted and not deemed ownership. Clear? Yes. Sir, any other property means clubbing again. House property means deemed ownership. Sir, I have transferred any other asset to my spouse, minor children, any minor children. Then it is not covered here. It will be clubbing. Clear? Only house property is covered here. Okay. Then, holder of an impairable estate, that is HUF, is holding the property on behalf of all their members. In that case, who is considered as the deemed owner? HUF. Next, member of a cooperative society. Now, cooperative society owns a house and they have given it or allotted on a lease or a rent or on whatever basis to their member. Member is deemed to be the owner. Legally is not the owner, but still member is considered as the owner. Person is in the possession of the property. Sir, I have transferred my property to Sarvesh. But still, registration has not happened. Registration has not happened. Registration has not happened. In that case, who is the legal owner? Still me only. But for income tax purpose, who is considered as the owner? Sarvesh. Because property has already gone to him, he started enjoying that. Means he started staying in it. What can he enjoy in building, sir? He can stay and relax there. Okay. Alone. Alone. Person having right in a property for a period not less than 12 years. Sir, I have taken a property on lease for 15 years. Am I a owner? No, actually. But still I am deemed owner for income tax purpose. For income tax purpose. Fine. So at the end, I have made a simple format which will give you more clarity. On the exam days and all, you can simply run through it, guys. Okay. So, income from house property. If it is a let out property, LOP means let out property. So, it will start from here. Municipal value or fair rent, whichever is higher. Then compare with standard rent, whichever is lower. We call it as expected rent. Then actual rent, whichever is higher. GAV. We can do it as a separate working note also. Then GAV, we will take it here. Yes. Municipal tax paid by the owner during the previous year allowed as a deduction. Then 30% of NAV, interest on housing loan. Interest on housing loan, no limit, no limit. Please be careful. Then self-occupied property. Straight away we will go to interest. Straight away we will go to interest. Observe the format. Only interest. That too if it is there. But maximum 2 lakh or 30,000. Okay, you can just write there. Maximum 2 lakh or 30,000. Okay. Then deemed to be let out property. Deemed to be let out property. Same as let out property. But this will not be there. But this will not be there. You don't scratch. I am just doing it because actual rent will come for let out property. So deemed to be let out property, this will not be there. That means straight away expected rent will be the gross annual value. Expected rent would be the gross annual value. From here, everything else will continue as same. Clear? Yes, guys. Now coming to, sir, what if I have a loss? Sir, what if, first of all, what if I have multiple house properties? For each house, you calculate the income separately. At the end, add up everything. That is your income from house property. Now, sir, what if I have a loss? If it is a current year loss, house property loss, one house property loss can be adjusted against income of another house property. Sir, no, sir, I have only one house. That means current year house property loss can be adjusted against other rates of income, but maximum 2 lakh. Sir, I have a loss more than 2 lakh, but maximum you can adjust 2 lakh. In excess of that, carry forward. Okay, now, yes. So carry forward for how long, sir? 8 years. Once I carry forward, what will I do, sir? You can adjust it only against income from house property. Only against income from house property. Clear? But if you are following default scheme, even though it is current year house property loss, you cannot adjust it against other rates of income if you are following default regime. Clear? Yes. And if you are following default regime, interest on self-occupied property is not allowed. Yes, sir, it is not allowed. Now, if you have any brought forward loss, sir, in the past, I was following optional scheme, which was old regime before. I was following old regime or optional scheme. I had a loss, sir. Loss from what? Self-occupied property. Loss from self-occupied property means it is understood it is due to interest. Okay. And in the current year, I am following default regime, sir. Can I carry forward that loss? No. Under default regime, interest on self-occupied property is blocked. And if you have any brought forward loss which is relating to that interest, please leave it there and come to default scheme. Please leave it there and come to default scheme. So, what is the impact of default scheme under the head income from house property, guys? Interest allowed on self-occupied property, that is maximum 30,000 or 2 lakh, is blocked. Then current year house property loss, you cannot adjust it against any other rates of income. See, guys, once you come under the default scheme, if you have loss under the head house property, that will be from only let-out property or deemed to be let-out property. You can never have a loss from self-occupied. Very clear, because interest is not allowed. When interest is not allowed, you cannot have loss from self-occupied property. Okay, sir. Sir, I have current year loss, house property loss from let-out property or deemed to be let-out property. Can I adjust it against other rates of income? No, you cannot. Maximum, you can carry forward and adjust it within the same head. Next, sir, now for the first time I am coming to default scheme. In the past, I had loss from self-occupied property. Can I carry forward that and adjust within the same head only? I will adjust, sir. No, you cannot. No, you cannot. This is all about the income from house property, guys. Then the most important head and the largest head is the profits and gains from business or profession. Chapter 5, section 28 to 44D talks about profits and gains of business or profession. What, sir? Section 28 is the charging section. The profits and gains of any business or profession which was carried on by the assessee at any time during the previous year is chargeable to tax under this head. At any time, sir, I did business only for 3 months. By 31st March, I have already closed. So I have already told thank you for my business. So should I pay tax on that also? Yes. Even if you have done any temporary business or profession. Sir, I gave client service only for 3 months. After that, I was fed up, I stopped it. So should I pay tax on that also? Yes. At any time during the previous year, if you have carried on any business or profession, you are supposed to pay it. Yes. And some important tips while calculating the income under the PGBP is, sir, while computing the income under that PGBP and other sources, you can follow which method of accounting? Either accrual system or cash system, whichever you are following regularly for maintaining the accounts. Same thing you can follow here also. And while computing the income under that PGBP and other sources, you have to follow income tax provision along with ICDS. If you are following mercantile system of accounting only. Sir, what if I am following cash basis of accounting? Then actually ICDS is against cash system, so you need not follow it. Sir, you are telling that if you are following mercantile system, you have to follow both income tax provision and ICDS. What if there is any conflict? Who will prevail? Income tax provision will prevail. Boss will prevail. Okay. Next, sir, what if I have multiple businesses or professions? Then treat each of them separately. Treat each of them separately. For example, I have 5 different businesses I am carrying on, sir. In that case, compute the income of each business separately. At the end, you can add up everything and calculate income from business. That is total income. But income or expenses of one business cannot be set off or claimed by another businesses, guys. Income of that particular business is taxable for that business. Same way, expenses of that business can be claimed only by such businesses. Is that clear? Yes. And whoever is enjoying the profit, for them it is always taxable. And even under the head PGBP, what is taxable is the income which I am earning from my business or profession, whether it is in money or kind, doesn't matter. Sir, I gave services to my client. In return, he gave me a car, or in return, he gave me some property. In that case, is it taxable, sir? Yes, it is taxable under the head PGBP. You want me to adjust the temperature? Okay. Next, 28 is done. 29, computation format is given in 29, guys. Let me discuss this with an example. Guys, assume this is a P&L account. Now we actually, for the company and all, we prepare P&L statement, but for income tax purpose and all, maybe they will use the word P&L account or P&L statement, anything, but be ready for it. Okay, sir. Guys, we have prepared a P&L account for the year ended 31st March 24. Okay, now, so this is for accounts purpose. Sir, we have debited various expenses, we have credited various incomes, and at the end we have got to net profit. How much? By the time you guys reply, 15 lakh we will take. Net profit as per accounts is 15 lakh. Normally what we will do? We will not straight away accept that in the tax. We will take this as a base and make necessary adjustments. What happened, madam? Net profit, I am taking it as a base 15 lakh. Then necessary adjustments we will do. Okay. What are those, sir? Guys, please be careful. Sir, I am maintained accounts. I am patent accounts as per company law or accounting standard Ind AS and all. Is it final? Same thing we will take it for income tax purpose? No. For income tax purpose, whenever we are calculating the income under the head PGBP, we have to follow income tax provisions along with ICDS also. If I am following mercantile system. Okay. Profit as per profit and loss account we are taking as a base. So in my example, it is 15 lakh. Okay. Then add few items and deduct few items. At the end, we will get taxable income from business or profession. This is my main target. Okay. Add expenses or losses disallowed but debited in P&L account. Sir, there is an expenses which is debited here, 2 lakh, which is disallowed. As per income tax law, they are telling no, it is not allowed. Why and all we will see. Which expenses is disallowed and all we will see later. So when it is disallowed, guys, when you have debited something which is not allowed, already because of this your profit has come down. Yes. So what should you do now? Add up 2 lakh. Add up 2 lakh. Okay, sir. Next, incomes taxable as business income but not credited. Sir, there is an income which they are not credited to their P&L account. As per income tax law, clearly they are telling it is taxable in the. So assume there was an income of 3 lakh which is taxable, but they have not credited it. They have not credited it. Normally, this type of items they will give it in the adjustments. So what should you do? Add it up. It is taxable, but you are not credited. Add it up. Okay. So 3 lakh we are adding. Next, expenses in excess of allowed amount debited in P&L account. For example, sir, expenses is debited 2 lakh, but allowed is only 1.8 lakhs. They have given in the adjustment. Allowed is only 1.8 lakh. Means disallowed is how much? 20,000. 20,000. So how much you have to add back? 20,000. You have to add back how much? 20,000. You have to add back 20,000. Okay, sir. Next, deduct less expenses or losses allowed but not debited to P&L account. Sir, it's no fool will do this, but still, sir, expenses allowed as per income tax law, but that person has not debited it. Okay. For academic purpose, anything can happen, guys. Okay, so don't question the question. Tell it, how can this happen? Who will do this? So there was an expenses which was supposed to be debited. Assume 1 lakh, but they are not debited. Somewhere in the adjustment they have told this is what expenditure is incurred but not debited. So in that case, it is allowed, yes, but still not debited, yes. So what should we do? We can debit it. Now we cannot go prepare the P&L account again. So what will you do? Reduce from 15 lakh. So 1 lakh we are reducing it. Fine. Income not taxable as business income but credited to P&L account. That means, sir, incomes are credited here. Rent, interest, dividend, all these are credited here. It is taxable but not under the PGBP. So remove it from here. Because of this my income has gone up. So remove it and tax it under the respective rate. Tax it under the respective rate. Amount, let me take it as 5 lakh. So reduce it. Reduce it. Okay, sir. Then income which are exempt from tax but credited in P&L account. Sir, agriculture income is credited here. 20,000. Agriculture income is credited. It is income but not taxable under income tax law. And in accounts and all we don't care. We credit whatever we have earned. Clear? So because of this my profit has gone up by 20,000. Yes. So what should I do? Reduce it. Reduce by 20,000. So all this reductions. So 5 lakh and 20,000. So finally, whatever figure we derive is called taxable income from business or profession, which we have to include in our total income calculation. Clear? Yes, sir. Guys, here I have given what all adjustments can come. In the exam, all 6 may not come. Maximum, this is what you can get. Clear? But it will come in the names. Clear? Here I have told expense allowed, disallowed and all. It will be, they would have named it, that particular expenditure. Sir, what is allowed, what is disallowed, we have not yet discussed. We will do it. Clear? Yes. See, this is when they are following accrual system of accounting, guys. So there can be some professions and all which are following cash system. So if question is on cash system, then what should we take? Simply straight away take fees or gross receipts, whatever they have received, income. Straight away take it. From that, whatever expenses they have paid on payment basis, whatever they have paid, they will give incurred 2 lakh but paid 1,80,000. How much you will reduce? 1,80,000. When they are following cash system, please be careful. Same way, sir, fees, they have earned 10 lakh but received only 8 lakh. How much you have to take? 8 lakh. Cash system. Please be careful. Only if question specifically mention that. Only if the question specifically mention it, you follow this. This is very simple. If at all, if by chance, if it comes, I am just mentioning it. Clear? So if they have clearly given the assessee is following cash system, then straight away take fees or gross receipt, whatever they have earned and received. Take it. Okay, received. Then from that, whatever expenses they have paid, you reduce. The difference would be, means whatever you get is taxable business income or professional income, guys. Okay. Then expressly allowed deductions means the following expenses are allowed to be reduced while computing the income under the head PGBP. From section 30 it starts. 30. Expenses of business premises. Deduction is allowed in respect of rent, rates, current repairs, not capital repairs, only current repairs, and insurance for building that are used for the business or profession by the assessee. If you have incurred any revenue expenditure for the building which is used for business or profession, you can claim it. Sir, whatever capital expenditure, you will capitalize it, add it to the block and claim depreciation for it. Yes, sir. Next, business premises is nothing but building, guys. Next, expenses of business assets, any asset other than building, like furniture, plant and machinery, any other assets. This section allows deduction in respect of expenses on current repairs and insurance of a plant and machinery, furniture used for business profession of the assessee. Only revenue expenditure. Guys, in the law, in the section, they have not used the word revenue expenditure, but I have given in the bracket that you should have a knowledge. Why? Because if it is a capital expenditure, sir, I have purchased plant and machinery, I have purchased building, it is capital expenditure. You will claim depreciation on it. You cannot claim it under section 30 or 31. Depreciation is given in section 32. Please be careful with it. Okay, now? Yes. So what is covered in 30 and 31 is only revenue expenditure. Now they have used the word current repairs, current repairs. What is it, sir? See, current repairs means when you have incurred any expenditure for repair which will not increase the productivity of the asset, we call it as current repairs. Sir, I have incurred some repair expenditure, sir. After this repair, the productivity of the asset will increase, sir. In that case, we call it as capital repairs. We will add it to the cost of the asset. Capital expenditure. Clear? So already in the block, asset would be there. We have already included it in the block. We will just add this capital repairs there. Clear? Yes. Now coming to section 32, the most important section under the head PGBP. This section provides for compulsory deduction on account of depreciation. Everyone has to claim it. The rates of depreciation are also provided in the income tax rules and you have to follow it. Guys, everyone are supposed to follow WDV method of depreciation except power sector. Except power sector. This point. All assessees shall adopt only WDV method of depreciation, that is block basis. Here depreciation is not allowed asset basis, it is block basis. Sir, what is block? A group of asset with similar nature and similar rate of depreciation. We will put it together and form a block and we will claim the depreciation block wise and not asset wise. But for the assessee who is engaged in power sector, that is the generation and distribution of power, they have a choice. They can either follow WDV method or they can follow SLM method. If they are following SLM method, then they will claim depreciation on asset to asset basis, not block basis. Okay, fine, sir. So if they are following WDV method, they are told that the rules will specify the rate of depreciation. So what are the rates of depreciation? You are supposed to remember this for exam purpose. There are mainly two categories, tangible and intangible. Under tangible, there are three. That is building, furniture and fittings, and plant and machinery. Clear? Yes. So building used for residential purposes. That is, so residential purpose means we cannot claim depreciation. Yes, if it is used for personal purpose, you cannot claim. Some companies, they will purchase the building and they will give it for the employees to use it. Rent-free accommodation. Yes. So in that case, can company claim depreciation on it? Yes. So for company, what property it is? Deemed to be let out. Deemed to be let out property. So can they claim the depreciation? Yes, ultimately it is used for business purpose because my employees are staying. So my employees are happy. If they are happy, they will perform better. If they are performing better, company will perform better. If company is performing better, they will earn more profit. Clear? Yes. So ultimately it is used for business purpose. Now, sir, owner along with his family is staying in that building. Is it for business or personal? Personal. Clear? Yes. Building other than above, like factory building, office building and all. How much? 10%. But if there is any temporary structure, temporary building and all which is constructed, 40% guys. Furniture and fittings, 10%. Then plant and machinery. Under plant and machinery, there are various categories of assets. Motor car, motor bus, motor lorry or motor taxis used in the business of running them on hire, 30%. Motor car other than used in the business of hire is 15%. Ships, aeroplanes, ships is 20%. Aeroplanes, aero engines, 40%. Then books, 40%. That is the books whatever you guys use. Then, sir, will businesses have books? Definitely, even professionals. For example, if you have started practicing company secretary, you will have a separate cupboard to have the books because as and when required, you have to refer to it. No? Companies Act or FEMA Act, whichever acts you guys are practicing in. So, you will normally have some books for references. Sir, can we claim depreciation on it? Yes. Computers including computer software 40%. Then plant and machinery. If they simply give the name plant and machinery, it is always 15% guys. Then intangible assets except goodwill 25%. For goodwill there is no depreciation allowed. Okay, coming back to the provisions for depreciation. Conditions for allowability of depreciation. Assessee should be the owner of the property or the asset and it should be used for business or profession. Sir, what if it is used for personal purpose? You cannot claim it. Sir, what if it is partly business, partly personal? Only whatever is proportionate for business, only that much will be allowed. Only that much would be allowed, guys. Okay. Then, where the asset is been acquired and put to use for less than 180 days during the previous year. Sir, we have purchased the asset and put to use during the previous year. Check more than 180 or less than 180. 180. In residential status, we have seen 182. Please don't get confused. Know the difference. Wherever anything may confuse you, always know the difference. Residential status 182, 60, 365, 730. What did I talk about? The number of days. Clear? Whereas here 180. Where an asset has been acquired and put to use for less than 180 days during the previous year, then only 50% of the prescribed depreciation shall be allowable in that year. Okay, and I have also given as a shortcut for you to remember the date on or after 5th October of our previous year. If it is purchased on or after 5th October, it is understood it is used for less than 180 days, only give 50% depreciation. 50% means not straight away, whatever is the rate, 50% of that. Clear? Yes. Next, sir, what if it is before 5th October? Any month, April, May, June, July, August, September, or October 3rd, 2nd, 4th, some dates like that. In that case, full depreciation you can claim. Full depreciation. Guys, please be careful. If asset is purchased and put to use for less than 180 days, during the previous year, only in that year 50%. In the next year and all, yes, they can claim full depreciation. Okay, let us also see the format now. We will first take how to compute depreciation. Under WDV method, it is always block-wise, guys. Group of assets, not asset to asset. Okay, opening return on value, we will take it. For us, it is 1st April 23. And for that, if at all during the previous year, if any asset is purchased, we will add it. And please segregate it. How much is for more than 180 days? How much is for less than 180 days? So asset acquired and put to use for 180 days or more separately, less than 180 days separately. Both may not be there always, but if at all if it is there, add it up. Then net sales proceeds during the previous year. If you have sale proceeds means sir, I myself sold it or I have put up for a scrap or else asset was destroyed, I received the insurance compensation, everything will come here. Clear? Yes. Next, you will get written down value for the purpose of depreciation. On this value, we will apply the depreciation rate and calculate depreciation. And reduce it, we will get the closing written down value at the end of the year. So at the end of the year means 31st March 24, guys. And this will become the opening written down value for next year. And please be careful whenever there is a purchase, especially this item. Assume guys, this item is 2 lakh. Clear? And written down value for the purpose of depreciation is 10 lakh. In that case, you have to segregate. Out of 10 lakh, first 2 lakh will be this. Remaining would be more than 180 days. Remaining 8 lakh is more than 180 days. So on this, assume the depreciation rate is like on furniture 10%. So on this 10% of that 50%. Whereas on 8 lakh, straight away 10%. On 8 lakh, straight away 10%. So please be careful. So when return down value for the purpose of depreciation is there, if at all if this item is there, please first take that. Remaining will be for more than 180 days. Remaining would be more than 180 days. Normally for sale, we follow FIFO basis. So whenever there is a sale, assume that it is out of opening WDV. Out of opening WDV, guys. Okay. If asset is capable of being used, still depreciation will be calculated, guys. Means, sir, asset is ready to use, but I have not used it. In that case, can I still claim the depreciation? Yes, enjoy. Next, E point we have seen, and there is no question of having loss or profit on the sale of individual assets. Sir, when I have sold the asset, we will reduce it from the block. And will we calculate profit or loss on the sale of that asset? No. Will we compute capital gains? No. Until and unless you claim depreciation on that asset which you have sold, you will reduce it from the block. Will we compute capital gains, sir? No, we will not. Only when depreciation fails, we will compute capital gains. When will it fail also, we will see. Only when depreciation fails under section 32, capital gains will take over under section 50. So when is it? When all the assets in the block are sold. Sir, I had 10 assets in the block, all 10 we have sold it. For a lesser value, sir, doesn't matter. We cannot claim depreciation now. Why? Because there is no asset in the block. So in that case, section 32 fails. Immediately section 50 will take over. When we are applying section 50, it is always short-term gain or short-term loss. Then, when the assets are sold for a higher value, there is no value in the block. There is no value in the block. That means, sir, 10 assets were there. 10 assets were there. All 4 assets I have sold for 12 lakhs. Only 4 assets I have sold for 12 lakh. So what is the WDV for the purpose of depreciation? It cannot be negative. So whenever it is negative, we will write nil. Still we have 6 assets, sir. Asset is there, but we cannot claim depreciation. We cannot claim depreciation because there is no value in the block. So immediately section 32 fails, section 50 will be changed and we will compute capital gains. Clear? Sir, in the future, if I sell that 6 assets also, will we compute capital gains? Yes. And for that, what would be the cost? 0. And section 50 will apply to compute short-term gain or short-term loss. Next, for a new plant and machinery which is purchased and installed in factory for the assessee who is engaged in manufacturing or the power supply who is following WDV method. Power supply who is following WDV method. They can claim additional depreciation of 20% on new plant and machinery only in the first year. So, who is eligible for it? The assessee who is engaged in manufacturing or the assessee who is engaged in power supply who is following WDV method. For the new plant and machinery which they have purchased and installed in factory, they can claim normal depreciation 15% plus additional depreciation 20% in the first year. From the second year and all, they will claim only 15%. In the first year of purchase, if they are purchased and put to use for less than 180 days, then they will claim only 10% in the current year of actual cost and remaining 10% of actual cost, they will claim it in next year. Clear? So 20% is of actual cost. Please be careful with it. Clear? Normally allowed only in the first year, but in the first year if it is less than 180 days, then 10% now, 10% next year. That's all. From the next years and all, only 15%. Normal depreciation. Okay. Now coming to section 35. Special section applicable only for a particular business, that is scientific business, guys. Section 35. Let me first cover this by this chart. Expenditure on scientific research incurred by an assessee for his own business. If he has incurred for his own business, both revenue as well as capital expenditure he can claim. Where? Under the section 35. Both capital is a special year. Okay, except land. Except land he can claim. Okay, sir. This is when you have incurred after the commencement of business. Both revenue, every revenue expenditure and capital expenditure you can claim except land. Except land. Then, sir, what if I have incurred any expenditure before commencement of business? You can claim it in the year in which you have commenced the business. But, is it all, sir? Capital expenditure you can claim everything except land. But, if it is revenue, you can claim only salary paid for research personnel excluding perquisite. Perquisite is not allowed. And cost of raw material. And cost of raw material. Only that much you can claim. Sir, any other revenue expenditure, if it is incurred before commencement of business, you cannot claim it. Clear? Sir, what about the revenue expenditure which was incurred 3 years before? You cannot claim it. Both revenue as well as capital, both you cannot claim. Only 3 years before. Clear? For example, I started my research business from 1st April 22, sir. So within 3 years, revenue expenditure plus capital expenditure. Revenue means only two, cost of raw material and salary paid to research personnel excluding perquisite is allowed. Capital expenditure except land is allowed. Clear? Yes, sir. Now this is when assessee himself is engaged in research business. Sir, what if I am giving contribution to outsiders? Nowhere connected to my business, still I can claim it as business expenditure. If I am giving contribution to an approved institution or college or university who is using that money for research purpose, then 100% of whatever I am giving, I can claim it as deduction, guys. You can see here, I have given it clause wise. 35.1.1 revenue expenditure incurred on scientific research related to assessee's own business, he can claim if it is incurred after commencement of business in that year, same year, full amount, any expenditure. If it is incurred 3 years before the commencement, only 2 is allowed. Salary to research personnel excluding perquisite and cost of raw material. Okay. Then 4 I am talking about. Capital expenditure except land incurred on scientific research related to assessee's own business. Incurred in the year after commencement, you can claim that year only 100%. Again on that you cannot claim depreciation. Only 100% when it is allowed here. Again you cannot claim the depreciation. And you will add the asset to the block but at zero value. You will add the asset to the block but at zero value. Okay. Sir, what if capital expenditure is incurred before commencement of business? If it is incurred 3 years before the commencement of business, you can claim it in the year in which you commence the business. Then contribution to outsiders. Contribution to approved research association, college, institute, university for research scientific research allowed. Then contribution to company for scientific research allowed. Company, please be careful, only company. Okay, here. Then contribution to approved research association, college, institute, university for social science or statistical research allowed. Then last one, contribution to national laboratory or IIT for scientific research undertaken under an approved program. One common thing everywhere is approved. For the person for whom you are giving, they should be approved to do the research, guys. Clear? Yeah. Now capital expenditure of specified business given in section 35 AD. So if assessee is carrying on a specified business, whatever capital expenditure he has incurred during the current year, 100% of that he can claim in the same year except LGF. Except LGF, not KGF. LGF. That is except land, goodwill and financial instruments. These three you cannot claim. Any other capital expenditure if you have incurred, you can claim it in that year only. In the year in which you have incurred 100%. But again you cannot claim depreciation. Sir, what if I have incurred any capital expenditure before commencement of business? Irrespective of the year, there is no year limit here. You can claim in the year in which you have started your business or commenced your business. But there are certain conditions and all which you have to satisfy. That is, once you have purchased and you started using the asset for specified business, at least for 8 years you have to use it. If within 8 years, if you start using it for some other business, then the deduction whatever you have claimed will be withdrawn. Will be withdrawn in the sense that is the amount of deduction what you have claimed, you have to take it, minus if depreciation was allowed, how much you would have claimed, we will reduce it. Remaining is taxable as business income. Remaining amount is taxable as business income, guys. Sir, what if I have sold this asset? I have purchased it, claimed the deduction and then sold it. Then in that case, whatever sale value is there, entire amount is taxable under the head PGBP, entire sale value. We don't even calculate profit or loss. Entire sale value will be taxable under PGBP because 100% of the capital expenditure you already claimed. So now whatever is the sale value will be taxable under the head PGBP, guys. Now coming to section 35D, which talks about preliminary expenditure. The expenditure which is incurred by the assessee before the commencement or in connection with the extension or expansion of the undertaking or setting up of a new unit or new branch. Normally preliminary expenses means what you have incurred before you commence your business, but here they are telling even if you have incurred anything for the purpose of extension or new unit or new branch opening, even then that will be considered as preliminary expenses. Now how can we claim it, sir? If it is an Indian company, first deduction is given for Indian company or other than Indian company, they should be resident in India. Indian company, you know, always resident in India. Yes, sir. First we have to calculate qualified amount. If it is an Indian company, what is qualified amount? First A we have to calculate. What is A? IR of 5% of cost of project or 5% of capital employed. So take capital employed, take cost of project, take 5% of each, whichever is higher. Compare that with actual preliminary expenditure, whichever is lower. That is the qualified amount. Okay. Sir, what if it is other than company? Then they should be resident in India. Sir, what if I am a partnership not resident in India? You cannot claim deduction here. Okay. Then qualified amount you calculate first. What is it? A lower of A, 5% of cost of project. No capital employed here. Only cost of project. Okay. Compare that with actual preliminary expenses, whichever is lower. Whichever is lower. Okay, sir. Then once we get qualified amount, 1/5 of that I can claim every year. Means we can claim it in 5 equal installment from the year in which I commenced the business, or from the year in which I have extended my business, or I have opened a new unit. Now, sir, this cost of project means what? Cost of project means cost of fixed asset. Capital employed means issued share capital, both preference and equity, debentures, long-term borrowings. Reserves and surplus will not be included. Please be careful. Okay, sir. This figures has to be taken as on what date? 31st March. That is the end of the year in which you have commenced your business, or the end of the year in which extension took place. Okay. Next, other expressly allowed deductions under section 36 subsection 1. Insurance premium paid on the policy which is taken to cover the risk of damage or destruction on the inventory or stocks is allowed as deduction. Next, health insurance premium paid on the policy which is taken in the name of employees is allowed if it is paid in any mode other than cash. Sir, what if it is paid in cash? Only 100 rupees, sir, 1000 rupees, sir, 2000, nothing is allowed. There is no monetary limit. You have to pay everything in any mode other than cash. Okay. Bonus or commission paid to the employees is allowed, but it should not be paid in the form of dividend or profit, share of profits, but subject to 43B. Then, interest on borrowed capital. If I have taken any loan for the purpose of business or profession, whatever interest I am paying, I can claim it as a deduction. But if loan is taken for the purchase of the property or the asset which is used for business, whatever interest I am paying till the asset is put to use will be capitalized and will be added to the cost of the asset as per section 43 subsection 1. 43 subsection 1 talks about the actual cost of the asset to claim depreciation, to add it to the block. So if loan is borrowed for the purpose of purchase of asset, the interest whatever is paid till the date the asset is put to use will be capitalized. Sir, after the asset is put to use, we can treat it as revenue expenditure and claim deduction here. Okay, but subject to 43B. Employer contribution to provident and other funds, that is for the benefit of employees. Allowable if the fund is settled upon the trust, it should be recognized or approved, and it should be for the benefit of the employees. Employer contribution can be claimed. Now guys, whenever we are learning PGBP, it is always from employer's point of view. Whenever we are learning salary, it is from employee's point of view. Now, whatever expenses the employer has paid, it became income for the employee. There we learned how it is taxable, how much is taxable, how much is exempt and all. Same way, whatever employer is giving, he can also claim it as an expenses. Yes. So, employer contribution is allowed provided it is for recognized or approved fund. Okay. And for the benefit of the employees, subject to 43B. What is 43B? We will cover it later. Then, loss of animals. Sir, I had purchased animals which was used for business, not as a stock. I am not a breeder. See, I am a dog breeder or animal breeder or bird breeder and all, then it will be a stock for me. If anything is died, I cannot claim it as an expenditure. But I was using an asset for my business like a donkey or dogs and all. Some people use it as a security purposes. So in that case, sir, if it dies, I suffer loss. Can I claim it as my business loss? Yes, you can. Okay. Yes. Next, employee contribution to welfare fund. Important. Employee contribution to any fund, what employer will do is, first he will collect it. He will deduct it from employee's salary and remit it to the fund, respective fund. So what they are telling in income tax law is, when you deduct or collect it from the employee, it is your income. Credit it to your P&L account. Credit it to your P&L account. When you deposit it to the fund, claim it as an expenditure. Claim it as an expenditure. Ultimate effect would be nil. But what they want you to do is, whatever you collect, please remit it. You don't keep it. You don't enjoy the money. And your remittance is within what date? Within the due date of the respective fund. Here, for example, assume whatever PF has been collected by employer, he has to deposit within 15th of next month. So, in this month, whatever PF is collected, assume in May, it has to be deposited within 15th June. So, what if it is deposited 20th June, 25th June? It will be credited, but it cannot be debited. That means indirectly it is taxable for the employer. Means they are telling indirectly, please don't do that. You don't play with the employee's money. Don't keep it as your money and invest somewhere, earn the return and enjoy it. Okay, so when you collect it, it is your duty to remit it within the due date of the respective fund, not within the due date of filing income tax return, within the due date of the respective fund, whichever fund you are depositing to. Okay, then bad debts which is written off as irrecoverable in the books is allowed as deduction, guys. Next, provision for bad and doubtful debts is not allowed. Provision means, sir, I am providing for future liability or future expenses. They are not allowing under income tax law, but it is allowed only for scheduled or non-scheduled banks, public financial institutions, state finance corporations, state industrial investment and NBFC, because for them the risk is high. We call it as non-performing asset, NPA. On that, can they create the provisions and all, sir? Yes, for them only it is allowed. Whereas for other businesses and all, provision is not allowed, guys. Bad debt is allowed. You have actually suffered loss means you can claim it. Sir, I am anticipating that someone may not pay me. Can I claim it now only? No. When you actually suffer loss, you can claim. Next, expenses on family planning. If the expenditure is, if it is revenue in nature, allowed. If it is capital in nature, it is allowed in 5 equal installment. It is allowed only for corporate associate. Corporate associate means company, guys. It is allowed only for companies. Revenue expenditure, you can claim it in full. Capital means 5 installment. That is, from the year in which you have incurred it, you can claim it in 5 installment. Then securities and commodities transaction tax. Sir, whenever I buy and sell the securities and commodities, whatever I earn from it, if it is taxable under the head PGBP. So, if it is taxable under the head PGBP, whatever I buy and sell, when I buy securities and sell securities, I will pay securities transaction tax. Same way, when I buy and sell commodities, I will pay commodities transaction tax. You can claim it as an expenditure. You can claim it as an expenditure. Sir, no, sir. It is an investment for me. That is taxable. When it is sold, it is taxable under the head capital gains. In that case, can I claim STT or CTT? No, you cannot claim. Only if it is taxable. When you sell, if it is taxable under the head PGBP, only then you can claim STT and CTT as your expenditure. These are specific expenditure. Each and every section clearly told this is what is allowed. 37(1) is telling any other expenditure which is not covered above. It should not be personal in nature. It should not be capital in nature. It should not be illegal. It should not be immoral. And it should not be disallowed in any of the future sections. Then it is allowed. Then it is allowed, guys. Clear? Yes, sir. Means they are not naming it. It is general deduction. Not covered above, not covered later. Not covered above means not allowed in any of the section from 30 to 36. Not covered later means not disallowed later. Because 40, 43B and all talks about disallowance. Yes, sir. Then not personal in nature, not capital in nature, not illegal. Allowed. Clear? Because you can see salary nowhere mentioned. Office related expenses nowhere mentioned. So they cannot keep on giving the list of the expenses telling me this is allowed, that is allowed, this is allowed, that is allowed. That what? Any other expenses are allowed subject to all the conditions. For all these conditions are satisfied, allowed. So now, if there is any expenditure which is incurred by the assessee for the purpose of which is offence or prohibited by law, is it allowed, sir? No, it is not deductible. For example, sir, I gave a supari for one of the gunda to kill my competitor or to give warning to my competitor. So my business improved now because of it. So can I claim this as my expenditure? No, you cannot. Clear, sir, my business only, sir. Because of that only my business sales full shoot up. So can I claim it? No, you cannot, because it is prohibited. You cannot do it, is an offense under the law. Next, CSR expenditure. So you guys know, based on the turnover profit of the company, so companies are supposed to contribute to the society. A certain percentage of their profit, they have to contribute it to the society. Now, can they claim it as an expenditure? No, because that is not incurred for their business or profession purpose. That is for the society. Okay. And guys, this is what I have given, not openly given anywhere in the provisions or in the law, but this is what is understood, especially from 37(1). Okay. So the following expenses are not allowed while computing the income under this head. This is for your better understanding and clarity. Preference and equity dividend is not allowed. Why, sir? Because it is appropriation of profit. Clear? Means out of your profit you are distributing it to the shareholders. Then any provisions created for future liability or expenses, any provision. Sir, can I create it for future liability or future expenses or future losses? No. When you actually suffer, you can claim it. Next, transfer to any reserve. You are creating reserve for your future expansion. We will not give it as an expenditure. Any reserves, guys. Okay. Charitable and political contribution, not allowed under the head PGBP. But you can claim deductions in chapter 6A. But not allowed under the head PGBP. Okay. From now on, again important. See guys, whenever the payer is paying any expenses to the payee, he has to check whether whatever payment he is making is covered under TDS. If it is covered under TDS under the respective section, he is supposed to deduct a part of it and remit it to the government. Remaining he will give it to the payee. If not, payer will be treated as assessee in default. And whatever loss of revenue to the government, he has to make it good. Means he has to pay out of his pocket. And if he has not deducted TDS or else deducted but not remitted to the government within due date of filing income tax return. Guys, please be careful here. The due date to remit TDS is 7th of next month. Whatever TDS I have deducted, I have to remit it within 7th of next month. But here what they are referring to is not TDS due date. Here what they are referring to is the due date of filing income tax returns. So they are telling, if you have deducted TDS, even if you have given late fine, we will still accept it. But from 8th interest will start. If you have not remitted within 7th, from 8th interest will start as per TDS chapter. But here what they are telling is, if you have not deducted TDS or you have deducted but not remitted to the government within due date of filing the income tax returns, then you cannot claim that expenditure. You cannot claim that expenditure, guys. Clear? How much and all we will see it. Fine? Sure. TDS not deducted or two default are covered here. Not at all deducted or else deducted but not remitted to the government. For this, under TDS chapter also there is a consequences. You have to pay interest, penalty and free boarding and lodging also you may get. Over and above that, your expenditure is disallowed here. Okay, under the PGB. TDS deducted, TDS not deducted or deducts TDS but not paid the same on or before the due date of filing the returns under section 139 subsection 1. What is the due date to file income tax returns? Sir, if I am supposed to furnish transfer pricing report, that is if I am engaged in international transaction, 30th November. Sir, if I am supposed to get tax audit or if I am a company and all, then the due date to file returns is 31st October. If not, in all other cases, 31st July. Clear? And if question is silent, here always try to take 31st October, guys. Clear? Means I don't know, sir, which 3 dates to take, so 31st October you take. For PGBP chapter, I am telling you. 31st October of assessment here. When question is silent. Okay. Fine. So as per section 40A1, any sum payable outside India or to a non-resident or foreign company within India, if you have not deducted TDS or deducted but not remitted, how much expenditure will be disallowed? 100%. As per 40A1A, the expenses payable to resident, if you have not deducted TDS or deducted but not remitted, then 30% would be disallowed. 30% would be disallowed. That is maximum tax rate in India is how much? 30%. They are telling disallowed. Clear? Sir, what if I deducted and remitted in the future? Or else I deducted but not given to you within time. I am giving it later. In that case, whatever was disallowed in the past will be allowed in the year in which you make it good. And one thing, sir, for resident payment, how much would be disallowed? 30%. So in the future, if I remit the TDS to the government, how much will be allowed? 30%. Not again 100%. Because 70 was already allowed. So what is disallowed will be allowed for you subsequently. Next, as per 48(2), income tax or foreign income tax shall be disallowed because we are calculating the income to compute the tax on which we are supposed to pay tax. Correct? Na? So before calculating the income only, you cannot claim tax. So anything with respect to income tax, guys, you cannot claim it. Whether it is income tax paid or income tax provisions, you cannot claim it. Sir, I have paid income tax in US, sir, UK, sir, can I claim it here? No. Amount paid by way of royalty, license fee, service fee, privilege fee, service charge by state government undertakings to state governments shall be disallowed. As per section 40A3, important guys, one expenses is covered here. That means salary will not come here. Clear? Because for salary we have a separate dedicated section. Salary payable outside India or to a non-resident and TDS has not been deducted or TDS deducted but not paid within what date? Within the TDS due date. What is the TDS due date? 7th of next month. Then permanently disallowed. Sir, I am giving it on 8th, sir. Please, sir, apology, accept, sir. No. Permanently disallowed. 100% disallowed. Sir, 8th I gave, no. So next month I can claim, no. Permanently disallowed. Please be careful. Here it is TDS due date. So salary is covered here means what is covered in 40A1 is other than salary. Other than salary, guys. Next 40B, important again. Applicable only to partnership firm. Guys, now when firm is paying to partners For income tax purpose, partner is different, firm is different. Clear? Now when firm, whatever income the firm is earning, who is liable to pay tax? Firm. Now, once the firm earn all the profit, whatever share of profit is there, share of profit if they are giving to the partner, is it again taxable in the hands of partner? No, it is exempt. It is exempt. Share of profit given by the firm to the partners after all the expenses, after paying income tax, is not again taxable in the hands of partner. Same way, what they are telling is, if partnership firm is giving interest, salary or remuneration to the partners, can firm claim it as an expenditure? Yes, they can claim it. They are free to claim it, but not however, how much ever they want. There is some restrictions, because you may decide how much ever to take now. Interest 30%, salary 30 lakh per month. Agree na? So manipulation you cannot do. So interest maximum 12%. Okay, now means if it is mentioned in the deed. Sir, in the deed it is given 15%, sir. So interest as per the deed or 12%, whichever is lower. Sir, in the deed only 8% is given, only 8%. Only 8%. Clear, sir? In deed nothing is mentioned, sir. 0. Got. Next. Partners are getting remuneration or salary. Remuneration or salary includes everything, guys. Bonus, allowance, perquisite, everything. Partners are getting it from firm. Now, everything they get, is it allowed for the firm? No. It is depending upon 40B limit. 40B is telling actual remuneration or the limit whatever we are putting. Whichever is lower is allowed. Whichever is lower is allowed. Provided this partner is a working partner. He should be a working partner and it should be mentioned in the deed that how to calculate your salary or how much is your salary. Sir, there is no deed at all, sir. No remuneration. Means remuneration will not be allowed. Clear? Sir, he is not a working partner, sir. Sleeping partner. But for sleeping he is getting paid. In that case, will it be allowed for the partnership firm? No, it will not. Now, sir, what is the limit? We have to calculate the book profit of the firm, guys. Provided he is a working partner plus deed is there. In the deed, the salary, how much is the salary or the manner of calculating salary is mentioned. Okay. Now, first we have to calculate book profit of the firm. What is book profit of the firm? The taxable business income of the firm after all the expenses except remuneration. Except remuneration means you would have claimed all other expenditure. If something is disallowed, you would have disallowed it. Everything you have followed except remuneration, because remuneration we are yet to calculate. So book profit is nothing but taxable business income of the firm, but before remuneration. If remuneration is already debited, please add back that. Please add back that. If it is not yet debited, don't do it. Now we will calculate. On the first 3 lakh book profit or in case of loss. First let us take loss. If it is loss, straight away 1,50,000 maximum, guys. Clear? Yes. So on the first 3 lakh book profit, 90% of book profit or 1,50,000, whichever is higher. If it is a loss, straight away 1,50,000 or 0, whichever is higher, 1,50,000. Next, on the balance, 60%. Assume, guys, the book profit is 20 lakh. We have calculated and it will not be directly given sometimes, you have to calculate. So 20 lakh. So on that case, on 3 lakh, 90%, 2,70,000. Hello? On the balance, how much is the balance? 17 lakh. On 17 lakh, how much? 60%. Clear? This is the limit as per 40B. Give me the amount quickly. Huh? Hey, 17 lakh into 60%, madam. 1020. 1020. So 12 lakh 90,000. 12 lakh 90,000 is the limit, right? Yes, sir. 12 lakh 90 is the limit, sir. What is the actual remuneration? Assume 15 lakh. Assume 15 lakh. So whichever is lower, how much is allowed? 12 lakh 90. 12 lakh 90. Sir, firm has actually paid 15 lakh, sir. Partners have received it, sir. They have enjoyed it, sir. Doesn't matter. 1290 is allowed as expenditure for the firm. Now, for partner, how much is taxable? He received 15. How much is taxable? 1290. Under which head, sir? PGBP. Interest and remuneration received by a partner from the firm is taxable under the head PGBP because there is no employer-employee relationship there. Okay. Partner and partnership firm is principal and agent, not employer and employee. Sir, employer, sir, that is why he is a working partner, he is a working employee, he is getting salary. You may give whatever name you want. In income tax law, they are telling, no, you are not employer-employee. So in that case, what is allowed to the firm is taxable in the hands of partner under the head PGBP. Sir, what about the remaining 2,10,000, sir? That will not be taxable. Even though the partner has enjoyed this, nothing is taxable, because when it is disallowed for the firm, it will not be taxable in the hands of partner. Only what is allowed for the firm is taxable. So how much we are allowing them? Only 12,90,000. So only that much will be taxable in the hands of partner. Okay. Next, 40A series. This too, especially very important. 40A2. If you make unreasonable payment to your relative, then A2. As per section 40A2, excessive or unreasonable payments made to a specified person, that is either relative or associated concern, is disallowed. How much is disallowed? Only excessive part. Sir, from my business, I have made an excessive payment for my relative. Actual payment was 1 lakh, sir, but I have paid 1,50,000. How much would be disallowed? 50,000. Next, as per section 40A3, very important, cash payment made to a single person in a single day, more than 10,000 is disallowed. For a single person in a single day, in cash, disallowed. Sir, in what mode payment can be made? Rule 6 ABBA will tell. Abba, we will see that later. Now we woke up. However, in case of payment is made to plying, hiring or leasing of goods carriages, the amount specified is 35,000. Instead of 10,000, it is 35,000. Please be careful with exceptions. And for this cash payment, there are certain exceptions also, where they are telling you can make. If you have made any payment in rural areas or to the farmers or to the government, RBI and all, they are telling yes, you can pay it in cash. Then, as per 40A7, no deduction shall be allowed in respect of any provisions made by the assessee for the payment of gratuity to his employees. Provision is not allowed. When you actually pay, amount might be huge, still allowed. Because many a times what happens, the employers will keep on creating the provision to pay gratuity. Because when they are supposed to pay gratuity, the amount would be huge. Suddenly they cannot arrange for the funds. So what they do, every year a part of the profit they will set aside as a provision, and when the employee retires, they will pay gratuity. So now every year when they are setting aside and creating the provision, can they claim the expenditure? No, only when the year in which they pay, they can claim it. Whatever amount they are paying, they can claim it. Okay. Change in the rate of exchange, 43A. Sir, I have purchased the asset from the foreign supplier on credit. Or I have purchased the asset by taking the loan from foreign institution or outside India. In that case, the cost of the asset will affect my cost. Sorry, the cost of asset will be affected through fluctuation in exchange rate. Fluctuation in exchange rate. So, this section is applicable only in the following two cases. Observe it. Where an asset has an acquired, which is any depreciable asset which is used for business or profession from any country outside India on credit. That is, you have purchased from outside India but on credit. So payment we will be making later. When can you start claiming depreciation? From the date you bring the asset and start using it. Clear? Yes. Then you have taken the asset, you have purchased the asset. For supplier you have paid it in full. But how did you get the money is, you have arranged for a loan, foreign loan. Clear? Again, what I have to repay depends on the exchange rate on the date of repayment. Yes. So now guys, listen. Sir, I had purchased an asset for $1 lakh. On the date of purchase, the exchange rate was 80 rupees per dollar. So how much I will capitalize? 1 lakh into 80. I will capitalize, sir. Okay. I will add this asset to the block and I will start claiming depreciation. Yes. Next. On the date of repayment or on the date when I am paying to the supplier, the exchange rate is 85 rupees. 85 rupees per dollar on the date of payment. So in that case, I will end up paying 5 rupees more for each and every dollar. Yes, sir. So 85 minus 80. So what is my exchange loss? 5 rupees. Into how much I have to pay? $1 lakh. $1 lakh. So this much is my exchange loss. Exchange loss, which I will add it to the cost of the asset. How much I have already capitalized? This much. Agree. Now for that I will add this 5 lakh. I will add 5 lakh. What is this? Exchange loss. I ended up paying more. When will I add it? When I am actually paying it. Clear? See, in accounts and all, we will revalue the asset at the end of each and every year based on exchange rates. But we will not do that here. We will revalue it, or we will do revaluation upward or downward. We will add or deduct only when I am paying it. If I paid extra, I will add it. If I have paid less, I will deduct it. We will take vice versa case. So on the date of repayment, exchange rate was 78 rupees per dollar. I have already booked for how much? 80. So now 80 minus 78, 2 rupees is a gain for me, exchange gain. So 2 rupees into 1 lakh dollar, 2 lakh is the exchange gain, guys. What should I do? I have to reduce it. I have to reduce it from the cost of the asset. So on this increased or decreased cost, I will continue to claim depreciation. Clear? So if it is exchange loss means I ended up paying more. What should I do? Whatever more I am paying, I have to add it to the cost. Then if it is exchange gain, I am ended up paying lower. That means I have gained something. I have already capitalized more. So what should I do? Whatever is your gain, reduce it. Next, expenses allowed on actual payment. Guys, when we were covering section 36(1) also, few payments were subject to 43B, subject to 43B, correct? Now what is 43B, sir? What is 43B? They have listed out some expenditure here. They are telling the following expenses are allowed only if payment is made within the due date of filing the income tax return. Not within 31st March, within the due date of filing the income tax returns. If you have made the following payments only within the due date of filing the income tax returns, you can claim it. If not, no, you cannot. Sir, what if I make the payment after the due date? You claim it in next year. Which are those expenses, sir? Taxes, duties, cess or fees payable under any law except income tax law. Because whatever you pay under income tax law is not allowed. We saw it under 48(2) only. Yes, sir. So any other thing like for GST, municipal tax and all, if I have paid, can I claim it as an expenditure? Yes, provided you have paid it within the due date. Then bonus and commission to employees, interest in respect of term loan or advance borrowed from specified institution, leave encashment, amount payable to Indian Railways for use of railway asset, chaya song, shooting, you know, na? Employer contribution to PF or superannuation fund or any other fund for welfare of employees. Employer contribution, please be very careful, not employee. Employee we have already covered under 36(1). First deemed income, then if it is deposited within the due date of the respective fund, allowed. Employer contribution, it has to be for recognized or approved fund. It should be for the welfare of the employees, and here they are telling it should be paid within the due date of filing income tax returns. Okay. Sir, what if it is paid after the due date? Allowed in the next year. Then one important change they have brought now, guys, for the payment made to MSME. Actually, the implication or the implementation of this has been postponed. Okay, due to because many people criticized it. So, or they told no, immediately don't implement it. So that is why it has been postponed. But for academic purpose, question can be asked. So important. So that is why. So try to cover this. Sum payable by the assessee to micro and small enterprise. Micro or small enterprise. Small companies. For supply of goods or services beyond the time limit specified in section 15 of MSME Development Act. MSME means micro, small and medium enterprises. But here medium is not covered for income tax. Clear? Yes. So what they are telling, guys, see, please listen here. 43B, important, I am telling you. 43B is connecting to section 15 of MSME Act. What is 43B is telling? If payment is not made within the due date given in section 15 of MSME Act, then it is disallowed. Now what is section 15 of MSME Act is telling, sir? First check. Sir, is there any written agreement between the assessee and micro and small enterprise? Who is assessee? The person who is having business or profession. Clear? Now, I am the assessee who is having PGBP income. I have obtained some goods or services from whom? Micro or small enterprise. Micro or small enterprise. For this I am making payment. Na? They are talking about this. Is this payment allowed or not? Check, sir, whether there is an agreement between these two parties. If there is agreement, then check what is the due date as per that agreement. Because normally when we have an agreement, in the agreement there will be a due date. Within 60 days make the payment, within 40 days make the payment. Yes. So, if there is a written agreement between the assessee and the micro or small enterprise, then if it is there, yes, no, okay. Payment has to be made as per the agreement, whatever is the date mentioned in the agreement, or maximum within 45 days of accepting the goods or services. Who has accepted the goods? Me. So, within maximum is 45 days. Sir, as per the agreement, 60 days is there, sir, 90 days. No, as per section 15, they are telling maximum 45 days. Because there is high chances of you guys manipulating the small and medium enterprises, or sorry, micro enterprises. Clear? So they are telling within 15 days make the payment. Within 15 days make the, 45 days make the payment. Even as per the agreement, 60 days, 90 days and all is there. Sir, what if it, as per agreement, only 30 days is there? 30 or 45, whichever is earlier. 30 days. You have to make payment within 30 days. Clear? Yes. Next. Sir, what if there is no agreement? No written agreement, sir. Then payment has to be made within 15 days of accepting the goods or services. What if payment is not made within 15 days? Then, however, if the sum is not paid within the time limit specified above, the deduction for expenses would be allowed in the previous year in which actually paid. Normally, see guys, payment has to be made within this many days. If it is not paid, it will be allowed when it is paid. Clear? So they are trying to cover only the expenses which is incurred at the end of the year. Clear? For example, sir, I have purchased the goods in April. I was supposed to pay within 45 days or 15 days, but I paid in August. Can I claim it in same year? Yes, you can claim it. Because I didn't pay within this time limit, but I paid in same year, no? So I can claim it. So which expenses they are mainly targeting here is, sir, I have incurred the expenditure. I have purchased the goods or services in March, but I didn't pay within 15 days or 45 days. I paid in April or May. Can I claim it in this year? No, you claim it in next year. Claim it in next year. Sir, I purchased but never paid. Can I claim it, sir, on accrual basis? No, you cannot claim. Clear? So the intention, the main intention here of the law is to protect the interest of micro and small enterprise. Because the large company, the large associates and all may dominate these people. Telling you sell me now, I will pay you later after 60 days, 90 days, 6 months and all. Clear? And these people, small and enterprise, in order to grow their business, in order to increase their market share, they will also accept it. Clear? Government is telling no, let them grow. Like you also started from zero only. No? Same way they people also are starting. Support them. Don't make payment after so long. How will they run their business? Working capital from where they will bring. Okay. That is the intention, guys. Next, 41. 41. Section 41 enumerates items of notional income which are deemed to be the income from the business or profession. So, guys, the following incomes are taxable under the head PGBP even though you have already shut down your operation. Okay. Which are those, sir? Remission of any liability or recoupment of loss or expenditure. Sir, in the past I had claimed any expenditure or loss. Now I have recovered it. Is it taxable now? Yes. Sir, in the past I had paid GST. I have claimed it as an expenditure. Later I claimed it as a refund. Is it taxable? Yes. Same way. Sir, my stock was destroyed by fire. I have claimed it as a loss under that PGBP last 2 years back. Now I am receiving insurance compensation. Is it taxable now, sir? Yes, it is taxable. Clear? So if you have claimed any expenses or loss in the future, in the past, if you have recovered it in the future or in the current year, then in the year in which you have recovered it, it is taxable. Then balancing charge on the assets depreciated under SLM for power sector. So power sector, if they have opted for SLM basis, assume guys they have purchased the asset for 10 lakh. So the cost of the asset is 10 lakh. So they claim the depreciation for 3 years. For 3 years. Let me take it as 3 lakh. So what is the written down value now? Left out 7 lakh. Assume guys they have sold it. Assume they have sold it. So they have sold for how much? Let me take two values. Let me take two values. One is 5 lakh, one is 8 lakh. Both cannot happen simultaneously, but I am just covering both. 5 lakh means there is a loss of 2 lakh. There is a loss of 2 lakh. So value of the asset was 7 lakh, but you have sold for 5 lakh. That means there is a loss of 2 lakh. Yes, sir. We call it as terminal depreciation. Allowed in the year in which you have sold the asset. Loss on the sale of asset which was charged for depreciation under SLM method will be allowed as terminal depreciation in the year in which it is sold. Okay. Under that PGBP. Next, sir, what if I have profit? So 7 lakh is the worth of asset, but we have sold it for 8 lakh. How much is the profit? 1 lakh. We call it as balancing charge. Not profit, balancing charge. But as per normal terms, it is called profit only. Profit on sale of the asset. Where is it taxable? Under the head PGBP. As per section 41 subsection 2, balancing charge B, second alphabet. Okay. Sale of scientific research asset without use in the business. Sir, scientific research asset we saw. Clear? If it is used in the business, obviously you will add the asset to the block but at nil value. Later if you sell, section 32 will fail and section 50 will pitch in. Sir, section 35, capital asset I purchased. I claimed deduction but I never used it. I sold it like that only, sir. In that case, it is taxable under this head. Sale value minus whatever you already claimed will be taxable. Sorry, sale value or the amount of deduction what you have claimed, whichever is lower would be taxable here. Sale value or the amount of deduction, that is 100% of the capital expenditure, whatever you have claimed would be taxable here, whichever is lower. Okay, next, bad debts recovered allowed earlier. See, bad debts is not included in subsection 1. But for that, there is a dedicated section. Bad debt, debt, alphabet D, fourth. So subsection 4. Okay. Bad debt recoverable taxable is whatever you have recovered. If by chance, in the past, if something was disallowed, then we will reduce that. So for example, sir, in 2021, I claimed 1 lakh bad debts, but income tax officer or assessing officer allowed only 60,000. So how much was disallowed? 40,000. 40,000. Okay, this is also 40K. Oh, so 40K is disallowed, sir. Yes. Now in 23-24, I recovered it, sir. How much I recovered? In 80,000. Bad debt recovered 80,000. Will entire 80,000 taxable? No. Whatever was disallowed, we will reduce it. 40,000. Only remaining 40 would be taxable. Only if question is specifying about disallowed, we will take it. If nothing is given, entire bad debts recovered would be taxable. Then, subsection 5. Deemed profits from a defunct business. This is a new addition for subsection 5. Deemed profits from a defunct business can be set off. Defunct means the business which you have already closed down. Can be set off against brought forward losses of such business even after the expiry of 8 years. Sir, now I have already shut down my business, sir. I have shut down when? In 22-23. I have liquidated. Okay, sir. Now, in 23-24, I recovered some expenditure from it, or whatever loss I had already claimed, I have recovered it, sir. How much? 2 lakh. This loss I had claimed in 15-16, sir. In 15-16, I had claimed it. For which business? Same business which I already closed in 22-23. So in that case, if you have claimed any loss or expenses in the past, which you have recovered now, clear? It is taxable. But the business what you have closed, if you have any carry forward loss from that business, if you had any carry forward loss, this 2 lakh can be adjusted against that loss. Even if 8-year period is already over. Even if 8-year period is already over, maximum you can carry forward the business loss for how long? 8 years. So even if 8-year period is over, still you can adjust it, because the amount what I have recovered is from the business which is closed down. The loss which I had is from which business? Which I have closed down. So whatever I have recovered, can I adjust it against the loss from the same business? Yes, you can adjust. Even though 8-year period is over. Even though 8-year period is over, guys. So the first part, computation part, done. Now let us move towards maintain. Who should maintain the books of account? Who should get their books of accounts audited? 44AA, accounts. 44AA stands for accounts. Who should maintain the books of accounts, guys? Specified person. First of all, who is specified person? In the note, as per rule 6F, specified person includes person carrying on the profession of legal or medical or engineering or architectural or accountancy or technical consultancy or interior decoration or a film artist or company secretaries and information technology professionals. If you are carrying any of this profession, not as a business professions, then you are called as what? Specified profession. When or specified person. When should you maintain the books of accounts? You might be carrying it as a sole proprietor, you might be doing it as a partnership firm, however it is. If you are carrying on the following professions, then when should you maintain the books of accounts? If your gross receipts is more than 1,50,000 in the last 3 years, all 3 years. Now we are in which year, guys?
25.
Hey, previous year, man. 23, 20. For exam purpose, previous year means 23, 24. Okay, don't forget that. So go back to last 3 years. 22, 23, 21, 22, 21. Sir, in all these 3 years, gross receipts, all the years, assume gross receipt is, sir, 1.2 lakh, 1.8 lakh, 2.2 lakh. Should I maintain the books of accounts in 23, 24? No, I need not. And all the 3 years it should be. What, madam? See, in all the 3 years immediately preceding the previous year. Okay, fine. Chalo. Now, sir, next case I will give. Gross receipts is 1.8 lakh, 2.2 lakh, 3.8 lakh. Should I maintain books of accounts in 23-24? Yes, I should maintain. In all the 3 years, if it is more than 1,50,000, yes, in the current year, I have to maintain books of accounts from day one. From day one. Okay, sir. Next, non-specified person. Means I am not carrying on any of the professions, sir. Then check whether you are an individual or HF. Then, if income from business or profession more than 2,50,000, you have to maintain. Or sales or turnover or gross receipts from business or profession more than 25 lakh. Anyone, if you are satisfied, also you have to maintain it. Then, no, sir, I am a company, partnership firm, or LLP, AOP, BOI and all. In that case, income from business or profession more than 120, or sales or turnover more than 10 lakh. You have to maintain books of accounts. When, sir? In any one out of the 3 years immediately preceding the accounting year. In any one, not all 3, any one. That means, sir, assume we are I am talking about this point, or else let me take individual HF. Now I am an individual HF who is carrying on the business. My income, we are talking about this point, guys, please be careful. So individual or HF also I will mention better here. Okay, my income is 1.6 lakh, 2.2 lakh, 2.8 lakh. Should I maintain books of accounts? Should I maintain books of accounts? Yes, in any 1 year. In any 1 year, I am satisfied. So in the current year 23-24, I have to maintain my books of accounts. Same way. Assuming this is 2.4, should I maintain? No. But let us check the turnover. If not income, we have to check the turnover. Now turnover is 20 lakh, 24 lakh, 28 lakh. Should I maintain the books of accounts? Yes, I have to. Either income or turnover is more than the limit means I have to maintain it. When? In any 1 year out of the last 3 years. Sir, I am starting my business or profession in the current year, sir. In 23-24, I am starting it. It is a loose provision, is what I believe. But still, if I am starting my new business or profession, if you believe that you will cross the above limits by the end of the year, they are telling from the day one you maintain the books of accounts. Which is not fair, because in the previous cases and all, they told here, in the past, if your income or turnover is more than that, in the current year, you maintain the books of accounts. When I started my business itself, I may not have an idea by the end of the year how much I will cross on them. Okay, as a safety, I should start maintaining it. I should start maintaining it. Correct? Now here there is no history for me. What they are telling is if it is likely to exceed by the end of the year, maintain books of accounts from day one. Clear? Yes. But somewhere there is a disconnection between this and this. Okay, because, sir, if I am covered here, then I may start maintaining books of accounts from day one only. So in the future, if I go and look back, I would have already maintained books of accounts. Agree. So I need not check what is my income, what is my turnover, what is my gross receipts and all. But okay. Next, books of accounts has to be maintained for how long, sir? For a period of 6 years from the end of relevant assessment year. So if books of accounts is for 23-24, that is previous year 23-24, which is the assessment year 24-25. So when will the assessment year end? 31st March 25. Correct. Now from here 6 years, guys. That means obviously you would have maintained for this year. You would have maintained for this year. Correct. Now books of accounts is related for what? 23-24. So you would have definitely kept for that year. Then for assessment year also you have to keep it plus 6 years. So effectively including this year 8 years. 8 years. But in the law they have told 6 years from the end of relevant assessment year. Remaining 2 points I will cover it along with presumptive. So what if I don't maintain? What if I don't maintain? I am supposed to maintain but still I am not maintaining. In that case, if a person fails to keep and maintain or retain any books of accounts and other documents, penalty of 25,000 would be leviable. Now sir, I am not covered above. Can I still maintain the books of accounts? Voluntarily you can maintain. But if you are covered here, mandate. Yeah, next. Audit of accounts. That is, we call it as tax audit as per section 44 AB. Section 44 AB makes it obligatory for a person to get his accounts audited before a specified date by a chartered accountant. So what is specified date we will see first. Specified date means 1 month prior to the due date of filing the income tax return, that is 139 subsection 1. Guys, whenever tax audit is applicable, the due date to file income tax returns is 31st October of assessment year. 1 month prior to that means 30th September. So what is the due date to file tax audit report is 30th September of assessment year. Okay. Now who should get their books of accounts audited? Whoever is maintaining books should get their audited? No. if the total sales, turnover or gross receipts in business is more than 1 crore, they have to get their accounts audited. But the threshold limit now has been increased to 10 crores subject to the following condition. That is, aggregate of all the amounts received and all payments made in cash does not exceed 5% of the said amount. Guys, normal limit is 1 crore. But extended limit of 10 crores is applicable subject to limit. What is it, sir? For example, assume my total receipts is 50 lakh and my total payments is 30 lakhs. Maximum how much I can receive in cash is 5% of it. Maximum how much I can receive in cash, guys? 5 lakh. No, sorry, 50 lakh into 5%, 2,50,000. Maximum I can receive in cash. If I receive 3 lakh, 5 lakh, 10 lakh in cash, then what is the limit applicable for me? 1 crore. If I cross 1 crore, I have to get my accounts audited. Clear? Next, same way. So here, 30 lakh into 5%, it comes to 1,50,000. Maximum how much I can pay in cash? 1,50,000. Maximum how much I can pay it in cash? 1,50,000 or less than that. Not more than that. Okay. Fine. This is what the limit. If I cross 5% limit, then 1 crore is the turnover limit applicable for me. If not, 10 crore. Okay. Next, whenever I am following the presumptive scheme, should I get my accounts audited, sir? No. If I am following it, I need not. Then, if gross receipts in the profession is more than 50 lakh, I have to get my accounts audited. Next, in case of the assessee covered under section. Now, sir, this 3 again we will see along with the presumptive because that is connected to presumptive. Next, we have seen based if you are doing business, when should you maintain? If you are doing profession, when should you maintain? For profession, there is no extended limit and all, guys. For profession, there is no extended limit and all. Okay. Now, sir, I am supposed to get my accounts audited, but I didn't get it. I didn't appoint chartered accountant. I didn't get my books of accounts audited. In that case, what for me, sir? Penalty. Penalty under section 271B if assessee fails to get accounts audited. How much? 0.5% of the turnover or gross receipts or 1,50,000, whichever is lower. Whichever is lower, guys. So easy. 44AA, penalty is 271A. 44AB, penalty is 271B, guys. Okay. Chalo. We'll proceed further. Now for presumptive schemes. Presumptive taxation under section 44AD. This section is applicable only to resident individual, HUF and firm other than LLP. Sir, company and all, can they follow this? No. LLP also cannot follow. Okay. But in resident individual, HUF and firm, not always, subject to something, certain things. Carrying on any business other than the business referred to in section 44AE, whose total turnover or gross receipts from such business in the previous year does not exceed 2 crore. So your income or the turnover from the business does not exceed 2 crore, means less than or equal to 2 crore. Okay. Or does not exceed 3 crore, this extended limit is there subject to condition. Provided aggregate cash receipts, they are not talking about payment, only receipts, in the relevant previous year is less than or equal to 5% of total turnover or gross receipts. Means maximum you can receive 5% in cash, not more than that. If you receive more than 5% in cash, then the limit applicable for you is 2 crore. And what is the presumptive income, sir? 8% of your gross receipt is your income. Remaining 92% is deemed to be your expenses. But if you satisfy certain condition, then 6% will be your presumptive income. Note, presumptive income under section 44AD shall be calculated at 6% on the turnover or gross receipt sales if the following conditions are satisfied. Turnover gross receipt sales is received by any mode other than cash within the due date of filing the income tax returns under section 139 subsection 1. If you are not received within that date, then it is 8%. For example, sir, totally during previous year 23-24, I have received 80 lakhs from my business, gross receipts. Gross receipts is 80 lakh. So I have received in cash 10 lakhs, sir. Then within the due date, I have received 50 lakhs, sir. Then after the due date, how you have received doesn't matter. After the due date, I have received 20 lakhs, sir. What is my income? What is my income? What is the amount I have received in any mode other than cash before due date? 50 lakh. On that 6%. On that 6%. On the remaining, it is 8%. On the remaining, it is 8%. We have to add up all these three. That is our presumptive income, guys. That is our presumptive income under section 4480. Okay. Now, assessee whoever is following 44AD, if they are liable to pay advance tax, they have to pay it in one shot on or before 15th March of the previous year. Then, the provisions of section 44AD shall not apply to a person carrying on any profession referred to in rule 6F, because for them 44ADA is applicable. 44ADA is applicable. Yes. Next, a person earning income in the nature of commission or brokerage is not eligible. A person carrying on any agency business. Why? Because for them profit margin is more. They're telling, no, for you presumptive scheme is not available. Then assessee covered under section 44AE, goods carriage business, because for them separate presumptive schemes are there. Then assessee who has availed exemption under section 10A or deduction under section 10AA, 10B, 10BA or any other deductions claimed under chapter 6A heading C, income based deductions. For this people's 44AD presumptive scheme is not available. Now, once you are following 44AD presumptive scheme, you have to follow it for next 5 years. In any year in between this, if you want to go out, you cannot come in again for next 5 years. So totally 6 years. The year which I go in plus next 5 years, you have to follow 44AD. Subject to other conditions and all. That is your turnover is within the limit and all. Sir, what if I have crossed the limit? Definitely you have to go out. Definitely you have to go out. So, sir, no sir, I have not crossed the limit, but I felt my income is less than 8%. So I will actually calculate my income. So I want to go out. If you want to go out and if you are calculating your income as per normal provisions, okay, if your total income is more than basic essential limit, you have to maintain your books of accounts and get it audited. Yes. Chalo. Next 44ADA. This is for specified profession, guys. So here rule 6F we saw na, the person who is carrying on na, same. So same people are covered here. This section is applicable to resident, individual and partnership firm only, but not for LLP. So even for companies and all it is not available. Engaged in specified profession as per rule 6F and whose gross receipts in the previous year from such profession does not exceed 50 lakh. 50 lakh is a normal limit, but they have extended this limit to 75 lakh if your aggregate cash receipt is less than or equal to 5% of gross receipts. Clear? So please be careful. 75 lakh is subject to condition, whereas 50 lakh is always available. No. And here only receipts part they have given, not about payments. Clear? Take total receipts. In that, how much you are received in cash. If it is less than or equal to 5%, you are eligible for 75 lakh. If not, 50 lakh. Okay. So what is your presumptive income? 50% of your gross receipts is your presumptive income. Remaining 50% is deemed to be expenses. Okay. Now, a person who is covered under 44ADA, if he is liable to pay advance tax, he has to pay it in one installment on or before 15th March. Next, business of plying, hiring or leasing goods carriages. If the assessee who carry on the business of plying, hiring or leasing goods carriages and who owns not more than 10 goods carriages, less than or equal to, even 10 exactly also fine, at any time during the previous year, the income shall be computed as follows. Sir, for 1 day or 2 days, I owned 11 vehicles, 12 vehicles, sir. You are not at all eligible for this. Throughout the previous year, you should have owned 10 or less than that. So what is the presumptive income? In case of heavy goods vehicle, when a vehicle is called heavy goods vehicle, if the vehicle weight, excluding the goods and all, vehicle weight if it is more than 12,000 kilograms or 12 tons, we call it as heavy goods vehicle. So for heavy goods vehicle, what is the presumptive income? 1000 rupees per ton of gross vehicle weight or unladen weight for every month or part of the month. Sir, what? The vehicle weight was 15 tons and I owned it for all 12 months. In that case, 15 into 1000 into 12 months, guys. Into 12 months. Clear? Yes. Next, vehicles other than heavy goods vehicle. And sir, what if it is like 15.5 tons? Make it 16. Make it 16. Round it off. Means sir, 15,500 kgs, sir. Make it 16 tons into 1000 rupees into 12 months. Sir, what if I owned it only for a part of the month? Assume 8 months. Then accordingly take only 8 months. Even part of the month you have to take full month. Days and all ignore it. Even 2 days, 1 day, 5 day, 10 day in a month, full month. Vehicles other than heavy goods vehicle, presumptive income would be 7,500 for every month or part of the month per vehicle, not per ton and all, per vehicle. 7,500 for every vehicle per month or part of the month. Okay. Guys, whenever we are following 44AD or ADA and 44AE, this provisions has been brought to reduce the compliance burden of the assessee who is doing small profession or small business. So they need not maintain the books of accounts, they need not get it audited. But sir, can they claim any expenditure? No. All the expenditure is deemed to be allowed, including depreciation. But if the assessee is covered under section 44 AE is a partnership firm, they can claim 40B deduction. That is remuneration and interest, they can claim. Only for the firm which is covered under 44 AE, they can claim. Clear? And please be careful. Sir, if the assessee who is covered under 44 AE, if they are liable to pay advance tax, they have to pay it in 4 installment only. Only for AD and ADA, they are telling 1 installment. Okay. And now, sir, assessee whoever is covered in presumptive scheme, if they agree for presumptive scheme, they need not maintain the books of accounts, they need not get it audited. Sir, what if they don't agree? If you are an assessee who is covered under 44 AD or ADA, who is not agreeing for presumptive income, if your total income as per normal provision is more than basic exemption limit, maintain books of accounts, get it audited. Whereas 44 AE, if you are not agreeing for the income calculated as per 44 AE, you have to maintain the books of accounts and get it audited. And here we don't check basic exemption limit at all. Yeah. Yes. Now, guys, for adjustment of loss, we treat 3 businesses as 3 categories. We classify the businesses into 3 categories, not for tax rate purpose. Tax rates for business income is always normal rates. Only for adjusting the loss. Only for the purpose of adjusting the loss. Okay. What are those, sir? Speculation business, specified business, and all other businesses is normal business. So speculation business means when you buy and sell something online without physical delivery. Loss from speculation business can be adjusted only against income from speculation business. Sir, can I adjust loss from one speculation business against income from another speculation business? Yes, you can do it, but not against other business incomes. Maximum you can carry forward the speculation business loss for 4 years. Okay. Specified business, we have seen already 3580. If the assessee is doing specified business, especially most of them are engaged in infrastructure, warehousing and all, you would have incurred huge capital expenditure and everything is allowed under 3580. Again on that you cannot claim depreciation. Yes, sir. So normally in the initial years you will have huge losses. So loss from specified business can be adjusted only against income from specified business. Sir, can loss from one specified business be adjusted against income from another specified business? Yes, you can do it, but not against any other business income or not against any other rates of income. And loss from specified business can be carried forward for indefinite period. It has no life. Okay, infinite period. Then any other business, check whether it is current year or brought forward. If it is a current year business loss, it can be adjusted first within the same head against any business income. Sir, can loss from normal business be adjusted against income from speculation, income from specified? Yes, you can do it, but vice versa not possible. Okay. Sir, no sir, within the head I don't have any income. Can I adjust it against other heads of income? Yes, you can do it, except salary. Except salary. And you know, casual income, we cannot adjust any loss. So that is always there. Okay. So loss, current year business loss can be adjusted against any head except salary. Okay. No sir, I didn't have any income under other heads also. Next, what will you do? Carry forward for next 8 years. And once you carry forward, you can adjust it only within the same head. That is PGBP. You can adjust it only within the same head, guys. Now, sir, what is the impact of default regime? What is the impact of default regime under the head PGBP? Under the head PGBP. Additional depreciation cannot be claimed on new plant and machinery. Normal depreciation can be claimed 15%, but additional is not allowed. Okay, 20% is not allowed. Only normal. Okay. Even if you are engaged in manufacturing, power sector business, still you can claim only normal. Then deduction in respect of tea, coffee and rubber business, which is allowed under section 34 AB, will not be claimed here. It is blocked. Then deduction for donation made to outsiders for research purpose is blocked. Then deduction in respect of capital expenditure incurred for specified business, that is 35 AD, blocked. Now one more twist here. Sir, in the past, I had already claimed 35 AD deduction where I was following optional scheme or old regime. I have a loss. Now from current year I am coming for default regime. Can I carry forward that loss and adjust? No. Under default 35 AD deduction is blocked. That means if you have any loss relating to this, please leave it and come. Next, deduction for expenditure on agriculture extension project. is also blocked. So the following expenditure under the head PGBP is blocked under the default scheme of section 115 BAC, guys. Then rule 6 ABBA. So wherever we have seen, you are allowed the expenditure only if you are making in any mode other than cash. Sir, in what mode can we make the cash? In what mode can we make the payment? Rule 6 ABBA is telling the payments can be made or received in the following modes. Which are those modes? Account pay check or bank draft, credit card or debit card, net banking, IMPS, UPI, RTGS, NEFT, BHAM, that is Bharat Interface for Money or Aadhaar Pay. Yes, sir. So you can make the payments only in the following modes or receive it. If you are making it in any mode, any other mode, we will consider it as cash and disallowed, guys. So in simple, in the below cases, payments or expenditure is not allowed if it is made in cash. So which all sections are covered here? So for which all section rule 6 ABBA is applicable, that is ABBA. 35 AD, capital expenditure, you cannot pay more than 10,000 in a cash in a single day. Na? So how can we pay it? In the following way. Sir, what if I have paid 10 lakh in cash? You cannot claim, even if you have incurred it. Then 40A3 or 3A, revenue expenditure paid more than 10,000 in a single day to a single person is disallowed. Yes, so that will also be covered here. Then 43.1, that is the capital expenditure for the asset which is used for business. You can capitalize it and add it to the block to claim depreciation. Even there, if you have incurred more than 10,000 in a cash, it is disallowed. Then 44 AD and ADA. Guys, here some higher limits and all is there. Na? So they have told cash receipt should be within certain percentage, that is 5% and all. Less than or equal to 5%. Cash receipts are cash payments. So in that case, you have to receive in what modes? Or you have to pay in what modes? In the following modes. Then 43CF, 50C, we will cover it in capital gains. 56.210, we will cover it in income from other sources. 80JJAA in deductions. But for all these sections, rule 6 ABBA is applicable, guys. Next, and please be careful, 40A3 is important, guys. We will disallow here only if it was allowed previously. Only if it was allowed previously. Correct. So for example, I will tell you here. Sir, health insurance premium is paid in cash 5,000. Less than 10,000, no sir. Allowed, huh? No. Because it is disallowed here only. They are clearly told it is allowed only if you are paid in any mode other than cash. So it is disallowed here only. So can I go and tell, 40A3, only 10,000 they have told, so I can claim it? No, no. You cannot. Clear? Same way. Sir, assume bonus or commission is paid 20,000 in cash to a single person in a single day. Here it is allowed because here they are not talking anything about cash. But 40A3 disallows it. Clear? So, before coming to 40A3 only, if it is already not allowed before, then straight away it is already disallowed. No sir, I have crossed all other sections and I have come now to 40A3. I have stopped here and watching 40A3. If it is disallowed here, disallowed. If it is allowed here, yes, you will go proceed further. Clear? Yes. Yes, so this is all about PGBP, guys. Profits and gains of business or profession. Next head is capital gains. Chapter 6, section 45 to 55A talks about capital gains. So till now, how many sections we have covered in heads of income? Income from salary we have done with. Section 18 to 21 is omitted. 22 to 27 income from house property we have covered. Then PGBP 28 to 44D we have covered. Now we are yet to see 45 to 55A, that is capital gains. But in PGBP and capital gains, all the sections is not a part of your syllabus. Know that. Okay. So now, sir, when is capital gains attracted? Section 45, which is a charging section, is telling any profits or gains arising from the transfer of capital asset affected during the previous year is taxable under this head. So the key term is transfer and capital asset. So there are three conditions here. Transfer of capital asset during the previous year. Only then it is taxable here. Clear? And during the previous year, there are certain exceptions also where the transfer would have taken place in 1 year but taxable in some other years. We will see that also. Okay. Sir, what is capital asset first? So capital asset and transfer, important definitions, guys, for capital gains head. What is capital asset? Capital asset is defined in 240. Capital asset means property of any kind held by the assessee, any securities held by FII, that is foreign institutional investor, ULIP, that is unit linked insurance plan, issued on or after 1st February 2021. not exempt under section 1010D. When it is not exempt means for ULIP, if you have paid more than 2,50,000 premium in a year, whether you have single policy or multiple policy, if you have paid more than 2,50,000, then you cannot enjoy the exemption under section 1010D. When you cannot enjoy the exemption under section 1010D, it is a capital asset. When it is a capital asset, when the policy matures, it is taxable under the capital gains. But it does not include stock in trade, means whatever I have highlighted in green color is not a capital asset, guys. Okay. Whatever I have highlighted in red color is a capital assets. Okay. Stock in trade, raw materials and consumables, personal assets of movable nature held for personal purpose is not a capital asset, but exception is there. Jewelry, archaeological collection, drawing, painting, sculptures work or art, sculpture work of art is a capital asset. Even though it is a personal asset of movable nature, still it is a capital asset. Clear? Means what we wear, jewelry and all, bangles, earrings, chain, everything is a capital asset. Then continuation of the list. Rural agriculture land, gold bonds, special bearer bonds issued by central government is not a capital asset. Is not a capital asset. So that is why, sir, after reading all this, what is capital, what is not capital, you will get doubt. That is why I have identified, I have differentiated with the color. What is given in red is a capital asset. What is given in green is not a capital asset. So what is given in green, if it is transferred, will we compute capital gains? No. If something is not a capital asset, why will you compute capital gains for it? Next, transfer 247. Sale, exchange or relinquishment, surrender of capital asset. Even if you surrender it, sir, I am fed up with my brother, I am surrendering my shares or I am surrendering my property to him, even that is a transfer. Okay. Extinguishment, cancelling, I am cancelling my right over that property, sir, still transfer. Compulsory acquisition under any law, sir, transfer. Means the government is undertaking because they are extending the road, highways and all, or they are constructing metro over my home only, sir. So they are demolishing my house because they want to construct the metro. In that case, whatever compulsory acquisition has happened, they will pay me compensation. It is a transfer. Conversion of capital asset into stock in trade is a transfer. Then maturity or redemption of zero coupon bond is a transfer. Guys, this I will explain later. Conversion and all, I will take care later. So this is a transfer, guys. Now, so section 45 clearly told, if there is a transfer of capital asset only, it is covered here. So both we have seen. So if something is not a capital asset, if something is not a transfer, it is not taxable here. And easy to remember, 45. 45. Who is the captain of Indian cricket team? Rohit Sharma. What is his jersey number? 45. Capital gains. Chalo. Now, 48. 48. See guys, 46 and 47 talks about what is not transfer. Okay, I will try to cover it along with the other things later. 48. Capital asset will be first identified as short-term capital asset or long-term capital asset, because transfer of long-term capital asset lead to long-term capital gain. Transfer of short-term capital asset lead to short-term capital gain, and rates are different. So we have to do it as I calculate. Some things are short and long, everything is one and the same. No, you cannot do. Okay, because the rates are different. Capital asset, first period of holding we have to decide. Period of holding. So if the asset is held for so long, guys, more than certain period, it is called long-term asset. And when you transfer it, we will compute long-term capital gain. And for long-term capital gain, one of the advantages, indexation is allowed. Indexation is allowed. Sir, what if I held that asset for less than that certain period, sir? Then we call that asset as short-term asset. And when you transfer it, short-term capital gains would be computed. So there are three categories of assets, guys. So 12 months, 24 months and 36 months. Sir, are we supposed to remember this? Yes. Short-term capital, and whenever you are computing the capital gains, so straight away don't compute it. First tell, is it a long-term, short-term based on period of holding? First of all, what is period of holding? The time gap between the date of purchase till the date of transfer. We call it as date of acquisition. From the date of acquisition till the date of transfer, how long did the assessee hold it before transferring it? Okay. So the following assets, guys: listed securities, equity preference and debt. All securities includes everything. Okay. Equity preference, debt, bonds on a recognized stock exchange or unit of equity oriented fund or unit trust of India or zero coupon bond. If this is held for more than 12 months, long term. If not, short term. Then second category, unlisted shares only, not securities, unlisted shares, equity and preference. Then land or building or both, which we call it as immobile property. If it is held for more than 24 months, long term, less than or equal to 24 months, short term. Then last category, see, if you remember this too, last always 36 months. Clear? But still, in order to avoid the confusions, I have just mentioned few of the assets here. Unlisted securities other than shares, because only shares is covered here. Okay. Like debentures, bonds and all is covered. Then unit of debt oriented fund, equity oriented fund is covered here. Debt is covered here. Please be careful. Then unit of business trust, EFT. One of the thing is unit of business trust. That is why I mentioned. Okay. Then other capital asset, any other capital asset. It is always 36 months. So what I suggest is remember 12 months and 24 months. All other will fall in 36 months. If you have held it for more than 36 months, long term, less than or equal to 36 months, short term. Okay, sir. Now, so I have transferred short term capital asset. So we have to compute short term capital gains. If it is on EFT, equity shares, unit of equity oriented fund or unit of business trust, then it is a special income taxable at 15% under section 111A. Then if it is on any other asset, it is a normal income taxable at normal rate as applicable to the assessee as per the scheme opted by. Then long term capital gain on the transfer of EFT taxable at 10% in excess of 1 lakh under section 112A. If it is any other asset, taxable at 20% on the entire amount under section 112. Yes, sir. These three are special. Against the special incomes, sir, can we claim Chapter 6A deductions? No, you cannot claim. Sir, can I claim any expenditure? Yes, you can claim. Cost of acquisition, cost of improvement and expenses on transfer you can claim. Any other expenditure you cannot claim. Okay. Then, sir, can I adjust any loss? Yes, inter-adjustment you can do, which I will explain at the end of this head. Then, sir, then if there is any shortfall in the basic exemption limit or unexhausted basic exemption limit, can I adjust it against capital gain special income? Yes, you can do only if the assessee is a resident individual or HGF. Okay. Next, guys. So with respect to period of holding, I am covering now. Capital gains arising from the transfer of market-linked debenture or unit of a specified mutual fund would always be a short term. This is a new section which is added as per section 50AA. It is always short term. You don't even check period of holding. Okay. Sir, what is the format to compute short term and long term capital gain? Fixed format. You have to follow it. First, we will take the full value of sale consideration, which is nothing but the sale value. If by chance if it is not, that is not available, then we take fair market value or stamp duty value. Expenses on transfer, that is at the time of sale, what is the expenditure incurred like commission, brokerage and all. Net sale consideration you will get. Cost of acquisition and improvement we will reduce. Cost of acquisition means the purchase price. Improvement means once I have purchased, to improve that property, if I have incurred any capital expenditure, it is called cost of improvement. Then exemptions is available against short-term capital gain under section 54B(d)(ga) if you are ready to reinvest the amount whatever you have got. In that case, you can claim the exemption, remaining would become taxable. If the question is silent about exemption, whatever is gross will always be a taxable figure. You need not worry about exemptions. So what if it is a long-term capital gain? How do we calculate it? Full value of sale consideration, expenses on transfer, we will get net sale consideration. From that, we will reduce indexed cost of acquisition and indexed cost of improvement. Indexation benefit is available because this asset was purchased long back. So obviously due to inflation, now the price would have gone up. So that is why they are allowing you indexation based on cost inflation index. Then we get gross long-term capital gains, and from that we can claim various exemptions provided I am satisfying the conditions given there. I am ready to reinvest it. What are those exemptions? We will cover it in the second part of this head. Taxable long-term capital gains you will get. Okay, if question is silent about exemption, always straight away gross will become taxable, guys. You need not even mention about it. Okay. Then coming to chargeability, capital gains is always chargeable to the capital gains is chargeable to tax in the year in which the transfer took place. In the year in which the transfer took place, but there are certain exceptions for it. Means transfer would have taken place in some year, but it will be taxable in some other year. What is it? Just yeah, so it will be taxable in some other year. Sir, when is it? Which are those cases? Insurance compensation received on destruction of an asset. We are cancelling our rate because insurance company is giving the money or new asset. So is it a transfer, sir? Yes. When it is taxable in the year in which you receive the compensation. What is the sale value? Well, value of any money or FMV of the other asset received. Guys, simple. Sir, my asset was destroyed in the year 22-23. So insurance company took that. They valued it. Okay. Is it a transfer, sir? Yes, it is a transfer. But they paid me compensation in 23. 3 is not looking like 3. Okay. 23-24. So compensation was paid in the year 23-24. Insurance company paid me. Okay. In that case, it is taxable in which year? In 23-24. Computation, everything will happen till 22-23. So assume the actual date of destruction is 15th October 22. So what is the date of transfer? 15th October. Indexation will be till what? If it is a long-term asset, 15th October. So period of what? Holding till when? 15th October. Everything, computation, everything will happen till this date, but it is taxable in the year in which you receive the compensation. And what would be the full value of sale consideration? if the insurance company is giving you the money, whatever money you are getting. No sir, they gave me a new asset. Abba, thank God. So in that case, whatever is the value of that asset. Oh, next, profits or gains arising from ULIP is taxable in the year in which such sum is received. First of all, when the ULIP will be capital asset? Sir, only if the yearly premium is more than 2,50,000. So in that case, you cannot enjoy the exemption under section 1010D. When you cannot enjoy the exemption under section 1010D, it is a capital asset. When it is a capital asset, in the year of the maturity of the policy, it will be taxable, guys. So, sir, assume when the ULIP matured, I received 50 lakh. Entire 50 lakh is taxable? No. So, from that, how much ever premium I have paid? Assume I have totally paid 38 lakh premium. So, how much is my profit? 12 lakh. Only this much will be taxable. Whatever premium I have paid should be reduced, guys. Next, conversion of capital asset into stock is taxable in the year of sale of stock. Guys, this is important transactions. Let me cover it together. Sir, I had a stock. I am converting it into capital asset. The asset is moving from which head to which head? PGBP to capital gains. Correct now. So what they are telling in section 28 is whatever is the fair market value of the stock on the date of conversion is taxable under the head PGBP. Is taxable under the head PGBP. So assume the conversion happened on 1st September 22. So on that day FMV was 15 lakh. So how much is taxable under the head PGBP? 15 lakhs. Tomorrow, what is the cost of asset, capital asset? 15 lakh. If this is sold, what is the cost of acquisition? 15 lakh. Clear? Yes. Same way. So what if capital asset is converted into stock or inventory? Now asset is moving from capital gains head to PGBP head. So PGBP head is telling, capital gains head is telling it is a transfer. It is a transfer. So it is a transfer, that means capital gains is computed. Yes. But when is it taxable? The year in which stock is sold. The year in which stock is sold. So for computing capital gains, what is the full value of sale consideration means? The fair market value of the capital asset on the date of conversion. That is the full value of sale consideration. So the full value of sale consideration is FMV of what? Capital asset. When? On the date of conversion. On date of conversion. And your date of conversion is only date of transfer. Yes, sir. But when is it taxable? In the year in which stock is sold. So in the year in which stock is sold, under the head PGBP, we will take sale value of stock minus FMV. FMV will be allowed as cost. Which FMV, sir? Whichever FMV we have taken here will be allowed as cost. So the remaining is PGBP income. Remaining is PGBP income. Whereas in the same year, even this capital gains would be taxable. Same year. Clear? So in the year in which the converted stock is sold, we will have two income. One is PGBP, one is capital gains. But capital gains, period of holding, indexation, everything is only till the date of conversion. Only till the date of conversion, guys. Okay. So I have tried to cover both here together. Conversion of capital asset into stock is taxable in the year of sale of stock. So when is it a transfer? In the year of conversion. Sale value is fair market value of capital asset on the date of conversion. However, period of holding and indexation is only up to the year of conversion. Next, compulsory acquisition of capital asset is taxable in the year in which compensation is first received. Sir, there is a compulsory acquisition. Is it a transfer? Yes. When there is a compulsory acquisition, I don't have money to pay tax. First you give me, I will pay out a part of it to you. Clear? So normally government will do a delay. So they would have made a compulsory acquisition now, they may pay the amount in the next year and all. So in that case, whatever compensation they are paying, when I receive the first installment, if at all if I am receiving it in installment, it would be taxable in the year in which I received the first installment. Transfer happened on the date of compulsory acquisition. Computation, everything will happen on the date of compulsory acquisition. Even period of holding, indexation, everything is up to the date of compulsory acquisition. But when will I pay taxes? Only when you give the money. Clear? Sir, if there is any delay in payment of compensation, for that if they give any interest, is that also taxable? Yes, under the head other sources. In the year in which I receive it. Oh. Sir, in the future, what if the compensation is enhanced and I received extra money? In the year in which I receive enhanced compensation, it is fully taxable. And sir, will I again claim cost of acquisition? No. If you already claimed cost of acquisition while computing capital gains when you received the initial compensation, again if it is increased in the future because I took the case to the court and asked for more money, if enhanced compensation is given in the future, then for calculating the capital gains, we will straight away take enhanced compensation. We cannot reduce any cost of acquisition if I have already claimed it when I received the initial compensation. Okay. So, however, the period of holding and indexation is up to the year of compulsory acquisition, guys. Yeah. Now, points on computation. Indexed cost of acquisition, which is available only for a long-term assets, guys. What is long-term assets? We already covered. Depends on the period of holding. If a long-term asset is acquired before 1st April 2001, which is a standard date for capital gains purpose. Okay. So, we call year 2001 and 2 as a base year. So, 1st April 2001 is like a base date. Okay. So, if asset is acquired before 1st April 2001 by the assessee, then compare the actual cost, that is the purchase cost, with FMV as on 1st April 2001. Whichever is higher, you will take and apply indexation on that. So, whichever is higher, you will take, on that you will apply indexation. So, indexation means cost inflation index for the year of transfer divided by cost inflation index for 2001-2, which is a base year. Sir, what is cost inflation index? For the base year, it is 100. They started with 100, and as of now, that is previous year 23-24, it is 348, guys. That is our previous year. Sir, are we supposed to remember it? Yes, these two at least remember. Sir, in between, what about the in between years? There is a cost inflation index, but I have not given because for academic purpose, those things are not important. If at all, if in the question, if it is required, they will mention it in the question itself. Okay, please, this two you please remember. Okay, and for a year of transfer, normally in majority cases will be our previous year, guys. That is 23-24. So numerator, cost inflation index in the numerator will majority of the cases will be our previous year. Clear? Yes, sir. Next, exception means this we will not apply in few cases. When is it? In case of intangible assets, the actual cost will be cost of acquisition. Actual cost, no question of FMV and all. Yes. Sir, what if the capital asset is a land or building or both? Then we have to do this. We have to do step calculation. Compare FMV with stamp duty value first. Take whichever is lower. Compare that with actual purchase price. Actual cost of acquisition or purchase price is only the same. So compare that with the actual cost incurred. Whichever is higher we will take. And on this we will apply indexation. This is only for land or building or both. Okay, sir. Then, if the asset is acquired on or after 1st April 2001, then we will straight away take cost of acquisition, no question of FMV, no question of stamp duty value. Then we will apply indexation for it. Why, sir? Because from 1st April 2001 we have indexation. Cost inflation index is available. Please apply that. Before that we didn't have it. So that is why we are doing FMV, stamp duty value and all. Yeah. So cost of acquisition, straight away we will take it. Apply indexation for it. Cost inflation index for the year of transfer divided by the cost inflation index in the year in which asset is purchased. Whichever year it is. We will have it, and if it is not base year, definitely they will give it in the question, guys. What is cost inflation index for that respective year? Okay. Then cost of acquisition shall have to be adjusted by cost inflation index only for long-term assets. Only for long-term assets. But for the following assets, indexation is not applicable. Indexation is not applicable for the following asset. Which are those, sir? Long-term capital gain taxable under section 112A EFT. For that, indexation is not applicable. Cost of acquisition is different. Calculation of cost of acquisition is different. I will cover it later. Okay. Then long-term capital gain from the transfer of bonds or debentures. Indexation is not available. But for capital indexed bonds and sovereign gold bond, indexation is available. If sovereign gold bond is redeemed by individual, it is exempt. It is not a transfer. There is no capital gains. But if it is redeemed by others, it is taxable. Can we claim indexation? Yes, you can claim. Next. Capital gain on the depreciable assets under section 50. That is when section 32 fails, we will apply section 50. It is always short-term gain or short-term loss. Yes. Same way, section 50 AA, which is new section. Whatever we compute under section 50 AA is always short-term, guys. Is always short-term, irrespective of the period of holding. Okay. So in these three cases, there is no question of indexation. Even though the asset might be long-term, still there is no indexation. Next, cost of improvement. First of all, sir, what is cost of improvement? Cost of improvement is the cost, capital cost, which we have incurred after the asset is purchased to improve it. For example, sir, I had purchased the land and I have put a compound around it, sir. Or else I have purchased a building, first floor only was there, now I have constructed another floor, sir. In that case, what is it? Cost of improvement. It should be capital in nature. Cost of improvement incurred prior to 1st April 2001 shall always be nil. I would have incurred it, but still it will be nil. Why, sir? Because simple, guys. When improvement has taken place before 1st April 2001, it is understood, it is acquired also before 1st April 2001. Yes, sir. And when we are taking FMV, FMV already includes both acquisition as well as improvement. Means as on that day, what is the fair market value of that property, which includes the improvement done also. So it is already taken care here. That is why again separately they are not allowing the improvement cost. Okay. Then if the improvement cost is incurred on or after 1st April 2001, whatever cost we have incurred, we will claim it. We will claim it. Sir, what if asset is long term? Can I claim indexation for cost of improvement also? Yes, you can claim it. How is it? Cost of improvement you will take, that is actual cost what we have incurred, into cost inflation index for the year in which we have transferred, divided by cost inflation index for the year in which improvement took place. In which year did I do the improvement to my asset? Okay. So guys, in shortcut is most of the time majority numerator would be more than denominator. Clear? Means once you apply indexation, your indexed cost should definitely be more than cost of acquisition. If not, what is the use of doing indexation? Clear? At least if by chance if you do any mistake, there only you should understand you are wrong and the slap, not your neighbor, yourself, and correct it. Clear? Yes. Then if you do that and all in the exam hall, then full drama will happen. Okay. If you get angry, show on yourself. Okay. Chalo. If the capital asset is a goodwill or right, any right, business right, commercial right and all if I have taken, cost of improvement will always be a nil, guys. Then cost of acquisition means what, guys? My purchase cost. What did I pay to purchase the asset? But in some special cases, cost of acquisition is different. What is it? If it is a self-generated goodwill that, sir, I have built a reputation for my own business. In that case, what is the cost of self-generated goodwill? Nil. If I have purchased the goodwill, whatever I have paid for it. Then stock in trade converted into capital asset, we already discussed. Fair market value of the stock will be taxable under the 8 GBP and the same thing will be allowed as a cost to the capital asset. Then asset become the property of the assessee on gift, will, inheritance, distribution of assets of HUF on partition or amalgamation or demerger. Guys, in case of gift, will, inheritance or a distribution of assets of HUF on partition, sir, is it a transfer? No, it is not a transfer. But in the future, if receivers sell it, is it a transfer for him? Yes. But what is the cost of asset? He has not paid anything. Nil. Actually, cost is nil. But we will take the cost to the previous owner. Whatever was the cost to the previous owner will become the cost to the successor when he sell the asset. Clear? Yes. And sir, what about the period of holding? It includes the period of holding of the current recipient plus the previous owner. Both. Okay. Sir, what if by chance cost to the previous owner is not available? The person is gone forever and he has not told me the cost and he went like that only. He didn't tell me the cost, but he has left the property to me. Understood, na? In that case, if I am not able to derive the cost, then take FM. Then take FM. Next, this amalgamation and demerger, I will just cover it along with the examples, guys. Sir, amalgamation. Now you know Maruti Motors and Suzuki, you know. Okay, they both have been amalgamated. Maruti Suzuki now. Okay, married. Okay. Maruti Suzuki. Yes, sir. Huh? Don't go beyond the provisions. Oh. Maruti Motor. Marriage means excited. Excitement. Maruti Motors and Suzuki got amalgamated, guys. Now, sir, the assets of Maruti Motors and Suzuki will be transferred to this company, new company. Yes. So we call this as amalgamating companies. And this is what? Amalgamated company. Yes, sir. So all the capital assets they transfer for the new company. Yes. Is it a transfer, sir? No. So do we compute capital gains? No, sir. Next, provided this company is an Indian company. Okay, asset is within India only. Next, sir, I was a shareholder, sir. I was a shareholder in this amalgamating company. They took back my shares and they are giving me the shares of Maruti Suzuki, sir. In that case, is it a transfer, sir? No, it is not a transfer. It is not a transfer. But in the future, if I sell these shares, what is the cost? Whatever cost I have incurred to purchase these shares of the amalgamating company, that will be the cost. Same way, sir, for this capital asset, when it is transferred from amalgamating company to amalgamated company, which is an Indian company, you told it is not a transfer. What in the future if this amalgamated company sells it? Is it a transfer? Yes. What is the cost? Cost to the previous owner. Cost to the previous owner. This is amalgamation. Sir, what if it is a demerger? You know, what have I? Reliance Industries. So, Reliance Industry demerged one of its element, JFS. That is Geo Financial Services. Not entire company, only a part of it. Around 6 point something they did it. So, they demerged one of their business component or vertical, Geo Financial Services, guys. So, some of the assets, not all the assets, some of the assets of Reliance Industry got transferred to JFS. Sir, is it a transfer? No. Is it a capital gains? No. Now in the future, if JFS sell this asset, is it a transfer? Yes. What is the cost? Cost to the previous owner. Cost to the previous owner. Now, sir, I was a shareholder in Reliance Industries. They are not taking back my share. My shares in Reliance Industries will continue, and they will allot me a new shares in JFS. They allot me a new shares in some proportion. They will fix the proportion and all. So in that case, will it be a transfer, sir? No, I didn't transfer anything. They are just giving me the new shares in JFS. Now, what is the cost of acquisition of JFS shares? Is they will divide it. Means, assume I have paid 1000 rupees to purchase the shares of Reliance Industries. They will divide this cost as how much for Reliance Industry, how much for JFS in the ratio of demerger. In the ratio of demerger, and this ratio things and all is not covered for you. You need not worry, guys. Clear? So this things, whichever is not a transfer, is covered in section 47. Clear? So transfer of capital asset in case of amalgamation or demerger is not a transfer, provided the receiver is an Indian company. Same way, if shares which I were holding in that respective company, sir, will if that is transferred and they are giving me the new share, will that be considered as transfer? No, guys, that is also not a transfer. Okay. This we have done with. Next, where the capital asset become the property of the assessee on the distribution of capital assets of the company on its liquidation. If company distributes its assets on liquidation, it is again covered in section 46, first item. Sir, is it a transfer? No, it is not a transfer. Next, if this asset is sold by the shareholder in the future, it is a transfer for him. Yes. What is the cost? Fair market value of the asset on the date of distribution. But please be careful, for shareholder we have to compute capital gain. Why? Because he would have surrendered his shares. It is a transfer for him, for shareholder. Whereas for company, when they are distributing the asset to the shareholder, take it and on liquidation, it is not a transfer. On liquidation, please be careful. Next, when capital gain arises from the transfer of specified shares or sweat equity shares referred to in section 17(2), sweat equity shares will be allotted to the employees at a discount. When it is allotted at a discount, that discount component will be taxable in the hands of employee under their salary. Clear? Now, for example, FMV of the shares was 200. Shares was allotted for 120. So, what is the purchase price for the employee? 120. What is the discount he got? 80. So, that 80 would be taxable under the head income from a salary, guys. Correct? Now, in the future, if employee sell these shares, what will be the cost of acquisition for him? 200. Can he claim cost of indexation and all? Yes, if it is a long term, he can claim indexation. But 112A is there, which is the point where you cannot claim indexation. Yes, because we have to check when it is a shares, if it is a listed shares and all, it would be covered under 112A. Okay. Next, one more important thing. Sir, if ESOP shares are gifted, is it a transfer? Yes, it is a transfer. If ESOP shares are gifted, it is a transfer. Clear? Yes. Next, where the capital gains arises from the transfer of such property which has been subject to tax under section 56(2)(10), that is gift taxation. So, for gift taxation of movable or immovable property, we consider FMV and stamp duty value. If that is taxable for the recipient as income from other sources, then in the future, if he sell that asset, what would be the cost of acquisition for him? Fair market value or stamp duty value, which was taxed for him when he received the gift or when he has purchased for inadequate consideration. What was taxed for him under the head other sources, he can claim it as the cost of acquisition. Okay, I will again connect it when I go to 56(2)(10). Next, this physical gold thing. First, let me just read it. Where a capital asset being a electronic gold receipt issued by a vault manager become the property of the person as a consideration for transfer of gold, guys. Now, sir, I had purchased, I am just taking random figures, I had purchased 100 grams of gold for 7 lakh. For 7 lakh. Yes, sir. I had a physical gold now. I went to the vault manager and I told, Vikas went to vault manager and told, sir, I will give you my physical gold. Give me in electronic form because this is danger for me. What if someone come and rob my house? Okay, so it is danger to keep along with me. Let me keep it in electronic form. Electronic form means any day, anywhere I can sell it. Okay, through recognized stock exchange and all. Yes, sir. So they gave it the electronic copy, electronic gold receipt, EGR. Electronic gold receipts they gave. Equivalent to how much? What physical gold I gave? 100 grams. So equivalent to that, they give me electronic gold receipt. Telling, yes, Vikas, you have deposited so much. So this is what is your receipt. This receipt I can trade it in stock exchange or recognized stock exchange. Okay, sir. Now, I have deposited physical gold and I got electronic gold receipt. What is the cost of electronic gold receipt? If I sell it in open market, it is taxable, na? So what is the cost of it? Sir, what did I pay for physical gold? 7 lakh. So what is the cost of electronic gold receipt? 7 lakh. Clear? Okay, sir, now you gave physical gold. Na? For that you got electronic gold receipt. Is it a transfer, sir? No. Should we compute capital gain, sir? No. But if I sell this in the open market, electronic gold receipt, is it taxable? Yes. What is the cost of acquisition? 4 lakh. Sorry, 7 lakh. Okay, next. Sir, no sir, again I want my gold. I want to wear it. I want to use it. I want to show my relatives. I have bought it. So in that case, I went back to the vault manager and told, sir, I will give you electronic gold receipts. You give back me the physical gold. Is it a transfer? No, both is not a transfer. Capital gains? No capital gains. Clear? Now I got back what? My physical gold. What is the cost of my physical gold? What was the cost of electronic gold receipt? 7 lakh. That will become the cost of physical gold. 7 lakh. Cycle. That's all. Clear? Yes. So what is not transfer? Whatever we discussed. I deposited physical gold and got electronic gold receipt. Is it a transfer? No. Next, I gave back the electronic gold receipt and got back the physical gold. Is it a transfer? No. Where is it covered? Section 47. Section 47. Yes. Yeah. Next, right side. Right shares. This is an offer given by the share company to the existing shareholder to purchase the shares at some discounted price. So I have been offered. Assume I am already holding the shares of Reliance Industry. I have been offered to purchase the shares at 1000 or else 2500, where the actual share price is around 2900. Okay, actual market price is 2900, whereas they are offering me, offer price is 2500. I can buy it. They have given me the right. If I myself exercise the right and purchase the shares, what is the cost to me? 2500. Nothing special. What I have paid? Okay, sir. And will difference be taxable, sir? Discount? No, no. It will not be taxable. For I am not an employee, hence it will not be taxable. Next, if I am an employee, if I get a ESOP shares, we are already covered. That is different. We are talking now about ESOP shares. Next, okay, I don't want to purchase. I already have enough shares of in Reliance Industry. Now Uday came and told me, sir, give me that right. If I want to purchase, then open market price is 2900. If you at least give me the right, I can purchase at 2500. So I thought, okay, if I have it, I will not use. Why to waste it? Let me give it to him. And I told, hey, give me 100 rupees per right. Give me 100 rupees. I am renouncing my right. We call it as renouncing the right. I gave my right. Clear? Now, for Uday, what would be the cost of acquisition? 100 rupees for purchase of right from me plus 2500 to purchase the shares. Obviously, we will use that right. So, what is the cost of acquisition of right shares for him? 2600. 2600. Clear? Yes. Next, coming to bonus shares. Bonus shares, if it is allotted prior to 1st April 2001, bonus shares is given to existing shareholder free of cost. This is whenever the company want to capitalize their profit. Means they want to move the profit from reserves and surplus to where? Share capital. They will capitalize by issuing bonus shares free of cost. Actually, will the shareholders get any benefit out of it? No, because share price get adjusted. For example, sir, share price assume was 1000 rupees. Company announced a bonus of 1:1. I was holding 10 shares. So, once the company give the bonus, I will get 10 plus 10. How much? 20 shares. Come on guys. Before bonus, what was the value of my holding? 10 into 10,000 rupees. What was the value of my holding? 10 into 1000 rupees. 10,000. Any doubt in this? No. Next, after bonus shares are allotted, how many shares I would be having? 20 shares. And automatically the price get adjusted for 500. Shares price will get automatically adjusted. Now after bonus, how many shares I am holding? 20 shares into 500. What is the value of my holding? 10,000. So will bonus shares give me any effect in the market? Because many times people believe, company announced the bonus, go purchase the shares so that I will become rich. No, you will not become rich after the company announces the bonus if you go and buy it. Once the company announces, yes, share price may go up because of the decision. But by then already it is factored in. By the time you got to know company has announced, already price would have gone up. And if you purchase, you would be purchasing at a higher price. And will I get any benefit out of bonus? Just to literally to get more shares if I go and purchase, you will not benefit. If you trust the company, fundamentally company is right, only then go and buy it. Okay, now coming back to this. So for the shareholder, what is the cost of bonus shares, guys? So in my example, for this 10 shares, what I got bonus, what is the cost I incurred? 0. So in the future, if I sell this 10 shares, what would be the cost? 0. But if the bonus shares were allotted before 1st April 2001, they are telling actual cost which is nil, or FMV as on 1st April 2001. Definitely FMV will be positive. It can never be negative. So straight away you can take FMV. Straight away you can take FMV. Whichever is higher, guys. Okay. Sir, what if bonus shares are allotted first after 1st April 2001? Straight away you take nil. Straight away you take nil. That is actual cost is how much? Nil. No question of comparing FMV. Yes, sir. Now, I will come to this. Long-term capital gains being 112A, that is EFT. Equity shares in a company on which STT is paid both at the time of purchase and transfer. Okay. Or unit of equity oriented fund or unit of business trust on which STT is paid at the time of transfer. If it is acquired before 1st February 2018, because this provision 112A was brought from 1st February 2018. So if you have purchased before that, what is the cost of acquisition for you? Higher of actual cost, or second one, lower of FMV as on 31st January, that is preceding day, 31st January 2018, or actual sale consideration. Simple. First take lower of FMV and actual sale consideration, sale value. Compare that with actual cost, whichever is higher you take. Whichever is higher. This is only if you have purchased EFT before 1st February 2018. Sir, what if I have purchased EFT on or after 1st February 2018? Actual cost you take. Sir, what if it is long-term asset? Still actual cost. No indexation. No indexation. Same way, guys. Sir, what if this equity shares are allotted as bonus? Same story, guys. Same story. That is higher of actual cost or lower of FMV or actual sale consideration. Same calculation. Yes. Next, some more important points. If no cost has been incurred for acquisition, that is for purchase, then the cost would be nil. But there are certain exceptions. Sir, I got it as a gift, will, inheritance and all. In that case, I didn't pay anything, but still they told cost to the previous owner. I am talking about in any other case. In any other case, sir, I didn't pay anything. That means what is your cost? Nil. No deduction shall be allowed in respect of securities transaction tax paid. Under capital gains head, there is no deduction for STT. Guys, we discussed if securities sold is taxable under the 8 PGBP, STT can be claimed under the 8 PGBP. But if securities is a capital asset for you, when you sell, capital gains is computed. No STT is allowed. No STT is allowed. Next, notional transfer of goodwill on admission retirement of a partner is not chargeable to tax. Sir, in case of admission retirement death of a partner, or even in case of dissolution and all, we calculate the goodwill and distribute it to the partner in that ratio, this ratio, that whatever ratio, sacrifice ratio, gain ratio, old ratio, new ratio, whatever is there. Sir, will that attract capital gains? Is it a transfer? No. That is only for book adjustment purpose. Next, in case of gift, will, partition or HF, it is not a transfer. But for the receiver, if he sell it in the future, is it a transfer? Yes. What is the cost? Cost to the previous owner. Period of holding will include the period of holding of the previous owner also. Clear? Yes. Next, conversion of preference shares or debentures into equity shares does not amount to transfer. Sir, if one form is converted to another form, here, like preference shares into equity or debentures into equity, do you know the convertible preference shares, convertible debentures? Yes, sir. So, is this conversion a transfer? No. Now, in the future, if this equity share is sold, is it a transfer, sir? Yes. What is the period of holding, sir? It includes both. Period of holding of the previous asset, period of holding of the equity share. What is the cost of acquisition of equity shares, sir? Cost of acquisition of debenture or preference shares. Previous asset. Not previous owner here, previous asset. Okay. Next, any compensation or enhanced compensation received by an individual or HF on compulsory acquisition of agriculture land is in specified area, that is urban area, is exempt. If it is in rural area, it is not at all a capital asset. If it is in urban area, we call it a specified area in income tax. I have used the word urban area. In law, what word they have used is specified area. Specified area means urban area. Okay. So, if the agriculture land is in a specified area, is it a capital asset, sir? Yes. If I sell it, is capital gains computed? Yes. But government came and acquired the compulsory acquisition of my agriculture land. And who is the owner of that land? Individual or HF, which was used for agriculture purpose. Then, entire compensation, whatever you receive is exempt under section 1037. Next, enhanced compensation received is chargeable in the year in which you receive it, but cost of acquisition would be nil. I have already mentioned this. Redemption of preference shares will amount to transfer and chargeable to tax, guys. So, what is the sale value? Redemption value. What is the cost of acquisition? Purchase value. Not so. Advance money received. Sir, I wanted to sell my property. I showed it to a prospective buyer. He came, saw everything, gave a token advance and told, I will come back in 1 week. I will pay the remaining amount and we will get the property registered. But he never came back. He never came back. In that case, I have received the advance money and I have forfeited it. I have all the right to not give back because obviously I have waited time as value. Time as value. So in that case, if I have received any advance money and if I have forfeited without transfer didn't take place. For the same person, I am not transferring it. Even if I am transferring, but for some other person. In that case, if it is received before 1st April 2014, it shall be reduced from cost of acquisition before indexation. If it is a long-term asset, before indexation, reduce it and then apply indexation. Next, sir, I have received it on or after 1st April 2014, provision changed. It is taxable in the year in which you received it under the head other sources. Again, when you sell that asset, we will not reduce it from the cost. Okay. Yes. Some special transactions under capital gains. Section 50. Section 50 will pitch in only when Section 32 fails. Section 32 talks about depreciation. It fails in two scenarios. When all the assets in the block are sold, irrespective of the value. For how much you sold doesn't matter. Or else there is no value in the block. Means sale value is more than the WDV in the block. In that case, depreciation under Section 32 fails. Immediately we have to compute. Short-term capital gain or loss under Section 50. So what is the format to compute it, sir? Full value of sale consideration you will take it minus expenses on transfer, that is on sale, opening return down value, that is on 1st April 2023, additions to the block if any, means if you have purchased anything during the year before you sell it. So the final figure, if it is positive, it is short-term gain, if it is negative, it is loss, guys. Then 50AA, new section. Transfer of specified mutual fund or market linked debenture. Market linked debenture means where the returns depends on the performance of the market index, guys, like Nifty, BSE and all. Okay, Nifty, Sensex. Yeah, short-term capital gains in case of transfer of units of a specified mutual fund acquired on or after 1st April 2023 or a market linked debenture. Any of these two assets, if you have sold it, then full value of sale consideration or redemption value or maturity value, which is nothing but sale value, whatever value you are getting back, take it. Then minus expenses on transfer or redemption. From that again, reduce cost of acquisition or improvement. Normally for these assets and all, no improvement will be there, only cost of acquisition. But as a format they have given it, but only acquisition, guys. Okay. And we will always derive taxable short-term capital gain or loss. So should we check period of holding and all? No. Irrespective of the period of holding, it is always short-term, guys. Here also, guys, sometimes they will confuse you. Asset was purchased 10 years back, block was there from 15 years and all. Some stories they will give to confuse you. It is always short-term. And sir, this short-term gain, whatever we calculate, is it special covered? Both I am talking about. Is it covered under section 111A, sir? No, 111A covers what? Only EFT. So both of this will not come under 111A. If it is not 111A, what is it? Normal income. Taxable at normal rate. Then slump sale under section 50B. When the entire company or undertaking is sold without assigning the values for individual assets, we call it as slump sale. Here, undertaking or the company itself is an asset, guys. If it was held for more than 36 months, we call it as long term and we compute long term capital gain. If it was held by the assessee before transferring it for less than or equal to 36 months, then it is short term, we will compute short term capital gain. Sir, what is the full value of sale consideration here? IR of FMV1 or FMV2? IR of FMV1 or FMV2? What is FMV1, FMV2, sir? FMV1 being the fair market value of the capital asset transferred. Whichever assets I have given, what is the value of it? Okay. Or FMV2, what I have got. What I have got means how much money I have received. Or sometimes it may not be given in the money forms. Assume they have given the shares of some other company. In that case, whatever is the value of that shares. Clear? FMV1 means the value of the assets which I have transferred. FMV2 is what I have got from the transfer, from the sale. If I have got money, whatever is the money value. If I have got some other asset, whatever is the value of that asset. Okay. From that we have to reduce expenses on transfer on the sale. Then we get net sale consideration. From net sale consideration, we have to reduce cost of acquisition, no indexation, even if the asset is long term. Why, sir? Because cost of acquisition means net worth as on the date of transfer. Net worth means what, sir? Total assets minus liabilities. Total assets minus liabilities, guys. Yes. And everything has to be calculated on the date of transfer and on book value. If there is any revaluation of assets, we have to ignore it. We have to ignore it, guys. Okay. Next 50C, again an important, because we will study with along 43C here, both, and even rule 6 ABBA is applicable for this. Okay. So what is it we will see? Guys, if I had any long-term capital asset or any land or building, not long-term, any land or building as a capital asset which I have transferred. Normally we will take sale value as full value of sale consideration. Yes, but here what they are telling in 50C is, as there is high chances of manipulating in real estate sector, we will not accept what value you tell. We will compare actual sale value with stamp duty value. If the difference is up to 10%, okay. If the difference is more than 10%, then we will adopt stamp duty value as the actual sale value to compute capital gains. Clear? So I will just give an example. Assume actual sale value is 50 lakhs. Actual sale value is 50 lakh and stamp duty value is 52 lakh. Take 110% of actual sale value. How much is that? 55 lakh. So check whether stamp duty value is within 55 lakh. Yes, sir. So in that case, to compute capital gains, what is the full value of sale consideration? 50 lakh. Because up to 10% difference, they are telling fine. Okay, sir. Next, sir, what if stamp duty value was 60 lakh? 110% of actual sale value comes to how much? 55 lakh. And stamp duty value is more than that. Stamp duty value is more than 55 lakh. In that case, this will be adopted as full value of sale consideration. This would be adopted as full value of sale consideration. You can see here. I have given all the things here. Actual sale value more than stamp duty value. What do we take? Actual sale value as full value of sale consideration. No confusion there. Next, sir, stamp duty value is more than 110% of actual sale value. If it is, sir, 105, 102, 108 and all, fine. If it is more than 110, then we will take stamp duty value. Now, sir, no, once we have taken stamp duty value, assume it is 60 lakh. Assessor is telling, no, the value of my property is less than 60 lakh. So, it will be referred to the valuation officer. Now, valuation officer gave the value where stamp duty value is more than valuation officer's value. So, for example, valuation officer gave 58 lakh. What do we take as full value of sale consideration? 58 lakh. No, sir. Second possibility. Valuation officer gave 75 lakh. What will assessor tell? Sir, 60 is fine, sir. 60 is fine, sir. Clear? If valuation officer's value is more than stamp duty value, then stamp duty value. This is only, this may not be there always, guys. Only if it is referred to the valuation officer. Means if assessor is not agreeing for stamp duty value. Okay. So stamp duty value, will it be same number every day? No, it will keep on changing. So on what day should I take it? On the date of transfer. But if date of agreement and date of registration is different, on what day should I take it, sir? Which will be before date of agreement? So if you apply your common sense on stamp duty value, okay, date of agreement and date of registration, which will be before, guys? Always this one, and this will be after. So which stamp duty value will be more? Date of registration when compared to date of agreement. They are telling you can take the stamp duty value as on the date of agreement, provided at least a part of the consideration is received on or before this date in any mode other than cash. In any mode other than cash. In what mode can I receive? Rule 6ABBA. Clear? Yes, sir. No, sir. Entire money is received after date of agreement. Or else I received a token advance in cash, sir. In that case, the stamp duty value has to be taken on date of registration. And then compare that with actual sale value and see which is more. Now same provision, same to same provision is applicable under the head PGBP if land or building is held as stock in trade. So when you sell that stock, where is it taxable? Under the head PGBP. So to compute the income under the head PGBP, what would be the sale value? Same thing here. Whatever we followed. What would be the sale value means whatever we did it here, guys. So together I have done it as they both are connected. Please be careful. 50C is when land or building is a capital asset. 43CA is when land or building is a stock in trade. Both cannot happen in the same case. Okay, as the asset covered scenario is same, I have covered it together. And even for 43CA also rule is applicable, rule 6ABBA. Next, coming to losses. There can be two categories of losses here, long-term loss, short-term loss. If there is a long-term loss, you can adjust it only against long-term gain. Sir, long-term loss of one asset, can it be adjusted against long-term gain of another asset? Yes, but only long-term. Long-term loss can be carried forward for next 8 years. And short-term loss can be adjusted against short-term gain or long-term gain of any asset. Sir, 111A or anything. Here there is no special category. Okay. Short-term loss can be adjusted against short-term gain or long-term gain. Okay. And it can be carried forward for 8 years. Guys, one thing you keep in mind, capital gain loss cannot be adjusted outside the 8, whether it is current year or brought forward. Now coming to the second part of capital gains, exemptions. Now you can see here, sir, I have got a gross capital gain, short term or long term. I have to pay tax on it. Yes, sir. You have to include it in your total income calculation, and you have to pay tax on it at special rates, or if it is a long short term, other than EFT, at normal rate. But if I am ready to reinvest in a particular asset within a certain time, they are giving me the exemption. They are giving me the exemption. So in that case, in each section they are told clearly what asset should be transferred, what asset should be purchased, within what time it should be purchased, and once you purchase, how long should you hold it. Everything they have told under the head capital gains, or under the head, under the respective sections. Only when you satisfy all that, you are eligible to claim exemptions. And guys, except two sections, in majority of the section, what is the amount of exemption is the gross gain or the cost of new asset, whichever is lower. The gross gain or the cost of new asset, whichever is lower. Chalo. So this exemption list is actually big, but I have tried to simplify as much as possible here. Entire list. This and all will definitely help you on the exam days, guys. Make use of it, because see, and this you will understand only if you have studied from the regular books. Illa sir, I will study it away. Sir, final, I want to go participate and win. Will it happen? No. Okay. You have to participate in all the games. You have to be the table toppers. Only then you have to pay qualifiers. If you qualify there, go and pay final. If you win there, champion. Like that. Clear? Huh? Now we are almost in like semi-final or qualifiers. Okay. Sir, hope you guys have done well in your tournament. Chalo. Already it has happened. I believe you guys have done it well. Fine. Chalo. All the sections, guys. What are the things important? Sir, what asset I have transferred? What asset I have purchased? Within what time I should purchase? Then, with how long should I hold that asset? And each exemption is available for whom? Available for whom? Few exemptions are available only for individual HF. Few exemptions are available for everyone. Okay. 54. Available for individual and HF. Sir, which is the old asset transferred? Long-term residential house. Which is the new asset to be purchased? Residential house. Within what time? If you are purchasing it 1 year before the date of transfer, or 2 years after the date of transfer. If you are constructing it 3 years from the date of transfer, plus or minus it plays major role. Okay. Next, 54B, available for individual HF. What is transferred? Agriculture land. What to be purchased? Agriculture land. But before the agriculture land which you have sold, it should be at least used for agriculture purpose by you or by your parents before transfer, at least for 2 years. Sir, barren land, sir, agriculture land for namesake, but I have not used it, sir. Then you cannot claim this exemption. Clear? Agriculture land used by you at least for 2 years for agriculture purpose before transfer, or by your parents. Okay. Then within 2 years you purchase new agriculture land. Okay. Next, 54D, compulsory acquisition. B, agriculture land. B, agriculture land. So A, B. Okay. Then D, compulsory acquisition. So C, D. Okay. Compulsory acquisition of what? Land or building forming part of individual industrial undertaking, not your home. Industrial buildings. Okay. To land or building of industrial undertaking existing or newly set up. Sir, I had a land or building which is form part of my industry, which is now compulsory acquired by the government because they want to extend the highways and all. In that case, it is a compulsory acquisition, means transfer. Yes. So I have to pay capital gains on it. Yes. But now obviously I have to continue my show. I have to acquire for a new land or building where I will run my business. So I went and purchased a new land and building in a new area. For that, can I claim exemption? Yes, you can claim. But again, before compulsory acquisition, at least 2 years, that land or building has to be used by the ACCA for industry or business, guys. So the new land or building has to be purchased within what time? 3 years from the date of transfer. 54 EC, any ACCA, available for any ACCA. Long-term capital asset being sold. Okay, which is land or building. What is sold is land or building. Now, what should I purchase, sir? Specified bonds of REC, PFC, IRFC or NHI. REC stands for Rural Electrification Corporation, PFC, Power Finance Corporation, IRFC, Indian Railways Finance Corporation, and NHI, National Highway Authority of India. Sir, these bonds has to be purchased within 6 months from the date of transfer. Okay. Then 54 EE, any ACCA, available for any ACCA. These three available to any ACCA, guys. Then asset transferred is any long-term capital asset, anything. Okay, long-term. Then to what? Specified funds. Specified funds. within 6 months from the date of transfer. Oh, in all these cases, sir, what is the amount of exemption? Cost of new asset or the amount of gross capital gain? That is gross short term or long term, whichever it is. Whichever is lower. Whichever is lower. You are safe, don't worry. Aram se pay attention. 54F. Individual and HF. Exemption is available only for individual HF for what, sir? Long term capital asset not being residential house. What you have sold is not residential house, but what you are purchasing is a residential house. Okay. Then purchase 1 year before or 2 years after. Construction within 3 years from the date of transfer. Clear? Yes, sir. Now, sir, here they are telling maximum exemption is for 10 crore. Both under section 54 as well as 54F, they are telling maximum deduction is for 10 crore. Sir, I have purchased a new house for 12 crore, but cost is restricted to 10 crore. Even if you have paid more than 10 crore, it is considered as 10 crore. Both for 54 and 54F. There is a difference between 54 and 54F. 54 is you have sold residential house, purchased residential house, maybe in different area. Sir, why will I sell and buy? Why do you care? Okay, so ACCA has done it because now maybe you would have sold in one area and purchased in another area. Okay, but here 54F sold any asset other than residential house. But what are you buying? Residential house. Sir, I sold all my gold, land, everything. I purchased building now. So can I do it? Yes. Time paid and all is same. Even the maximum limit 10 crore is same. But how much I can claim is different, which we will see. Next 54GB, individual or HF. Long-term residential property is sold to purchase what? Equity shares of an eligible company or eligible startup. Okay. Now, you will purchase within what time? Before the due date of filing the income tax returns. Okay. Means the year in which you have transferred the residential property, na? For that year, what is the due date to file income tax returns? Within that time, you have to purchase what? The equity shares. And once you have invested in the equity shares of the company, who got the money? Company. Company should use that money to purchase a new asset within 1 year. Within from 1 year from where? The date of purchase of equity shares. Now, I have to purchase equity shares within due date of filing the income tax return. Once I purchase, from there, within 1 year, they have to use the money to purchase a new asset. They means who? Company. Okay. In both these cases, the amount of exemption is different. Compare the cost of new asset with net sale consideration. Sir, what is net sale consideration? We already forgot, sir. Net sale consideration. Compare this with cost of new asset. If cost of new asset is more than net sale consideration, entire gross gain is exempt. Entire gross gain is exempt. Clear? Sir, what if cost of new asset is less than net sale consideration, sir? Cost of new asset is less than net sale consideration. Then we have to use a formula. Otherwise, the capital gains in the same proportion as the cost of new asset pairs to the net sale consideration. That is gross capital gain into cost of new asset into net sale consideration. Sorry, vice versa. Cost of new asset divided by net sale consideration. Let us assume net sale consideration is 20 lakh, guys. Gross gain obviously will be less than that. Gross capital gain, this is net sale consideration, is 12 lakhs, sir. Cost of new asset is 15 lakh. Cost of new asset is 15 lakh. Is it less than net sale consideration? Yes, sir. So how do we calculate it? Gross capital gain is 12 lakh. 12 lakh into cost of new asset 15 lakh divided by net sale consideration 20 lakh. So definitely you will get the amount of exemption less than 12 lakh. Less than 12 lakh when you apply this concept. Okay. Next 54GA. Any assessee shifting their business from urban area to SEZ area. Urban area to SEZ area. So obviously whatever asset they add in urban area, they are selling it and purchasing the new asset in SEZ and they are completing the shifting. Yes. So in that case, the asset has to be purchased in SEZ within 1 year before or 3 years after the date of transfer, and shifting has to be completed. So what is the exemption? Cost of new asset plus expenses incurred for shifting. Compare that with gross capital gain. Whichever is lower is exempt. Whichever is lower is exempt, guys. Yes. Now some shortcuts for remembering this. Withdrawal of exemption and all. Guys, whenever we purchase a new asset, it has a lock-in period. You have to hold it for certain years. If you sell it within that period, Then we have to compute cost, capital gains on the transfer of new asset. Yes, plus whatever exemption you would have already claimed when you purchase this asset will be withdrawn. Will be withdrawn. How is it? There are two patterns. For which section? How? For section 54 EC, EE, F and GB, if the new asset is sold within the period specified in the respective section, then the capital gains exempted earlier is taxable in the year of transfer of new asset. That is, when you transfer new asset, we will compute the capital gains on the transfer of new asset. Yes, plus whatever exemption you have claimed earlier will be taxable again. Will be taxable again. So two capital gains would be there. Next, for section 54, 54B, 54D, if the new asset is sold within the period specified in the respective section, then the capital gains exempted earlier is deducted from the cost of new asset while calculating the capital gains on the transfer of new asset. So, for this sections, if you have sold the new asset within the certain period or the lock-in period, then when you are calculating the capital gains on the transfer of new asset, you will claim cost of acquisition. Yes, from that cost of acquisition, whatever exemption was claimed earlier, we will reduce it. And if it is a long-term asset, after reducing it, we will apply indexation. Okay? Yes. Sir, what is that lock-in period? Lock-in period for of a new asset is 5 years for section 54 EC and GB. Whereas for all other sections, whatever new asset you have purchased, the lock-in period is 3 years. After 3 years, can I sell it, sir? Yes. But on that, we will compute capital gains. But exemption will not be withdrawn. But if you sell it within that period, capital gains also will be computed on the transfer of new asset, plus exemption also will be withdrawn. Then applicability of sections. For individual and HF, section 54, 54B, F and GB is applicable, whereas remaining sections for all SSC. Then types of asset transferred, old asset, whichever you have transferred. Now you have gross gain. You are willing to claim exemption. Now which is that asset? For section 54, 54 EC, EE, F and GB, they are telling long term. Whereas for other section, it can be long term or short term. Even in the format I have given, only few sections for 54, short term, sir. Why, sir? Because for short term capital gains, exemption is available only in 3 sections. Whereas for long term, everywhere it is available. Okay. Fine. So full lightning, rain. Students have gone, CA students have gone to write exam today. Okay. By seeing their performance, God is given all this. Maybe. Chalo. 2:48, they have started from 2 o'clock. 2 to 5 is the CA exams. Where are you going, sir? CS exam is in June, sit. Okay. Fine. The last hit of income, guys, that is income from other sources, is covered in section 56 to 59. Basis of charge. Section 56. Income chargeable under the Income Tax Act, which does not specifically fall for assessment under any of the heads discussed earlier, will be taxable here. But always like that, sir? No. Section 56(2) clearly tells the following incomes are taxable here. But that is the end list, sir? No. In addition to that, if there is any income which is not covered under any of the first 4 heads, it will be taxable under the head other sources. And whenever clubbing get attracted, it will always get attracted under the head other sources, irrespective of the nature of the income. Means if I am liable to pay tax on someone else's income, then it will always be clubbed with my income under the head other sources. Then guys, under the head PGBP only we have covered. Whenever we are computing the income under the head PGBP and other sources, which method of accounting we will follow? Either mercantile or cash basis, whichever the assessee is regularly following for accounts purpose. And also, if he is following mercantile system, we have to also follow ICDS. Okay, 56 to 10 list out certain incomes which are taxable under this head. What are those? Dividends income of the shareholder, including deemed dividend, under section 222. Interest expenditure incurred to earn such income is allowed as deduction, provided like I have taken loan to purchase shares. In that case, I am paying interest on the loan. Yes. Can I claim as expenditure against my dividend income? Yes. But maximum 20% of such income. No deduction will be allowed for any other expenditure. Guys, for example, assume I have earned a dividend income 1 lakh. I have earned a dividend income. Cool, no problem. Listen. Okay. Dividend income 1 lakh. Dividend income 1 lakh. Sir, I have incurred a interest expense to earn this income of 40,000, sir. Can I claim entire 40,000? No. 40,000 or 20% of dividend income, whichever is lower. 20,000 of my dividend income, 20% of my dividend income comes to how much? 20,000, or actual interest expenditure, whichever is lower. Sir, what if my interest expenses is only 4,000, sir? How much I can claim? Only 4,000. Only 4,000. Is that clear? Yes. Next. And you cannot claim any other expenditure. Amount received under a keyman insurance policy, including bonus, if it is not taxable under any other head, received by legal heir or nominee. Guys, keyman insurance policy is a policy which is taken in the name of key managerial person of the company. Who will pay the premium? Normally company. Now, if policy is matured, if employee receives the amount, taxable under the head salary. Sir, policy matured, but employee received the amount, taxable under the head PGBP. Sir, employee gone forever. Nominee or the legal heirs received the amount. Where is it taxable for them? Other sources. Next, any winnings from lottery, crossword puzzles, races, including horse races, card games, and other games of any sort, or from gambling or betting of any form or nature, casual income. And it is taxable always at 30%. No expenditure claimed can be against this. No chapter 6A deduction. No loss can be adjusted against it. And you cannot even adjust basic exemption limit against this. Then income from machinery, plant or furniture let out on hire, that is whatever rent you are earning from letting out of machinery, plant or furniture, if it is not taxable under that PGBP. When it is taxable under that PGBP, if it is your business, taxable under PGBP. If not, no sir, I had plant and machinery, for time being I was not using it, so I let it out for 2-3 months. I earned some income. Where is it taxable? Other sources. Then interest on securities or other interest income, if not taxable under the head PGBP. Again, interest, only if earning interest is my business, like banks, financial institution and all. It is taxable under PGBP. Sir, I have invested in debenture, bonds and all. I am earning interest or on my deposits with the bank, post office. Where is it taxable? Other sources. Income from letting of machinery, plant or furniture or building, which is inseparable. If it is separable for building, house property. Others means any other asset, either PGBP or other sources. Here, if it is inseparable, everything is either under PGBP or other sources. Then shares issued by closely held company means private company. Closed, they are closed, they are not open to public. In excess of fair market value of such shares means we have to compare, is issue price more than face value? Yes. And also check, is it more than fair market value? Yes. So the difference between the issue price and fair market value is taxable under the head other sources. Next, interest received on compensation or enhanced compensation will be taxable in the year in which you received it. So our government compulsory acquired my property. They gave me compensation later, sir. Government, you know how fast they are. So they gave you late. In that case, they will give you along with interest. Yes. So is interest compensation taxable under the head other capital gains, which is full value of sale consideration. What about interest, sir? Taxable under the head other sources. But 50% flat deduction. Only remaining 50% is taxable. Okay. Advance money received and forfeited for transfer of capital asset on or after 1st April 2014 is taxable year. Before 1st April, we will reduce it from the cost under the head capital gains only. Okay. Next, family pension is taxable under the head for family members who is receiving it. Okay. Family pension, whatever the family members are receiving it, wife or children or whoever is receiving it, for them it is taxable under the head other sources. Because for them there is no employer-employee relationship. Okay, the person who had employer-employee relationship has left us. Clear? So in that case, for the person who is receiving it, it is taxable under the head other sources. But that family member can claim a deduction of 1/3 of such pension or 15,000 per annum, whichever is lower. Maximum 15,000. Okay. Sum received, including bonus. Important, guys, because there is an amendment in this. Important. Sum received including bonus under life insurance policy other than unit linked insurance policy and keyman insurance policy. Because ULIP, if it is taxable, where is it taxable? Hey, ULIP, if it is taxable, where is it taxable? Capital gains. Sir, keyman insurance policy, 338s are there. Salary, PGBP or other sources, any of the three. Other than that too, if it is not exempt under 1010D, then it is taxable under other sources. So now it is important for us to understand when it is exempt under 1010D. Okay. Next page I have given. Important, exemption under section 1010D. When is it exempt under section 1010D? When it is exempt, it is not taxable. If it is not exempt, it is taxable. Okay, guys, when policy, when it matures, life insurance policy we are talking about. If life insurance policy matures on the death of the person, it is completely exempt. The legal heirs or nominee would be receiving the amount. For them, it is fully exempt. no condition, no if, no but, nothing. Sir, what if the person was alive? The term or the life of the policy has come to an end and he has received the amount. In that case, whoever has received it can enjoy the exemption only if the conditions are satisfied. If not, it is taxable. Where it is taxable? Other sources. Sum received under section 80T, first let me read this. Sum received under life insurance policy is only exempt other than the following. Other than the following means the following is not exempt. Okay, red color means not exempt. Sum received under section 80DD subsection 3. Sir, my dependent was disabled. I had taken policy in his name. When he is disabled, I enjoyed a deduction under section 80DD 75,000 or 1,25,000 when he was alive. When he is gone, I received the policy amount. I had taken the insurance and I had named myself as nominee. I received the amount. Will that also be exempt? No, that will not be exempt because during his life you have claimed standard deduction under section 80DD dependent disabled. Next, sum received under key man insurance policy, no if but always taxable. Either salary, PGBP or other sources. Okay. Next, premium payable for any year for the policy issued. Premium payable for any year for the policy issued. Check when the policy is purchased. You will be paying premium for years together, but the date of purchase of the policy we have to take it. If it is on or after 1st April 2003, but on or before 31st March 2012, you cannot pay more than 20% of the sum assured as a premium every year. Even in 1 year if you have paid, you have violated it. You cannot enjoy the exemption. Then on or after 1st April 2012, more than 10% of the sum assured. Or on or after 1st April 2013 and policy is for a person covered under section 80 DDB, specified disease, or 80U, assessee himself is disabled. So, assessee himself, you means you yourself are disabled. Okay. In that case, 15% of the sum assured. Guys, general case always 10%. If they have clearly given who is the person, then apply 15%. Clear? As on today also what percentage? 10%. Okay. Even in 1 year you cannot pay more than that. Sir, by mistake in 1 year I have paid more than 10% of the sum assured, sir. When the policy matures, it is fully taxable. Fully taxable. Now one more condition what they have added. This is a new thing, masala. Amendment. Also for a policy issued on or after 1st April 2023, our beginning of our previous year. If aggregate amount of premium payable more than 5 lakh in monetary for any year during the term of such policy. Come on guys. For the policy purchased on or after 1st April 2023, what is the percentage limit? 10%. What is the monetary limit? 5 lakh. You cannot exceed both. Even if you exceed any one, you cannot enjoy the exemption. You cannot enjoy the exemption. Very important. That is why I have also given some examples. But before that, sir, whatever premium I pay on life insurance policy, you can claim deduction under section 80s. Clear? But there also limit is there. If you have paid more than 20%, 10% and all, you can still claim deduction, but only that much. 10% or 20%. Clear? But if you have paid more than 20% or 10% of the sum assured as premium per year, you are not at all eligible for exemption. But deduction you can get, but maximum that much. Only 10% or 20%, whatever is the percentage. As on today, percentage is 10%. If by chance in the exam, if date of the policy is not given, please take 10%. Okay, chalo. Now I have given some example, guys. For the policies which are issued on or after 1st April 2023, we have to check two things. Percentage limit how much? 10% of what? Sum assured. Monetary limit 5 lakh. So for example, I will just give an example. Sir, I have taken a policy for 60 lakh. I have taken a policy of 60 lakh. Now I have paid 5,50,000, sir. 5,50,000. Within 10%, okay. But monetary limit I have crossed. Can I enjoy the exemption? No, I cannot. Clear? Yes, good. Chalo. I have given a number of examples. Please observe the figures carefully. Observing. Date of policy is on or after 1st April 2023. Okay. So, sum assured. Policy XYZ. 30 lakh, 40 lakh, 60 lakh. Yearly premium. 4 lakh, 4 lakh 50, 6 lakh. Always first check percentage. 4 lakh. Already we have crossed. More than 10%. Then 4 lakh 50. More than 10%. And exactly 10% here. But more than 5 lakh. Exactly 10% okay. But more than 5 lakh. So, all three not eligible for exemption. If this policy matures on the death of the person, always exempt. For death, we will not disturb the family. Telling, hey, your person had paid more than 10%, please pay. No. Okay. If the insured had died and if the family members have received the policy amount, it is completely exempt for them. When are we checking these percentages is only when the insured is still alive. till the end of the period of the policy and he received the amount. In that case only we are checking it. So in all these three cases, and wherever I have given the illustration, we are assuming that the policy is maturing on the expiry of that time. That is the period, not the expiry of the insured. Okay. Illustration 2 also, same story. Sum assured 50 means that data is same. Sum assured 50, 40, 60. Okay. Yearly premium 4 lakh within 10%. Fine. Within 5 lakh also. Fine, sir. Then 40 lakh. 3 lakh 50,000 is the yearly premium. Within 10%. Yes. Within 5 lakh. Yes, sir. Fine. Taken care. Then policy Z 60 lakh and 6 lakh. More than 5 lakh. So ruled out. More than 5 lakh ruled out. Now, sir, I can claim for both exemption X and Y. Yes. But aggregate cannot exceed 5 lakh. Aggregate cannot exceed 5 lakh. That means I can either enjoy for X or Y, not for both. Sir, now as the assessee, I have to plan. Where am I getting more money? 50. So try to enjoy exemption for that. Sir, I want to take for Y also, sir. If you add up both, what is the aggregate premium paid? 7.5 lakh. More than 5 lakh. You cannot claim. So if you have multiple policy, then 5 lakh limit is for all the policies put together, not per policy. Clear? Yes. Next. So that is why I have taken different examples here. Observe. Sum assured 30, 30, 20. Premium paid 2, 2, 2. So everything is within the limit. Everything is within the limit. Good, sir. Percentage also, amount also. But can I claim exemption for all three? No. If I add 2 plus 2 plus 2, how much it is? 6 lakh. Can I claim the exemption for all the three policies? No, sir. The maximum 2 policy. Now I have to choose. Where am I getting maximum benefit? 30, 30. Correct now. So I will choose this 2. So 2 plus 2, 4. So within 5 lakh. And each of the policy within 10% premium is there. So that means I can enjoy the exemption for both. Yes. Sir, for Z also give, sir. Please, sir. No, you cannot. Thank you. Chalo. Sum assured. Last case. 70, 80, 60. Yearly premium 7, 650, 6 lakh. Guys, listen. Individually, everything is within 10%. In percentage, please check individually. Clear? Don't aggregate and check and all. Percentage, check individually. Huh? It's falling on her. Chalo. Listen. If it is not falling on you, if it is not disturbing you, you can aram se focus is what I believe. Huh? So yearly premium 7 lakh, 6 lakh, 50, 6 lakh. More than 5 lakh everywhere. Yes. So individually only more than 5 lakh. That means, can you enjoy any exemption? No, sir. Sorry. Now, if you cannot enjoy exemption, it is taxable under other sources. How much? First of all, when the policy matures. When the policy matures? At the expiry of the term, not at the expiry of the insured. If the insured is gone, then exemption is fully available. Where any sum is received, including bonus, at any time during the previous year, under a life insurance policy other than ULIP and Keyman insurance policy is taxable as follows. ULIP and Keyman is not covered here because ULIP, capital gains. In Keyman insurance policy, I told you any of the 3 years. Okay, other than that, how much money you have received totally? Take it. Total money you have received. Assume guys, the policy has matured and I have received 60 lakh. Is entire 60 lakh is my income? No, sir. I have paid premium, sir. So assume throughout the life of the policy, you have paid 45 lakh premium. 45 lakh premium. Now for life insurance premium paid, you have claimed benefit under section 80C na. What is it? Deduction. But deduction is not given for how much ever you pay. Maximum deduction under section 80C is how much? 1,50,000. And per policy also limit is there. 10% or 20%. Correct? Assume even though I have paid 45 lakh, I have claimed deduction under section 80C only of 30 lakh. We will reduce it. Remaining is how much? 15 lakh. So 15 lakh we will reduce. Remaining 45 is taxable. Remaining 45 lakh is taxable. I will repeat quickly. Take whatever sum you are receiving at the expiry of the policy. From that we have to reduce. First you do inter-adjustment here. Total premium paid minus how much ever deduction you have claimed under section 80C for premium paid during the term of the policy. Reduce that much. Clear? So net amount you take it to the outer column, which is 15 lakh. That is the premium paid for which you have not claimed the deduction. Reduce it from the amount and the remaining is taxable under the head income from other sources. Income from other sources, guys. Okay, let us continue. Now, this taxability of gift also is very important. Gift can be in three forms, guys: money, movable property, or immovable property. If gift is received as money, that is cash, in that case, if the aggregate amount which I have received during the year from number of people, not from single person, number of people during the year, if it is more than 50,000, entire amount is taxable. For example, you gifted me 30,000. Within 50,000, nothing is taxable. Now each of you gifted 20 people 10,000. 2 lakh. More than 50,000? Yes, entire 2 lakh is taxable for. Clear? So 50,000 is not per person. It is for a year aggregate. If I am receiving gift from multiple people, then everything is covered here. All the people put together, aggregate. Okay. Specific movable property, shares and securities, jewelry, only those are covered here. Any other movable property is not covered. So shares and securities, jewelry, archaeological collections, drawings, paintings, sculpture, a work of art, or bullion. If these assets are received without consideration as a gift, check fair market value of that. If fair market value of that asset is more than 50,000, entire fair market value is taxable under other sources. Sir, what if fair market value is less than 50,000? Nothing is taxable. Next, sir, I have purchased this asset but for a lower price. Compare actual purchase price with fair market value. We call that as inadequate consideration. If inadequate consideration is more than 50,000, then inadequate consideration is taxable under other sources. Sir, if inadequate consideration is less than 50,000, then nothing is taxable. For example, assume I have purchased, purchase price is 50 lakh. Fair market value of that asset was 60 lakh. In that case, what is the difference? 10 lakh. Is it more than 50,000? Yes. How much is taxable? 10 lakh. Clear? Huh? Yes, sir. Next, we will take it as thousands. Sir, I have purchased an asset for 50,000. The fair market value of that is 60,000. So, what is the difference? 10,000. It is more than 50,000? No, nothing is taxable. Okay. Next, immobile property. I have got it free of cost. I have got it free of cost as a gift. In that case, check stamp duty value. If stamp duty value is more than 50,000, entire stamp duty value would be taxable. Okay. Sir, I have purchased immobile property, sir, but for a lower value. In that case, compare the stamp duty value with actual purchase price and see how much is inadequate consideration. First, calculate inadequate consideration. That is the difference between what? Stamp duty value minus actual consideration, which is nothing but purchase price. Check whether it is more than IR of 50,000 or 10% of actual consideration. Okay, for example, sir, I have purchased, purchase price is 50 lakh, but stamp duty value is 60 lakh. Clear? Yes. So now check 50,000, this is A, or 10% of actual purchase price, which is 50 lakh, which comes to 5 lakh, whichever is higher. Whichever is higher, 5 lakh. So inadequate consideration, you see, inadequate consideration is how much? 10 lakh. Is inadequate consideration more than 5 lakh? Yes. Here I repeat once again, take 50,000 standard amount, take 10% of actual purchase price, whichever is higher. Whichever is higher. How much is that? 5 lakh. Check. Is inadequate consideration more than 5 lakh? How is inadequate consideration calculated? Stamp duty value minus purchase price or actual consideration. Okay. Is 10 lakh more than 5 lakh? Yes, sir. So how much is taxable under the head other sources? 10 lakh. And in the future, if I sell this asset, what is the cost of acquisition for me? Stamp duty value. How much is that? 60 lakh. 60 lakh. So if FMV or stamp duty value was taxable for the recipient or the buyer under the head other sources, he can claim the same as cost of acquisition for that capital asset in the future, guys. Okay. Now, these assets are taxable, especially movable and immobile property is taxable for the recipient only if it is in the nature of capital asset for them. If it is not capital asset, then it is not taxable for them. Clear? Sir, it is a stock for me. Obviously, stock means you will purchase at lower price and sell it at higher price. That is my business. So, in that case, this will not be applicable. Inadequate consideration and all will not be applicable. But there are certain exceptions. That is, if gifts are received, any of these three gifts, money, immobile property or movable property, if it is received from relative on the occasion of marriage, not marriage anniversary and all, only marriage, first marriage, any number of marriage. Okay. Under, because first marriage restriction is not there here. Under a will or by way of inheritance or some more things are there. These are the important things, guys. If you have received the gift under any of this situation or from relative, it is completely exempt irrespective of the value. Irrespective of the value. Then whenever clubbing get attracted, it will get attracted under this head, guys. Next, Deductions which are not allowable. While computing the income under the head other sources, the following expenses are not allowed, guys, as per section 58. Any personal expenses, not allowed. Any interest which is payable outside India on which TDS is not deducted, not allowed. Any payment which is chargeable under the head salary, means you are paying a salary which is taxable for the recipient under the head salary, but you are paying outside India on which TDS is not deducted. You cannot claim it. Then 30% of the sum payable to a resident on which TDS is not deducted, or else deducted but not remitted within the due date. Same like 40A, 40A1, 40A1A. Okay. Then any expenditure in respect of which a payment is made to a related person, 40A2, to the extent the same is considered excessive or unreasonable. Then any expenditure in respect of which a payment is or aggregate of payment exceeding 10,000 in a single day to a single person, 40A3. Cash, 3C, third letter. Okay. No deduction in respect of any expenditure incurred on connection with casual income. For casual income, even online gaming, whatever new section has been added, BBJ, you cannot claim any expenditure. Then deemed income, same like PGBP, guys. These two are somewhere connected to 58 and 59, somewhere connected to PGBP also, but covered under the head other sources, but connected to PGBP. Okay. Now, if I have claimed any expenses or losses in the future under the head other sources, if I recover it in the future, then it is taxable under the head other sources. Same like 41(1) deemed income, guys. Next, few exemptions. 1015 gives exemptions for income by way of interest, premium on redemption or other payments on securities and gold deposit bond issued by central government shall be exempt. Same way, interest on post office savings bank account, which is 3,500 in case of individual accounts and 7,000 in case of joint accounts, would be exempt. Then 10th only in case of post office savings bank account. Sir, what if it is FD, RD and all? No exemption. What if it is in bank? No exemption, but deduction is available. We will see that in deduction chapter. 1016, scholarship granted to meet the cost of education would be completely exempt. Who is giving it? Doesn't matter. Then 1017, daily allowance, constituency allowance of MPs and MLAs is fully exempt. But if that MP, MLA is choosing default scheme, then for them it is also blocked. They have blocked themselves. Great. 1018, family pension received of individual who has been in the service of central or state government and has been awarded Paramveer Chakra, Mahavir Chakra, Veer Chakra or any other gallantry award is exempt for that family member. Sir, what if that person was alive and he received pension? Even under the head salary, for them it is exempt. Next, family pension received by the widow of the children or nominated heirs of a member of the armed forces of the union where the death of such person has occurred in the course of the operational duties. That is, the person who is working in Indian Army has died during any operations, guys, means any war and all, or enemy attack. In that case, on their death, the government would be giving family pension to their family members or dependents. So whoever is receiving that family pension is fully exempt for them. Fully exempt. Sir, you told 1/3 or 15,000, that is for other cases. Other cases, whereas this one is always fully exempt. In any other cases, family pension, what is the amount of deduction they can claim? 1/3 of pension or 15,000, whichever is lower, guys. Whichever is lower. Yeah, now we will revise chapter 8, which talks about income which do not form part of total income, or in simple, we call it as exempt income, guys. We have already seen some exemptions under the respective head of income. We also have some more exemptions which we will be seeing here, and few will be repetition. So adjust. So tax is calculated on the total income of the assessee for the previous year. Sir, have you already learned how to calculate total income? Not yet. We have seen just 5 years of income, and now we are learning exemption. There are 3 more topics left. What are those, sir? Clubbing, set off of losses and deductions. Only after all this we will know how to calculate total income. We will be perfect in computing total income. Okay. And guys, moreover, whatever we are focusing in this marathon is more about the provisions, and wherever required, I will be telling how to apply it and all. So you should also practice some good number of problems. Sir, only provisions enough may not be. You should know how to apply it in the problems. So I am helping you to understand wherever required, but please solve some good number of problems. Clear? And also already the question paper discussion, that is December 2023 question paper discussion video has already been uploaded. So try to make use of it and watch it. Along with that, if you still want to practice more questions, guys, RTP and MTP discussions for CA inter students have been uploaded. Portion is almost same. You can make use of it. The first part of those videos would be MCQ and the second part would be descriptive, both for direct as well as indirect. you can make use of that also, so that you can practice some good number of problems. Along with that, please practice writing, which is very, very important. If you're simply watching, then it will not be helpful for you completely. At least for a few hours a day, like 1 at least or 2 hours at least, you try it, guys. Because in the exam, you know that 3 hours full, you should be writing. You cannot orally tell the answer to the evaluator. Clear? So make sure that you have good writing practice. Please take care of small things. Yeah. Tax is calculated on total income of the assessee for the previous year. The difference between the exempt income, deductions and rebate is as follows. First, let us understand the difference, because sir, what is exempt, what is deduction, what is rebate? Confusion, what is it? First, rebate, easy. Let us finish that. Rebate means the tax relief given, provided you satisfy a certain condition. That is, under section 87A, rebate is available only to resident individual whose total income is within 5 lakh under optional scheme. Under default regime, within 7 lakh, up to 7 lakh. Even if it is more than 7 lakh, marginally still allowed. Here, which is important. I have told you a number of times already. Then exemption. Guys, if I have any income which is exempt under income tax law, I will claim the exemption under the respective head. If it is fully exempt, nothing is taxable. If it is like partly exempt, like whichever is lower and all, then what I have received minus exempt, remaining is taxable under the respective head. And it is always mandatory to disclose that I have source of income and then claim the exemption. It is not like, anyway, exempt, no, leave it at that. No. You have to disclose it and then claim the exemption. But please be careful, agriculture income is exempt completely under section 10(1). But if the same assessee has both agriculture income as well as non-agriculture income, the tax computation format is different. Take care of it. Yes. Then, please be careful, exemption is claimed under the respective head. And in your exams, if there is any exemption, which like nothing is taxable, sir, at least give a note. At least give a note for the same, guys. Sir, old syllabus, where to give the note, sir? Old syllabus students, don't worry about note, working note and all. Just choose the right option. That's all. Then deductions. Guys, there are two set of deductions under income tax law. One is the deduction which is allowed under the respective head. That is income from salary, section 16. Standard deduction, profession tax, entertainment allowance. Yes, sir, section 16. Next, under income from house property, municipal tax paid. Standard deduction 30% of gross annual value. Then, 30% of net annual value. Then, interest on housing loan. These three are allowed. Same way under that PGBP, capital gains, income from other sources, expenditures are allowed, guys. Under the respective head, while computing the income under the respective head. Yes, sir. Then there is also a deductions under chapter 6A. Chapter 6A deductions are given based on income, investments or payments or contribution donations made. What are those? We will learn separately in the deductions chapter. So there are two set of deductions. But while claiming deductions under the respective head, only if you have income under that head, you will claim it. Sir, I don't have salary income, so I want to claim 50,000 deduction. Can I do it? No, you cannot. Okay, only for the employees who have salary income can claim standard deduction under section 16. Clear? Same way, under each head, if you have income under that head, you will claim expenditure under that head. If not, you will not. Okay, general exemptions are given in section 10 of the Income Tax Act, guys. So section 10 clause something. We will call it as clause here because each of them are independent of each other. The items of exemptions specified in section 10 are as follows. 10(1). Agriculture income as defined in section 2(1)(a) is exempt from income tax in case of all the assessee. Agriculture income from an agriculture land used for agriculture purposes, exempt, guys. Then 10(2). Any share of profit received by a member of HUF is only exempt in the hands of member. Now, HUF is different, member is different. HUF would have paid tax on their income. After paying tax, if they distribute it to their members, take it, enjoy anta. In that case, for the members, again it is not taxable. It is exempt for them. But other incomes of the member and all will be taxable for them. Then, same way, 10(2)(a), share of profit distributed by the firm to the partner is exempt. Only share of profit, not the salary, interest, remuneration, what they give, that is not exempt. Only the share of profit. Then, 10(7). Any allowances or perquisite paid or allowed outside India by the central government to a citizen who is giving service outside India but to the central government. Any allowance or perquisite is exempt. Then 10(10)(b) we just now covered, guys, recently. So I am straight away going to 10(11)(a). Any amount received in the nature of interest or withdrawal from an account opened in accordance with Sukanya Samruddhi account rules shall be exempt. Full amount, whatever you withdraw. You will withdraw totally how much? How much you have contributed, principal amount plus the interest. You will also get interest on it. Entire amount is exempt. Entire amount is exempt. Sukanya Samruddhi account is an account which can be opened in the name of girl child for the benefit of girl child. Then 10(20). Following income of a local authority is exempt from tax, local authorities or local governments, Gram Panchayat, Taluk Panchayat, those people. Income from house property, capital gains, income from other sources is fully exempt. Whatever they have under the data. Then, under the PGBP, income from a trade or business carried on by it which accrues or arises from the supply of commodities or services within its jurisdiction. Within its jurisdiction, if they supply anything from which they earn, it is exempt, guys. For example, sir, what is the local authority for Bangalore means BBMP. They supply anything within Bangalore. Within Bangalore, if they supply anything, any goods or services, it is completely exempt. Now, sir, outside the Bangalore, if they supply anything, is it taxable? Yes, it is taxable. But if they supply water and electricity anywhere, not only in Bangalore, anywhere, it is exempt. Okay, water and electricity can be supplied anywhere, within the jurisdiction or outside the jurisdiction. Okay. Then 1022B. Income of a news agency set up in India solely for collection and distribution of news will be exempt subject to specified condition. Previously and all, we used to wait only for half an hour news. Now number of news channel, whichever channel you put, in between one news channel will be there. Clear? No entertainment, only news channel. And in that news channel, same thing, they will account rupee full day. Whatever news they have got, full day, that only. Okay. Now in that case, sir, why are those so many people opening news channel? What is the revenue for them? Who will watch it? They enjoy complete exemption. And here there are who are backing this news channel is very important. And most of the news channel are backed by politicians or business officials. 1023C. Income of any hospitals or institution for the reception and treatment of persons suffering from illness or mental defectiveness existing solely for philanthropic purposes and not for the purpose of profit shall be exempt from tax subject to specified condition. Means hospitals, they may not be doing the business with an intention to earn profit, but they are making profit. Clear? So here they are telling they should not have an intention to earn profit. So in their object clause, they should have not mentioned that our object is not to earn profit. They would have mentioned to give quality health services to the patients, to take care of them like their family members. Okay. If you go to the hospital, until you open your purse, they will not open door. Okay. Or the syringe. So, in that case, sir, whatever income they are earning is exempt subject to conditions. They should be for philanthropic purpose. They should not have any intention to earn profit. Intention is important. Sir, I didn't have intention to earn profit, but I earned it. Doesn't matter. That is why they are giving exemption. You earned it. So that is what is exempt, is what they are telling. Okay. 1023D. Any income of following mutual funds is exempt from tax. A mutual fund registered under the SEBI Act 1992 or regulation made thereunder. A mutual fund set up by public sector bank or public financial institution or authorized by RBI subject to conditions notified by central government. Means they have to satisfy certain conditions. Even whenever mutual fund, any advertisement is happening in the news channel or whenever you are watching the match or so, whenever you are watching anything, mutual fund advertisements will come, guys. They will also tell investment in mutual funds are subject to market risk. Please read all the terms and conditions properly. Same way here they are telling. Okay. So for them also, whatever income they are earning is exempt. They get something called as entry load, exit load, guys. Okay, means they will collect money from us, they will invest our money and they will earn out of it and they will not give everything for us. Obviously, they are also working for profit income. So they will deduct certain part of it and give it the balance for us. So whatever they are getting, will it be exempt, sir? Yes, subject to condition. Then 1032. Whenever clubbing get attracted of a minor child, whenever the minor child income is clubbed with the parent, either father or mother, whoever is having higher income. So with the parent whose income is clubbed, that is either father or mother, in whose hands the minor child's income is clubbed, that parent can claim exemptions of the amount clubbed or 1500 per minor child, whichever is lower. 1500 is not per month, per minor child. Sir, if 3 minor child's income is clubbed, all 3 will be clubbed. Okay, here there is no restriction and all. Exemption also will be given for each minor child. Actual amount clubbed or 1500, whichever is lower. Then 1037, we covered it under the any compensation or enhanced compensation received by individual or HF on the transfer of agricultural land in urban area. If it is rural area, it is not at all a capital asset. By way of compulsory acquisition in a specified area is exempt, guys. We already covered it in capital gains head. Then this and all is a general provision, general exemptions, guys. Clear. In addition to this, in new syllabus, they have also given the list, big list, Ananthan Bala. But sir, should we cover all those things? Need no, guys. Okay, they have just given the list, section content, but provisions they have not given. So you need not worry. Okay. Next, specific exemptions. Just you are on, na? It's on, na? So specific exemptions. So specific exemptions are given other than section 10, guys. So what is it? 11. According to section 11 subsection 1, income derived from a property held under a trust wholly in part for charitable or religious purposes, charitable or religious purpose, shall be exempt to the extent to which such income is applied for such purposes. Now, whatever this religious or charitable institutions or concerns are there, whatever income they are earning from the property owned by them is completely exempt, provided whatever income they earn, they will apply it for what purpose they have been established. Okay, now there is a charitable institution which is taking care of age-old people. So they have a property, they are earning rental income. Whatever rental income they are earning should be applied for the purpose of taking care of age-old people. Same way religious. Okay. Next, income in the form of voluntary contributions made with the specific directions that they shall form part of the corpus of the trust or institution shall be fully exempt. Now many a times you guys would have received a call, or at least your parents or relatives telling, sir, we have set up a charitable trust. If you contribute for us, you can claim ATG deduction. Please do it. And okay, we are doing so and so. They will tell all those things. Now, in that case, sir, whatever voluntary contribution they are receiving it, is it exempt for them? Yes, provided they are using that money for the purpose why they are established. Clear? Huh? Yes. Corpus means you can use the money only for the purpose why you have established. Sir, can they go for foreign tour and come? No. Sir, can they purchase any asset out of that money and all? No. You should use for the purpose why you have been set up. What is your core objective? Then same way, sir, for the contributor, donors, they can claim deduction. Yes, ATG. ATG. Under chapter 6A. Then 13A, political parties are liable to pay tax on their income and they are assessed as association of persons. However, the income derived by this parties as income by way of voluntary contribution, whatever they get is exempt. Then income from house property, income from other sources, capital gains is completely exempt, subject to conditions. They have to get their books of accounts audited and all those conditions are there. Guys, voluntary contribution, for the recipient it is exempt. For the giver, donation deduction can be claimed under section 80 GGB or GGC. GGB is for a company, for others GGC. Then any voluntary contribution received by electoral trust, they are like a middleman. Sir, I don't have any contact with this party, sir. How will I give contribution? I want to contribute to the political parties. In that case, there will be a middleman called electoral trust. You contribute to them and they will give it to the political parties. So, I gave it to electoral trust. So, can I claim deduction under section 80 GGB or GGC? Yes, I can claim. Now, for electoral trust, whatever they are receiving, is it exempt, sir? Yes, subject to condition. Such electoral trust distribute 95% of the aggregate donations received to any political party registered under Representation of People Act. Means whatever they have received, minimum 95% they should have given in the same year to the political parties. Minimum 95%. Okay. Next, such electoral trust functions in accordance with the rules made by central government. 14A. Expenditure incurred in relation to any exempt income is not allowed as a deduction while computing the income under any of the 5 heads of income. Now, sir, agriculture income is exempt. So I have incurred some expenditure. Can I claim that expenditure against any other income? No. If you have incurred the expenditure for earning the income which is exempt, that expenditure cannot be adjusted against some other taxable income. Next, 10AA, it is a deduction, not exemption, deduction, guys. Deduction for a unit in special economic zone, SEZ. So an entrepreneur who has begun or begins to manufacture or produce article or things or provide services in SEZ between 1st April 2005 to 31st March 2020. Guys, between this date you should have started it. But even after this you can claim deduction. Between this date you should have started. The period is already end. Now you don't plan to start. Okay. Section 10AA provides deduction to assessee who derive any profit and gain from the export business. Okay. Export of articles or things or services, including computer software, subject to fulfillment of prescribed conditions. So how much deduction, guys? First we have to calculate eligible profit. How to calculate eligible profit? Take the total profit of SEZ unit, only SEZ unit. Same company may have branches outside the SEZ also. Take only the data of SEZ unit or SEZ branch. Okay. Now what is SEZ means? The area which is declared by the government as SEZ. They have offered to the people, you come and start your business here. We give some tax benefit. We give you some tax benefit. So take the profit, total profit earned by SEZ unit, then multiply that with export turnover divided by total turnover of SEZ unit. So you will get nothing but the profit which is attributable towards export business of SEZ unit. So we call that as eligible profit. So for the first 5 years of your business, you can claim 100% of eligible profit as deduction. Next 5 years, that is from 6th to 10th, you can claim 50% of eligible profit as deduction. Last 5 years, that is from 11th to 15th, you can claim 50% of the eligible profit or the amount which is transferred to special reinvestment reserve, that is special SEZ reinvestment reserve. And they have also told why you have to use this money. Clear? That we will see. So in the last 5 years, how much guys? 50% of the eligible profit or the amount which is transferred to special economic zone reinvestment reserve, whichever is lower. In the last 5 years only. Okay? Yes, sir. And whatever amount I have transferred here, I have to use it to purchase new assets for my business. I cannot declare dividends out of it. I cannot invest this money outside India and all. I have to use this to purchase the asset for my business, guys. Okay. Now, sir, will the amount remain same in every year? No. Every year you have to do this calculation. Calculate eligible profit first and then check how much is the deduction you can claim. Then note, freight, telecommunication charges and insurance expenses attributable to the delivery of the articles or things outside India or expenses incurred in foreign exchange for rendering services including computer software outside India are to be excluded both from export turnover and total turnover. If these items are already included in the turnover, please reduce it. Reduce it while applying it here. This formula. While applying this formula, reduce it. Okay. Now we are done with this chapter. What is the impact of default scheme on this chapter or on this topic, sir? So the following exemptions or deduction is not available for the assessee who is following default scheme under section 115 BAC, sir. What are those? Leave travel concession, HRA, this too we already covered under salary hit, guys, but that is not available for them. Then official and personal allowances other than those as may be mentioned, section 1014, which are at the end of salary hit also I have given this. Then allowances to MPs and MLAs, here only we covered it. Okay, allowances to MP and MLA it is exempt, but if they are opting for default regime, they told no, you cannot claim it. That is the last head of income. Guys, one more thing. Sir, salary received by MP, MLAs and all, where is it taxable? Other sources. Why, sir? Because there is no employer-employee relationship. They are just representing the constituency from which they have elected. So whatever salary they get from the government is taxable for them under the head other sources. That is why that exemption also I have given at the end of other sources, guys. Okay. Next. Allowances for income of minor. They are giving huge exemption now. How much? Whenever the income of a minor child is clubbed, the parent can claim exemption of actual amount clubbed or 1500, whichever is lower. That is also they are not giving. Okay. Then deductions for the units established in special economic zone units. Now you would have already set up it because now this default scheme came recently. Sir, you told you can claim only if you have set up before 31st March 2020. Yes. Assume you have set up somewhere in 2018. You will claim it for next 15 years. Yes. So now once you come under default regime, can you continue to claim that deduction under section 10AA? No, you cannot. Sir, I am engaged in export business, sir. In SEZ only, sir. No, you cannot claim. No, you cannot claim, guys. So this is all about this chapter. Fine, guys. So the next chapter is chapter 9.1, which talks about clubbing of income. Clubbing means not the one which you are thinking of. This is clubbing of income. Means, sir, for someone else's income, I am liable to pay tax. Sir, how come, sir? For someone else's income, why should I pay tax, sir? Your near and dear ones. Okay. So we'll see. Section 60 to 65 covers the provisions with respect to clubbing. This section the situation in which the income is to be clubbed, that is, sir, for someone else's income I am liable to pay tax, so someone else's income will be clubbed with my income. Under which head? Always under the head other sources, irrespective of the nature of the income for other person. For them we will first calculate the income under whichever head it is, but that will not be taxable in their hands, it will be taxable in the hands of mine, but under the head other sources. Whenever clubbing get attracted, it is always under the head other sources, guys. Okay. So we'll see section by section. Section 60. When income alone is transferred without transfer of asset, clubbing is attracted. Sir, I have earned the income and I transferred to you. Assume. Okay. In that case, whose income is that? Mine. So for whom it is taxable? Mine. So if I transfer income for the recipient, it doesn't amounts to he has earned the income, so it will be taxable for them. No. I am the one who has earned it and it will be taxable in my hands. Then section 61. Revocable transfer of assets also attract clubbing. Revocable transfer means what? Gaining the right back. Means I have transferred the asset to you, telling, hey, after 2 years you have to give back to me. Assume in this 2 years I have huge income, including rental income. So what I thought, okay, let me transfer few assets to you, so you will earn the income from it. After 2-3 years, assume I am planning to retire, so you give back to me. I have put a condition. Conditional transfer we call it as. Okay. Or else I have transferred an asset to you, telling whatever income you generate from that asset, give it to my spouse, give it to my children, give it to my brother, something like that. I have put a condition. So ultimate beneficiary is not you, someone else, either me or my near and dear ones. So exceptions to the above means in the following cases clubbing will not be attracted. Clubbing will not attract if the transfer is not revocable during the lifetime of the transferee. For example, I have transferred to a person telling if you die, property should come back to me. If you die, property should come back to me, not to someone else. So in that case, sir, will clubbing get attracted? No. Next, clubbing will not attract if there is a transfer of asset to a trust and not revocable during the lifetime of the beneficiary. I have transferred an asset to a trust and I have told trust, if you shut down, if you close down, asset should come back to me. In that case also, clubbing will not get attracted, guys. So for whomever I have transferred the asset, it will be taxable in their hands only. Next, coming to 64 subsection 1, income of a spouse or son's wife. Spouse means for husband, wife, for wife, husband. So now first, income of a spouse by way of salary, commission, fees or any remuneration, whether in cash or in kind, from a concern in which the other spouse has substantial interest will be clubbed. Substantial interest means 20% or more. Now I am holding the shares in A Limited of, so assume Vikas is holding 25% shares, equity shares in A Limited. So in that company, Mrs. V is working. Now if she has qualification, education or experience and all, nothing is clubbed. Whatever salary she is earning, it will be taxable for her in her hands under the head salary. No sir, she doesn't have any qualification, so she doesn't have any experience, nothing sir, abbu dabbu. In that case, clubbing will get attracted. Whatever salary this person is earning will be clubbed in the hands of Mr. V, who is having substantial interest in the company, because of his influence, the other person is getting the salary, guys. Many a times it happens. Many, especially in case of private companies, what people will do is the promoter or founder, they will start the company and appoint all their family members, okay, as one of the employees, whether they are working or not, whether they are educated or not. They will try to distribute the salary. Why? To deviate the income of the company, to claim it as an expenses. So in order to avoid that, unreasonable payment also is there. 48 agree na? That is also there. Plus here for your wife and all, if you means substantial interest means obviously that person might be a promoter or the founder, co-founder of the company. Correct? So that is why, because of your influence, you are making your wife to get more and more salary. Or might be wife to husband also. So our wife is holding the shares, husband is abu dabbo. In that case also it is applicable. Clear? Huh? Yes, because next Bhagya will stand up now. Sir, how common? Next, both wives, both things are covered, guys. Next, sir, whether share was purchased before the marriage or after the marriage, does it matter? No, it will not matter. Clear? Sir, husband had purchased the shares before the marriage, sir, doesn't matter. After the marriage, sir, it doesn't matter. Clubbing will get attracted. But the key point here is clubbing will not attract if the person, whoever is drawing the salary now, if they are capable of getting it. If they are capable of getting it because of their qualification, experience or knowledge, then clubbing will not get attracted. Next, sir, what if both are having substantial interest? Now, Mr. B is also having, Mrs. B also is having, that is assume 25%, or both put together 20%. Both put together minimum 20%, substantial interest. In that case, both are drawing salary, sir. Both are drawing salary. In that case, will clubbing get attracted? Yes, clubbing will get attracted. Clubbing will get attracted. Yes, you can see the next point. Where both husband and wife have substantial interest in a concern, means company, and both are in receipt by way of salary from the same concern, such income will be included in the hands of husband or wife whose total income before clubbing is more. Sir, now clubbing will get attracted. In whose hands, sir? Whoever is having, before clubbing, whoever is having higher income. With them, the other person's income would be clubbed. Okay. Next. Third one somewhere connected to deemed ownership also, where an asset other than house property is transferred by an individual to his or her spouse without consideration or for inadequate consideration, means gift, or you have sold but for a lower price. Income generated from the such transferred asset attracts clubbing and taxable in the hands of the transferor. So, if husband or wife have transferred the asset to the other person, that is the vice versa person, in that case, if the asset is transferred for a lower price, that is sold but for a lower price, or else given as a gift, 56 to 10 will not get attracted. Relative, close relative, first relative only, spouse only. Correct. So in that case, 56 to 10 will not get attracted, but clubbing will get attracted. So the receiver, whatever income they generate from that asset, will get clubbed. Will get clubbed for the transferor. Clear? So here they have excluded house property. Why? What is the reason for it? Because 27 covers that. Deemed ownership. Clear? If house property is transferred to a spouse without consideration or for inadequate consideration, then who is considered as deemed owner, transferor? And for him, where is it taxable? Other sources? No, house property only. House property only. Please be careful. Sometimes they will frame the questions like this. In my regular classes also, I have stressed on this in the questions while solving. Yeah, next. Exceptions to the above. In case the transfer is before marriage or in connection with an agreement to live apart, merger and demerger. Merger means marriage. Demerger means divorce. If property was transferred before marriage, you guys were not relative. Agree, 56 to 10 get attracted. Yes, sir. Now, sir, no, sir. From the day one, we were already committed. In our art, we were already married, sir. Doesn't matter. Clear? Next. Sir, one more thing. Now, why is this clubbing getting attracted is, I am giving it for free of cost to the other person. Sir, no, sir. Consideration is there, sir. What consideration? Love and care, sir. Love and care, sir. The other person is giving me the love and care. That is my consideration. No. That is not the valid consideration in the law. Okay, for you it might be a valid consideration. Sir, I want, sir, I want love and care, sir. That is why I gifted the property, sir. Okay, for you that is fine. But in the law, it is not a valid consideration. In that case, clubbing get attracted. Clear? And for property, how will we decide whether it is for adequate consideration or inadequate consideration? For immobile property, stamp duty value. For movable property, fair market value. Okay, so in simple guys, these exceptions. Let us come back. If anything is transferred before marriage, clubbing will not get attracted, but 56 to 10 will get attracted for the recipient, not for the giver, for the receiver. Okay. Then, sir, after divorce, clubbing will not get attracted. Clubbing will not get attracted. So, after divorce, can 56 to 10 be attracted? Yes, because 56 to 10 doesn't, marriage covers, but divorce is not covered. Divorce is not covered. Now, sir, 56 to 10 covers marriage. Marriage may happen for number of days. All those days are covered, guys. On the occasion of marriage, reception, haldi, muhurtam, whatever you call it as. Okay. All the event is a part of marriage. Clear? Sir, I received some gift on reception. I received some gift on haldi and big ruta. You know big ruta? Don't know. Okay, like fine. At least for those who ever understand, sir, I received the gift on that day, sir. Exactly that day I didn't tie that knot, sir. Doesn't matter. All these are a part of marriage. So if you receive any gift, not from your spouse, from anyone, it is exempt for you. Okay. The income from the assets transferred shall not be included in the income of the transferor after the death of the spouse. Either transferor or transfer. Where will you club? Person is no more there. Agree. Where will you? You will go there and club with them. No. Okay. When one of the person, either the transferor or transfer is gone forever. Okay. Oh, beta, Charles, oh, beta. In that case, you cannot club. Agree. Both. Either husband or wife, if anyone has gone, then there is no case of clubbing, guys. Next, Income arising on transferred asset alone have to be clubbed. Income earned by investing such income arising from transferred asset cannot be clubbed. For example, sir, I have transferred an asset to my spouse. From that asset, she generated an income of 1 lakh. Will it be clubbed? Yes, it will be clubbed. Now, 1 lakh she has reinvested and she is earning some income. Will that income also be clubbed? No, no. Income on income will not be clubbed. Okay. Next, if asset is transferred to son's wife, wife is done now. Till now, wife is done. Next, son's wife, daughter-in-law. Okay. See how the law is. Law is allowing for the parents to transfer the asset or inherit the property to their son, but not to their daughter-in-law. Because, sir, inheriting will and all is exempt. Even it is not a transfer. Even 56 to 10 does not get attracted. Clear? Somewhere some things are not fair, but still okay. If asset is transferred to son's wife, daughter-in-law, if you can transfer to your own, okay, but not to sons. Okay, see again, sir, if you transfer to your wife, I told you, see, 56 to 10 will not get attracted, but the income whatever is generated from that asset will be clubbed. Same way here, sir, if asset is transferred to daughter-in-law, then for that asset 56 to 10 might not be applicable, but for income whatever she generate from that will be clubbed. Oh. If asset is transferred to son's wife without consideration or for inadequate consideration, income generated from such transfer attracts clubbing and taxable in the hands of transferor. Where, so guys, two things they have directly covered. What is it? A person transferring to spouse or a person transferring to son's wife. Correct? Both they have covered. Now, person transferring to third person. Person transferring to third person, not their spouse, not their son's wife, but for the benefit of these people. I am transferring the asset for third person, telling, hey, you have to give whatever income you generate from that to my spouse or to my son's wife. So who is the ultimate beneficiary here? These people. It is like indirectly I have transferred this to these people only. So will clubbing get attracted? Yes. Whatever income this third person generate from that asset will be clubbed in the hands of transferor, guys. Clear? Yes. So please be careful. This third person is not spouse. It is not a son's wife because it is called direct transfer. What they have tried to cover here is indirect transfer. Okay. Then 64(1)(a) junior. Income of a minor child. Guys, keep it very simple. If minor child earn any income without their efforts, it is always clubbed. How they earned it, what is the source, who gave them the money, who gave them the asset doesn't matter. Clear? Parents only need not give them the money. Assume grandparents have given the money for them. They have kept it in FD. Interest is clubbed. Yes, interest is clubbed. So, for minor child, if they have earned any income without their efforts, it is always clubbed. With father or mother, whoever is having higher income before clubbing. And whenever the income of minor child is clubbed with the parent, father or mother, that parent can claim exemption under section 1032 of the amount clubbed or 1500 per child, whichever is lower. Sir, income is clubbed for 3 children, sir. How much exemption they can claim? 1500, 1500, 1500 maximum. For example, sir, there are 3 minor children for me. Okay. Now, A, B, C. Amount clubbed is 8000, 1000 and 3000. How much exemption can be claimed? How much exemption can be claimed? 1500, 1000. Please be careful. Then 1500. Remaining is taxable. Under which item? Other sources. Hope you guys got it. 1032. Okay. So please be careful that 1500 you have to check child wise. If the amount clubbed for that child is less than 1500, you can claim only that much exemption. That is what we did it. Clear? Yes. Next, sir, what if child is earning the income out of his own efforts, sir? He is having very good talent, so he is a child artist or he is playing under 19 World Cup within 18. Okay, within 18 years also. Sarfaraz Khan and all, they played under 19 World Cup when they were below 18. So they are earning some income, sir. So they are earning some man of the match and all. So for whom it is taxable? For them only. But the parent will act as a guardian, as they will not have signing authority. Same way, guys, now you know the Sarigamapa juniors, child artist in film and all, they will be singing or they will be acting. In that case, whatever money they get paid. You know, Power Star, Punit Rajkumar, whom we recently lost, he started acting at the age of very less, below 18. below 18. Definitely you would have got paid for it. Okay, not so small. Okay. So in that case, sir, will that income be clubbed or will it be taxable in his own hands? In his own hands, guys. Okay, that's all. Now, sir, we discussed 1032. If the parent in whose income the income of a minor child is clubbed, if they are following default regime, for them that is also not there. 1032 exemption is not available, guys. So easy to remember. 64 1A. 1 is for spouse, 1A is for junior, that is minor children's. Now we have a concept in our country, V2 hours 2 anta. So 64 divided by 2, 32. So exemption is given under section 1032. 1032 for what? Income of a minor child which is clubbed. 64 subsection 2, income of an HUF. For an HUF to be found, at least there should be 2 people, 2 members, correct? Now that is when we can form a family. HUF, yes sir. Where a member of HUF converts or transfers self-owned property into a property of an HUF for inadequate consideration, then the income will be clubbed in the hands of the transferor, that is the member. Sir, what is it? Simple, guys. Assume A is a member of HUF. He had his own property. He transferred it in the name of HUF. Now, who is the legal owner? HUF. But whatever income the HUF will earn from this property will be clubbed with A. Because A has transferred it for inadequate consideration or without consideration, for free. Clear? Next, this is one case. Who is the legal owner? HUF. But it will be clubbed in the hands of whom? The member, whoever has transferred it. Next, sir, after few days, the HUF got partition. And whatever property A has given to HUF, now that property is going to Mrs. A. Mrs. A means again you try to do indirect transfer. If you directly give to Mrs. A, then clubbing will get attracted. So what you did, you gave to HUF and HUF, you partitioned and it is going to the Mrs. A. So in that case, what they are telling is, whatever Mrs. A will earn from the property, which A gave to HUF and HUF gave to Mrs. A, this will be clubbed in the hands of Mr. A, not HUF, Mr. A. Mr. A, guys. That is what is given in section 64 subsection 2. Please be careful. Guys, in section 10 subsection 2, exemption is given for share of profit received by a member from HUF. This will not be a part of it. 10 to 64 2. Try to study together. 10 2 talks about what? Exemption for whom? Member. Of whom? HUF. Of what? The share of profit or income which they receive from HUF. Clear? That doesn't cover this. That doesn't cover this, guys. Next, other points on clubbing. Income from asset transferred is clubbed and not income on income. If transferred asset is sold, then capital gains are clubbed. Sir, I have transferred the asset to my spouse without consideration. So whatever income she is earning from that asset will be clubbed? Yes. After few days, she sold that asset, sir. Compute capital gains for her. But it will be clubbed for in my hands. So what income is that? Capital gains. But with me, where it will be clubbed? Other sources. Please be careful. Next. In case of clubbing of income of a spouse, the marriage shall subsist both at the time of transfer and at the time of earning the income. Means, sir, I have transferred the asset. We both are in relationship, means marital relationship. Next, till the relationship is there, clubbing will get attracted. The moment there is no relationship, means, sir, due to any reason, the divorce happen. In that case, on the date of divorce, the clubbing will stop. The clubbing will stop. Income for clubbing purposes includes losses also. Even losses is clubbed. We talked about capital gains now. Sir, the spouse had capital loss, sir. She sold it for a loss. In that case, will that capital loss also will be clubbed? Yes. Clubbing of income means income includes loss also. Then cross transfer. Cross transfer means you are indirectly trying to transfer the benefit to the other person. How is it? We will see. The Supreme Court in case of CIT, that is Commissioner of Income Tax versus Keshavji Morarji, 1967, this case happened in 1967, observed that if two transactions are interconnected and are parts of the same transaction in such a way that it can be said that circuitous method, means indirect method, was adopted as a device to evade tax, the implication of clubbing provisions would be attracted. Means, guys, simple. Now, A, B, Mrs. A, Mrs. B. Sir, A gave gift to Mrs. B. Why and all, don't question. Sir, 10 lakh. Now, B gifted to Mrs. A 15 lakh. 15 lakh. Now it is called cross transfer or cross gift. In that case, what they are telling is check what is the common amount. What is the common amount? 10 lakh. So on 10 lakh, whatever income Mrs. A and Mrs. B is earning will be clubbed with their respective husbands. Husbands, clear? It will be clubbed with the respective husbands. That is, whatever Mrs. A is earning on 10 lakh will be clubbed in the hands of Mr. A. Same way, whatever Mrs. B is earning on 10 lakh will be clubbed in the hands of Mr. B. Clear? Yes. This is called cross transfer, guys. Yeah. Now, chapter 9.2, which talks about set off and carry forward of losses. Section 70 to 80 talks about the set off and carry forward of losses, guys. So there are two categories of losses mainly, current year loss and carry forward loss, and it has to go in the same order, guys. In this single chart I have covered everything, and please observe the priority, the same order 1, 2, 3, it has to go in the same flow. You cannot interchange the position. First we should always take care of current year loss. So in the current year, if I have any loss, how do I adjust it? First intra-head first. Intra-head means within the head. If that is not possible, then inter-head. Inter-head means against other heads. Sir, is intra-head adjustment possible? For a current year loss, you can do first intra-head adjustment. You can do it, subject to certain exceptions. If that is not possible, you can adjust it against other heads of income, subject to again exceptions. Okay, it is possible, but the following are the exceptions. What are those exceptions, sir? So try to remember what is exception. That would be more beneficial. It is allowed. Intra-head adjustment is allowed. Means you can adjust the loss within the same head, except the following. Speculation business loss, specified business loss. These two losses can be adjusted only against same nature, guys. Then long-term capital loss also can be adjusted only against long-term gain. Then loss from activity of owning and maintaining resources. See, if you have income from activity of owning and maintaining resources, it is taxable under other sources. But if you have loss from this, you can adjust it only against income from activity of owning and maintaining resources. I have marked here, you can see, I have highlighted. Such losses can be adjusted only against same income. Same income means, sir, can I inter-adjust this one against the other? That is also not possible. Specified business loss can be adjusted only against specified business income. Speculation business loss can be adjusted only against speculation business income. Sir, can I adjust specified loss against speculation income? No, that is also not possible. Next, sir, if intra-head is not possible, then we will look for next opportunity. What is the next opportunity? Inter-head adjustment. That is against other heads. If it is a current year loss, you can adjust that loss against other heads of income, subject to certain exceptions. What are those? Same 4 points. Whatever we have saw here, obviously you cannot adjust within the same head only, means you cannot adjust it outside the head also. Same 4 points. Plus, loss under the head PGPP, that is profits and gains of business or profession, cannot be adjusted against salary income. Same way, short-term capital loss cannot be adjusted against other heads of income. Short-term loss can be adjusted only against short-term gain or long-term gain. Then, sir, no sir, I couldn't adjust. Intra also was not possible, inter also was not possible. Then what will you do? You will carry forward the loss to next year. So if you cannot adjust the loss in the year in which you have suffered it, then you will carry forward it for future. But if you want to carry forward, you have to file loss returns. We will cover that later. Okay. So when you have filed the loss returns and given the details, you can carry forward the loss. And once you carry forward the loss, inter-head adjustment is not allowed. Inter-head adjustment is not allowed. Maximum is you can adjust it within the same head, but again subject to exceptions. You can adjust it only within the same head, but these exceptions will continue there also. Will continue there also. Yes. This is simple chart where entire things is covered. Now we will go one by one. Set off of current year losses, section 70 and 71. Loss from house property. Sorry, salary I have already told. First head we can never have loss. Only out of the remaining 4 head, possibility of loss is there. I am not telling everyone will have loss, but possibility of loss is there. Okay. So first head, there is no chances of having loss. Loss from house property can be adjusted against income from any other house property. That is intra. If that is not possible, then any other head of income, but maximum 2 lakh. But if you are following default regime, this is not possible. This is not possible. Default regime. Maximum you can carry forward and adjust within the same head. Okay. Then loss from business or profession, normal. I told you for the purpose of adjusting the loss, we will divide the business into 3 types: speculation, specified and normal. Any other business, we call it as normal business. Okay. So income from any other business or profession, you can adjust it. That is intra. If that is not possible, against any other head except salary. Against salary, you cannot adjust. Okay. Then loss from speculation business can be adjusted only against income from speculation business. Same way, loss from specified business can be adjusted only against income from specified business. Okay. So all these three will fall under which head, guys? PGBP. PGBP. Then short-term capital loss, we can adjust it against either short-term gain or long-term gain. Whereas long-term loss can be adjusted only against long-term gain. Guys, nature need not be same. For example, sir, I have long-term gain from land. I have a long-term loss from gold. Can I adjust it? Yes. Asset need not be same, but the gain should be same. Means long-term or short-term. It is like that. Clear? Yes. Next. And for adjusting purpose, guys. For adjusting loss purpose, short-term capital loss, whether it is special or normal, doesn't matter. You can adjust it. Clear? Special means what? On transfer of EFT, which is covered under section 111A, 15%. Any other transfer, any other asset, normal income. So here for adjusting loss, should we segregate like that, sir? No. For adjusting loss, one and the same. Okay. Next, loss from activity of owning and maintaining resources. This will come under IFOS. This can be adjusted only against same income, guys. Clear? And wherever A, B is there, first A, then B. Please be careful. This is for current year loss. Sir, current year loss was not possible. So what will you do? Carry forward. So when you carry forward or brought forward, one and the same. So while counting the number of years, how long can you carry forward? Don't count the year in which you have suffered the loss. It is like next 8 years, next 4 years, guys. Clear? So while counting that 8 years or 4 years, we should not consider the year in which you have suffered the loss. Because for that year, it is not carry forward loss. That is current year loss. Okay. Loss from house property can be adjusted only, carry forward we are talking about. Please be careful. Don't get confused. So it can be adjusted only against income from house property in the next 8 years. Okay. Next, loss from business or profession, normal. Income from any business or profession in the following 8 years. Then loss from speculation, only against income from speculation in the following 4 years. Then loss from specified business can be adjusted only against income from specified business indefinitely. Okay. And please be careful, guys. Sometimes twist would be given in the question. See, specified loss or speculation loss cannot be adjusted against other incomes. But sir, I have an income from other business. Can I adjust it against, I have loss from other business. Can I adjust it against speculation business income or specified business income? That is possible. Vice versa is possible. Please be careful. Yeah. Next, short-term loss can be adjusted against short-term gain or long-term gain because both will come under same head only in the next 8 years. Then long-term loss can be adjusted only against long-term gain in the next 8 years, guys. This too you remember easily. Long-term loss only against long-term gain. Same like special losses. Okay. Then short-term loss only against short-term gain or long-term gain. Whether it is current year, whether it is carry forward. Effect is same. Then loss from activity of owning and maintaining resources. Income from activity of owning and maintaining resources in the following 4 years. So here I have also mentioned how long can we carry forward the loss. If you have any loss under the head other sources, you cannot carry forward it. Maximum is you can adjust it in the same year. Very less possibility of having loss under the head other sources, guys. Sir, lottery, betting, gambling and all, what if I have loss? You cannot even claim expenditure there. So there is no question of having loss from casual nature. Clear? Yes, sir. Now, any loss under the IFOS, if at all if you have, you can maximum adjust within the same year. You cannot carry forward. But one loss which you can carry forward under other sources is loss from activity of owning and maintaining resources. You are not participating in race. You are making the horse ready for the race. Clear? So in that case, whatever income you earn is taxable under other sources. But if you suffer loss, you can carry forward. Okay. So it is 0. It can be only adjusted in the same year. But exception is loss of activity of owning and maintaining resources, guys. Then unobserved depreciation and specified business loss can be carried forward for n number of years. N means indefinite. Clear? And sir, unobserved depreciation fine, specified business loss. Why, guys? In specified business under section 3580, they are allowing capital expenditure in the same year. So initially in the initial years, you would have huge loss because the investment into that businesses would be huge. You can just look into the number of businesses or the type of businesses covered under section 3580. Infrastructure, they would have invested crores together in developing that. clear their warehouse or buildings or whatever they have done with hospitals and all. So obviously they will have huge losses. So they are telling, okay, whatever loss you have, I will give n number of years. You break even, you start making profit, and then you adjust it. But don't adjust it against any other income. You take how much ever year you want. You adjust only against that hit. Clear? Because they will take years together to break even. Break even means to recover all their cost. Only then they start making profit. That is why the year limit is not here. Next, loss from activity of owning and maintaining resources and speculation business loss. Speculation business loss means what? Speculation business means what? Sir, when I buy and sell something online without physical delivery. Okay. This can be carried forward for maximum 4 years. Any other loss? 8 years. So remember this 3. Any other? 8 years. That's all. Other points on losses. Unobserved depreciation can be set off against any head. Actually, it is not a loss, guys. Unobserved depreciation means, sir, when the profits of the business was not sufficient for recovering the depreciation, then what you do? Depreciation, you keep it as a last line item. First, charge all the expenses. If you already have loss, we call that as business loss, which has a limited life of 8 years. Whereas unobserved depreciation, keep it as a separate item, which you can carry forward for any number of years, and you can adjust it against any head except salary. Except salary, guys. Hope you guys got it. So whenever you have a possibility of loss, keep the depreciation at last. At last. So unobserved depreciation can be set off against any head except salary, and against casual income you cannot adjust any loss. What? Then loss under the head income from other sources cannot be carried forward for further years except loss from activity of owning and maintaining resources. Then no loss can be adjusted against casual income taxable under section 115 BB or BBJ, new section with respect to what? Online gaming. And undisclosed income taxable under section 115 BBE, guys. Okay, means you have undisclosed income, you cannot set up any loss against it. It is taxable actually at the rate of 78%. Undisclosed income 60 plus surcharge plus cess. So effectively the rate is 78%. Then loss from a source which is exempt cannot be set off with taxable income. Sir, agriculture income is exempt. Now, sir, due to low rainfall or heavy rainfall, both are a problem for farmers actually. Clear? So now, sir, due to low rainfall or heavy rainfall, a farmer suffered a huge loss. Now, agriculture loss, can he set it off against any other income? No. If there is any income which is exempt from the same source, if you have suffered loss, then that loss cannot be adjusted against other taxable incomes. Loss return shall be filed under section 139 subsection 3 within the due date mentioned under section 139 subsection 1 to claim the benefit of carry forward of losses. If you want to carry forward your loss, you have to file your loss returns. The exception is house property loss and unobserved depreciation. Even if you have not filed it within due date, still you can carry forward it. Then impact of default regime. Impact of section 115 BAC on this chapter, guys. So following brought forward losses or depreciation is not allowed to be set off while computing total income under default tax regime under section 115 BAC. Simple, always know the logic, guys. Brought forward, please listen. Brought forward loss from self-occupied house property. If you have loss from self-occupied property, you can carry forward and adjust it against income from house property. But when will you have loss under self-occupied property? Because you have interest. What will lead to a loss of self-occupied property? Because of interest under section 24B. But under section 115 BAC default scheme, now interest on self-occupied property is blocked. So if you have any loss, not now, related to some other year, please leave it there and if you are now entering 115 BAC, come fresh. Don't bring that loss. Why? Because that loss is relating to interest which is blocked under section 115 BAC. Same way, brought forward specified business loss under section 35 AD. Guys, under default regime, 35 AD is blocked. Means even though I am doing specified business, I cannot claim deduction under section 35 AD for my capital expenditure. What can I do? Add it to the block and claim depreciation under section 32. Okay, na? Now, sir, in the past I have already claimed 35 AD deduction. I have a huge loss, sir. Now from this year I want to enter 115 BAC default scheme. Can I come, sir? You can come, but leave the loss and come. Because that loss is again relating to what? A deduction which is blocked under default regime. Next, brought forward business loss on account of deduction under section 35(1), 2, 2A, 3 or 35(2AA), contribution to outsiders, scientific or any other research, statistical and all. So if I have contributed to others, sir, I myself is doing research, I can claim both revenue and capital except land. I am contributing to someone else, even though it is not connected to my business, still it was allowed under PGBP, but it is not allowed under default regime. Under default regime. Now, sir, I have a business loss. Come on, guys, please pay attention. I have a business loss of 10 lakh. I have a business loss of 10 lakh. Why? Because find out the reason for loss. Last year, I had contributed under section 35 for someone else 5 lakh. I had claimed a deduction for 5 lakh. So I have a loss, sir. Plus my business loss also 5 lakh. So in this 10 lakh, how much I can carry forward is only 5 lakh. Remaining 5 lakh, thank you. Why? Because this loss was relating to the contribution made to the outsider, which is blocked under default regime. When it is blocked, you don't carry forward that loss relating to it. Clear? Sir, entire 10 lakh is due to that, sir. Don't carry forward anything. Don't carry forward anything. Next, unobserved depreciation attributable to additional depreciation under section 32(1)(2)(a). New plant and machinery installed in factory for the person who is engaged in manufacturing or power sector. Yes, sir. Now what is it? Sir, guys, assume totally I have unobserved depreciation 5 lakh. In that, due to additional depreciation, it is 1 lakh. And normal depreciation 4 lakh. Totally I have unobserved depreciation. Now, normally unobserved depreciation means I can carry forward and adjust it against any except salary and casual income. Yes, sir. But now what they are telling is, see, under default regime, additional depreciation is blocked. You cannot claim it. Even though you are a manufacturer, even though the new plant and machinery you have installed in factory, still you cannot claim it. Only normal depreciation you can claim. Now, when you are coming to default regime, if you have an unobserved depreciation relating to additional depreciation, please leave it there and come. Please leave it there and come. You can maximum carry forward how much? 4 lakh. But this 1 lakh will be added back to the block. Will be added back to the block because already you would have reduced it from the block now. Clear? While calculating depreciation under section 32, written down value for the purpose of depreciation minus depreciation under section 32. Depreciation under section 32 includes both normal depreciation as well as additional depreciation. Yes, sir. So I would have already reduced here. So they are taking back that benefit from me. Yes. So what should I do? Add back 1 lakh to the block. So on that, I can start claiming or continue to claim normal depreciation, even if I am under default regime. Is that clear? Yes. Next, current year house property loss cannot be set off against other rates of income, guys, which we already seen. Actually, the loss things I have covered it advice also. Now we have seen it as a separate chapter as well, guys. Many students get confused with this loss treatment and all, and moreover now under default regime they have made more confusing. First of all, it was confusing. Okay, now after bringing this default scheme under, they have blocked few things which is more confusing now. So please make sure that, guys, only this 2-3 pages if you just go through, only 2 actually, it will have more clarity for you. Let us move towards the deductions chapter. Deductions from gross total income, chapter 6A, section 80C to 80U. Guys, there are 2 types of deductions under income tax law. One is under the respective head while computing the income under the respective head. The second one is deductions under chapter 6A. Deductions under chapter 6A you can claim irrespective of what income you have. But you should have income. Only if you have gross total income you can claim deduction. Sir, no gross total income, sir. Can I claim deduction? Against what will you claim? What will you claim? I don't have any figure. So, for claiming gross total income, for claiming deductions against gross total income, your gross total income should be a positive figure. Now, sir, I have a gross total income 3 lakh. How much maximum deductions I can claim? 3 lakh. Sir, I am eligible for 5 lakh deduction, sir. Still 3 lakh. Sir, remaining 2 lakh, can I carry forward, sir? No. Deductions and all you cannot carry forward. So deductions are given in order to reduce the tax burden to the assessees, guys. If they want to plan their tax, they can reduce their tax liability by availing various deductions. And deductions under chapter 6A is given from section 80C to 80U. Various deductions are there. Few are income based deduction, few are investment based deduction, few are payment based deduction, few are donation based deduction, few are contribution based deductions. Clear? So under each section they have told deduction is available for whom? For what? Maximum how much? These 3 mandatorily you should remember. Which are those? Deduction is for what? What you should do? Payment, income you should have earned, or contribution. Then deduction for whom? Individual, HUF, only resident individual, or any assessee, like that. And majority of the section has maximum limit. You should know that because many other times they will test on that. Clear? Yes. So till now we have covered till here, guys. Hope you have also done along with me. Yes, sir. Now income, each head of income we have covered, and if at all if there is any income which is exempt, we will claim the exemption under the respective head. Yes, sir. Then clubbing we saw. Clubbing will always get attracted under other sources. Then set off and carry forward of losses. See guys, I have given it separately here. Doesn't mean that you will do like this in the exam. Okay, because in between if I start giving a set off of loss, and the format doesn't look good. But you know, the set off of loss should always be either intra-head or inter-head, under the respective head or against the other head, provided it is a current year loss. Clear? Please adjust then and there only. Okay, then we derive a gross total income. Against that, we can claim chapter 6A deduction, what we are learning now. So, and against chapter 6, against gross total income, we can claim two deductions. One is chapter 6A deduction, another one is 10AA deduction. 10AA is what deduction? SEZ. From my export business, whatever profit I have made by operating in SEZ. Guys, what you have to do is, if you are eligible for 10AA, first include the profit, entire profit, whatever you earned under that PGBP. Then you will claim deduction here, 10AA deduction. But deduction is only with respect to export profit for the first 15 years. First 5 years, 100%. Next 5 years, 50%. Last 5 years, 50% of eligible profit or the amount which is transferred to SEZ reinvestment reserve, whichever is lower. Okay, so I have already told maximum deduction you can claim under chapter 6A is gross total income. Maximum deduction you can claim is gross total income, guys. Next, so chapter 6A deductions cannot be claimed against special incomes. What are those, sir? Capital gains special income, any capital gains special income, and casual incomes. Okay, so if your gross total income includes that, for example, sir, my gross total income is 20 lakh. In that, long-term capital gain is 5 lakh. Casual income is 3 lakh. Other income is 12 lakh. In that case, what is the maximum deductions I can claim? 12 lakh. What is the maximum deduction I can claim under chapter 6A? 12 lakh. Okay. Next, as per section 80AB, deductions specified in chapter 6A under the heading C, deductions in respect of certain incomes shall be allowed only to the extent such income computed in accordance with provisions of Income Tax Act 1961 is included in the gross total income of the assessee, and the return of income is filed on or before the due date given under section 139 subsection 1. There are few income based deductions, guys. So when you are claiming income based deduction, first include that income under the respective head, whatever income you have earned, and then claim the deductions, and then claim the deduction. And deduction is available only if you have filed return within the due date of filing the returns. Only for part C. Part C includes what, or heading C includes what? The income based deductions. Only if you have filed your returns within the due date, you are eligible to claim it. Sir, I have income based deduction, I am eligible, sir, but I couldn't file my returns within the due date, sir. You have to include it in the income, but no deductions. But no deductions, guys. Okay, let us see the deductions one by one. Be extremely attentive now. So I have tried to cover in short whatever is possible. ATC. ATC is one of the major deduction where majority of the people are dependent on, guys. ATC, ATD and all. So ATC deduction is available only for individual and HUF. For what and all, sir? Lot of components are covered. Some important things I have given here. Life insurance policy premium, deposit into PPF, that is public provident fund or statutory provident fund or recognized provident fund. Whose contribution? Employees contribution or assessee's contribution. Then Sukanya Samruddhi account, pension fund set up by any mutual fund, fixed deposit for at least 5 years, senior citizen savings schemes, tuition fees paid, principal repayment of housing loan subject to certain conditions. Then stamp duty, registration fee, etc. We call it as like investment, deposit or contributions made. Maximum deduction under section 80C is 1,50,000. Maximum is 150. Sir, I have contributed only 80,000, sir. You can claim only 80,000. If you have contributed 10 lakh, you can claim only 1,50,000. I have also given one diagram for it, like which will give just a glimpse of whatever is covered in 80C, guys. You can just have a look into it later. Yeah. Next, 80CCC. Sir, CC is not there, sir. No, CCC. Individual available for only individual, and whenever it is only individual, any individual, guys, whether resident or non-resident, doesn't matter. Okay. Contribution to pension fund of LIC or any insurance company. Okay. Here mutual fund is there. Please be careful. Don't get confused. Whereas here LIC or any other insurance company. Okay. Maximum deduction is 150. Then ATCCD subsection 1. Individual. Available for individual. For which contribution? Employee or assessee contribution to National Pension Scheme, NPS or Atal Pension Yojana of the government. How much is the deduction? If you are an employee, then 10% of the salary maximum. Or if you are a self-employed person and all, you can still open the NPS account and contribute. In that case, 20% of your gross total income. If you are not in employment, if you are opened it outside. Okay. So all these three put together. Within the section there is a limit. ATC 150, ATCCC 150 and ATCCD subsection 1. 10% of salary or 20% of gross total income. But all this put together, they are telling in section ATCCE, maximum 150. Maximum 150. Okay. So section wise also you have to check, aggregate also you have to check. So all these three put together, you cannot cross 150, even though you have invested. Next, ATCCD subsection 1B, additional deduction for assessee contribution 50,000. This is over and above 150. This is over and above 150. Means totally you can claim for your contribution how much? 2 lakh. Clear? 150 above and 150,000 year. CCD subsection 1B. Bonus. B means what? Bonus. Bonus 50,000. Okay. CCD subsection 2, employer contribution. Okay. So employer contribution to NPS. Contribution by central government or state government. Means if employer is central government or state government, they are the one who started, but later they made it open to everyone. NPS schemes. Okay. If central government or state government are the employer, maximum the employee can claim for employer contribution how much? 14% of the salary. Okay. Then contribution by any other employer, means private employers who is not central or state government. Then for them, employee can claim how much? 10% of the salary. But for employer contribution, first include it in the salary income and then claim the deduction here. Clear? This is for only for NPS. Whereas for RPF and all guys, exemption is given under salary rate only. No deduction. Exemption is given under salary rate only. Statutory provident fund fully exempt. Recognized provident fund means employer contribution up to 12%, interest up to 9.5% of interest. Unrecognized, nothing is exempt. And for unrecognized, here also deduction is not given. Then CCH2, new section, Agnipath scheme, available for individual whom we call Agniveer. Assessee's contribution and central government contribution both can be claimed as deduction here. Sir, limit sir? No, whatever they are contributing they can claim it. But employer contribution, who is the employer here? Central government. Sir, any other private people? No. Okay, here mandatorily who is the employer? Central government. Clear? So central government contribution first include it under the head salary and then claim the deduction here. Whatever is the amount. No limit, no percentage, nothing. Okay. Then ATD, again one more important section. Many of the people get confused with this, so please be attentive. Guys, ATD gives deduction for 2 payments. Medical insurance premium, not life insurance, medical insurance premium or health insurance premium, one and the same, or Mediclaim we call. Everything is one and the same, guys. Whatever premium we are paying for the health insurance policy taken in the name of assessee and his family. Family here includes spouse and dependent children. In case of HUF, any member of HUF. Okay. Or parents, both father and mother. Assessee's parents, please be careful. Now, for assessee and family, all put together, you can claim maximum 25,000. And for parents, both father and mother put together, maximum 25,000. If they are paying less than that, only that much. Maximum is, that is the maximum limit. Okay, sir. And then this 25,000, up to 5,000 can be incurred for preventive health checkup, which can be incurred in cash. But premium cannot be paid in cash. If you pay it in cash, thank you, no deduction. So please be careful, 25, but in that 5,000 is for preventive health checkup. Okay, sir. Now, if any of the person in whose name the policy is taken, if he is senior citizen, that is 60 or more, in that case, instead of 25, the limit is 50. The limit is 50. Now, sir, assessee himself is, say, for example, health insurance policy is taken in the name of assessee and spouse both. But only assessee is senior, sir. Claim 50, no problem. Sir, assessee and spouse both are less than 60, sir. Obviously, children also less than 60. So, maximum they can claim is 25. And here, parents, one of the parent is senior citizen, 50. 50. Okay. Next, medical expenditure. Medical expenditure is given as deduction only if you are incurring out of your pocket. Out of your pocket makes sense. How is it? Means, see, if you have taken the policy in the name of a person, if they are taking any treatment, who will pay the amount? Insurance company. Agree na? So what they are telling for this deduction is, if the person for whom treatment is taken, in his name, if already policy is there, we are not giving deduction for medical expenditure because you have taken benefit the other side. Here you have already taken the benefit, so this side we will not give it. Clear? So medical expenditure is allowed as a deduction only for those person for whom medical insurance policy is not there, plus their senior. Who? Assessee alla. Patient is a senior. 60 or more. Patient, please be careful. Sometimes they will confuse you. Telling Vikas, aged 30 years. And they will continue the story. For a parent who is aged 65, he has incurred a medical expenditure. Will you give deduction? Yes, please be careful. Here the age is not of assessee, it is of patient. Medical expenditure. Assessee and family, here family again same story, spouse and dependent children. Maximum 50,000. Patient should be senior. Okay. Then parents, maximum 50,000. Maximum 50,000. So treatment is only for resident senior citizen for whom policy is not taken. Not taken. Please be careful, guys. Because in that case, insurance company will pay the money. So anyway, you are not giving out of your pocket. Why should I give for you? Is what the department is questioning. Okay. Yes. Chalo. This is what. And then preventive and checkup can be paid in cash, whereas premium or expenditure cannot be paid in cash. Then one more twist is there. This is the individual limits, guys. This is the individual limits. Now listen. Sir, assessee is covered here. Okay, na? And parents might be covered here. Yes. How much he can claim? If he is normal person, 25,000. If he is senior, 50. Parents, obviously, when he is senior, definitely parents also will be senior. So 50,000. Clear? So here 50, there 50. Clear? Next. Sir, assessee is covered here. Whereas spouse and children are covered here. How much they can claim? How much they can claim? Assume spouse and children within 60. So 25,000 we can claim. Agree, na? And assessee senior you assume. In that case, how much we can claim? 50,000. Agree? Yes, individually. But there is one more twist. Telling both premium and expenditure put together for assessee and family, you can maximum claim 50,000. Maximum. They are telling limit. You can claim less than that also if your actual expenditure is less than that. Same way for parents both put together maximum 50,000. Sir, how is it possible? I will give one more example. Assume guys, mother is covered here. Policy is taken. Okay, less than 50 or more than 50. Less than 60 or more than 60. Let us take less than 60 only. How much we can claim? 25, sir. Father is covered here, sir. More than 60. We have incurred a medical expenditure. Maximum how much we can claim? 50. So totally for parents, how much it comes to? 25 plus 50, 75. Can we claim? No. For parents category, both put together maximum 50. Both put together maximum 50. This is all about ATD. Next, DD. So DD, when will you take policy? When you are scared of what? Diseases. Sir, what if I get that? What if that happens? This happens. Now, sir, now one news is going on. Whoever took Covishield are scared. Covishield. You know na what they have announced and that. So people are scared. Don't worry. Whenever it is time, we all have to go. Okay. Because in that tension only we should not lose our life. Okay. So sir, I am scared. Now I want to take policy. Yes. So when people are scared about diseases, they take policies, health insurance policy. When they are scared of death, they will take life insurance, ATC. Okay. When they care for their life. When they care for their near and dear ones. Because I might be gone. My near and dear ones should be independent. So what will I do? If I care for them, I will take life insurance policy for me, not for them, for me. Okay. So in that case, if I go, at least they will be independent. Clear? Yes. Try to remember like that. So ATD is like when you are scared of disease, guys. Next, ATDD, dependent is disabled. Sir, there is a person who is dependent on me who is disabled. In that case, if I am just taking care of them, or if I have taken any policy in their name and I am paying the premium, in that case, irrespective of the actual expenditure I have incurred, I can claim a flat deduction of 75,000. If the dependent is suffering from severe disability, almost gone but not gone, in that case, 1,25,000 flat, not 75 plus 125, 125 straight up. Clear? And here actual expenditure might be more or less, doesn't matter. Flat deduction. Okay. This is ATDD. ATU we will cover it. Here it is, which is read with together. When assessee himself is disabled, assessee, you yourself is disabled. Clear? But you are independent. in that case, you will claim deduction for yourself. You will claim deduction for yourself. Now, many US, they have everything, but still they look like disabled. Sir, we lost everything. We don't have anything. They have everything, but they are like, sir, what is there in our life? What is life? Okay, why we are doing this? Okay, what is there in life? Nothing more. At the end of the day, we all have to die. Still 2025. Already they are thinking about it. Huh. Chalo. Asasi himself is disabled and he is a resident. In that case, no one else should claim deduction for him, telling he is dependent. He is independent person. So in that case, he himself in his own return, he can claim 75,000 or 1,25,000 flat deduction. Clear? And one more thing, guys. In ATDD, now, sir, assume dependent means blood relative, not the person whomever you want and come take them and take care of them and claim deduction. No. Sir, I was going in the road, some person was there disabled, I took him to the home, I am taking care of him, so can I claim that deduction? No. Thank you for your service. Yeah.
What about the people being there on?
That also. Only blood. Only blood. Obviously, when I am going in the road, I will tell I am adopting him only. Okay. Yeah. So, no adopting and all. You can do it, but deduction is not. Okay. Great service. As a service, yes. Yes. ATDD. Guys, assume a person is dependent on me and is disabled. I have taken a life insurance policy in his name and paying premium. And the person gone. And I had named myself as nominee. Now, when policy matures, can I claim exemption under 1010D? No, I cannot. I cannot claim exemption. You have already enjoyed enough benefit when the person was alive. Now you cannot take any benefit. ATDDB, specified diseases, available only for resident individual and HUF. Medical treatment of specified disease for associate and dependents. What is specified disease and all? You need not worry. Actually, it is mentioned in the rule. Deduction is maximum for actual expenditure of 40,000. Or if the patient is a senior citizen or super senior citizen, 60 or more or 80 or more, then 1 lakh or actual expenditure, whichever is lower. But if any amount is recovered from insurance company or any amount is paid by employer and all, we will reduce it, guys. First, you will take actual expenditure or 40,000. Assume is less than 60 patient. So whichever is lower, 40,000. From this, if anything is recovered, we will reduce it. Recovered from whom? Employer or insurance company. We will reduce it. After reducing it, if this figure is still positive, only that much deduction can be claimed. Next, ATE for the most important thing any person should have is education. If you have right education, it will take care of you throughout your life. Mark my words. Education, money will come and go. Assets will come and go. Relationship will come and go. But education and qualification, hey, get it. Education, what you have, relationship and attraction. Not you, behind you. Education or qualification will be with you until you are there. So try to grab how much ever is possible, guys. That will take care of you. I am telling you, if you take care of this youth and try to get maximum, how much ever you want. Sir, CS is the end. No, even after that you can set a high standard and do something. Foreign course or whichever course you want or certification. Set always high standard. Be on the top. Don't be just that normal person. Okay, there are a lot of normal people already. Crores together. You be extraordinary. Okay, you will stand out, guys. And you mark my words, you can change the fortune of your entire family if you have good education. That is very, very important. So this is the right time for you. Time may not come again. Sir, I will study after 30, after 40. No. The level of concentration what you have now will you not have it later. Same way the support, the responsibility, you don't have any responsibilities what I believe as of now. The things will not be same after 5-6 years, guys, or even after 3-4 years. So please make sure that now you have nothing but studying. What else you have? Nothing but studying. Just focus on that. Try to get as much as possible. That is very, very important, guys. Okay, education. If loan is taken for, deduction is available for individual and loan is taken for the purpose of higher education. Higher education means +2. Sir, now parents are taking loan EMI system for nursery and all, sir. Nursery only lakhs together. So can they claim deduction for interest and all? No, only +2. Okay, Papa, government has to change now. Okay. Only for higher education, that is after +2. for any degrees, guys. So if that education is in India, sir, foreigns, I want to do in foreign, so I have obtained the loan and all, no deduction for interest. Okay. So maximum it is allowed for 8 years, but there is no monetary limit. How much ever interest only, not principal repayment. How much ever interest you are paying, you can claim in the maximum 8 years. Sir, even after 8 years, I am still repaying, sir. In that case, you need not claim deduction from 9th. Clear? Yes. Then section 80EA, individual can claim deduction here. Additional deduction for interest on housing loan borrowed between 1st April 2019 to 31st March 2022. The period is already over to borrow the loan. But if you have borrowed the loan during this period, you can claim the deduction even after this. So today you can claim deduction, but you cannot borrow the loan to claim deduction here. If you already borrowed in, like from 19 to 22, you can claim deduction even today. Okay. And for acquisition or construction only, no repairs, renovation and all. And of what? Residential house property. So maximum 1,50,000. Maximum 1,50,000. So 24B already allows you the deduction, but there for self-occupied property maximum is how much? 2 lakh. So what if I am paying more than 2 lakh? The remaining you can claim here. Maximum 150. So totally for self-occupied property 2 lakh under 24B and 150 here. Provided here time limit and all is there. Clear? Yes, sir. And stamp duty value of the property should be less than so and so limit. The conditions are there which you have to satisfy everything. EB is with respect to Bandi. B is for Bandi, that is vehicle. Individual, it is available for individual. Interest on loan taken for purchase of electric vehicle, not any vehicle, electric vehicle, 2-wheeler, 4-wheeler, whichever vehicle it is. Okay. During 1st April 2019 to 31st March 2023, maximum is 1,50,000. Again, only for interest, guys. So E for interest. All the E series is with respect to interest. It sounds like interest. Okay. G is for givers. Givers sleep well. Eat, takers or the person who is receiving it, they eat well. Okay. 80G, donations. Any assessee can claim deduction here. Donation to certain funds or charitable institution, etc. depends on the purpose and category. There are 4 categories, guys, A, B, C, D. But here you can give the donation not in cash. Up to 2,000 you can give in cash. More than 2,000 means you cannot give it in cash. Okay. Guys, there are 4 categories here. A, B, C, D. There are various funds covered under each category. Hope you guys are already aware of it. So each fund, especially A, is very important because a lot of nationals, prime ministers things are covered there. If you are contributed anything for the fund covered under A, 100% deduction. For B, 50% deduction. For C, 100% deduction subject to limit. For D, 50% deduction subject to limit. So let us take now for figure. I have contributed for each of this 1 lakh. For each of this 1 lakh. How much deduction I can claim? How much deduction I can claim under section 80G? 1,50,000. Okay na? Yes. So aggregate this 2 lakh. C and D put together how much? 2 lakh. We have to compare that with what? 10% of adjusted gross total income. Sir, what is 10% of adjusted gross total income? What is that adjusted gross total income? Gross total income, reduce all the deductions from section 80C to 80U except G, because G we are doing it now, and capital gain special income, you reduce it. Whatever figure you get is called adjusted gross total income. Take 10% of it. Let us imagine adjusted total income or adjusted gross total income is 2 lakh. So 15 lakh is 15 lakh. So 10% of that comes to 1.5 lakh. Yes, sir. So compare that. Whichever is lower. 1.5 lakh. Whichever is lower. Yes, sir. Now how much deduction I can claim for C category, D category? For C first you dedicate full. So C, how much you have contributed? 1 lakh. Do you have so much money? Yes, more than 1 lakh I have. Dedicate full. 1 lakh. Then remaining is how much? 50,000. Dedicate it for D. But for D, 100% deduction? No, only 50%. So 50,000 is the remaining amount. Sir, how did you get it? 1 lakh, 1.5 minus 1. 1 we already given for C, na? That is why. Okay. Into 50%. 25,000. 25,000. Okay. Now let me change this number. Sir, what if this is 8 lakh? So you will get only 80,000? Yes, sir. So now this figure, 2 lakh or 80,000, whichever is lower. 80,000, Okay. So you will dedicate entire 80,000 to what? C category. D category. Thank you. No deduction for D category. Sir, I contributed, sir, but you are not eligible to claim deduction. Clear? Yes. Yes. Next, GG. Rent. And here GG is available for a rent paid if you are not receiving HRA. If you are receiving HRA, obviously you will claim HRA exemption under 1013A. And GG deduction is also only if you are paying rent. If you are staying in your own house, no deduction. So it is available for individual for rent paid. Least of the following is exempt. Actual rent paid minus 10% of adjusted total income, 25% of adjusted total income, or 5,000 per month. That is 60,000 per year. Provided you are paying rent for all the months. If you are paying only rent for 6 months or 8 months, accordingly it will be into 6 or 8. Same way, even adjusted total income you have to take only for that period. Only for that period. Normally adjusted total income is for entire year. If I am staying in rented house, you have to do proportionately. Like 6 by 12, 8 by 12 that you have to do. Okay? Yes. And here also adjusted total income means same guys. Same like ATG. But here it is after all the reduction from ATC to ATO except GG. Then GGA. Any assessee, certain donations for scientific research, social science or statistical research or rural development or national urban poverty eradication fund. Guys, this assessee should not have PGBP income. If he has PGBP income, you would have claimed under that PGBP one. Clear? Any assessee not having PGBP. Not having PGBP. Okay, sir. Then he cannot contribute more than 2,000 in cash. Okay. How much ever he is contributing, he can claim deduction. Under what? Not PGBP in deductions chapter. Chapter 6A, deductions. Then political GGB and GGC. If Indian companies are contributing to any political party or electoral trust, not in cash, not even 100 rupees they can give in cash. 2,000 limit is not there for this. Only 2,000 limit is there for ATGGA and G. Up to 2,000 you can give it in cash, not more than 2,000 for G and GGA. Whereas for GGB and GGC, no cash. Okay. So GGB, Indian company contributing to political party or electoral trust can claim 100% of the deduction, whatever they are contributing. Then GGC, any other person like you and me, individuals or other than company, they can claim deduction for any political contribution or electoral trust, 100% of whatever they are contributing, but it should not be in cash. Sir, political contribution need not be direct also. For example, sir, I am incurring some expenditure which is contributing as a support to a party. Can I claim it as political contribution? Yes, I am printing a pamphlets and giving to them, sir. What is the achievements in last 5 years? Or what will they do if they come to power? I am printing the pamphlets and giving it. Can I claim it as political contribution? Yes, you can claim it. Next, income-based deductions, guys. Everything I have not covered here. Few important things. Income-based deductions. ATJJAA. Assessee engaged in manufacture. Actually, this is not income-based deduction, but it is falling under income-based deduction. But here deduction is given for the salary paid to new regular workman. Clear? To promote employment opportunities. Okay. Assessee engaged in the manufacturing business, guys. So obviously he is having PGBP income. For whatever salary he has paid for all the workers, he would have claimed deduction under the head PGBP. No condition there, no regular, no casual, nothing is there under PGBP. But here they are telling, if you have appointed new regular workman who has worked during the previous year for more than 240 days, 240 or more, in that case we treat them as new regular workmen. Sir, what if it is less than 240? Then the exceptions are there for leather products, apparels and all, where the number of days are less. You can treat them, if they worked for less than 240 days during the previous year, you can treat them as new workers for next year, guys. Okay. And new regular workmen will not include like casual labor, contract labor and all. Okay. So whichever new regular workman you have appointed during the previous year, whatever salary you pay for them, you can claim 100% deduction under PGBP. Plus 30% of whatever salary you pay for them, you can claim it as a deduction for 3 years under section 80JJAA. 80JJAA. You can see 30% of additional employee cost for 3 years. So totally the person who is creating the employment opportunity will get how much deduction? 190% for whatever salary they are paying. This government is ready to lose because they want to create the employment opportunities. That's all. Clear? Yes, because obviously you have incurred 100 rupees, means they are giving deduction for 190 rupees. Clear? Yes. QQB and RRB talks about the royalty income. QQB, resident individual available for royalty income of author or joint author of any book other than textbooks. Any book other than textbook. So normally in books, what will be there? Questions. QQB. Okay, other than textbook. Normally in textbook questions would be there, but believe any book questions would be there. So QQB. Maximum deduction is how much? 3 lakh. Then, sir, RRB, resident individual, royalty income of a patentee who is registered, means who is the innovator, who is registered as the true and first inventor in respect of invention. When will I take patent, right? When I have done some research. I have innovated something. R for research. Okay. What is the maximum deduction? 3 lakh. Okay. Next, TTA, TTB. Now, TTA, TTB to be studied together, both gives deduction for interest, but not for the same associate. So, TTA is giving deduction for individual and HUF for interest on savings account deposit with any bank, cooperative society or post office. Sir, I have kept savings account with my father. He is giving me the interest. Can I claim deduction here? No. So, maximum is how much? 10,000. Whereas TTB available only to resident senior citizen. Interest on any deposit, any. Whereas TTA is for savings. Okay. With whom? Bank, cooperative society or post office. Maximum 50,000. Sir, can same person, I am a senior citizen, can I claim under both TTA and TTB? No. Only TTB. Sir, I am a regular person, means less than 60. I can claim only TTA, but only for savings interest. Sir, I am aged, less than 60. I have interest on FD or RD. Can I claim deduction? No, you cannot. But it is taxable, but no deduction. Sir, I am more than 60. I have interest on savings, FD, RD. Can I claim deduction? Yes, provided you have with bank, cooperative society or post office. Clear? But senior citizens can claim only TTB, but not TTA. Both we cannot give it. Okay, sir. Next. One more thing, guys. Now for post office, exemption also is there. Exemption also is there. Now assume, sir, I have a savings account with the post office. I have earned 15,000 interest income. Where is it taxable? Other sources. So 15,000 fully will be included? No. 15,000 minus 3,500. Remaining is how much? 11,500. Clear? So obviously this will be a part of my gross total income. Now under section 80 TTA, how much deduction I can claim? Assuming I am not senior. How much deduction I can claim? 10,000. Clear? Yes, same way. Sir, I have a savings account in the post office and I have earned an interest of 8,000. 8,000. So how much is taxable? 8,000 minus 3,500. Exemption is available. Exemption is available for 3,500. How much is taxable, sir? 4,500, which will form part of gross total income. Now under section 80 TTA, how much deduction I can claim? 4,500. How much interest is included in gross total income? Only that much you can claim. Sir, I have other income, sir, salary, house property and all. I can claim against that? No. Only what is included here, you can claim here. Hope you guys are clear. Sir, what if I am a senior citizen, sir? Still, whatever interest you have, you can claim it. Now I am a senior citizen. Interest on post office is 40,000. 40,000. Exemption is how much? 3,500 for individual account. Joint account means 7,000. Obviously, joint means at least 2 people will be there. So, 36,500 income from other sources. Okay. Then deduction under section 80 TTB. I am a senior, na? Resident senior. Sir, I am a non-resident. You cannot claim TTB. Please be careful. So, how much, sir, maximum? 36,500. 50 is available, but I have only 36,500. Only I can claim that much. And many a times this will be hidden information in the question, guys. Please be careful with TDA and TTB. And nowhere they will tell, please, you are supposed to claim deduction, please claim it. In the question, they will just give the data. You have to catch it and implement it in your answer. ATU we already done with. Now coming to the impact of 115 BAC default regime. Very simple, very easy. Sir, if individual HUF, AOP, BOI are artificial juridical person, if they are following default regime under section 115 BAC, for them in chapter 6 only 3 deductions are given. Under chapter 6 only 3 deductions are given. Rest all blocked. Which are those, sir? CCD subsection 2 employer contribution to NPS. Yes. Then CCH subsection 2 employer contribution, that is central government contribution to Agnipath scheme. Yes. And ADJJAA, that is employment opportunities. Clear? Only these 3 are allowed. Rest all blocked. Next, for a resident cooperative society who is following optional regime under BAD or BAE, same story. For them only one is allowed. Why? Because these two are allowed for individuals. Cooperative society is not individual. So obviously that is not available for them. Yes. So maximum they can claim is only 80 JJAA. That's all. 80 JJAA. This is all about the deductions chapter, guys. Yeah, fine, guys. So now we will revise chapter 11, which covers the top 3 topics, that is TDS, TCS and advanced tax. 3 important topics. Out of these 3, the most important one is TDS. So first, in single chart, we will try to understand the concept of TDS, and then we will go through on what payments TDS has to be deducted and at what rate. Who has to deduct it and from whom. First, payer, whenever he is paying any expenses, guys, he has to check what he is paying. Is it covered under TDS provisions? That is he supposed to deduct TDS? If yes, before paying the amount, he has to deduct the TDS. He has to deduct the TDS at whatever rate is applicable on the respective payment under the respective section and remit it to the government within 7th of next month. Within 7th of next month with a standard date for TDS remittance. Now assume I am paying 1 lakh to the payee. I am supposed to pay, on which TDS applicable is 10%. Okay, so how much I am supposed to deduct? 10,000. So I will pay how much to the recipient or payee? 90,000. Now 10,000 whatever I have deducted, I have to remit it to the government within 7th of next month. And payee will receive only 90,000. But while computing the income of the payee, he has to consider entire 1 lakh as his income. As his income. Sir, what about 10,000 Govinda? No. Now, when he is computing the income, he has to take care of this 1 lakh. Assume, guys, along with this 1 lakh, he has other income also, which is 9 lakh. So, his total income is 10 lakh. On which we have calculated the tax as per the respective scheme. I am just taking random figure. Assume the tax liability is coming to 1,20,000. Random figure. How and all, don't question me now. Okay. 1,20,000. So, will he pay entire amount to this much to the government? No. Whatever amount is already been deducted as TDS, TCS, or if he is liable to pay as advance tax, he will reduce it. As of now, we are covering TDS. So, we will reduce it. TDS, we will reduce it. How much, sir? Assume, guys, this may not be the only TDS deducted. Sir, 9 lakh whoever has paid also would have deducted TDS on my income. Yes. So, assume totally 70,000 TDS has been deducted on my income. So, remaining 50,000 I have to pay to the government. Remaining 50,000 I have to pay to the government, guys. Yes, sir. And 120 is including cess. Including cess. I have just taken the random figure, guys. Okay. Means what I meant to tell is we should always take the gross figure while computing the income of the payee. Even in the exam, in total income calculation and all, if they have given gross figure, always take it straight away. Sir, what if they have given net of TDS or after TDS? For example, assume Vikas has received the amount net of TDS 90,000 they have given. And sometimes TDS amount they may give or sometimes they may not give. When they are not given, you should know it. What is the rate of TDS applicable? Yes. Assume they are not given, but the rate you know that it is 10%. So how you will calculate the gross figure is gross amount is equal to net amount, which is 90,000 in my case, divided by 100 minus TDS rate. 100 minus TDS rate in percentage. That is net amount how much in my case? 90,000. What I have received. From that I have to calculate how much I have earned. How much I have earned is gross. How much I have received is net. Okay. Divided by 100 minus TDS rate is how much? 10%. So take both in percentage. So you will get how much? 90,000 divided by 90%. Simple, guys. Out of whatever I have earned, after TDS, how much I have received? 90%. So 90% of what I have earned, I have received. So 90,000 divided by 90% will give me how much? What I have earned. What I have earned. And please be careful, 10% is not always common. In my example, I have taken TDS rate as 10%. So payment to payment, it will vary percentages. So you should know in that particular payment what is the percentage applicable. So that is why I gave the formula. How to calculate the gross amount, guys? Come on. Net amount or the amount received divided by 100% percentage minus TDS percentage. Clear? Yes. Sometimes in the total income question, one of the twist might be this one. So please be aware of it. Okay, sir. Next, sir, this person will reduce TDS here. Now, what is the proof that he has paid? For that, payer has to give the proof of certificate telling, sir, see, I was supposed to pay 1 lakh for you. Government had asked me to deduct TDS under the respective section. I have deducted it and remitted to the government on so and so date. The payer has to give proof to the payee, and that proof will be in the form of Form 16, 16AA or 16A. Who will give to whom? Payer to payee. And also every quarter, payer has to file TDS quarterly return. He has to file TDS quarterly return with whom? With the government or department. Telling, sir, what all I have done during the month. Means what all payments only. What about your business and all, they don't care in TDS return. This is not income tax returns, TDS returns. So over the quarter, this is quarterly, guys. So in that quarter, assume April, May, June quarter, what all payments I have made, for whom I have made, their PAN number is what? PAN number is a unique number. And how much payment I have made, how much TDS I have deducted, under which section, when did I remit to the government, all these details I have to give in TDS returns to the department for a quarter. TDS deduction and remittance is monthly, but TDS returns is quarterly. Clear? Means whatever TDS I have deducted, assume in May, I have to deposit it to the government within 7th June. Within 7th June. 7th of next month is a standard date, guys. Whereas for last month of the year, that is March. For March, they will be busy in closing books of accounts and all. So they are told 30th April. 30th April. This is when the deductor is other than the government. If government office is only deducting TDS, they are deducting and putting to their own account. In that case, government office. In that case, it depends what they are deducting TDS. Are they depositing with income tax challenge or without income tax challenge? Depending upon that, due date would be there. Okay. Next, sir, why should payer do so much? What are the 4 responsibility of the payer? He should check whether the payment is covered under the TDS. If yes, he has to deduct it, remit it to the government within 7th of next month. If not, from 8th, interest will start. Okay. And file TDS returns with the government and also issue form or certificate to the payee. If he doesn't do this, then he will be called as assessee in default and is liable for all the consequences. He has to give TDS out of his own pocket along with the interest. And penalty also will be levied. Plus, he can also get free boarding and lodging in the form of imprisonment. Plus, in addition to that, whatever expenses he has incurred will be disallowed. If the payment is made outside India or for a foreign company and all, in that case, 100% is disallowed. Or if the payment is made to a resident, then 30% is disallowed under the 8 PGBP. If it is not deducted or else deducted but not remitted to the government within the due date of filing income tax return, not TDS due date, filing income tax returns. Please be careful. 40A1 and 1A talks about due date of filing returns, not due date of TDS. Okay, this is a summary of the TDS, guys. Now let us see, sir, on which payment TDS is applicable. Clear? Guys, in my regular classes, we have covered in detail. Here, whatever is important, only those columns I have taken. So please be aware of it. So 192 covers salary payment. Whenever employer is paying to the employee salary, which includes allowances, perquisites, everything, employer will ask the employee at the beginning of the year only, sir, if you have any investments, deduction eligible and all, please submit the information. Based on that, employer will calculate the tax of the employee, income and also tax. And whatever tax is supposed to pay every month from the salary, the employer will be deducting. Here there is no fixed rate, depending upon what is the salary income of the employee and how much deductions he is claiming, everything. How much is his total tax liability? Na? On an average, that would be deducted from his salary income. Okay, and while calculating salary, all the exemptions, deduction, whatever the employee is eligible for, everything will be taken care. Sir, what if the salary income is less than 5 lakh or less than 7 lakh or less than basic exemption limit? TDS would not be deducted. Even if employee is eligible for rebate, TDS would not be deducted. Then 192A, premature withdrawal from EPF, that is Employees Provident Fund. If it is withdrawn, recognized Provident Fund within 5 years, unrecognized Provident Fund, fully taxable whenever you are withdrawing it. Yes. So aggregate payment is more than 50,000. TDS is 10% when it will be deducted at the time of payment. Next. 193, interest on securities. Securities includes bonds, debentures and all, not shares. See, securities include shares, but on shares you will not earn the interest. Okay. What is the threshold limit? Guys, wherever threshold limit is given, if it is crossing such amount, means the amount what I am paying in a year, wherever the threshold limit, see, if there is any exception, I will mention it in that respective section. If not, wherever threshold limit is given, assume it is per year. And if the payment amount crosses the threshold limit, on the entire amount, TDS has to be deducted. Clear? Not only in excess of, entire amount. Okay, but there are certain exceptions for this. Under the respective section, I will highlight it. Okay, more than 10,000 for 8% or 7.75% savings taxable bonds, and in case of other like interest on debentures by a public company to a resident individual. Who is the debenture holder? Resident individual or HUF, which is paid through account pay check. Then the threshold limit is 5,000. In any other case, there is no threshold limit. Clear? Yes. What is the rate of TDS, sir? 10%. When TDS has to be deducted? At the time of credit or at the time of payment, whichever is earlier. Sir, what is this credit payment? Guys, listen. There can be two types of transaction. You know, na, cash transaction, credit transaction. Cash means literally payment is made immediately. Sir, actually what people believe is cash transaction means literally cash is paid. No. Even if you are paid through bank, we don't call it as bank transaction. We still call it as cash sales, or the expenses is paid immediately. Yes. Now, there are two kinds of transaction, guys. Assume, sir, I have paid immediately. So what would be the entry in my books? I am the payer. Who am I? Payer. So in my books, if I have paid the expenses immediately, what is the entry I will pass? Expenses account debit to bank or cash. To the extent possible, always we will use bank because we know there is a surgical strike on cash. When it happens, sir, it is keep on happening in the income tax law. Because there is a threshold limit, you cannot pay more than 10,000 in a cash to a single person single day. Okay, because there is no accountability for it. Okay, so assume this transaction happened on 1st October 23. So TDS has to be deducted on what date? 1st October. When it has to be remitted? Within 7th of November. Within 7th of November. Correct? Yes. This is cash transaction. Sir, what if it is a credit transaction? Assume, guys, on 1st October, I booked the expenses. I have incurred it, but I didn't pay immediately. Okay, good. Expenses to. Expenses account debit to payee. Payee. Correct? Because I am liable to pay. Until I pay is the liability in my books. I will show as the like credit or whatever name you give. Payee, I am using it as relevant to income tax. So we will show it as a liability in the balance sheet until I pay. Credit balance is there. Okay. Now assume I am making the payment on 5th November. 5th November. What is the entry? Payee to. I am cancelling the payee account. To what? Bank. To bank. In this case, when TDS has to be deducted? Whichever is earlier. Whichever is earlier. What is the date of payment, guys? Date of payment is 5th November. Sir, date of credit. Date of credit for whom? Payee. Means in the books of payer, on what day did I give credit to payee? Not credit in the bank account. Credit to the account of payee in my books. That is in journal entries. Clear up? Please don't get confused. Okay. I have given credit on what day? 1st October. When did I make the payment? That is credit to bank account. That is called payment. When did I give it? 5th November. Whichever is earlier, I have to take it. That is, hey, 1st October. 1st October. So in that case, when TDS has to be deducted? 1st October. Means in October. When it has to be remitted? 7th November. Now, sir, assume this is like 15th November, sir. I have not yet made the payment. When will I deduct it? In that case, give it out of your pocket and later deduct and keep it in your pocket when you are making the payment. Hope you understand. So on or before 7th November, give it out of your pocket, TDS, whatever amount is there. Later, when you are actually making payment, deduct it from the amount and keep it in your pocket. Clear? Sir, anyway, payment I am making on 15th November, so I will deduct on 15th November only and I will give it from 8th November, interest will start. If you are okay with it, you can do it. Clear? Yes. So not only this section, many sections has when TDS has to be deducted means the payment or credit, whichever is earlier. Everywhere this is the same thing, guys. Clear? And some sections has date of payment. So in that case, date of credit and all doesn't matter. Whatever date you are making payment, on that date TDS has to be deducted, like salary and all. Okay. Okay. This is common for all the section wherever date of payment and date of credit is there, guys. Okay. So 194 dividend. Dividend is earned by whom? Shareholder. Why? For investing in shares. Okay. So what is the threshold limit? More than 5,000 for individual shareholder. No threshold in any other case. Means if the shareholder is an individual like you and me, then 5,000 per company. Per company. Sir, I have invested in 60 companies. Okay. Now all company put together 5. No. Each company, because they are paying a dividend. When they are paying, if they pay more than 5,000, they will deduct TDS. Now assume, sir, Infosys is paying me a dividend of 10,000. Should they deduct TDS? Yes. On how much? Entire 10,000. Entire 10,000. Now, sir, ABC Limited, I have invested in Infosys. Infosys is paying them a dividend of 4,000. Should they deduct TDS? Yes. Because the shareholder is ABC Limited, who is not an individual. So if the shareholder is other than individual, there is no threshold limit. So the rate of TDS is 10% at the time of credit or payment, whichever is earlier. Then 194A, interest other than interest on securities like bank deposits, loans, advances and all guys. So what is the threshold limit? More than 40,000 in a financial year in case of interest is paid by bank, cooperative society or post office. Means the payer is the following people. Please be careful guys. If the payer are the following people, 40,000 is the limit. Sir, what if I am paying the interest for bank, cooperative society or post office? It is exempt. No need to deduct TDS. If I am paying, sir, I have taken loan from bank. I am paying interest in return along with principal repayment. So on interest, it is an income for bank. So obviously, should I deduct TDS on it? No. If bank, cooperative society or post office is a payee, the payer, whoever it is, they should not deduct TDS. But if they are the payer, they will deduct TDS. If payee is a resident senior citizen, limit is more than 50,000 in an above case. Why? Because they try to connect to ATTTB. Because for ATTTB, they can claim deduction up to 50,000. Yes. So they are told if the resident senior citizens are earning the income, interest income, any interest income up to 50,000, no TDS. If it is above 50,000, entire amount is liable for TDS. Then more than 5,000 in a financial year, in all other cases, TDS rate is 10% at the time of credit or payment, whichever is earlier. Then B, BA and BB is talking about casual income. All three sections. Rates is same guys. Rate will not change. So easily you can remember. Casual income other than horse race, because horse race is covered here. Actually other than horse race and winnings from online games, both. Other than this to all other things are covered in 194B. Okay. What is the threshold limit? More than 10,000. The TDS rate 30% at the time of payment. Then I will cover 194BB first. Winnings from horse rate, again casual income only. More than 10,000, 30% at the time of payment. Sir, why did they make two different sections? I also don't have idea, because both are casual, both rate is same at the time of payment. Threshold limit is 10,000. I don't know the purpose why they have made two different sections. Doesn't make so much sense, but still, for exam purpose, please remember the sections. Then BA, winnings from online games, which is a new section. BBJ, 30% we saw, new section. BA with respect to TDS on the same. Whoever is paying it, that is the organizer or the person who is running that platform or the mobile gaming platform. Winnings from online games. So here the threshold limit is different on the net winnings, entire net winnings in a person's user's account. What is the TDS rate? 30%. When? At the end of the financial year, if you are not withdrawn the amount. Sir, in between the year, I am withdrawing the amount from the account. In that case, when you are withdrawing, the payer has to deduct it. Sir, at the end of the year, still the amount is there. Sir, next year I want to earn more, so I have kept there only. In that case, at the end of the year, the person whoever is organizer, he will deduct it. He will deduct TDS guys. So 30% everywhere. But please be careful. This is important and bit different also. Guys, easy. Casual income somewhere connected to B. Betting and all. Clear? B is all about betting. So 115 BB talks about casual income. It is taxable at 30% under the head other sources. Then one more new section they have added now, BBJ, that is for online gaming. So there also they are telling 30% is the tax rate. Where is it taxable? Other sources. You cannot claim any expenditure, you cannot claim any loss, you cannot claim any chapter 6 deduction, you cannot even adjust basic exemption limit guys. Clear? So tax rates are given under this section, whereas TDS rates are given under section 194B, BA or BB. Clear? Yes. And casual income. So CB somewhere connected. Next, C, contractor. Payment to contractor. C for contractor. So if payment is made to resident contractor, whoever is making the payment, we call him as contractee. He should deduct TDS. If the single sum what he is paying, single payment, more than 30,000. Sir, what if he is making multiple payments? In a year, the threshold limit is 1 lakh. If you are making in aggregate more than 1 lakh, then deduct TDS on the entire amount. Okay, how much, sir? If the payee, that is a contractor, is individual or HF, 1%. If the payee is any other person, then 2%. And when? At the time of credit or payment, whichever is earlier. Important guys, try to remember this, important. Then 194D. So C is all about contract. D, insurance commission. Who is paying to whom? Insurance company to insurance agent. More than 15,000 in a financial year. What is the TDS rate? 10% for a domestic company, 5% for all other company. That is, if agent is a domestic company, sir, can agent, normally individuals will be the agent. Okay. But some people can form a company and do it as agency business. In that case, 10%. If in any other case, like you and me are an agent, insurance agent. So whatever policy we sell, we get whatever premium. Assume we made all our friends and relatives to take the policy. We care for them a lot. Many people who are the agent, they care their family, near and dear ones too much. Okay, they are like, hey, what man, if you go, your family will suffer, please take the policy. The intention behind this is commission. Okay, so I have made, assume I am an insurance agent, I have made the people to take policy. Now whatever premium they will pay to the insurance company, now out of that a certain percentage I will get it as a commission. Now insurance company is paying me a commission. Now, if it is more than 15,000, they have to deduct it at the time of credit or payment, whichever is earlier. Then 194DA, this is when policy matures. When policy matures, guys, if 1010D exemption is available, obviously it is not taxable. When an income is not taxable for the recipient, TDS will not be applicable. So when 1010D is not applicable, we already learned under other sources. Okay, that means it is taxable for the recipient, whoever is receiving it. Yes, sir. So obviously, guys, have simple logic. Who is receiving the amount? The insured only. Because if insured is gone, it is fully exempt, irrespective of the condition. Correct? If family members or legal heirs are receiving it, it is fully exempt for them. So insured was alive, the term has ended, and he has received the amount. And if it is not exempt only, TDS is applicable. Okay. Any sum under a life insurance policy more than or equal to, only, sir, in few places, most of the places more than is there, and here more than or equal to 1 lakh in a financial year. What is the TDS rate? 5%. When? At the time of payment. At the time of payment, please be careful only if it is not exempt under section 1010. Now, this too again connected to life insurance. Sir, when will I take life insurance? When I am scared of death. I am scared of death. So, when policy is there, when whatever premium you are paying, you can claim deduction under ATC. When policy matures, you are eligible for exemption under section 1010D. If you are not eligible, then 194DA will be applicable. Whereas for insurance agent, D. So this D, DA and 1010D all somewhere connected to life insurance. Clear? Yes. So when you guys are also studying something connected to this, you do it. Okay, even in my regular classes, I have made you to write and all, so that again you need not go in search of somewhere we shall learn something now, what is it and all. You need not waste time, because from now on time is very, very precious for you. Each and every day, each and every hour contribute a lot. 194G, gambling again. Commission on sale of lottery ticket. So lottery is more of gambling. Yes, sir. Now lottery agent will get a commission for every ticket he sell. Clear? Legal in Kerala state and all. Yes. So in that case, if the organizer is paying more than 15,000 commission to a lottery agent in a year, then they have to deduct TDS at 5% at the time of credit or payment, whichever is earlier. So G is like gambling, that is the lottery, guys. Then 194H, any other commission or brokerage. Guys, lottery commission, insurance commission is covered separately. Any other commission or brokerage is covered under 194H. In the exam, if they give simply commission paid or brokerage paid, please apply H. Okay. Again, more than 50,000 in a year, 5% TDS at the time of credit or payment, whichever is earlier. Then 194I, I am paying rent. Who am I? Tenant. For whom I am paying the rent? Owner. So if I am paying in a month, see, rent is monthly payment. But in aggregate, in a year, if you are paying more than 2,40,000, then tenant has to deduct TDS. On plant and machinery and equipment, 2%. For land, building, furniture or fixtures, 10%. Building is let out for what purpose, or asset is let out for what purpose, it doesn't matter. If it is more than 2,40,000, deduct TDS. Then when TDS has to be deducted? At the time of credit or at the time of payment, whichever is earlier. Then 194IA, payment on transfer of immobile property other than agriculture land. Payment on transfer of immobile property other than agriculture land. So agriculture land is not covered here. Okay, means I have transferred myself, no compulsory acquisition, I have transferred it. Okay, sir. So if purchase price is more than or equal to 50 lakh, compare purchase price with consideration for transfer is nothing but purchase price. Who has to deduct TDS here? Buyer, because he is the one who is paying to seller, na? Yes. So if purchase price is more than 50,000 or stamp duty value, compare this to whichever is higher. Okay. If that is more than 50 lakh or equal to 50 lakh, then TDS has to be deducted at 1% at the time of credit or payment, whichever is earlier. For example, let me take purchase price is 40 lakh. Stamp duty value is 60 lakh. Whichever is higher is 60 lakh. Now, TDS has to be deducted on what? 60 lakh. At how much? 1%. Now, how much buyer is paying to seller? 40 lakh. So, from 40 lakh, he has to reduce TDS how much? On 60 lakh, 1%. Please be careful. Clear? Remaining he will pay to the seller. Sir, next, I will take different example. Purchase price is 60 lakh. Stamp duty value is 55 lakh. Whichever is higher is 60 lakh. So on 60 lakh, TDS has to be deducted at 1%. So buyer will pay how much to the seller? 60 lakh. On that, TDS has to be deducted at 60 lakh, 1%. Okay. Next, IB. IB. Payment of rent. Payment again rent. Yes. By individual or HF. Because guys, I doesn't cover the tenant who is an individual or HF who was not subject to tax audit last year. Means payer will not include individual or HF who was not subject to tax audit last year as per 44 AB. So for them, they have included a new section only if they are paying monthly rent more than 50,000. Monthly rent more than 50,000. Then TDS has to be deducted at 5%. When, sir? Last month of the financial year or the last month of tenancy, whichever is earlier. So for example, assume I have stayed in a rented house and I am paying a rent of 60,000 per month. Throughout the year I stayed in rented house. From April to February I need not deduct TDS. So in March, how much TDS, how much rent I am paying? 60,000. From that, how much TDS I have to deduct is throughout the year how much rent I have paid including March into 12, 720. Clear? On that 5%. On that 5%. How much it comes to? 36,000. Remaining you will pay to the owner. Is that clear? Yes. Only the last month. For the entire year TDS has to be deducted. Not only, sir, for only 60,000 you will deduct TDS? No, no, no. For the entire year rent, but you will deduct only in the last month. Okay, let me tell. Sir, what if I am vacating the property after 8 months? At the end of 8 months, I am vacating it. In that case, last month of tenancy, I am paying how much rent? 60,000. Now, how much total rent I have paid in a year, including 8 months? So, only 8 months we have to take, including the 8th month, into 8. Into 8. On that 5%. On that 5%. TDS has to be deducted. Okay. Next, 194J. J for professionals. Fees for professional or technical services, royalty, non-compete fee, director remuneration. Payment is more than 30,000 in a financial year for each category of income. Sir, I am paying 25,000 technical fee, 25,000 professional fee. Should I deduct TDS? No. For each category, 30. Okay. But for director remuneration, there is no threshold limit. Sir, I am paying 10,000 director remuneration. Is it taxable? Yes, it is taxable. Sorry, is TDS deductible? Yes. And obviously for the director, it is taxable. Guys, listen. Sir, for a director who is a full-time director of a company is paying salary as well as director fee. On what TDS has to be deducted? On salary, TDS would be deducted under 192. And for director fee or sitting fee, TDS would be deducted under 194J. Clear? Always see like this. Whenever company is paying to a director, is it salary or director fee or sitting fee? For director, where is it taxable, guys? Salary means income from salary. So where should the employer deduct the TDS? 192. Then where this is taxable? Income from other sources. So where should the payer deduct the TDS? 194J. 194J. Important difference. Clear? And sir, in GST, reverse charge mechanism is applicable. That is only on this component. Reverse charge mechanism where company has to pay tax. GST. Okay. What is the rate of TDS, sir? 2% if the payee engaged in call center or fee for technical services or royalty in the nature of consideration for sale or distribution or exhibition of films, guys. 10% in all other cases like professional fee and all. When TDS has to be deducted at the time of credit or payment, whichever is earlier. 194K, okay. Income in respect of units of mutual fund, specified undertaking or specified company. Mutual fund enjoy exemption of whatever income they earn. Yes, 1023D. Yes, sir. Now, the person who has invested in mutual funds is given TDS, means the mutual fund, when they are paying the amount of income to the investor, they have to deduct TDS if they are paying more than 5,000 in a year. And rate of TDS is 10% when they have to deduct it at the time of credit or payment, whichever is earlier. This is who has to deduct? Mutual fund or that specified undertaking and all. From whose money? Investors' money before paying them. 194 LA, compulsory acquisition. Sir, land has been acquired. LA means what? Land has been acquired. Land or building both are covered, but I am just giving shortcut. compensation on acquisition of certain immobile property. Compensation will be paid when, guys? When it will be paid? Compulsory acquisition. So here, guys, please be careful. IEA also is there. IEA means I myself sold it willingly. Okay. LA means they came and acquired. They came and acquired. Who, sir? Government authority. Because anyone cannot come and acquire like that. So in that case, if the compensation paid is more than 2,50,000 in a financial year, then 10% is the TDS. 10%. Please be careful, guys. IEA and LA try to study together, but the things are different. They are 1% and here 10%. When TDS has to be deducted? At the time of payment. Then 194M. Payment to contractors, commission or brokerage, fee for technical services. Sir, all this we already saw under section 194C, 194H and 194J, no sir? Yes. But all these three sections cover payers other than individual and HUF who are subject to tax audit last year. Means if individual or HUF is not subject to tax audit last year, then in the current year they are not payer as per section 194CHJ. But for them, a new section they added later. So, for the payers who are not covered under section CHJ, they might be covered under M. Who are those people, sir? Individual HUF, who was not subject to tax audit last year. I have mentioned here. Individual HUF who is not covered in CHJ. Okay. If they are paying more than 50 lakh in a financial year, then they have to deduct TDS at 5% at the time of credit or payment, whichever is earlier. Then 194N. N, if you are withdrawing huge money, they are telling no. Okay, you can withdraw, but they will deduct TDS. But actually, this is one special section, guys. Why? Because when I am withdrawing the money from my own account, this will not lead to income for me. Bank is not the payer, I am not the payee. Agree? Still TDS would be deducted. Whereas in all other cases, for the payee, it is in the nature of income. Okay, obviously I am liable to pay tax it, and there is a genuine reason why the payer has to deduct TDS. But now, when I am withdrawing the income from my own account, you are asking the bank to deduct TDS. This is just to track the money. You are withdrawing so much money, we are interested to know what will you do with it. Okay, that is what the government is telling. When is it? When the withdrawals is more than 1 crore in a financial year. What is the TDS rate? 2% of the sum exceeding 1 crore. But 3 crore in a financial year in case cooperative society. If cooperative society is withdrawing the amount, then 2% would be the rate in excess of 3 crore. But there is one special person. The person who is withdrawing the amount is a special category person. That is, if the recipient, the person who is withdrawing the amount, account holder, has not furnished the return of income for the last 3 continuous years, then in the current year the threshold limit for him is 20 lakh. If it is more than 20 lakh, 2% TDS. If for the same person, if he is withdrawing more than 1 crore, then it is 5%. Clear? How is it? I will explain. When TDS? At the time of payment. Guys, assume I am a normal person. I have filed my returns, okay, on time. Sir, in that case, what is the threshold limit applicable for me? 1 crore. Assume I have withdrawn 1.2 crore from my bank account. So, how much TDS would be there? Minus 1 crore, that is on 20 lakh, the TDS would be applied. Only on the excess part. Please be careful. Now, sir, I have withdrawn only 80 lakhs, sir. No TDS. No TDS. Next, sir, I am covered here. I am covered in this scenario. That is, sir, I have not filed my returns from the last 3 years, and it is the duty of the bank to collect that information. Okay. Now, in that case, assume, guys, I have withdrawn 80 lakh. Same 80 lakh. I have withdrawn 80 lakh. What is the threshold limit applicable for me? 20 lakh. So, on 60 lakh, what is the TDS rate? 2%. 2%. Now, the same person has withdrawn 1.2 crores. How much is the TDS? Guys, 1 crore minus 20 lakh. Threshold limit is 20 lakh. On that 2%. In excess of 1 crore, how much he has withdrawn? 20 lakh. On that 5%. On that 5%. So, this is the total TDS to be deducted. This is the total TDS to be deducted. Is that clear? Yes. So, please be careful. Here, it is only in excess of. Only in excess of and not on the entire amount, guys. So, if you are withdrawing huge money, they are telling, no, wait. We want to know why you are withdrawing it. Okay, the purpose of this is that. 194O, online purchase. payment by e-commerce operator to e-commerce participant for any sale of goods or provision of services. Guys, now the seller is selling his goods or services through e-commerce operator, that is Amazon, Flipkart, those things, okay, to the buyer. So the buyer will pick the goods from the e-commerce operator which is displayed there on their platform, and they will order it. And once they place the order, they will ask the seller, please send the goods anta. Who will collect the payment? From the buyer, e-commerce operator, and e-commerce operator will pay it to the seller. So now for the government, it is difficult to catch hold of these people. Okay, who is actually the face of the business? E-commerce operator. They're telling e-commerce operator, you do as a need. Okay, you do as a favor. Whenever you are making the payment to the seller after deducting commission, obviously they will also deduct a commission. So whatever payment you are making to the seller, please deduct TDS on that and give it, so that I can track this person. So when you are deducting and giving the TDS, you will give this person's PAN also. So obviously this person is forced to disclose his sales now. Clear? Yes. Okay. Payment by e-commerce operator to e-commerce participant. This person is nothing but e-commerce participant, seller, for any sale of goods or services through them. No TDS for e-commerce participant being an individual or HUF who has furnished his PAN or Aadhaar or the e-commerce operator, and where the gross amount of such sale or services during the financial year is less than or equal to 5 lakh. Means if this person is individual or HUF who has given his PAN or Aadhaar to the e-commerce operator, and his sales is less than or equal to 5 lakh in a year, small person leaves. Sales only 5 lakh. So obviously his profit will be less than basic essential limit or less than rebate limit. So we are telling no, don't deduct TDS. Clear? In any other case, yes, TDS has to be deducted. Sir, there is any threshold limit? No. For example, individual HUF, sales is more than 5 lakh. TDS has to be deducted. Sir, the seller, that is the e-commerce participant, is a company, partnership firm and all, always TDS. How much, sir? 1% of the gross amount of such sales or services or both at the time of credit or payment, whichever is earlier. Guys, listen. Now, sir, buyer totally paid 10,000 to e-commerce operator, purchase price. So what e-commerce operator is doing is he's charging 20% commission. Obviously, he's giving platform and all. Yes, sir. He's charging 20% commission. So he will deduct 2,000 and he will give 8,000 to the e-commerce participant. That is for him. Yes, sir. TDS has to be deducted on what amount? 8 or 10? 10,000. Gross amount of sales. You can see the word what they have used. Gross amount of sales. How much, sir? 1%. So on this 1%. So totally you will deduct his commission plus TDS 1% on 10,000, and remaining you will give it to the e-commerce participant. But TDS, the e-commerce participant will get it as a credit. Okay. O for online shopping. Next, P, pension. If a senior citizen, guys, who is aged 75 or more, if he is earning pension income as well as interest income from the same bank, Section 194P is asking the bank to deduct TDS. Whatever the senior citizen is liable to pay, deduct it as TDS. We are not giving you any rate. Calculate his total income. Whatever is his tax, deduct it as TDS and give it to us. And we are also exempting this person by filing the income tax return. He need not file, because whatever he is supposed to pay, the bank has already deducted and given it to the government, guys. So if by chance, if pension plus interest both put together is less than 3 lakh, or if they are a senior citizen, super senior citizen, and if they are following optional scheme, their basic exemption limit is only 5 lakh. So in that case, TDS need not be deducted. Even if they are eligible for rebate also, no need to deduct TDS. Next, 194Q, large quantity you have purchased. You have purchased huge quantity. Purchase of goods. Who are you? Buyer. Who is making payment? Always think from that point of view. Whenever you are learning TDS, you have to think from payer point of view. So in case of purchase, who will pay to whom? Buyer to seller. So if purchase value is more than 50 lakh in a previous year months from a single seller, sir, I have purchased 10 lakh from different people. Should I deduct TDS? No. From the single person throughout the year. If you have purchased more than 50 lakh, then also see buyer's turnover in the last year from the business. If buyer turnover in the last year from the business is more than 10 crore, only then is covered as payer year. Sir, in the current year he has purchased more than 50 lakh from a seller, but last year his turnover was less than 10 crore. Then he did not deduct TDS. But we have to check TCS. payer or the buyer need not deduct TDS. Only if is covered here, that is if his business turnover in the last year was more than 10 crore, he will deduct it. How much, sir? 0.1% of the sum exceeding 50 lakh. Again important, different. At the time of credit or payment, whichever is earlier. For example, I have purchased the goods worth 80 lakh. How much TDS I have to deduct? Minus 50 lakh, that is on 30 lakh, 0.1%. On 30 lakh, 0.1%, guys. Important again. Next, 194R, benefit or perquisite given by normally company to others, not employee. Because if it is employee, 192 only covered. Others, who is not an employee. Okay, in that case, if that value of the benefit or perquisite is more than 20,000 in a financial year, 10% TDS has to be deducted before providing such benefit or perquisite. Then 194S, virtual digital asset. That is like crypto, this Bitcoin and all those things, guys. Consideration for transfer of virtual digital asset. If it is more than 10,000 in a financial year, whoever is paying it, they have to deduct TDS at 30% at the time of credit or payment, whichever is earlier. Then, if the person who is paying it is a specified person, who is like individual HF, who is not having any income under the PGBP, then the threshold limit is 50,000. In that case, only if they are paying more than 50,000, they have to deduct TDS at the rate of 30%. Then, guys, all the sections, whatever we have covered, TDS would be deducted by the payer only if the amount is taxable in the hands of recipient or payee. Sir, if the recipient is enjoying the exemption, then payer need not deduct TDS, guys. Tax deducted is an income received. Sir, I told you in my example, how much TDS did we deduct? 10,000. So, is it an income for the payee? Yes. Whatever TDS has been deducted is an income for the payee, but two exceptions are there. The tax paid by the employer under section 192(1)(a) on non-monetary perquisite, it is actually perquisite to the employee, but exempt under section 1010cc. And same thing is not allowed for the employer as an expenses. He cannot claim it. Tax paid by employer on the non-monetary perquisites of employee. Is the exempt perquisite in the hands of employee? Yes. And can employer claim it as an expenditure under the PGBP? No, he cannot. Clear? Now, sir, tax paid by employer on the allowances and monetary perquisite of employee. For employee, is it taxable? Yes, as perquisite. Can employer claim it as an expenditure? Yes. Company is not paying income tax on their income, on the income of employee. Can they claim it as an expenditure? Yes, as like similar to salary expenses. But if company or if employer is paying income tax on their income, they cannot claim it. They cannot claim it. Please be careful. Next, tax deducted under section 194N. I highlighted there only. Sir, is it my income? No, I am withdrawing my own money. It is already taxed before. Clear? White money, not black money. Because when it is in the bank, we believe that it is a white money. Okay, we have already disclosed it and we have already paid tax on it. Now I am withdrawing that money and the bank is deducting TDS. So whatever TDS they are deducting, is it considered as my income? No. But I will get a credit of it. But that is not my income. It was my income. It is already credited to my bank. It is somewhere already taxed. Now I am withdrawing it. Again, don't tax me. It will lead to double taxation. Okay, so I will get the credit of it. I will get the credit of it. So I will get the credit. I will get the credit of the same. Whatever TDS has been deducted, guys, the payee will get the credit of that. Clear? I told you, while paying tax, we don't pay that amount. We will reduce it and pay it, guys. Next. Sir, when the return has to be filed? We saw. Just a second, I will show. This returns has to be filed. Yes. So there are three returns: 24Q, 26Q, 27Q. When? Who should file it? For what? Yeah. So the payer, after he deduct the TDS and remit it to the government, he should also file quarterly returns, guys. 24Q is for all the TDS deducted on salary. 26Q is for all the TDS deducted for any payment made to resident other than salary. Other than salary. And 26Q, so 26Q, 27Q is for any payment other than salary made to non-residents or foreign companies and all. Yes. Next, 27EQ I have covered here only. It is TCS returns. TCS returns. Okay, guys. Next, sir, what if I don't do? What if I don't deduct TDS? Then the payer will be termed as assessee in default. And whatever TDS he was supposed to deduct and give it to the government, he has to give out of his own pocket along with interest of. If TDS is not deducted, interest at the rate of 1% per month or part of the month on the tax from the date on which such tax was supposed to be deducted till the date you deduct it. And tax here means only TDS part, guys, not on the entire amount. Okay. Next, where TDS is deducted but not remitted to the government, serious offense. You are playing around with government money. So in that case, the interest is 1.5%. Interest at the rate of 1.5% per month or part of the month on the tax from the date on which such tax was deducted to the date on which such tax is actually paid to the government. Clear? Means by leaving higher interest, they are telling please don't do it. If you do, then heavy interest. Along with this, penalty which may be as high as the amount of TDS in default and rigorous imprisonment for specified time. Guys, now if the payment by the payer is made to the payee who is a resident and that resident is very obedient, he has disclosed the income and he has paid the tax and he has filed the returns. In that case, the date the resident payee has paid the tax and filed the returns, the payer will be relieved from all the consequences. Consequences will not continue because government has got what they are supposed to get. TDS done. Next, TCS, tax collected at source. Guys, TDS who will deduct from whom? Payer, before paying it to payee, if TDS is applicable. But TCS is different, collected. Who will collect from whom? Seller from buyer. Guys, assume, we will see which cases it is applicable, but I am first explaining the concept. Seller, whenever is selling any goods or services which is covered under TCS, because not everything is covered, only few transactions are covered. In that case, assume guys, seller is charging 5 lakh to the buyer for his goods. In addition to that, he should also collect TCS. Assume TCS applicable 1%. So on 5 lakh, 1% also he should collect, which comes to 5,000. So totally he should collect how much from the buyer? 5 lakh, 5,000. Is that clear? Now one more thing. Sir, assume seller is charging including GST 5 lakh. GST, I am just taking randomly. GST 1 lakh 20. So 620 is charging. Now TCS has to be collected on what amount? 5 lakh. Assume TCS rate applicable is 1%. It is on this. Clear? So in addition to 620, we should also collect 1%, which is 5,000. So 625 he has to collect. 625 he has to collect. Actually, 125 belongs to government, but 5,000 is towards income tax, whereas 120 is towards indirect tax. Clear? Yes, sir. Now, guys, listen. 5,000 the buyer can get credit in income tax. That is, from his tax liability he will reduce 5,000. Whereas this 120, if he is satisfying all the conditions given under section 16, 17 in GST, CGST Act, he can claim the credit. Who? Buyer. That is input tax credit. If he is registered, conditions satisfied, all those things. Okay? Yes. Now, even in TDS also it is like, sorry. How did I forget to keep saying? Now, in TDS also, if payer, when payer is paying to payee, assume guys he is paying 10 lakh. He is paying 10 lakh. Now, sir, payee has raised a bill for 10 lakh plus GST 1.8 lakh. Who has raised the bill? Payee. So, payer is paying totally 11.8 lakh. Payer is totally paying 11.8 lakh. So, TDS, assume 10% is applicable. 10% is on what? 10 lakh. Excluding GST. Clear? Means on GST component, TDS should not be deducted or TCS should not be collected. Clear? Both TDS as well as TCS, guys. Tax collection at source, TCS, as the name says, means collections of tax at source at prescribed rates by the seller or the collector from the buyer of specified goods, not all the goods. And few services also they have added. We will see it. Tax should be collected at the time of debiting the amount to the account of the buyer or at the time of receipt of account, whichever is earlier. Guys, what is it? We will see. Please pay attention. This is from whose point of view? Who is supposed to collect TCS, guys? Come on, always go by logic, concept, nothing to mug up. Who should supposed to collect TCS? Seller. So now in seller books, you see what entries is passing. First possibility, cash transactions. Cash transaction. What is the entry you will pass? Cash or bank account debit to sales. Assume it is on 1st July 23. So when should we collect TCS? 1st July, sir. 1st July. Second kind of transaction, credit transaction. So what is the entry on the date of sale you will pass? Assume 1st July again. What is the entry you will pass? Buyer or debtor, whatever fancy name you call. Okay. So to sales. To sales. This is on the date of sales. Now assume the amount is collected on 15th August 23. Sir, holiday no sir. Payment bank through bank and all you can receive, no problem. So bank or cash account debit to buyer. Till buyer pay is having debit balance is a asset for me in the balance sheet. Debtors will be shown under current asset. Yes sir. So now the question is TCS should be collected on what day? Whichever is earlier. 1st July. 1st July. Please be careful. Here date of debit in seller book will be debit buyer or credit buyer? Debit buyer. So date of debit or date of payment. Date of payment is this. Date of debit is this. Whichever is earlier. Whichever is earlier. Only if it is a credit transaction. Cash transaction means only payment is there. Straight away take that date. Okay. But there are two exceptions for this. Tax shall be collected at the time of receipt of the amount only for section 206C1F and section 206C1H. For this two, straight away date of payment. Whereas for remaining section, date of payment or date of debit, whichever is earlier, guys. Okay. So which are the cases where TCS is applicable? Let us see one by one. Section 206C, subsection 1. Guys, TCS, everything is covered in only one section, 206C. If you can remember the subsections, great. Okay, because different scenarios are covered in different subsections. Clear? Yes. Chalo, we'll see one by one. 206C, subsection 1. Sale of alcoholic liquor for human consumption 1%, scrap 1%, minerals being coal or lignite or iron ore 1%, tendu leaves 5%, timber or any other forest produce 2.5%. There is no monetary limit. Whatever amount of sales is there, TCS has to be collected at this rate. TCS would be applicable only if the buyer is a trader who has purchased the above goods for further sale. Sir, what if I have purchased the above goods for my personal consumption? Alcohol, I went and purchased and added it. In that case, is TCS applicable? No. Anything, not only alcohol, anything. So, for example, sir, timber, I purchased it for doing furniture to my house, sir. Personal purpose again. So, is TCS applicable? No. When TCS is applicable is, if I have purchased it for further sale, only then the seller has to collect TCS from me. Now, sir, I have purchased it to use it as a raw material in my manufacturing process. Any of these above products. In that case, should seller collect TCS? No, he should not. Next, subsection 1C. Grant of lease, license of parking lot, toll plaza, mining and quarrying, other than mining and quarrying of mineral oil, petroleum and natural gas. On this, TCS is not applicable, whatever is given in bracket. Other things, TCS at 2%. Then, section 206C, subsection 1F. Sale of motor vehicle of value more than 10 lakh, ex-showroom price. Ex-showroom price, because what will the seller get? That is the motor companies. Okay, like Tata Motors, Mahindra and Mahindra, what they get is ex-showroom price. All other things, whatever we pay, much more than this we pay. The other amounts and all will be going to different people, guys. So if ex-showroom price is more than 10 lakh, TCS has to be collected at 1%. TCS is applicable only in case of sale of motor vehicle in retail sales. That is when consumers or customers are purchasing it. Sir, Tata Motors distributed the car what they have manufactured to various showrooms, sir. Actually, it is not same, first of all. But on that, is TCS applicable? No. Only when showroom sells it to the people, that is TCS is applicable. TCS is applicable, guys. So we have, remember, like Formula 1 or Ferrari car. I have a dream of purchasing Ferrari. You try to remember like that. Yes. 1G, sir, I am going where? Outside India. So in that case, you want to get foreign currency. You cannot go and spend their Indian rupees. Yes. So I want to convert Indian rupees into foreign currency. So I approached authorized dealer. So I wanted to convert. I asked him, hey, convert my Indian 10 lakh rupees into any foreign currency. for which he will charge commission. But TCS here is applicable on the amount which is converted, not on the commission. Please be careful. Yes, sir. Or else, sir, I wanted to go for a trip. So I went and approached an authorized dealer or Thomas Cook and told, hey, give me a package, foreign package. Okay, you take care of everything. I will come whenever you tell. Okay, I will travel, guide me, everything. Everything is available. Guide, including guide is available. Okay, stay, food, everything they will take care. Okay, if you have money, everything they will do. Whatever you want. Okay. In that case, sir, they are selling the foreign package for me for 30 lakh. In that case, whatever I am paying them, na, I am supposed to collect TCS. I am supposed to collect TCS, guys. Chalo. I repeat, sorry. The person who is selling the foreign tour package, he should collect it. Means he is charging me 30 lakh. In excess of 30 lakh, TCS he has to collect. Clear? Who? He will collect from me. 30 lakh plus TCS. Okay. So, 1G. Provides for collection of tax by every person being an authorized dealer who receives amount under the liberalized remittance scheme of RBI for remittance from a buyer being a person remitting such amount. In simple conversion of Indian rupees into foreign currency, guys. Being a seller of an overseas tour program package who receives any amount from the buyer who purchases the package. Important, guys, because there is a change in between the year. Amendment again in this. So, first one is different. Remaining three are like common. First one is with respect to purchase of overseas tour program package. If it is purchased on or before 30th September, that is mid of the year exactly, 5% of such amount without any limit. If I have purchased it after on or after 1st October, then 5% till 7 lakh and in excess of 7 lakh, 20%. For example, guys, assume I have purchased foreign tour package here for 10 lakh. On 10 lakh, 5%. Clear? Sir, what if I have purchased here? We have to divide it. 7 lakh on 7 lakh, 5%. And in excess of 7 lakh, it is 20%. In excess of 7 lakh, it is 20%. Did you guys get it? Yes, sir. Next, sir, what if I have already got a package here? Listen, this is also interesting. Just let me clear. I have already got a package here. First off, I went for some foreign country and I came. What is the TCS applicable? 5%. Then second off, again I felt, let me go again for some other country or same country, wherever you go. You are purchasing the foreign tour package. Assume for 10 lakh. What is the TCS applicable? What is the TCS applicable? For 2 lakh, 5%. For 8 lakh, it is 20%. Sir, 2. Yes, 5 is already taken care here. So remaining, because 7 is like per annum. So, remaining 2 lakh, it will be 5% and another 8 lakh, it would be 20%. Clear? Yes. Next 3 are conversion, guys. How much TCS depends on for what purpose did you convert Indian rupees into foreign currency. If amount remitted is for the purpose of education or medical treatment outside India, then TCS would be 5% of the amount in excess of 7 lakh in a financial year. For example, sir, I have converted 10 lakh. So minus 7 lakh. On 3 lakh, 5%. On 3 lakh, 5%. Okay. Next, amount remitted out is education loan obtained from any financial institution as defined in section 80E. Then 0.5% of the amount in excess of 7 lakh. Sir, assume I have converted 8 lakh for studying abroad and I have paid the fees there and all. So in that case, 8 lakh minus 7 lakh on 1 lakh, 0.5%. 0.5%. Okay. This to our special purpose. For any other purpose, last case. Amount remitted is for the purpose other than mentioned above. Then we have to check, is it before 30th September or after that? On or before 30th September, 5% of the amount in excess of 7 lakh. If it is on or after 1st October, then 20% of the amount in excess of 7 lakh. Guys, please be careful. For all this, 7 lakh is the limit per annum. It is not for each. It is not for each. All three put together 7 lakh. Sir, I went. Listen, guys. Interesting. First, I converted 10 lakh for medical purpose. What is the TCS rate applicable? Minus 7 lakh on that 3 lakh, 5%. Correct? Then later again I went for conversion for this purpose. I converted 5 lakh. Assume it is on or after 1st October. On or after 1st October. So here it will come 5 lakh. How much TCS has to be collected? Entire 20%. Because 7 lakh benefit I already enjoyed here. For each category they have given 7 lakh. But if a person is converting the money for all three or one or more, in that case, per year 7 lakh. Sir, what if I went and exchanged for the second time, third time and all? Then 7 lakh is per annum. When I go and exchange the money for second and third time or fourth time and all, I have to give the information about what I have exchanged before to the person whom I am approaching second time or further. Clear? So 7 lakh is per annum, guys, irrespective of the purpose. Clear? Yes. However, under subsection 1G, TCS will not be applicable if the buyer is a non-resident in terms of section 6, that is a residential status, and does not have any permanent establishment in India, guys. Then subsection 1H, it has to be read with 194Q. Let us recall 194Q. If the buyer has purchased the goods worth more than 50 lakh in a year, and if the buyer's turnover in the last year is more than 10 crore, only then he will deduct TDS under section 194Q. Agree? Yes. Next, if 194Q is not applicable, we have to check section 206C1H, but from seller point of view. If seller has sold the goods more than 50 lakh, and if seller's business turnover in the last year is more than 10 crore, then he has to collect TCS here. He has to collect TCS. What rates are? Same 0.1%. In excess of 50 lakh. In excess of 50 lakh. Let me read it. A seller who receives consideration for sale of any goods of aggregate value more than 50 lakh in the previous year, other than the goods being exported out of India or goods covered elsewhere, means if goods exported, that doesn't cover, and also goods covered elsewhere means, sir, for example, scrap or alcohol and all is covered here. So if already it is covered under any other subsections, again it will not be covered in 1H, guys. Okay, so TCS is 0.1% in excess of 50 lakh excluding GST, means that 50 lakh should not include GST. For example, sir, assume purchase value is 48 lakh plus GST 2.4 lakh. So in that case, 50.4, should TCS be applicable? No. Sir, TDS? No, because it is including GST. So excluding GST, check is it more than 50 lakh. If not, no TDS or no TCS. Clear? So please be careful, guys. So from buyer point of view, we have to check what? 194Q. From seller point of view, we have to check 206C1H. Okay. First, we always priority is for 194Q. Second priority is for 206C1H. If 194Q is not applicable, only we will check 1H. If already applicable, please don't check. Sir, what? Assume buyer turnover is also more than 10 crore, seller turnover also more than 10 crore. What is applicable, sir? Both? No, 194. 194Q. So here, if purchase value is more than 50 lakh, or here sale value is more than 50 lakh, both excluding GST. Excluding GST, guys. TCS or TDS rate is same. That is 0.1% in excess of 50 lakh. Here also 0.1% in excess of 50 lakh. Only on the difference. Only on the difference. Okay. Done with the TCS. Some provisions connected with the TDS TCS, guys. What if there is default? Means, guys, whenever payer is deducting TDS or whenever the seller is collecting TCS from the other person, he has to take PAN, because PAN is a unique number for income tax purpose. Sir, what if payee or buyer doesn't give it or he doesn't have it? Then TDS has to be deducted at a higher rate or TCS has to be collected at a higher rate. How much? We will see. Higher rate of TCS for non-filers of income tax returns and non-furnishers of PAN, section 206 CCA and 206 CC. As per section 206 CC, if PAN is not intimated, tax shall be collected by whom? Buyer. If buyer has not given his PAN to the seller, then seller will collect how much TCS? Twice the actual rate or at the rate of 5%. And this 5% in case of section 206 C1H, it would be 1%. Actual rate is 0.1%, but here we will not take 5%, 1%. Clear? For example, sir, buyer didn't give PAN. Assume 194C1H is applicable. In that case, Twice the actual rate would be how much? 0.2%. And here 1%. Whichever is higher, 1%. So the seller will collect how much TCS? 1%. Same way. Let me take one more example. Assume, sir, this is applicable. 2.5%. Yes, sir. So 2.5%. 2.5 don't want because exactly it will come to same. 5% we will take. 10 to leaves. 5%. Okay, sir. So 10 to leaves. Buyer didn't give the PAN. So in that case, twice the actual rate, 10%. Or 5%. Whichever is higher, 10%. Whichever is higher is 10%. Twice the rate. Actual rate is how much? 5%. Into 2, 10%. Maximum rate is how much? 5%. Whichever is higher, 10%. Huh? Which one?
So the rate, the twice the normal rate or at the rate of 10%.
This one, nah? Okay, 10%. Fine. So 10 or 10, whichever is higher. So it will be 10 only. 10%. Okay, next. So 10%. Next, CCA. Sections 206 CCA requires tax is to be collected at source by a person from a specified person. So again, buyer at higher of the following rate. Who is specified person? We will see it later. Higher of the following rates. At twice the rate specified in the relevant provisions of the Act or at 5%. Twice again, 5% is here. Whatever is the TCS rate into 2. Whichever is higher. Whichever is higher. Here it is 5% only. Yes. Sir, who is specified person? I have given here. Specified person is same for both TDS as well as TCS, guys. Who is specified person? A person who has not filed the returns of income from the previous to assessment year, for which the time limit of filing the return of income under section 139 subsection 1 has expired. And the aggregate of TDS and TCS in his case is 50,000 or more in each of these 2 previous years. These provisions are not applicable to a non-resident who does not have any permanent establishment in India, guys. Okay. Both put together, TDS plus TCS under all the sections is 50,000 or more. And he has not filed his income tax returns for the last 2 years, for which already time is over. Okay. And the maximum TCS rate along with this higher whatever is there, which should be collected is 20%. Maximum 20%. Okay. Then, sir, what for the same person if both is applicable? Sir, buyer didn't give PAN also and is specified person also. Apply both the sections separately and take whichever is higher. Apply both separately and take whichever is higher. TCS will be collected at that rate. Then for TDS, sir, what in the same scenarios if it is TDS, payer, how much TDS he has to deduct? 206 AA provides if payer doesn't provide his PAN, then TDS has to be deducted at 20% or the actual rate, whichever is higher. Actual rate of TDS, no twice and all. Actual rate of TDS or 20%, whichever is higher. But for 194Q, it is 5%. Actual rate or 5%, whichever is higher, 5%. Oh. Next, section 206 AB requires tax has to be deducted at source by a person who is a specified person. That is, if pay is a specified person, same story. Same story, yes sir. So in that case, higher the rate, twice the actual rate, whatever is the rate of TDS, twice of it, or 5%, whichever is higher. Whichever is higher. However, 206 AB is not applicable for the following sections. That is 192, 192A, 192B, sorry, 194B, 194BA, BB, IA, IB, M, N. Clear? Yes. Now, sir, what if for the same person both sections are applicable? Let me just take an example. 194C, assuming pay is not an individual HF. What is the rate? 2%. Pay is not an individual HF. What is the TDS rate? 2%. So, assume the pay is not given a span. 206 AA is applicable? Yes. What is the TDS rate here? 20% or 2%, whichever is higher. 20%. 20%. Next, 206 AB. Assume the payee has not filed his returns for the last 2 years and TDS, TCS deducted or collected on his amount is 50,000 or more in both the years. Yes, in that case, twice the rate is 4% or 5%, whichever is higher, 5%. Now, as both the section is applicable for the same payee, will we collect 25%? No. 20 or 5, whichever is higher now. 20. So, what TDS the payer has to deduct? 20% from the payee. Yes, this is all about TDS and TCS. Last topic in this chapter, advance payment of tax. Advance payment of tax is based on the concept pay as you earn. Government has to run the show throughout the year. In the basic chapter we learned income earned in previous year is taxable in the assessment year. But here it is just opposite to that. They are telling pay as you earn it. Sir, you only told in the first chapter. No sir, that is how the government has told. Later they are telling this. If your tax liability is 10,000 or more, pay advance tax in 4 installment every quarter. As and when you earn, give my share. Government is telling, not me. Okay. So in that case, advance tax payment is purely based on estimation, guys. Please pay attention here. At the beginning of the previous year itself, I have to estimate what is my estimated total income. I will have at least an idea. May not be exact figure. Obviously, it cannot be exact figure. So starting at the beginning of the previous year, guys, I have to estimate my total income. And on that, I will already be knowing at the beginning of the previous year only, I will be knowing what is the tax rates applicable for me. Yes, estimate your tax liability. Estimate your tax liability. Assume it is coming to 1.5 lakh. From that, you will know on what all income TDS would be deducted and all. Yes. So TDS deducted, TCS collected, everything. What maximum can be deducted or collected, reduce it. Assume I am expecting 50,000. Remaining is how much? 1 lakh. Sir, is it more than 10,000? Yes. Pay advance tax. Pay it as advance tax. So we call this as advance tax liability. Advance tax due or liability. So I have to pay it in 4 installment quarterly. Not in one shot, 4 installments. So any amount which I pay before 31st March of the previous year is called as advance tax. Sir, will I get the credit of it? Definitely. So in the assessment year, you will calculate your actual income and on that your actual tax liability. From that, whatever TDS, TCS, advance tax has already gone to the government from your end, reduce it. Even after all that, if something is pending, you pay and file the returns. Sir, I have already paid more, sir, then you can claim the refund. Clear? Yes. Now, liability. The obligatory for an assessee to pay advance tax where the advance tax payable is 10,000 or more. Then exemption is for resident individual who is not having any income under the PGBP and if they are aged 60 or more. Okay, so they have to pay tax. They need not pay advance tax. Okay, means when will they pay, sir? In the assessment year on their actual income. Okay, fine guys. Sir, how should we pay? When should we pay? Advance tax quarterly. So you know each quarter when it will end, guys. April, May, June, July, August, September, October, November, December, Jan, Feb, March. Last month of each quarter, take 15th of that. Last month of each quarter, take 15th of that. That is the due date to due date to pay advance tax. Guys, please don't get confused with this and the due date to file TDS returns. For TDS returns, it is always after the quarter end. How will I know before quarter end what payments I have made, how much TDS I have deducted? Obviously, TDS returns has to be filed after the quarter end. After the quarter end. So, TDS returns is always 31st of the month succeeding each quarter. 31st of the month succeeding each quarter. Whereas for last quarter, April doesn't have 31st. So it is 31st May. The purpose is not that. Why? Because for last quarter or at the end of the year, there will be too much work for the assessee to close his books of accounts and all. That is why they have given 2 months time. Only for the last quarter returns. Clear? Yes, sir. Now, because students may get confused with this dates and that date. This is like advance. So we have to pay in advance before the quarter end. So whichever is the last month of each quarter, take 15th of that. That is the due date. Sir, how much I have to pay? First quarter, on or before 15th June, up to 15% of the advance tax due. Then, sir, let me take also amounts quickly. Sir, assume as per my calculation, advance tax due, as per my estimation, 1 lakh. So, advance tax due, please be careful. So, how much I have to pay in first installment? I will change the color just a second. How much I am supposed to pay in first installment? 15,000. 1 lakh into 15%, guys. Next, sir, in the second installment, on or before 15 September, up to 45%. Up to 45% means cumulative. Maximum you should have paid that much. Minus how much ever you already paid. So, how much I have to pay here? 1 lakh into 45,000. How did I get 1 lakh? Advance tax due. Okay, na? Into 45%, 45,000 minus how much I have already paid? 15,000. So how much I will pay now? So by second installment, I have paid totally how much? 45. So why they are including cumulative percentage means if you have by chance if you have paid less in first or second installment, at least make it good in the next installments. Then on or before 15th December, up to 75% of the advance tax due minus whatever you already paid. So as per my calculation, estimated advance tax liability 1 lakh. On that 75% comes to 75,000 minus how much I have already paid 45,000. How much I should pay now? 30,000. So totally, how much ever is my advance tax liability? I have paid 75% now. Okay, sir. Last one. On or before 15th March, 100%. Up to 100% minus whatever you have paid. So what is my advance tax liability? 1 lakh. On that 100% comes to 1 lakh. Minus I have already paid 75,000. That is 15, 30, 30. 75 totally. Remaining 25 I have to pay it. This is purely based on my estimation. Believing that my advance tax due is 1 lakh. Now, for the assessee who is following presumptive scheme under section 44 AD and ADA, if they are liable to pay advance tax, for them we are trying to reduce compliance burden, correct now, by asking them not to maintain books of accounts, don't get it audited and all. Yes. So obviously for them, we are telling you need not pay. Even though your tax liability is more than 10,000, you pay it in one installment on or before 15th March. On or before 15th March. But in any of these cases, guys, anything paid before 31st March also is considered as 31st March of previous year is considered as advance tax. Next, 234B. Sir, what about AE? That is goods carriage business, AE, presumptive scheme. If they are liable to pay advance tax, they have to pay it in 4 installment. Okay. Yes. Next, 234B. Guys, assume, sir, actually in the assessment year, I was shocked to know that I have earned more income. And my actual tax liability was 3 lakh. Was 3 lakh. Now TDS, TCS, actual TDS, TCS, because I will be knowing the actual data now, is assume 60,000. Previously I had taken estimation 50 because estimation may not be exact figure. So I am changing now 60,000. And advance tax I have totally paid how much? 1 lakh. Clear? Or else let me take like this. Advance tax payable was how much, guys? 2.4 lakh. But how much I actually paid? 1 lakh. Short payment is there. Short payment is there. That means minus advance tax paid. This is payable. Actual. How much I have paid is 1 lakh. How much is short? 1.4 lakh. The difference is more than 10%. If the shortage is up to 10%, they are fine. But if it is more than 10%, on the entire difference, they are charging 1% interest. From 1st April of assessment year till the day I actually pay this. Till the day I actually pay this. Is that clear? Yes. Now, under interest under section 234B is attracted for non-payment of advance tax or payment of advance tax of an amount less than 90% of assessed tax. Assessed tax means your actual tax liability, guys. This figure. Clear? Sir, I have not at all paid anything, sir. 1 lakh also I have not paid. Then on entire 2.4 lakh interest should be charged from 1st April. Clear? Of assessment year. Okay. Next, the interest liability would be 1% per month or part of the month from 1st April following the financial year, which is nothing but 1st April of assessment year. Up to the date of determination of income under section 143 subsection 1. They are telling up to the date of determination of income, but it is actually up to the date you pay that amount. Up to the date you pay the amount, whatever you are supposed to pay, still shortage. Sir, what if the difference is less than 10%, sir? No interest. Because obviously when you are estimating, there can be a chances of doing short estimation and all, underestimation and all. So in that case, if the difference is within 10%, no interest, guys. Clear? For example, sir, I was supposed to pay 2.4 lakhs, sir. I have paid 2.3 lakhs. 10,000 difference, sir. Should I pay interest? No. The difference is within 10%, no interest. Clear? Assessed tax is how much? 2.4. How much I have paid? 2.3. So divide one another. 2.3 divided by 2.4. Clear? Lakhs. So is it more than 90%, sir? Yes. That means no interest under section 234. Clear? Simple. I repeat once again. What I have paid divided by what I was supposed to pay, payable. Okay, let me call it as paid divided by payable into 100. If it is more than 90%, no interest. If it is less than 90% on the entire shortage, interest would be charged, guys. Next, 234C. 234B is for interest on total shortage. Sir, what if I have short paid in the installments? Even on that interest is charged. 234C. In case of all ACCA other than who is covered under 44 AD or ADA, for them different. On or before 15th June, how much they were supposed to pay? 15%. So 15% of tax due on returned income means your actual tax liability. In my example, 2.4 lakh. In my example, 2.4 lakh, guys. So 2.4 lakh, they were on that 15% they were supposed to pay minus what you have paid. If still difference is there, interest is 1% for 3 months. So totally 3%. Same way. On or before 15 September, you are supposed to pay 45% of your actual tax liability. Okay, in my example, 2.4 lakh minus whatever you have paid. Minus whatever you have paid. So if difference is there, then interest at 1% for 3 months. Then again, why 3 months, sir? The gap between one installment to another installment is 3 months, quarter. That is why. Then on or before 15th December, 75% is the specified percentage. I was supposed to pay 75% of what I am supposed to pay. That is 2.4 lakh. Minus whatever you already paid. The shortage is charged at an interest rate of 1% for 3 months. Whereas on or before 15th March, you are supposed to pay 100% of your advance tax liability. So take 100% of the tax due on returned income or assessed tax, one and the same. Your actual tax liability after reducing TDS and TCS minus what you have paid. So the shortage would be charged at 1% only for 1 month. That is for that 15 days or 16 days. Why? Because from 1st April 234B will take over. That is why only 1 month here. Clear? So 234C is for short payment in installments, whereas 234B is for short payment in total, which will start from 1st April of assessment year. Once 234C stops, 234B starts. However, guys, in the first and second installment, there is high chances that I may underestimate, because standing at the beginning of the year, how can you expect me exactly to tell how much I will earn at the end of the year and all? What I am supposed to pay in first installment is 15%. But they are telling even if you have paid up to 12%, we will not charge interest. Percentage is 15 only. But even if you have paid up to 12%, no interest. Means more than 12, within 15, still no interest. Same way. Second installment, how much I have to pay? 45. But even if I have paid up to 36%, they are telling no interest. That is more than 36, but within 45. Still no interest on the short payment. But I should make sure that I would have made it good in the upcoming installments at least. Clear? Means I can keep on changing my estimation in between the year. It is not like, sir, on 1st April, whatever I have calculated remain same. No. You can keep on changing it. Next. No interest is leviable under section 234C if the shortfall in payment of advance tax is on account of underestimation or failure to estimate the amount of capital gains, casual income accrues or arises for the first time under the head PGBP. Because I may not be able to estimate all this. Or dividend income, deemed dividend we call it as. Under section 234 ABCD, under 222, even E is there, but E is not covered here. Please be careful. Only ABCD. That E talks about loans and all, loan advances. Okay. Yes. Only ABCD. So it is difficult to estimate these things, guys. So they told, okay, if you have paid any less tax due to this incomes, we will not charge interest under section 234C. But once you earn this, at least you have an idea. Make sure that in the upcoming installment, you have considered this income and you have paid tax on it. If not, interest would be charged. Next, what is the tax due on returned income, or what is that assessed tax, the names what they have used? It means the tax calculated on total income, that is actual tax liability, declared in the return furnished by the assessee, less tax deducted or collected at source, that is nothing but TDS or TCS. If there is any relief available to the assessee under section 89, or any tax credit allowed to be set off in accordance with the provisions of section 115 JD, we have to reduce it. Remaining is called advance tax payable. Advance tax payable. We will check whether it is paid or not. If not paid or short paid, then we will charge interest. Then for the assessee who is covered under section 44 AD and ADA, sir, will they charge interest for each payment? No. For them, we are giving opportunity to pay only in one installment. So interest is charged at 1% only for 1 month. Only for 1 month. That is from 16th March to 31st March. Part of the month we are considering as 1 month. From 1st April to 34B will take over, which would be applicable, which is common for everyone. Okay. Self-assessment tax. What is self-assessment tax? Self-assessment tax means the tax paid by the assessee on the basis of self-assessment, that is, he himself has done the calculation before filing the return of income. Self-assessment is a process where a person himself assesses his tax liability himself on the income earned during the particular previous year and submit the income tax returns to the department. Clear? Means this will not cover TDS, TCS, advance tax and all. Okay. See guys, in the assessment year, I will do my actual tax liability. From that, I will reduce TDS, TCS, advance tax, everything. Even after reducing this, if the figure is positive, I have to pay that and file the returns, which is called self-assessment tax. Sir, what if this figure is negative? I already paid more. I can claim refund. But for claiming refund, you have to file the returns. In case, if there is a delay in furnishing the return of income, self-assessment tax shall also include interest for delay and fee for delay under section 234. If interest also will be there, fee also would be there, late fee. Refund. Refund means to repay or to restore what was taken under the income tax law. That is, if I have paid more, I can claim the refund of it by filing the returns, guys. Interest for delayed payment of income tax under section 220 subsection 2. An assessee who is liable to pay interest at 1% for every month or part of the month comprised in the period intervening between the expiry of 30 days, that is after 30 days, with effect from servicing of notice of demand and actual payment of tax for the delay in making the payment of tax demanded beyond 30 days from the date of receipt of demand notice. Now, I am supposed to do self-assessment, but if I have not done, the department will send me a demand notice telling, hey, because you are liable to pay so much tax, pay it anta. 30 days time they will give. From 31st day, interest also will start. Tax plus interest. Okay, at 1%. Section 220, subsection 2A empowers the board means CBDT, to reduce or waive the amount of interest payable by the assessee under the above section on the recommendation made by Chief Commissioner or Commissioner in this behalf. Now, if assessee requests are paying tax itself is a big thing for me, you are charging interest and all. If you want, I will pay tax. If not, that also I will not pay anta. If that is a situation or scenario, then the commissioner can waive off the interest. Not tax, only interest they can waive off. Nice. Fine. Yes, we are done with this chapter. Now, chapter 12, which talks about computation of total income and tax liability. If we are revising this chapter, it is revising like entire income tax, guys. Okay, that means which we have already done. That means, sir, this chapter is already taken care. Yes. Shall we move to chapter 13? No. Some important points. Steps for computation of total income and tax liability. What all is important? Determination of residential status, that is as per section 6, especially for individual it is important. Guys, in the question sometimes, first line of the question is very important. The who is individual, who is assessee, what is his age, what is his residential status normally will be given in the question. Catch that. Because that might somewhere help you in the calculation. Clear? Who is the assessee? What is his age, especially if they are individual, and what is their residential status? Somewhere in the calculation it may have impact, guys. Okay. Then classification of the income under the different heads, that are totally 5 heads of income are there. As per section 14, there are 5 incomes are classified into 5 heads of income. Yes, sir. Now guys, when computing the income, we should know which income is taxable under which head. Sir, what if some income I just put it under some head? Total income will not change, but the computation format will change. So will they deduct marks for us? Definitely they will deduct it. Then computation of income under each head after considering exemptions under the respective head, if any. Then under each head, first section is charging section, which will tell what income is taxable under that head. Then clubbing of income of a spouse and minor child, if at all if it is there. If at all if it is there, we will club it as per section 60 to 65. Then set off and carry forward of losses is there. If at all if it is there, if it is current year, both intra and inter is allowed. If it is brought forward loss, only intra. Everything we have covered already in detail. Then computation of gross total income. That is, if I add up everything, then if I take care of these two adjustments, I get something called as gross total income. And from gross total income, the assessee can claim chapter 6A deduction from ATC to ATU. Each section will tell deduction is for what, for whom, and how much. We have to take care of it. Then once we deduct this, we get total income or taxable income. And this is the figure on which the assessee is liable to pay tax, guys. And whenever there is a total income, first check, does it include any special income or normal income? If question is silent, entire total income we will assume it as normal income. Clear? And normal income is taxable either as at flat rate or slab rate, depending upon the scheme opted by the assessee. Please take care of small things like that. Then total income should always be rounded up to the nearest to 10 rupees as per section 288A. And tax liability, that is the final tax what we pay to the government, should be rounded up to nearest to 10 rupees again as per section 288B. Sir, under each head I will round off? No. Whatever income you calculate under each head, that you need not round off. But this figure, the final figure, only you have to round it off. And sometimes in the exam what happens? Sir, here you are given the format like this, sir. One of the question, only one income, that is only total income. Yes, that can also happen. Here, what is the maximum things can come, we have given. But, sir, assessee is having only salary income. So, income from salary will be the gross total income. Assume he is not claiming any deduction. Then, gross total income is a total income. Clear? Means, in between items, if something is not there, then entire, whatever income is earning, will become as gross total income. If he is not claiming any deduction, then that will become a total income, guys. Clear? If question is silent about any income under any head, assume it is 0. Consider it as nil. So next, some important points to be kept in mind, especially when question is silent or whenever you are doing computation, few things has to run in your mind, guys. Because question may not inform that. Check rebate, check marginal relief, check apply surcharge. Question might not mention it. Definitely they will not mention it. And many students would go wrong there, guys, in a hurry, because they will know that they would have studied, every student, a rebate, surcharge and all, every student would have studied. But the thing is, in a hurry, they will miss out. Okay, and whatever they do, they believe that it is correct, full marks, pakka. But the important point, they would have missed it. Clear? That is where the 2-3 marks difference will make for each question. I would have done everything. I believe it is correct. But one important thing I would have skipped, or I would have left it. And I would have not even noticed it. So that is where, sir, for 10 marks question or for 8 marks question, if I lose out that 2-3 marks, will it make difference? Definitely. Assume for every question you are losing out 2-3 marks like that, then it will make difference, no? Yes. So what are those, sir? Some important things as per my observations, guys. If salary received or salary earned or even pension is given, where is it taxable? Pension received by employee only, under salary. But please be careful, guys. Standard deduction of 50,000 has to be given, both under default regime as well as optional regime. Clear? If income from salary computed is already given or taxable salary is given, everything is taken care. Straight away consider that figure. Okay. Then same way, if rent received or rental income is given, nothing else is given in the question, straight away take that as GAB and provide for 30% flat deduction. Sir, interest is not given, municipal tax is not given, ignore it. Only if it is given, you will consider it. Whereas 30% of standard deduction, you should always give it. Whether given or not, guys. Please take care of it, because sometimes this will be the twist in the question, one or the other places. And I tell you, being my students, you should not miss it. But majority of the students will miss this. Clear? They will straight away take rent. And yes, they would have studied, everything is fine. But somewhere that concept, at that moment, didn't hit my mind. That is where that will happen. Means that 3 hours, how much crucial it is, guys. You would have studied for 5-6 months. And you would have revised that subject in 1.5 day, depending upon how much gap you have. If you are writing only one module, for tax, at least 1 day gap is there. Okay. So, you would have studied everything or revised everything in 1.5 day. And you will go to the exam hall, present whatever you have studied, whatever you have stored here, you will represent that in 3 hours. That 3 hours is very, very crucial. Just imagine, sir, I knew the answer, but I couldn't write it. That is like, that feeling I cannot explain. Clear? That should not happen, guys. That is why I keep on telling practice, practice, practice. Okay, try to complete 100 marks. That is very, very important. And even if you complete, don't walk off. Okay, try to cross check, do whatever, some extra things are required. Notes is supposed to be given, working notes has to be given. Please do it, guys. New syllabus, completely descriptive. Please take care of each and every step. In the question paper only, they would have clearly given your answer should include notes, working notes and all. Students will neglect it, thinking answer I have written, correct, notes, 1 marks, 2 marks, let it go anta. Please don't do that. Clear? Notes, working note, everything is a part of your answer. If you are writing anything which is not given in the question directly, please give a notes for it, or please give working notes. Or even if you are making any assumption, when question is silent, please mention what assumption you made. Why you made and all may not be required. Clear? Sir, because that, sir, our class teacher told me, because sir told me, that and all is not required. Okay, even institute will not know who I am. Okay, so In that case, don't worry about reason and all, but see, sometimes recommendation they will ask, suggestion they will ask, then you give your reason. Why are you recommending it, anta? Okay, see, some things I would have told. Don't apply it universally for everything. Clear? That is what student. I told no, don't give the reason, anta. But sir, suggestion or recommendation they have asked in the question. You told not to give reason, na? I didn't give it. Please don't do that. Clear? And as a student, take all the precautionary measure, whatever is possible from your end, guys. Always have extra pen, pencil, extra calculator, and be on time to the exam hall. Assume you are rushing in a last moment that the first 15-20 minutes will be like full panic for you. Okay, in a hurry. Why you are seeing her? She came later last time. So, no, fine. So all this please take care. And I know if you are writing especially the exams in a cities like Bangalore, Chennai, all whichever cities, there will be traffic. Everyone know, universal observation. Correct? Don't go to the exam hall like how you come here. Clear? Each and every minute counts, guys. Try to reach exam hall at least 15 minutes before. At least I am telling. You can go and sleep there only if you want. Okay? The before day, not next day. Sir, I will go and do 30 there. Next day, telling, hey, I didn't get the opportunity, I didn't do that, I didn't do this. No. See, please take care because anything can happen, any contingency, traffic jam might be there, that is there, this is there, especially when you are depending on public transport. Please take care of, guys. And if possible, once you get all ticket, before your exams, go visit that college and come. Go visit and means, go talk to your principal, teacher. No. Go check where is it and come back. Because sometimes in Bangalore and all, there are two colleges with the same name. Different area, same area, name, but it might be in two different places. All these things will happen. Please ensure all those things. Clear? On the exam day, assume you went to some other college, but your friend is calling, hey, where are you? I am in this college. Hey, not that college, this college. You are like gone. Clear? So please, small things matters. Sir, I am a matured person. I will do everything perfectly. Yes, I agree. But try, if possible, go visit that one place and come along with your friend, whoever has the same center. We can go with them, visit it, then come back. Don't spend your day there only, sir. Holiday, sir. Tourism, sir. No, come back. At least few days before. At least few days before, go check the college and come back. Clear? And on the first day, try to reach early because the room numbers and all you have to ensure, you have to go and make sure you see your place, and then if you still have time, you can come back or sit there and study, whatever you want. But I don't suggest. See, I as a student never studied in exam hall, guys. I believed in that. But I am not telling you that you should also follow the same because each individual is different, because at the last moment we cannot kissy anything is what I believe. Okay. Means we cannot achieve anything. Okay. We cannot achieve anything in the last moment. Oh, you heard a kiss. Hey, Sarvesho. So, what you have not achieved in last 6 months, last 1.5 day, you cannot achieve that in last 5 minutes. Okay, and there will be people coming, hey, this after pakka this time, this question, sir told me, whichever sir it is, I will never tell. Okay, this time this question will come, this chapter will come. You are like, I never studied this chapter. In the last moment you are studying. Okay, it's okay. Never, don't pressure your mind during last moment. Last 5-10 minutes, keep it calm. Keep it calm. Shh. First 15 minutes, guys, I might be telling as a joke, but everything is important. Please listen. First 15 minutes is a reading time. Please capitalize it. And make sure that once you are reading the question, whatever you are supposed to write for that, everything is striking for your mind. Clear? And sir, when sometimes what happens in that 15 minutes also, I will spend the entire 15 minutes to read one question. Please don't do that. Okay? At least, if not entire question paper, at least try to cover how much ever is. I am talking about descriptive, that is new syllabus people. MCQ and all, obviously, you can read more than one question. Okay? You don't, sir, old syllabus, one question, how possible? Now, so please make sure that you are trying to read maximum and everything should start striking to your mind. Whatever is there. Okay, means what you are supposed to write, how you have to start, how you have to continue. All these are important, guys. Means you should start framing the answer in your mind. Sir, not in the question paper. Don't write anything in the question paper. In your mind, you start framing the answer. Clear? And if something you are not so clear, put on some dot or something. Okay. But still, if you don't know one adjustment, don't leave the entire question. Still attend. Step marking would be there. Clear? But try to attend that kind of question later, guys. Okay. Try to answer first whichever you know best. Your first and second answer will give the message to the evaluator that who you are. Means not whose son, whose daughter you are. How well you are prepared. How well you are prepared. So please give a good message. So try, and also if by chance, sir, shh, one question, sub question I didn't knew that, sir. Try to keep it for later. Okay, don't leave empty pages in the starting only. Sir, A, B I have written, C, 5 pages I have left. Okay, some people will have that also. Extra page, extra sheet. Why? They have left everything here. If you have written, achieved, ask for next. Okay, everything left empty. Guys, all this will irritate the evaluator. Just imagine yourself as an evaluator. You have left every page empty. He is turning the page. By the time you see next content, 0 is ready. Okay, so don't test their patience. Already they are age-old people. Take care of them. Okay, as if they are your parents, take care of them. They may not treat you as their own children. Because, sir, I treated as my parents are, but they have given only this much marks. See, sir, you don't worry about how they treat. You treat them well. Clear? Yes. Come back. Age and residential status of the assessment. And one more, few more things, guys. All these are very important. See, sometimes your first paper may not go well as you expected. It happens many a time in a professional exam. But don't lose the hope. Still, if you get minimum there also, other papers can cope up. Guys, just imagine if you are prepared well, if it is tough for you, it is tough for everyone. Okay, so institute cannot fail everyone. 0% result can they give? Definitely. Clear? So the valuation might happen easy, or else they may give some additional marks, grace marks. Something may happen, some miracle may happen. You don't worry about that. You give your best, come out of it, forget about that paper and focus on next paper. And don't go to home and check, for this question what is the answer, for that question what is the answer. It will not change anything. Done is done. Focus on next paper. Please, once you come out of the exam hall, don't discuss, don't check the paper which is already done. Only focus on next paper. And next paper can overcome whatever you have lost in the previous paper. It happens, guys. Even for me, I was expert in accounts, is what I believed. Okay. So sometimes accounts paper will not go well. My inter, that is what I suffered. Inter means like however executive is there. Na? For CA, we have intermediate. So accounts, I believe that I will definitely score above exemption. But what I could write is only above 60. Around 65, 68 I was able to attend. Because paper was tough. But still I didn't give up. But when I was studying the next paper, it was keep on hitting me. But somewhere we have to avoid that thought. We have to avoid it, because definitely that cannot change, because one wrong paper or one wrong exam should not affect entire attempt, which is very, very important. That will happen, guys. It is common. Please accept the reality. Every paper will not go the way you expected. That is for sure. Accept it now only. Okay. If it is tough for you, definitely it will be tough for each and everyone. But you will aramse get above 40 in that. So please focus on other papers and try to score maximum there. Sure. Age and residential status of the assessee, especially age is for individual. Others and all age doesn't matter. So age and residential status will have impact, especially on rebate calculations and all. Even if you are opting for optional scheme, then higher basic age limit, senior, super senior citizens, those things will matter. Then few deductions are available only to residents. So those things and all, please take care. Then restrictions and maximum limit with respect to deductions. Most of the times when question is on deduction, guys, somewhere some maximum things has to be checked. Clear? They will give more amount, but you should know that you have to restrict it to certain amount. Then when total income includes any special income, tax it at special rate. If question is silent, assume entire total income is a normal income. First, always, if total income includes special income, always first calculate tax on special income and then on normal income. And go in a procedure. First check, sir, is rebate available? No. Is surcharge applicable? If yes, add it. If not, then always health and education cess will be. Health and education cess is common. Wherever I am liable to pay tax, I am supposed to pay 4% cess. Next, applicability of rebate for resident individual whose total income is up to 5 lakh or 7 lakh. Under default regime, even if it is marginally more than 7 lakh, you are still eligible. I somewhere feel that part is very important for upcoming exam. Yes. Next, I have also solved the question and I told you how to do it. Please take care of, because guys, amendments for June exam is very, very crucial. Because you guys know lot of repeaters would be there. Would have written in December or previously. Due to some reasons, they would have not cleared. Now, what many of the people do is they study same thing what they have studied before and they will go to the exam, believing that this time I have covered everything I have covered. Last time 3 chapters I had left, this time I have covered. But many a times what they have covered is outdated already. Clear? So that should not happen. Especially in a paper like taxation, that should not happen. So that is why I always focus on amendments. So please take care of them. Important, especially for June exams. Yeah. Applicability of surcharge, that is if total income exceeds the threshold limits like 50 lakh, 1 crore, 2 crore, 5 crore, 10 crore for companies and all. Then relief if total income is marginally more than the respective limit for surcharge. Guys. These are the few things which you have to take care. Sir, every question will have this or definitely not. But in your question, any of this might come. So when you read the question, things has to strike to your mind. Oh, this is what I am supposed to do for this. Yes, this is the total income and tax liability, guys. Next, assessment procedure, that is who is supposed to file returns, within what time they are supposed to file the returns. Assessor is required to file a return of income compulsorily as per section 139 subsection 1. Very important. Both who should file also is given. Then within what time they have to file also is given. Let us see both. First, guys, here 1, 2, 3, 4, 5 is given. If a person is already covered in 1, 2, you need not check next cases and all. Sir, for example, when will I check 5 is, if I am not covered in 1, 2, 3, 4, only then I will check 5. Sir, I have already covered in 2, sir. No need to check the further. Okay. Companies and partnership firms should file their income tax return every year, whether they have income or loss, doesn't matter. Then, person other than company and firm, if total income is more than basic exemption limit, whatever is the basic exemption limit applicable for them, if it is more than that, they have to file the returns. Okay. Next, that is what I told you. I hope I mentioned it. Guys, many people believe that, sir, if I am not liable to pay tax, means I need not file returns. May not be always correct. I might be eligible for rebate, but still I am supposed to file returns. That is, my income is assumed 6 lakh or 6 lakh 50. I am following default regime. Is it more than basic exemption limit? Yes. But am I supposed to pay tax? No. Should I file returns? Yes, I have to file. Ordinary resident, if such person at any time during the previous year hold any as the beneficial owner or otherwise any asset including financial interest located outside India, or as any signing authority in any account located outside India, or is a beneficiary of any asset including any financial interest located outside India. Guys, if I am a beneficial owner or any beneficiary of any asset for any time, sir, for few days I purchased the shares of foreign company. By 31st March I have sold it, sir, it doesn't matter. At any time if you are holding it, you are considered, you are covered here. You are supposed to file the returns only for ordinary resident. Next, fourth one. Every person being an individual HUF or AOP or body of individual or artificial juridical person, AJP, whose total income or total income of any other person in respect of which is assessable under this act without giving effect to. Without giving effect to means you add back these items. Provisions of chapter 6A or section 54, 54B, ECF exemptions for capital gains for reinvestment exceeds the basic exemption limit. Simple, guys. Total income you already calculated. Assume total income is only 1 lakh. Should you file the returns? No. As per the previous points, you will not. Then you have claimed chapter 6A deduction. Assume 3 lakh under any section. So what they are telling is you add back now. You pay tax only on 3 lakhs. So nil. But still you add back. How much is this? 4 lakh. Assume I am following optional scheme. It is more than basic exemption limit. Yes, sir. Should I file returns? Yes. And this addition is only for checking should I file returns. They are not asking me to pay tax on 4 lakh. Please be careful. Next, same way if I have claimed exemption in capital gains chapter under the respective section, I have to add back and see is it more than basic exemption limit. Okay. Next, fifth point. Any person other than the company or a firm is required to file the return if during the previous year if such person has deposited an amount of more than 1 crore in one or more current accounts maintained with banking company or a cooperative bank. More than 1 crore in current accounts. Sir, what if I have multiple current accounts all put together more than 1 crore? Next, has incurred a foreign travel expenditure, foreign tour of rupees more than 2 lakh for himself or any other person, or has incurred electricity expenditure of more than 1 lakh. In any of this case, if you are covered, filing returns is mandatory, guys. So these 5 points were there, but now they are made more. As per rule 12AB, the following people, if you are covered here, you should also file the income tax returns mandatorily. So who are those? A person who is, see, these people again not covered above. If you are already covered in any of these 5 points, you will already file returns. No need to check the rule. Okay, who are those, sir? A person carrying on the business, if his sales or turnover or gross receipts from business, if is more sales, not income, they are not supposed to pay tax on sales, but what limit they are checking here is sales. If it is more than 60 lakh during the relevant previous year, which is our relevant previous year, 23-24. Now, if he is carrying on the profession, his total receipts from a profession, if it is more than 10 lakh during the previous year, then a resident individual aged 60 or more, that is senior, at any time during the previous year, the aggregate of TDS and TCS under all the section, whatever is deducted or collected on his amount is 50,000 or more, he should mandatorily file the returns. Sir, what if it is any other person? I am not resident or I am not senior citizen. In that case, the amount is half of it. If TDS plus TCS deducted or collected is more than or equal to 25,000 in a year under all the sections put together, then you should file the returns mandatorily. Then a person having a savings bank account, the deposit in one or more savings bank account of a person in aggregate is more than or equal to 50 lakh savings account. Sir, I have 3 savings account. I have deposited 20. Should I file my returns mandatorily? Yes, aggregate is more than 50. 60 lakh. Next. Sir, okay. Here we learned who should file the returns. Now, when should they file the return? Mandatory, guys. Whoever is covered here, it is mandatory for them. Clear? Sir, I am not covered here. Can I still file it? Yes, you can file it. Voluntarily. Now, when, sir? When should they file it? Very, very important, guys. Because this has an impact even on PGBP chapter and other provisions. What is the due date for filing the income tax returns? If I am engaged in international transaction, I am supposed to furnish transfer pricing report as per section 92E, which is not a part of your syllabus. So for the assessee who is engaged in international transaction, they are supposed to furnish transfer pricing report. And when are they supposed to file their income tax return is 30th November of the assessment year, deadline, due date. For the assessee who is a company or for the assessee for whose books of accounts is subject to tax audit as per section 44AB, should always file the returns on or before 31st October of the assessment year. Whereas for any other assessee, it is 31st July. 31st July, guys. Yes. Next. Due dates very important, remember. Next, sir, I have income, I will file returns. Sir, I have a loss, can I file the returns? Yes. If you want to carry forward the loss, you have to file the returns. Except house property loss and unobserved depreciation. 139 subsection 3. An assessee can carry forward or set off of losses provided loss return has been filed under section 139 subsection 3 within the due date specified under section 139 subsection 1. Sir, what is the due date to file? Loss return, sir. Same due dates. There is no different rates. Whether it is income returns or loss returns, due date is same. Exceptions for the above is loss from house property and unobserved depreciation, which you can carry forward even if you have not filed the return within the due date. Belated return, 139 subsection 4. Belated wishes you guys will do. Sometimes if you have missed your friend's birthday or any event, yes sir. So in that case, sir, I can file my returns after the due date, but along with late fee. Along with late fee. A return which has not been furnished within the time allowed under section 139 subsection 1 may be furnished at any time before 3 months prior to the end of relevant assessment year. So, for previous year 23-24, what is the end of assessment year? 31st March 25. 3 months before that means 31st December 24. 31st December of assessment year. Or date of completion of assessment means when did I actually calculate my income and tax liability, whichever is earlier. Guys, if question is silent about this, always take 31st December of assessment year. Then there is also called revised return. I will just cover that first. Revised returns means, sir, I already filed my returns. I want to rectify some mistake was there, some error was there, or some omission was there. Can I rectify it, sir? Yes, revised return option is there. Any person having furnished a return under section 139 subsection 1 or a belated return under section 139 subsection 4 discovers any omission or any wrong statement therein may furnish a revised return at any time, same dates, on or before 31st December of assessment year or date of completion of assessment, whichever is earlier. Guys, please be careful. Revised return is available only under income tax law, whereas under GST there is no concept of revised. You can rectify your errors. You can maximum rectify your errors. That's all in GST returns. Then returns for some special people. These people are eligible to claim exemptions, which we already saw. Yes, sir. Now, guys, for these people, whoever is eligible to claim exemptions, what they are telling in returns chapter is, before you claim your exemption, if your income is more than basic essential limit, return filing is mandatory. Return filing is mandatory. We give exemption for you, but before claiming exemption, add back exemption whatever you have claimed. Check, is it more than basic essential limit? If yes, file the returns and claim the exemption. Okay. Let us see. Section 139, subsection 4A, returns of charitable trust and institution. Charitable trust or institution may furnish a return of income if total income computed before allowing any exemption under section 11 and 12, that is what is available, which we already covered, exceeds basic exemption limit. Okay. Sir, what if they are registered as company and all? Then what is the basic exemption limit for company? 0. So should they file the returns always? Yes. Clear? Please be careful. Basic exemption limit means if slab rate is applicable, you have basic exemption limit like 2 lakh 50 or 3 lakh. Sir, what if flat rate is applicable? Then for you basic exemption limit is 0. Return of political parties, 139(4)(b). A political party is required to file return of income if its total income before claiming exemption under section 13A exceeds the basic exemption limit. Grant of exemption under section 13A is subject to condition of political party filing the return. If they don't file the returns, no exemption under 13A. Then, return by scientific research association, news agency, trade unions, etc. 139(4)(c). It is mandatory for research association, news agency or trade union or mutual fund or trade union or venture capital company, venture capital fund to file a return of income if its total income before giving effect to exemption under section 10 exceeds the basic exemption limit. Dialogue is same, guys, what I already told. For all these three special people, before claiming their exemption, if the income is more than basic exemption limit, they have to file the returns. Then updated return was a new concept. 139(8)(a). What is it, sir? Updated return. Sir, original return was there, which we will file within due date. If I don't file it within due date, then belated return is there. Sir, I have filed original return or belated return, but mistake was there. I can correct it in revised return. Now, I have done any of this, or I have not at all done anything. Can I still file my return? Yes, that is called updated return. Actually, updated means you have done something, now you are updating it. But what they have told here is, even if you have not filed any return, still you can file updated return. But updated return option will open only when the revised return option is closed. Because if you are eligible for revised, first you will do revised. If that is closed, only then you will file updated returns. Because when you are filing updated return, they would be charging penalty and all. Okay. Any person may furnish an updated return of his income or the income of any other person in respect of which he is assessable for the previous year at any time within 24 months from the end of relevant assessment year. Within 24 months from the end of assessment year. Whether or not he has furnished a return, whether you have furnished the return or not, doesn't matter. Okay. Or you have filed belated return or revised return. Sir, can I update all of this? Yes. Whatever you have done. Sir, I have not at all filed returns. You can file updated. Sir, I have filed but original return within due date. I can update it. Sir, I have filed but belated return. Can I update it? Yes. Sir, I had filed original return. Later there was a mistake. I revised it. Can I update it again? Yes, you can do it. And revised returns can be done any number of time. Revision. Clear? Yes. Now updated return. Like what is the time limits? Guys, what is the previous year for us? 23, 24. Okay. Now what is the due date to file return? Let me take one date. Or it's okay. Let me mention everything. 31st July 24 or 31st October 24, or if it is a transfer pricing 30th now. Any of this. Not all three. Any of this. Okay. Under section 139 subsection 1. Okay, sir. Due date. Now, if I don't do it within this time, I can do belated return. Belated return, what is the time, sir? Belated return, what is the time? 31st December of assessment year. For belated return. Yes, sir? Yes. This is for belated return. This we call it as original return. Next, no, sir, I couldn't do it at this time also. Now, what is my assessment year? 24, 25. When will it end? 31st March 25. Agree na? Within 24 months from here. within 24 months from here, that is 31st March 27. I can file my updated return, guys. I can file my updated return. Now you can ask me, sir, can I go and file year only updated return? No. When revised returns, or sorry, belated return option is still there for you, you file that. Clear? Or if you have an opportunity to revise, do revision. Don't do updation. Updation is only when revision and belated is closed. Here, yes. So this will give you complete details. So for previous year 23-24, due date to file original return is 31st July or 31st October or 30th November. Then belated return or revised return. Okay, let me mention that also. Revised return 31st December of assessment year. Then what is the due date for updated return, sir? 24 months from end of assessment year. When will assessment year end? 31st March 25. 24 months from there. Within this period. Within this period. Okay. Yes. Next, guys, updated return is not allowed if it is causing loss of revenue to the government. Sir, I have already paid tax by filing original return. Now, by filing updated return, I am reducing my tax liability. No, they will not allow you. If updated return will reduce the tax collection for the government, they are telling no, you cannot. Or if your updated return is a loss return, they are not allowing it. Or else, sorry, I have already filed my return where I have claimed a refund of 2 lakh. Now I want to claim 3 lakh. Again, loss of revenue to the government. They will not allow it. Clear? So, simple. Keep it simple. If your updated returns bring more money, they allow you. If the updated return brings less money or it is reducing the money which is already paid, then they will not allow you to file updated return. You cannot even file it. Okay. Then updated return cannot be filed when, sir, I have already filed updated return for that year. Can I file one more? No. Revised return you can file any number of times, but updated return only for 1 year, one time. That's all. Next, sir, some proceedings are going on against me like assessment, reassessment or recomputation or revision. Can I go and file updated return? No. Still this is completed, you cannot file updated return. Okay. Next, defective return. Section 139 subsection 9. If assessing officer considers that the return of income furnished by the assessee is defective, he may intimate the defect to the assessee and give him an opportunity to rectify the defect within 15 days from the date of such intimation or within such period which he may extend it. So whenever, sir, if I have whatever return I have filed full defects, sir, in that case the assessing officer will inform me telling whatever return you have filed is not correct, please again rectify it or revise it. Within 15 days I have to do it. If I fail to do, it is as if I have not at all filed my returns. The consequences will be as if I have not at all filed my returns, guys. If the assessee fails to rectify the defect within the aforesaid period, the return shall be deemed to be invalid, and further it shall be deemed that the assessee had not filed the returns, or he has not at all filed the returns, guys. Very simple. Sir, he has filed, sir. Yes, but if you fail to rectify your defect within 15 days, they are telling as if you have not filed it. Next, interest for default in furnishing the return 234A. Guys, 234B and C talks about interest for non-payment or short payment of advance tax. 234A is for delay in filing the returns. Why I have mentioned here is all three are talking about interest only. Okay. 234B is for total short payment. When will it start? From 1st April of assessment year, 1% per month or part of the month. Then 234C installment, 1% per month. For first 3 installment, 3 months. Last installment, 1 month. Good. And for assessee who has opted for 44 AD or ADA, 1 month only. Okay. Next, when this interest would be levied under section 234A, failure to file return of income before the due date or does not furnish the return of income. How much, sir? Simple interest at 1% per month or part of the month. Period. From when to when? Return of income furnished after the due date. I have furnished but after the due dates. Belated. In that case, due date to date of filing. Due date means, assume due date is 31st July. Leave that. From next day you count. Clear. Till the date you file the returns. Okay. Sir, I have not at all furnished my returns. In that case, due date to date of completion of assessment. But here who will do the assessment? The department. Till they do assessment, till that day interest will continue. Interest is on what? Whatever I am yet to pay. Whatever I am yet to pay. Interest has to be calculated on amount of tax on total income as reduced by an amount of advance tax if any paid, any TDS, TCS, any relief under section 90 or 98, double taxation relief we call it as. That is for foreign income if I already paid tax. Now if I am an ordinary resident, it is taxable in India also now, but I can claim a relief. which is covered under section 90 and 90A. But it is not a part of your syllabus. You need not worry. Relief under section 89 or any other tax credits, guys. Simple. Assume, sir, my final tax liability is coming to 10 lakh. But already I have paid advance tax 6 lakh. Sir, TDS, TDCS deducted or collected on my amount is already 3 lakh. So how much I should pay to the government now? 1 lakh. So if I have not filed the returns within due date, interest would be calculated on how much? 1 lakh. Clear? Yes. Next, fee for late payment. Sorry, fee for delay in filing the returns. F for fee, late fee. A fee of 5,000 shall be levied if return of income is not filed within the time allowed under section 139 subsection 1. In cases where the total income does not exceed 5 lakh, means up to 5 lakh, the fee amount shall not exceed 1,000 rupees. So if your total income, whether you are opting for default regime or optional regime, doesn't matter. If it is up to 5 lakh, 1,000. If it is more than 5 lakh and if you have not filed your returns, then it is 5,000. Sir, I filed, sir, but belated. Still you have to pay late fee. Still you have to pay late fee, guys. Yeah. Now chapter 14, which talks about alternate minimum tax. It is a special provisions, guys, which is applicable along with normal provisions. Till now, whatever we have covered, I call it as normal provision, and whatever we cover now, that is AMT, I will name it as special provision. So if AMT is applicable, both the things we have to do. That is calculation as per normal provision as well as calculation as per AMT. When is it applicable? So is it applicable always? No. The provisions of AMT shall apply to all person other than company. Because for company, there is something called as MAT, who has claimed deduction under any of these three. Not all three, any of these three. Okay. Under section 80, IA, IB, IAB, IC, ID, IE, JJA, JJAA, LA, M, QQB and RRB, which you call it as income based deduction under part C of chapter 6A, except ATP. Even ATP will come under part C only. But if you have claimed, which is available for cooperative society, if you have claimed deduction under section ATP, then for you AMT is not applicable. But if you have claimed deduction under any of these sections, then it is applicable, guys. Or section 35AD, that is capital expenditure of specified business, or under section 10AA deduction, that is export profit of SEZ unit for 15 years. Yes. So if you have claimed a deduction under any of this, then AMT provisions would be applicable along with normal provision. Therefore, for every assessment year, 2 parallel computations are required to be made. That is when AMT is applicable. For those whoever AMT is applicable, 2 calculations. The first being computation of total income as per normal provision. That is whatever we already learned till now. And the other being computation of adjusted total income as per section 115 JC. So what is this AMT? How do we do the calculation? Guys, even when AMT is applicable, they may not mention in the question always. But you should understand. If the assessee has claimed any of this deduction, then you have to calculate AMT also. Okay. Compute the total income as per the normal provisions of the act, which you already learned. Yes, so then compute the tax at the rate applicable to the assessee, whatever rate is applicable to the assessee. If by chance, if total income includes special income tax, then special income at special rate, normal income at normal rate. Okay. Then depending upon the rates applicable to the assessee, yes, normal rates always. Surcharge, if total income has crossed the threshold limits, yes. Then health and education is always 4%. So tax as payable under normal provision. This is as it is, whatever we already learned. Whatever we have already learned, guys. Nothing special. Step 2 is special. Total income as per normal provision, take it as a base. Take it as a base. Okay, for that we need to make adjustments. Why AMT is applicable for you? Because you have claimed these deductions. Now, whatever deduction you have claimed, because of which AMT is applicable, add it back. Add it back. Okay, sir. Deduction under part C of chapter 6A, yes, except ATP. Then deductions under section 10AA, if at all if you have claimed, then deduction under section 35AD after reducing depreciation. For example, guys, assume total income is 30 lakh for you, and you have claimed 35AD deduction for your building 40 lakh. After that only you have got 30 lakh total income. Agree, na? Now you will take total income as a base. Yes, sir. Now for that you will add deduction. Yes, but not straight away 40 lakh. If 35AD deduction was not claimed, at least depreciation you would have claimed under section 32 on this building. Yes, how much? 10%. Reduce that 10%, which is 4 lakh. So remaining 36 lakh you will add. Remaining 36 lakh you will add. How much is the adjusted total income? 66 lakh. Clear? Huh? Yes. So please be careful. This reduction of depreciation is only for 3580 deduction because that is on capital expenditure. So what they are telling is if you had claimed depreciation, how much you would have claimed? Reduce that much. Actually, when you claim capital expenditure deduction under section 3580, for the same expenditure, depreciation is not allowed. But here, they are asking you to add back. That is why they are reducing the depreciation component. Okay. And rate of depreciation will be as applicable to that assessee. Normally, for specified business, the deduction they would have claimed for building guys, majorly. Clear? So 10% is the depreciation for office building, factory building and all. If it is used for residential purpose, then 5%. Then you derive adjusted total income. Yes. So once you get adjusted total income, then you go to step 3. So compute tax on adjusted total income at 18.5%. Always the rate is fixed, guys. Sir, special income, normal income, which scheme I have chosen doesn't matter. Always 18.5%. Okay. Then surcharge. If adjusted total income is more than the threshold limit, if this figure is more than 50 lakh, 1 crore, 2 crore, 5 crore, 10 crore, then only add surcharge. Sir, what rate, sir? Rate remains same. But here we should not check it for total income. Here we have to check it for which figure? Adjusted total income. Okay. Next. Once we do that, if surcharge is applicable, we will add it on which figure, guys? This figure. Whatever rate is there, on that rate we will apply it on the amount what we get here. Okay, sir. Next. Health and education is always 4% would be there. Then alternate minimum tax payable or AMT payable. We will keep a notation B for it. Now compare this two. Tax as per normal provision along with AMT payable. Whichever is higher, we have to pay it. Whichever is higher, we have to pay it, guys. Not both, any one. Now, if AMT is more than tax as per normal provision, the difference is allowed as AMT credit. Sir, what will I do with this credit? You can carry forward for next 15 years and you can adjust it whenever the tax as per normal provision is more than tax as per AMT, but only to the extent of difference. That is, after adjusting the credit, whatever tax you pay to the government can never be less than AMT, guys. Clear? So for example, if I have to give, I am just mentioning tax as per normal provision, then AMT. I am just giving the examples, quickly tell me. Yeah, tax as per normal provision is 10 lakh, AMT is 12 lakh. How much should I pay? 12 lakh. How much should I pay? 12 lakh. Sir, will I get any credit? Yes, AMT credit. 2 lakh. Next year again 15 lakh, 18 lakh. How much should I pay? 18 lakh. So how much credit I will get? 2 I already had plus 3, 5 lakh. 2 I already had plus 3, guys, 5 lakh. Next year, sir, tax as per normal provision 20 lakh. Tax as per AMT is 16 lakh. How much should I pay? 20. I will take 20. Okay, whichever is higher. But as I have credit, can I use it? Yes. How much credit I have? 5 lakh. But how much? My maximum I can use 4 lakh. That is the difference between these two. Okay. So reduce 4 lakh, pay only 16 lakh. Remaining 1 lakh you carry forward. Next year, sir, tax as per normal provision is 25 lakh. And AMT is 20 lakh. Whichever is higher, 25 lakh. How much I have to pay? 25. But I am having credit. Tax as per normal provision is more. How much credit I have? 1 lakh. What is the difference between these two? 5. How much I can use? Whichever is lower. So 1 lakh. So how much I will pay? 24 lakh. 0 credit. Okay, nothing to carry forward. Hope you are understanding. So in simple, how much credit you will adjust is the credit what you have or the difference between the tax as per normal provision or AMT, whichever is lower. Whichever is lower, guys. And carry forward. Sir, how long can I carry forward this? For next 15 years. And after 15 years, still, sir, AMT only is more, sir. Thank you for credit. You cannot carry forward. It will lapse. Next, some notes. Every person to which this section applies shall obtain a report, tax audit report we call it as, before the specified date referred in section 44 AB from an accountant, that is chartered accountant, certifying that the adjusted total income and alternate minimum tax have been computed in accordance with the provisions of this chapter and furnish such report by that date. Now, even the department, the other people and all will not understand all these calculations. So, if at all, if AMT is applicable for you, appoint a chartered accountant and get a certification that whatever calculation you have done is proper. Okay, means obviously chartered accountant will do it on behalf of you, but get a report from it. and that report has to be submitted 1 month prior to the due date of filing the income tax returns. Now when tax audit is applicable, what is the due date for you? 31st October of assessment year. 1 month prior to that you have to give the report, which is 30th September, on or before 30th September. And due dates is always like a deadline. Any day before that also you can do it, guys. Then AMT limit for a cooperative society is not 18.5%, it is 15%. Next, AMT is levied at 9% in case of a unit located in IFSC, that is International Financial Service Center, that is what Gift City we call in Gujarat, and deriving its income solely in convertible foreign exchange, 9%, guys. Only in these two cases it is different. In all other cases, irrespective of who is the assessee, it's always 18.5%. Next, whenever I am liable to pay AMT, sir, if I don't pay it, am I liable for interest under section 234 ABC and all? Yes, I am liable. Should I pay advance tax? Yes, if your tax is 10,000 or more, tax liability. Then, sir, if I am choosing the alternate scheme, if I am a cooperative society, if I am following BAD or BAA, or if I am individual HUF, AOP, BOI or artificial juridical person, if I am following 115 BAC, should I follow AMT? No, you cannot. You don't. Sir, I had a AMT credit in the past. Can I carry forward that once I come under default regime? No, you cannot. Simple logic, guys. Because under default regime, these two are blocked. These two are blocked. You cannot claim. Plus, Chapter 6A deductions, everything is blocked except JJAA. Except ADJJAA. All other things are blocked. Whatever is given here, I am talking about. Clear? Now, sir, if assessee has claimed ADJJAA deduction, and if he is following default regime, is AMT is applicable? No. AMT is not applicable. Rest all is anyway blocked. So obviously when it is blocked, you would have not claimed it. If you have not claimed it, AMT is not applicable. Clear? Yes. Sir, in the past I was following AMT. I had some AMT credit pending, sir. Can I carry forward that and adjust if I come to default scheme? No. If you are coming under default regime, for you AMT is not applicable. So if you have anything related to AMT, please leave it and come. Please leave it and come, guys. Yes, one last chapter, guys. Taxation of companies. Classification and tax incidence of companies. Few things are repeated here, whatever I have already covered in tax rate chapter. Quickly we will go through. Now, domestic company has some options. Optional regime. Here there is nothing called default, guys. For them it is either optional or regular provision. Optional under section 115 BA, BAA or BAB. BA 25% is the tax rate. BAA 22% is the tax rate, BAB 15% is the tax rate. 15% is the tax rate. But under all this, they have to forego certain exemptions and deductions, which are almost same like BAC, whatever we have seen. For individual HUF and all, whatever they have to forego, almost same list, guys. Clear? Means exactly not same. I am telling you almost same, not copy paste. Because, sir, HRA and all, can company claim? No. 1013A and all, can company claim? No. So, for them, when they are not at all eligible, why will they go and block it? Clear? So, what they have blocked is, for BAC, whatever is blocked, which are eligible for company, they have blocked here. Hope you got it. Clear? Yes. Next, no sir, domestic company doesn't want to follow optional scheme because they want to claim deduction or exemption, whatever they are eligible for. So, in that case, check their turnover in the year 21-22. 21-22. By mistake, I have not given here. That is how it is there. Okay, sir. So in 21-22, if it is turnover is up to 400 crore, for income tax purpose, we are considering you a small company, pay tax at 25%. If it is more than 400 crore, then 30%. Sir, in the question, nothing they have given, sir. Only they have asked us to calculate tax on domestic company. Always take 30%. Always take 30%. Then all foreign company, 40%. No if, no but. Then surcharge. Only if the total income is more than 1 crore, surcharge is applicable for companies. If total income is up to 1 crore, no surcharge. For foreign company, total income more than 1 crore but up to 10 crore, 2%. More than 10 crore, 5%. For domestic company, more than 1 crore but up to 10 crore, 7%. More than 10 crore, 12%. Easy to remember, guys. 2 plus 5, 7. 7 plus 5, 12. Clear? Yes. And you should also know the logic. Sir, why for domestic company so much, sir? You see the percentages here. The tax rates have been kept lower for them. So that is why surcharge rate is more. Whereas for foreign company, tax rate only every 40%. That is why surcharge is kept lower, guys. And if the company, domestic company is following optional regime under section BAA or BAB, then for them, irrespective of their income, it is always 10%. Sir, they have only 10,000, 10%. 1 lakh, 10 lakh, 10 crore, 20 crore, 30 crore, always 10%. Health and education cess will always be there at 4%. And one important thing, see, even if company is having special income, it is always taxable at special rate. Whether they are following optional scheme or regular scheme, it is always special income taxable at special rates. Carbon credit, section 115 BG. Sir, I had got carbon credit to emit the carbon emission, but I have not utilized it. Can I sell that credit, sir? Yes, you can sell it. When you sell, whatever income you earn, gross income is taxable at 10% plus surcharge plus health and education cess. Gross income, you cannot claim any expenditure. Okay, sir. Next, if there is any buyback of shares, how is it taxable? If there is a buyback of shares, that means company is taking back the shares and they are paying money to the shareholder guys. In that case, to protect the interest of the shareholder, they are telling company you try to pay tax. That is only for domestic company. Clear? Huh? So when is it? Sir, first of all, for whom it is income? Shareholder. Because he gave the share, it is like as if he sold it and he got back the money. So whatever buyback price the company is paying, it is considered as sale value for the shareholder. And whatever was his purchase price, that he will claim it as cost of acquisition. So we have to compute the capital gain as if it is the income of the shareholder. But who should pay tax depends. Whether shareholder or company now. So first we will see which shares is that. If the shares which are bought back is ESOP shares, that is the shares which were allotted by the company to employees. Guys, normally when companies are allotting shares to the employees, there will be some vesting condition telling if you satisfy so and so condition only, you will enjoy it. If not, we will take it back. Now, if the employee is leaving the company, then obviously there will be someone else who will be replacing you. So I have to give the shares for him. So when you are going, I will buy back that share and give it to the other person, whoever is coming to your position. Fair enough. So in that case, what they are telling is, shareholder, you pay the tax. You pay the tax. Company has all the right to buy back your share. So not taxable in the hands of company, it is taxable in the hands of shareholders as capital gains under section 46A. Computation and all is same, guys. Please be careful. Buyback price is a sale value. Whatever they are paid to purchase the share is a purchase price. But here for ESOP shares, what is the cost of acquisition? FMV on the date of exercising the option. For ESOP share, what is the cost of acquisition? FMV as on the date of FMV as on the date of exercising the option, guys. Because the difference between the FMV and the purchase price would have already been taxed as perquisite under the head salary. Next, any other share, not ESOP shares, sir, any other share. Check who has done the buyback. Domestic company na, other than domestic company na. If it is domestic company, they are asking company, you pay tax. Whose income is it? Shareholders' capital gains income. So a company should pay tax on their own income, whatever they are earning. Plus on shareholders' capital gains income on the shares which is bought back, company has to pay tax. At what rate, sir? 20 plus 12% surcharge plus 4% cess, which comes to 23.296. 23.296 effective rate. Who should pay tax on the capital gains income? Company. And the same is exempt in the hands of shareholder. And the same is exempt in the hands of shareholder, guys. Sir, what if the buyback? The same intention is simple, guys. Let shareholders sell it whenever they want. If company is buying back, we don't encourage that. If at all, if you do it, then you pay the tax. That is what they are asking for a domestic company. Then company other than a domestic company, not taxable in the hands of share company, it is taxable in the hands of shareholder. Same like ESOP shares. Same like ESOP shares. So what is capital gains here? Sale value, that is nothing but buyback price minus cost of acquisition. Clear? Sir, expenses on transfer and all we can reduce? Yes, that also you can reduce. Format remains same, guys. Short term or long term. Then MAT. For associate other than company, we had a special provision called AMT. Same way for company, we have MAT. And for company, it is always no if but no but. There it was like if you claim only any of these three deductions. But MAT is not like that. For every company, it is applicable. Okay. MAT provisions are applicable to every company, whether it is public company, private company, Indian company, foreign company, domestic company, it doesn't matter. Listed, unlisted, it doesn't matter. Sir, what is the format to calculate MAT? We will take net profit as per statement of profit and loss account. That is as per accounts before other comprehensive income. Okay, simple guys. As per schedule 3, they would have already maintained the accounts. Whatever is the profit derived there, take it. Whereas for banking company, insurance company and electricity company, they will not follow schedule 3. They will follow the format as given in the respective act. Whatever profit they have derived as per the format given in that respective act, take it. Okay. So for that, we have to do some add and less adjustment, which is not so important, is what I believe for your exams. Clear? What to add, what to deduct, just go through that list once. Not so important, because all those items are as per accounts, not as per tax. Okay. Okay. Next, once you do that add and less, you will get something called as book profit, not adjusted total income. Here we call it as book profit. Guys, 40B book profit is different. This is book profit is different. Please be careful. Don't get confused. Okay. So on this book profit, the tax on book profit is 15% always. Sir, special income or normal income, it doesn't matter. Always 15%. Okay. Next, surcharge as applicable. If the book profit is more than like 1 crore or more than 10 crore, then surcharge would be applicable. If not, no. Then health and education cess will always be there at 4%. Sorry. Tax liability as on book profits, that is nothing but MAT payable we will get, which we give a notation A or denote it by A. Next, compute the total income as per normal provision, which is like whatever we already discussed. Then compute the tax. This is as per income tax provision. Please be careful. This is not as per accounts. Then compute the tax at the rate applicable to the companies depending upon which option they are choosing or regular provisions and all. Your rate can vary. Okay. Whereas MAT rate will always be 15%. Next, surcharge as applicable. That is if total income is more than 1 crore or 10 crore. Then health and education says at 4%. Tax as per normal provision. We will denote it by P. Now compare this two. Whichever is higher they have to pay. Whichever is higher they have to pay. Guys, it is same like AMT, but here just steps are interchanged. Okay. So this was first step there and this was second step there. It is interchanged. Sir, can I do it like that only? Yes. You can take this only as first and this only as second. No problem. But final calculation should remain same. So higher of A or B, we have to pay it as per MAT provision. Now, whenever a MAT provision is more than tax as per normal provision, the difference is eligible as credit, MAT credit. And MAT credit, what will I do? Same like AMT credit. Whenever the tax as per normal provision is more than tax as per MAT, MAT credit can be used, and only to the extent of difference between MAT and tax as per normal provision. So how much credit you can utilize is the credit what you have or the difference between tax as per normal provision and MAT, whichever is lower. Whichever is lower. And it can be carried forward for next 15 years, guys. Next 15 years. And sir, will there be any interest for this MAT credit, AMT credit and all? No. Credit, interest and all will not be given. Now, sir, if there is any conversion of private company or unlisted public company into LLP, LLP is not a company. So can LLP take over the remaining MAT credit? No, guys. Because for them, MAT is not at all applicable. What will they do with MAT credit? Because for LLP, maximum what is applicable? AMT, not MAT. That too if they have claimed any of the 3 deductions. Okay. And sir, there are some exceptions also for MAT. Means for whom MAT is not applicable for few companies. Companies which is having income from life insurance business, or companies who are following optional regimes under section like BAA, BAB and all, or the companies which are following presumptive schemes. Presumptive schemes under PGBP we have seen. Yes, sir. Then also foreign company who is a resident of a country with which India has double taxation avoidance agreement. Even for those company it is not applicable. Then for a foreign company who is a resident of the country with whom the Indian government doesn't have double taxation avoidance agreement, but that foreign company is not required to obtain any registration in India. Even in that case it is not applicable. These are the exceptions for MAT. Means for this companies MAT is not applicable, guys. Okay. Then equalization levy, similar to TDS, not TDS, similar to TDS. Sir, when is this applicable? Guys, whenever, please pay attention for payer and payer, they are the important here. Who is the payer? Resident in India carrying on any business or profession, or a non-resident who has permanent establishment in India. Okay. Now, what he has done, he has taken some service, specified service. He has taken some specified service like digital or online advertising. From whom? Payee, who is a non-resident not having pay in India. So he is sitting somewhere outside India and making money from India through advertisement. Like example, I have given Google, Facebook and all. Okay. Or Meta. Now, for this service, the payer is paying more than 1 lakh. In that case, before you pay, deduct equalization levy at 6% on whatever amount you are paying. Clear? Please be careful what service is taking. Specified service. What is that specified service? Digital or online advertising or marketing. Okay. And the payment what is paying is more than 1 lakh. Sir, what if it is less than 1 lakh? No equalization levy. If it is more than 1 lakh, on the entire amount 6%. And once you deduct, he has to remit it to the government within 7th of next month. And also file a statement within 30th June of next year. Annual statement. Clear? This is the responsibility of payer. Sir, what if he doesn't do it? Then whatever expenses he is paying, he cannot claim it. As per section 40A 1B, 100% would be disallowed. If he don't deduct or deducted but not remitted to the government within the due date of filing the returns, not 7th, within the due date of filing the returns, guys. Okay, this is first part of equalization levy. This is first part of equalization levy. There is another part of equalization levy. As amended by Finance Act 2020, an equalization levy of 2%, not 6 now, 2, shall be charged on the consideration payable by an e-commerce operator who is a payer from e-commerce supply made or provided by it. These are the people who have purchased it, buyers, to a person resident in India or to a non-resident in specified circumstances or to a person who buys such goods or services or both using internet protocol address located in India, IP address we call it as. Yes. So if the following people are the buyers, whatever amount the e-commerce operator will collect and he will give it to whom? The e-commerce operator will collect and give it to e-commerce participant, actual seller. Before he give it, he has to deduct equalization levy at 2%. But here, as per part 2, this I will call it as part 2. Part 2 is not applicable when where the e-commerce operator has a permanent establishment in India, means they have office or branch in India, and such supply or services is effectively connected with such permanent establishment, or where equalization levy is leviable at 6%. Sir, it is already covered in part 1, sir. Again, will it be covered in part 2? No. Next, sales turnover or gross receipt of the e-commerce operator from e-commerce supply or services made is less than 2 crore. Only if it is more than or equal to 2 crore, they will collect. They will deduct equalization levy. Clear? And as per part 2, whenever they collect equalization levy, when should they remit it to the government? Quarterly, guys. For the first quarter, that is for the quarter ending 30th June, April, May, June, on or before 7th July. Next, for the second quarter, which is ending with 30th September, on or before 7th October. Third quarter, on or before 7th January. So for first 3 quarters, it is like this. Take always 7th of the month succeeding each quarter. 7th of the month succeeding each quarter. Whereas for last quarter, 31st March only. End of the quarter, 31st March only. So this is all about our marathon session. So guys, so the complete provisions, whatever we have done, I have tried to cover maximum with minimum time. So as you guys are aware, in regular class, actually we take more than 100 hours for direct tax, where we see everything in detail. So whatever I have covered there for more than 100 hours, I have tried to condense it and try to cover it minimum time. So hope it will be helpful for your preparation. So do watch. Hope by now you have already watched full video, and make sure that on the exam days also, to the extent possible, if possible, watch full video, or else whichever topics you need, mark it, keep it, and try to watch on the exam days as well. If you are writing only one module, at least 1 day gap will be there. So please make use of it, guys. Especially the day you finish the previous exam and come now, you might be tired. Try to make use of that time, because here when you are watching the video, you need not put so much of energy. Okay, and try to watch it on a big screen if possible, like laptop, TV, if you have the facility. If not, because mobile I don't suggest. What happens, there will be in between notification and all is coming, but if you have facility of watching in laptop or TV, try to do it. If not, mobile is the last option. So please make sure that you are covering each and everything. Don't try to filter out anything. Cover maximum, you will score maximum. Clear? So hope this was helpful for you. Please make sure that you guys will give your 100% and clear your exams, guys. Don't postpone it thinking that whether I have prepared it or not. Don't doubt yourself. Trust your preparation. You will do it. You will do it. If not, if you are not so confident still, whatever days are left for you from today, try to cover whatever is possible and give your best. Still miracles can happen. See, do what you can do. Let other things be in God's hands. Clear? So please focus. Don't give up at any moment, guys. Don't lose the hope. Everything will happen in your favor, provided you are strong, you are confident. All the very best. Do well. Take care.